Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj, and I'm very excited to meet you all in the CMA Intermediate Paper 8 Cost Accounting Marathon. Of course, this is just part 1 of the marathon because YouTube has this restriction that the maximum duration of a video can only be for 12 hours, right? Hence, we are splitting it into multiple parts, right? So, first, I will just give you guys an introduction. It's a must watch before you get started into this particular marathon. So, for those who do not know about me, so my name is CA Ganesh Bharadwaj. So, I am a faculty for two papers at the CMA intermediate level, paper 8 cost accounting and paper 12 management accounting. I'm also a faculty for two papers at the CA intermediate level, so paper 4 cost and management accounting and paper 6A financial management. It is for CA intermediate level, right? So that's a brief introduction about myself for those who do not know me, right? And guys, before we get started into this particular marathon, first I want to tell you guys a few things. We will set the ground rules so that you can properly and effectively make the maximum use of this marathon. This marathon is not just like a random going through of pages, absolutely not. This has concepts, plus I have also solved limited numerical problems. I've solved it, right? It is exhaustive coverage and it is a very good and an effective tool for you to revise, right, if you are approaching your exam. Now, I know many students will be having this doubt. Sir, is this marathon sufficient for me, sir? Can I use this as the base for preparation of my exam? Literally, this is a marathon, a revision lecture. So basically, the underlying assumption is that you have at least studied the subject once. So you cannot use this as a source of preparation as such, but some limited knowledge if you have, definitely this will be the best tool for you to revise maybe a month or even the day before your exam. This will be a very effective tool for you to revise. Clear with this, guys, right? And here I have literally covered concepts, and I've also covered some numerical problems wherever possible that actually represent a particular concept. So literally conceptual explanation plus numerical solving is also there, right? Now guys, I have actually created, or I have made, two books exclusively for your CMA intermediate students. For CA Inter, we have a separate book. For CMA intermediate, paper 8 cost accounting, we have two books. One is called the Concept Decoder. The other one is called the Solved Question Bank, right? Now, this Concept Decoder book, it has the list of all the concepts. It has all the concepts, right? Pertaining to your CMA intermediate paper 8 syllabus. Literally, guys, I have bifurcated this entire subject. This is your entire syllabus as per ICMA study material, right? They have divided into multiple modules and all that. So literally, I have made it into a total of 18 chapters here. So this is what I have made, and I have mapped every chapter with your CMA Institute study note. For example, overheads. In our book, it is chapter number 4. In your CMA Institute study material, it is module number 2.4. That way also the tracking has been done. And in just a span of roughly 230 pages, the entire study material has been covered here. Alright, so this is what we have done. For example, cost sheet, if you take, literally everything is in color format. So it is not some random coloring. There is a reasoning behind all these coloring as well. So we have literally condensed and presented it in a neat format, and that too, wherever possible, I have added something called as doubt busters. Meaning what? Basically, these are the places where you can generally make a mistake. So then and there, below this concept, I have created the doubt buster, right? And I have explained what it is. Now I've created the doubt and also clarified. So in our concept decoder, we have a list of all the concepts, and apart from that, we also have at the end of this chapter, first we have pure concepts, and then we have this pure theory discussion. So every chapter I have made it like this. For example, overheads, first we have all the conceptual explanation here, right? So whatever are required for problem solving, and then we have finally core theory topics. These are purely meant for theoretical purposes. This is how I have bifurcated in our concept decoder. With respect to our solved question bank, literally, guys, the solved question bank, it covers 100% of all the illustrations from your institute study material with solutions. And guys, on top of that, for example, let us take cost sheet. All the sums from institute study material are in this pink color background, right? These are available. And apart from that, look, even the past exam questions I have taken, right? Past exam questions, this will have a green color background, attempt number, everything is given with solution, right? So it is present with solution in this particular book. So this is what we have created chapter wise neatly, right guys? So this comes up to close to around 400 pages, just a question and answers with the entire institute study material and even the past exam questions. Clear with this, guys? So this is basically the book we use during our for our regular batches and our exam oriented batches, and even for this marathon I have used this book. And basically guys, to sum it up, in our paper 8 cost accounting overall, in this book it has 228 institute study material sums, 44 past exam questions, and even MCQs are also there, right? 181 MCQs are there in our book in paper 8 cost accounting. Similarly, in paper 12 management accounting, institute study material sums, separately we have another book, concept decoder and solved question bank for management accounting also. 215 sums from institute study material, and past exam questions 70 questions, and MCQs we have 287 MCQs, right? This is the overall coverage of the book which we are using. Of course, in this marathon it is a revision, right? So I will be revising the concepts, and wherever possible some limited numerical problems will also be solved. Clear with this, guys, right? And this concept decoder and the solved question bank, you can download it free of cost. The PDF copy can be downloaded free of cost, open PDF from our website, right? Under the free resources section, you can download the PDF. The link to our website is on the description. You can just download it, and you can happily use this for the purpose of this marathon as well as for your preparation. And of course guys, if you want to place a hard copy, or if you already have a hard copy, the hard copies can be placed once again on the book section of our website. You can just go and purchase it. Clear with this, guys? So this is an exclusive material for your CMA intermediate students, so there's no mix. And of course guys, even in our courses, be it regular or exam oriented courses, right, these recordings are done separately for CMA intermediate students. Not even a single minute of CA inter is there. For CA inter we have a separate recording, and CMA intermediate we have a separate recording. Why? In fact, paper 8 and paper 12, they have some common chapters. For example, marginal costing. Still, I would have recorded all these things separately, and in our regular batches, even the past exam questions, every single question we solve, MCQs, every single question we solve. Literally, it's a comprehensive coverage. Now, coming back to your question, sir, this marathon, is this sufficient for me, sir, as a preparation? Now, this is meant for a revision purpose. So the underlying assumption is that you should have already studied the subject once, so that this will be a useful tool for you to revise and recapitulate the entire subject. Because in our regular batches and all, each subject, paper 8, paper 12, each subject is for about 105 hours we take the lectures, right? Here in a marathon, it's close to about 20 hours. Around 20 hours, both, all the parts put together, it's about 20 hours roughly. So literally here we are condensing everything, and we are going to present it in such a way that it's useful for you to revise. Clear with this, guys? So the fundamental assumption here is that you should have definitely prepared the subject at least once. Clear with this, guys, right? Sir, I have not prepared, sir, and I am left with only 1 week from the exam. What can I do? In that case, still it is okay. If you watch this marathon, it will definitely give you some value addition for sure. Clear with this, guys? Now, on that note, in this first part of the marathon, some important chapters I am going to cover. What are they? Cost sheet, direct expense. Direct expense is a very small area, right? Overheads, a very important chapter. Marginal costing, another important chapter. Standard costing, another important chapters. These are the 6 chapters we are going to cover. Sir, 6 chapters, sir, in the single marathon? Yes, absolutely. The first part, marginal costing, guys, this itself, I have, it comes close to about 4.5 hours in this marathon. This marginal costing, it's a big chapter. We have covered 4.5 hours for this single chapter itself. And the standard costing comes close to about 2 hours. And overheads, actually, it comes close to about, one second, it comes close to about approximately around 4 hours. right? 3.5 to 4 hours, right? So that comprehensively, literally, we are going to see all these main chapters. Cost sheet is only for about 1 hour. Overall, it comes close to 12 hours, the first part. But trust me, guys, this marathon, the clarity that you're going to get is much better than maybe even some regular batches, even in some regular courses which you might have seen before, because literally all the concepts we are going to revisit, and of course certain numerical problems we will be doing limited coverage because this is a marathon. Clear with this, guys? So this is going to be the coverage in your first part of your marathon. In the upcoming second part, certain other chapters I will handpick from an examination, important examination perspective, and that also we will be solving. But predominantly these three are biggies, and this is the reason why these chapters I wanted to give it in the first part of the marathon. Clear with this, guys? Now before we start, there is one more thing I want you guys to prepare. Now I want you guys to prepare, please take a notebook, right, and have a pen, calculator, and also this concept decoder and the solved question bank with you when you are watching this marathon, right? Because this is very important for you, because only then it will give you a proper effective sense of watching this marathon. Now in your notebook, I want you guys to prepare something called as library of adjustment. Now what is this, sir? Certain limited sums in the class, in this marathon we will be covering. Of course, in all our paid courses, if you are already my student, so during the course of the lecture, I would have asked you to prepare that library of adjustment. You can follow this marathon along with the library of adjustment. For those who are maybe who have not watched my regular or exam oriented batches directly, if you're watching my marathon, then for those students, maybe you can now prepare this library of adjustment. Basically, what is this library of adjustment? Now every question that we will be doing here in this particular marathon, it will be having some adjustment or the other. That is what we are going to capture. Now there is a template for this. In this library of adjustment, you should note down the chapter name, right, then question number, then the page number from the solved question bank, and then you need to write down the adjustment and leave a bigger space for this adjustment. Why? Because this adjustment I will be dictating in the class. For example, let us say chapter name, we are doing one question from cost sheet. Let us say we are doing question number 1. Let us say it is appearing on page number 8 of our solved question bank. I want you guys to update all these things by yourself. This part, as and when we finish a question in the marathon itself, I will be dictating the library of adjustment. So I just don't want you guys to watch this like some web series. Properly make the best use of it, so that once you finish this, you would have effectively covered and revised the entire subject. This is the kind of coverage I want to give you all. And the first part of this marathon itself covers close to about 30 to 35% of your examination weightage. 30 to 40% we can say, but conservatively 30 to 35%, because we're doing some important chapters here. Clear with this, guys? Only direct expense is very small. The others are very big, and that too I'm not directly going to read and line by line. No, conceptually we are going to revise and explore and even do some numerical problems. Clear with this, guys? So that is going to be the coverage we are going to do in this particular marathon. And of course, guys, I want you all to prepare this library of adjustment. Clear with this, guys? So with this, let's get started with this marathon of your CMA Intermediate Paper 8 Cost Accounting. So let's get started. So now let's get started with the discussion of cost sheet chapter, right? So this is the first chapter of discussion in our marathon. So you can download this book, right? This color book, the entire PDF, you can download it. This is nothing but our concept decoder book, right? For CMA Intermediate Paper 8 Cost Accounting, right? So you please download this book. So this book is available under the free resources section of our website. The link to download our website is available on the description. You can download that. If you have a hard copy which you have purchased already, then very good. You can just keep the hard copy and follow this marathon. Now, guys, first, this chapter, cost sheet, right? This is one of the important chapters in your CMA Intermediate Paper 8 Cost Accounting. Now, let's revise this chapter comprehensively, right? Now, first, what is a cost sheet? A cost sheet is nothing but a statement of cost, right? And it shows various components of cost for a particular product, right? And to this cost, if you add your profit, you arrive at your selling price. Now guys, simple. Now the format of cost sheet, let us go and look at the format of cost sheet. What is the format of cost sheet? Opening stock of raw material plus purchases of raw material minus closing stock of raw material gives us something called as okay, and add all the direct charges related to raw material gives us something called as direct materials consumed. To this add your direct labor, add direct expenses, you get your prime cost. To this add your production overheads, you get your works cost, also known as factory cost, right? To this add opening WIP minus closing WIP, you get your adjusted works cost or adjusted factory cost. To this add your administration overheads, you get your cost of production. To this add your opening FG minus closing FG, you get your cost of goods sold. To this add your selling and distribution overheads, you get your cost of sales. To this add your profit, you get your sales. Now that's all, the chapter is over, right? So what the chapter is over. Now guys, this format of cost sheet is 100% logical. Now for some students, for some reason I've seen many CMA students generally resort to mugging up the format of cost sheet. Now I am literally going to decode this entire format of cost sheet, and in the next few minutes literally we will understand the reason why the format of cost sheet has been kept as follows. We will understand the logic behind it, and after you watch the next maybe about 20 minutes to half an hour, trust me, you yourself will be able to arrive at the format of cost sheet without mugging up, but purely logical. Clear with this, guys? So quickly, let's get started with the revision of this cost sheet format. Right, sir, all these line items, sir, some totally 22 line items are there, sir. How can we remember? Don't mug up. Conceptually, you learn, right? And with that, any kind of sum you will be able to handle. There is a beautiful saying of Abraham Lincoln: if you give me 6 hours to chop down a tree, I will spend the first 4 hours sharpening the axe. Which means you spend more time on learning the concept, automatically the execution will take only lesser span of time. 6 hours if you give to cut a tree, I will directly not go and cut it. First 4 hours I will sharpen the axe, right? A preparation will take more time. Once the axe is sharp, it can easily cut. The actual execution will take only 2 hours. It only takes lesser point of time. Clear with this, guys? This is a time tested logic. This is the approach which even we follow during our regular and exam oriented batches as well. Those who have seen, they know this, right? Where we do all the sums. But here in a revision, once again I'm going to do a conceptual revision with all the background, and we will also take up, right, a numerical problem, and we will cover this entire chapter as well. Right? Clear with this, guys? So let's get started. Now guys, in a company broadly there are 3 locations in a company. What are the 3 locations in a company? Your factory, then you have a corporate office, right? And you have a place called sales depot, right? Now what happens in a factory? The production activity happens in a factory, right? Raw material is purchased, it gets converted into a finished product. What happens in a corporate office? This is a place where the board of directors sit and they take all the main decisions for the company. Clear with this, guys? Or in other words, here is where your administration activity happens. Factory is where the production activity happens. Corporate office is where the administration activity happens, and your sales depot is the place where your sales activity happen. Right? Here only the sales activity happen, and from here only the products get dispatched to customer's location. So the distribution and other activity happens in the sales depot. So sales and distribution activity. Now, if you clearly bifurcate this chapter and conceptually learn it, automatically this cost sheet format, trust me, you will be able to derive it by yourself. That's about it. Now, further, guys, let's zoom into a factory. inside a factory, there are further 3 locations. I'm talking about inside a factory. Inside a factory, further, there are 3 locations. What are the locations? Now we have entered the factory. Inside the factory, once again, there are 3 locations. What are they? One is called as stores area. Then another place is called as factory shop. And there is another place called as warehouse. Sir, what is this, sir? Stores area is the place where raw material is getting stored. Factory shop is a place where machines are there. So from the stores, the raw material will be received and it gets converted into FG, or in other words, the WIP area is your factory shop. What do you mean by WIP? Work in progress. The production activity happens. This is the place where raw material gets converted into FG. And once they get converted into FG, they get stored in the warehouse. So literally, warehouse is the place where my FG, my finished goods, are getting stored. Clear with this, guys? These are the 3 locations inside a factory. Clear with this, guys? Yes. Now, literally, guys, what happens? We need to find, first of all, sir, for every unit produced, what is the cost? We need to find out. That is what literally this cost sheet tries to achieve. Overall, it tries to arrive at what? So the cost of goods sold, right? To this, you add something, arrive at cost of sales and all. So first you arrive at the total cost incurred, right? Now on this cost, if you add profit, you will arrive at the sales value. Clear with this, guys? So first, sir, how will I compute the cost? Simple. Now, guys, logically, we can think and we can arrive at this. Now, this is my stores area, right? Raw material area. Okay, fine. Now, what happens in my raw material area, right? At the beginning of the year, I will be having some opening stock of raw material, right? Yes. Then during the period, I would have purchased some raw material. Yes. Now literally the sum total of this is the total raw material available for consumption. Yes. Correct. Now out of this, I would have consumed some raw material. Consume means what? From the stores, I would have transferred it to my factory shop for the purpose of production. Right? So out of the total available raw material, one portion would have been consumed for my production, and maybe the balance will be left as unconsumed. So whatever stock is not consumed, I will call it as closing stock of raw material. Guys, clear with this? Or in other words, sir, in this period, sir, overall, what is the value of raw material consumed? Can I say it is nothing but opening stock of raw material plus purchases minus closing stock of raw material? The balance will be nothing but raw material consumed. Are you guys clear with this? So literally, this is the value of material that gets into my WIP area. Are you all able to understand this? Yes. So literally, this is the figure that enters into my factory shop. Clear with this, guys? So now what happens inside my factory shop? Look at this. So first, understand my direct material consumed is nothing but opening stock of raw material plus purchases minus closing stock of raw material. This is the first line item which they have given. Opening stock plus purchases minus closing stock of raw material. Here they have given direct charges related to raw material. Basically what they mean is all the costs incurred with respect to raw material should be added as a part of purchase. Literally, instead of giving it as a separate line item, they could have added it along with purchases. Literally, guys, there are only 3 line items here. Basically, along with the purchase cost, if you are also incurring some freight to bring your raw material to your stores area, that should also be added to the purchases. Clear with this, guys? Here they have mentioned it as a separate line item. If you want, you can add it along with purchases. Literally, the net of these 3 will give you the first line item, which is the direct material consumed or raw material consumed. Clear with this, guys? Now what happens? I enter into my WIP area and this direct material consumed is there. Guys, clear with this? Direct material consumed is there. Clear with this, guys? Now, this direct material will not get automatically converted into FG, right? On top of this direct material, I need to incur direct wages or direct labor. Clear with this, guys, right? Then I should also incur some direct expenses like royalty and other payments. Clear with this, guys? So for every unit produced, right, let us say I have to pay 5 rupees royalty. Clear with this, guys? Let us say I'm Reynolds, right? And Reynolds, or I'm Rorito, right? Rorito needs to pay Reynolds 5 rupees royalty for every unit manufactured, right? In that case, now this is also an expense that I incur here. Guys, clear with this? Are you all able to understand? Now, sum total of all the direct costs. What do you mean by direct cost? Direct cost are those costs which are readily available on a per unit level. Now, for every unit manufactured, I know that how much material is required. Let us say I need 2 kgs of raw material. Every kg required, right? Every kg cost me, let us say 1 rupee. So which means 2 into 1. So 2 rupees is the direct material cost per unit. On a per unit level, this figure is readily available. Let us say labor. Sir, I need to spend 4 hours of labor to manufacture 1 unit of pen. Every hour of labor, let us say, cost me 2 rupees. So 4 into 2, 8 rupees is going to be my labor cost, direct expense. Let us say I need to pay a royalty of 4 rupees for every pen manufactured. So 2 plus 8 plus 4, 14 rupees is the direct cost for producing every unit of a pen. So this all sum total of all the 3 direct costs is popularly called as prime cost. Look at this. Direct material consumed plus direct labor plus direct expenses is called as what? Prime cost. Prime cost refers to all the direct costs incurred inside the factory. Clear with this, guys? Now, on top of this, in my factory, I will also be incurring some indirect manufacturing cost. What do you mean by indirect manufacturing cost? Those costs which are not readily available on a per unit level, but still they are incurred in the factory. For example, your factory rent, right? Not available on a per unit level. It's a bulk figure, but it is incurred inside the factory only. Clear with this? Your supervision charges, right? Your depreciation on plant and machinery, your repairs and maintenance, these are bulk figures. Clear with this, guys, right? So now these are also required to be charged as a product. Why? Because they are incurred in the factory for the purpose of production only. Are you all clear with this? So all the indirect costs incurred inside the factory are called as production overheads. Clear with this, guy? Overheads means indirect costs. Production overheads means indirect costs incurred inside the factory. So I will add production overheads to this. Are you clear with this, guys? So literally, direct material plus direct labor plus direct expense put together is called as prime cost. Prime cost plus all the indirect manufacturing costs incurred inside the factory. This sum total is your full manufacturing cost incurred inside the factory. Clear with this, guys? Sorry. So we call this as works cost or factory cost. Works, factory, your manufacturing, these are all interchangeably usable terminology. Works cost or factory cost, or it is also known as your manufacturing cost, as the case may be. Clear with this, guys? Now, in your WAP area also, similar to raw material, you can be having opening stock and closing stock. Clear with this, guys? So here also I might be having opening stock of WAP and closing stock of WAP. Guys, clear with this? Now, literally, if you notice, this is the sum total of costs incurred in your factory shop WAP area. Clear with this, guys? Now, having incurred this cost, what would have happened? Maybe certain units you would have completed, the raw material production gets started, and you actually start converting into FG. Now, having incurred this cost, maybe some certain units would have been completed. From an RM, it gets fully converted into an FG, and certain units can be completed and transferred to your warehouse area. Well, certain units, sir, I would have started working on it, but before it gets converted into an FG, maybe this 31st of March would have happened. So those units on which I would have started the production, but it didn't get fully complete, I call it as closing WAP. Clear with this, guys? Or in other words, how will I arrive at the full cost of production with respect to units completed? I will say, so the sum total of all this cost, right, plus opening WAP minus closing WAP, I will automatically get this figure. Clear with this, guys? So literally till now what we got, prime cost plus production overheads is called as what? Works cost, or it is also known as what? Factory cost. We saw that. Guys, clear with this? So literally we have this. So we call this as what? Factory cost. Now to this factory cost, I add my opening WAP and subtract my closing WAP. If I do this adjustment, it is called as adjusted factory cost. Are you guys clear with this? So I call this as adjusted factory cost. Are you all clear with this? Are you all clear with this? Now what happens? This is nothing but cost incurred in respect of units completed. Now all these units will now be transferred to my FG area because these are completed units. Guys, clear with this? Now now what happens here? Now you look at this. So now here adjusted factory cost, this is nothing but the total cost of units completed and transferred. Guys, clear with this? This is nothing but the cost of units completed, right, or produced in this particular year. Now what happens? Once again in my FG area, I might be having opening stock of FG and I might be having closing stock of FG. Guys, clear with this? One second, I will just put this down here. Yes. So once again in my warehouse area, yes, once again in my warehouse area, look, this is the value of units produced in the current period. Now already I might also be having some opening stock of FG here. Guys, clear with this? So now the units completed in this year plus the value of opening FG is the total units available for sale. Guys, clear with this? Now out of these total units, maybe some units I might sell and some units I might not sell. Guys, clear with this? The cost incurred in respect of units sold is called as cost of goods sold, whereas the cost incurred in respect of units unsold is called as closing stock of FG. Are you guys clear with this? Or in other words, adjusted factory cost plus my opening FG minus my closing FG, if I do, I get my cost of goods sold. Are you clear with this, guys? Are you clear with this? Now my particular units move out of my factory. Guys, clear with this, guys? Now to this cost of goods sold, literally, guys, now my product moves out of the factory. Now once I move out of the factory, I can add the costs incurred outside the factory, namely the cost incurred in my corporate office and the cost incurred in my sales depot. So now the cost incurred in my corporate office is administration cost. So to this I can add administration overheads, right? And then I can also add my selling and distribution overheads, popularly referred to as SOH. Clear with this, guys? So if I add this to, I get something called as cost of sales. Clear with this, guys? Cost incurred in respect of units sold. To this, if I add my profit, I arrive at my sales. Are you guys clear with this? Are you guys clear with this? Yes. Now literally, guys, this whatever we learned here is called as flow of cost. If you know this flow of cost, the entire format of cost sheet you yourself can derive by yourself. As simple as that. Clear with this, guys? So now what we did here, literally the format of cost sheet, I will rewrite it here. Literally first opening stock of raw material plus purchases, right, minus closing stock of raw material. If you do, you will arrive at the value of what? Raw material consumed or direct material consumed. Clear with this, guys? Now this figure comes here. Now you enter into your factory shop. Now to this direct material consumed, what will you do? Add direct labor. Yes, add direct expense. Now wait, direct material plus direct labor plus direct expense is popularly called as prime cost. To this prime cost, you add production overheads. Now, production overheads is nothing but sum total of all the indirect cost incurred inside the factory. Now, this will be called as what? So, prime cost plus production overheads, you will arrive at what? Your factory cost or works cost. Clear with this, guys? Now once again to this, add your opening WAP minus your closing WAP. If you do this, it is called as adjusted factory cost. Add opening WAP minus closing WAP. It is called as what? Adjusted factory cost. Clear with this, guys? Right? Now what happens here? Adjusted factory cost. Now this this enters into your FG area. Now, in your FG area, add your opening stock of FG minus your closing stock of FG. Literally, now you get what? Cost of goods sold. Guys, clear with this? Add opening stock of FG minus closing stock of FG. You get your cost of goods sold. Now to this, add the two costs incurred outside the factory. Right? What are they? AOH and SOH. So to this, you can add your AOH and SOH, you will arrive at cost of sales. And to your cost of sales, if you add profit, you will arrive at your sales figure. Are you guys clear with this? Now, guys, literally speaking, by the way, now, those who actually know the format of cost sheet, now you guys might be having one doubt here or one issue here. Sir, administration overhead, sir, you missed it. No, I didn't miss it. Wait, I will tell you what has been done by CMA Institute. I will also show you the note given by our CMA Institute, but please wait. This is a perfect and a logical way to actually understand and remember the entire flow of cost and the format of cost sheet. Now, please remember, guys, this entire cost sheet is nothing but your trading and P&L account in an inverted format. Sir, what are you saying, sir? Now, trading account basically captures all the costs incurred inside the factory, correct? Right? Basically, you will be having what? Two opening stock, correct? Opening stock will have what? Multiple components. Stock is you have three components: raw material, WIP, FG. Guys, correct? Then what are the other costs you incurred in the factory, right? Then two purchases you have, right? In your factory you incur this. Then two wages you have in the factory only, it's incurred. Then two production overheads you have, this also incurred in the factory only. Then on the other side you have by sales you have, guys, correct? Then by closing stock you have, yes, under closing stock, once again, three components of stock: raw material, WIP, FG. These three are there. Guys, clear with this? So credit side, total sales plus all the closing stock minus all the debit side, literally now you get your gross profit, which is the balancing figure. Guys, clear? Now this balancing figure, what happens? You take it to your P&L account by gross profit. Now in your P&L account, you debit all the costs incurred outside the factory, which is nothing but 2 AOH and 2 SOH. Now you get your to net profit balancing figure, you get it. Guys, clear with this? Now literally, if you notice, this entire format of cost sheet is nothing but your trading and P&L account in an inverted format. I will prove this to you. Now line item wise, now what do we have as the first line item? Opening stock of raw material. Look at this, opening stock of raw material plus purchase. Look at this, plus purchase minus closing stock of raw material. Closing stock of raw material. Is there a? Yes. So gives you raw material consumed. Next, here add direct labor, direct wages, add direct expenses. Okay. So maybe direct expenses also is incurred in the factory only. So if you want, I will also add that direct expenses. If you want, I can also add that. So to direct expense, literally that is also incurred in the factory only. Yes. Then you get your prime cost. To this add your production overheads, get your factory cost, then add your opening WAP minus closing WAP, you get your adjusted factory cost. To this add your opening FG minus closing FG, literally you get cost of goods sold. Guys, clear with this? So literally you get your cost of goods sold. Sales minus cost of goods sold gives you gross profit ideally, and whatever cost you incurred outside the factory, right? Your AOH and SOH, AOH, SOH. Now literally you arrive at the total cost here, right? Now finally what you do is that sales minus cost of sales gives you profit, or in other words, cost of sales plus profit gives you sales figure. Clear with this, guys? Ideally, this is the format of cost sheet. Are you all clear with this? Literally, I've proved it to you. Your cost sheet is nothing but your trading and P&L account in an inverted or a statement format. Clear with this, guys? Now, let me tell you one very important thing which our CMA Institute has followed. This is with respect to your administration overheads. What has happened? Now, you guys tell me, where is administration overheads incurred? Sir, it is incurred in the corporate office, sir. Inside or outside the factory? Outside the factory. Guys, clear with this? Now, ideally speaking, administration overheads should never enter into your factory shop, or it would never enter into your factory area, guys, in these three locations. Correct? Right? So ideally, it is not a trading account item, it is a P&L account item. Clear with this, guys? Right? But however, our CMA Institute considers AOH as a trading account item. Why, sir? Don't know. Right? This is how CMA Institute has considered, and they want you to treat AOH as a trading account item, which means SOH is the only P&L account item here. Are you guys clear with this? So now, because of this, there is a slight change in the format. What happens now in your warehouse area? So this adjusted factory cost comes here, no? To this adjusted factory cost, they are adding AOH. Sir, why is AOH added in my factory area, that is warehouse, FG area? FG is in the factory, sir, but administration is incurred outside the factory only, no, sir. Why is it added? That's why this place alone, CMA Institute is following a method of considering administration overheads as a part of your production cost. And remember, if a particular cost comes in your trading account, it is considered for the purpose of stock valuation. Hence, we call it as a product cost. What do you mean by a product cost? Any cost considered for the purpose of stock valuation is called as product cost. So, CMA Institute considers AOH as a product cost, hence they want to consider it under the trading account item. Hence, accordingly, what happens? So, to this adjusted factory cost, they are adding this administration overheads. This sequence change alone, CMA Institute is doing. Are you guys clear with this? Suppose if you're also doing CA, then please understand the format of cost sheet is slightly different. It's slightly different. So separately, I'll be taking your CA for CA students separately. We'll be doing it. Don't worry about it. Right? First, for CMA inter students, CMA Institute considers administration overheads as a part of a cost incurred in the factory. Hence, what happens? There is a sequence change here. Sir, what is the sequence change here, sir? Now, what they are doing, one second, I will just take this, I will copy this and paste it down here. Right. So, okay. Now, what happens? Look at this. Our CMA Institute here alone, they are just making a sequence change. So what they are saying, everything else is same. Opening stock plus purchase minus closing stock gives you direct material consumed, add direct labor, direct expense gives you prime cost, add production overheads gives you factory cost, add opening WAP minus closing WAP gives you adjusted factory cost. Now adjusted factory cost enters where? Adjusted factory cost enters into your warehouse area. Now they are asking you to add this AOH here itself. So literally what our CMA Institute is asking us to do is that now this adjusted factory cost, add your administration overheads. Clear with this, guys? If you add your administration overheads, they call this as cost of production. What is this called as? Cost of production, which means what? This refers to the cost incurred in respect of every unit completely produced in this year, that is completed in this particular year. Clear with this, guys? Now this they are saying, this is the only change. So this refers to what? Adjusted factory cost plus administration overheads is called as cost of production. Then everything is same. To this cost of production, add your opening FG minus your closing FG, you get your cost of goods sold. Everything else is going to be the same here. Look at this. Here, now to this adjusted cost of production, so they are asking you to do what? Add opening FG minus closing FG, you get your cost of goods sold. Now the product moves out of the factory. Now don't once again add AOH. So adding of AOH doesn't arise here because AOH is already considered inside the factory. So now you just need to add one line item alone. And what is that line item? Selling overheads. That's all you need to add. So here just add your SOH. There is no change here. So this is called as cost of sales. Clear with this, guys? The total cost. To this, if you add your profit, you arrive at your sales figure. Are you all able to understand? That's about this particular area. Clear with this, guys? Now if you go and see, this is what they would have also mentioned. Opening stock of raw material plus purchase minus closing stock, right? Direct charges, I told you it should be combined here, right? So it gives you what? Direct material consumed, add direct labor, direct expense gives you prime cost, add production overheads gives you works cost. To this add opening WAP minus closing WAP gives you adjusted works cost. Now you get into your warehouse area, add AOH, call that as cost of production. Visualize. Now to this cost of production, adjust opening FG minus closing FG, you get COGS, cost of goods sold. Here you add only one line item, selling and distribution expense, you get your cost of sales. To this you add your profit, you arrive at a sales value. Once again, let me revise this. Now look at this. With the flow of cost, let me revise. Opening stock of raw material plus purchase minus closing stock gives you what? Raw material consumed. Now direct material consumed plus labor plus direct expense. Wait, give it a subtotal, a name. Sum total of all the direct costs are called as prime cost. To this you add your production overheads, we call it as works cost or factory cost. To this add your opening WAP, subtract your closing WAP, it is called as adjusted factory cost. Now you move out to your warehouse area, adjusted factory cost plus your administration overheads. Wait, give it a name called as cost of production. To this add your opening FG minus closing FG gives you cost of goods sold. So this is the cost of production in the current year, right? To this add opening FG, you will arrive at the total value of goods available for sale. Out of this I am remaining, out of this closing FG is the value of goods remaining unsold. The balancing figure is the cost incurred in respect of units sold. Now you move out of the factory. So now to this add your selling overheads. So you just need to add your selling overheads. You get your total cost called as cost of sales. To this you add your profit. You arrive at your sales. As simple as that, guys. Clear with this? Beyond this, nothing is required. This is fully logical. So we just spent about some 20 to 30 minutes, around half an hour we have spent here. And look at this. The entire chapter is literally over for you right now, provided you understand what are the three locations inside a company. Further, inside a factory, what are the three locations? And with the help of this, if you understand the flow of cost, the entire format of cost sheet is completely done for you. Once again, let's revise. Opening stock of raw material plus purchases minus closing stock of raw material gives us direct material consumed. To this, add your direct wages or direct labor, add direct expenses, gives you prime cost. To this add your production overheads, it is called as works cost or factory cost. To this do an adjustment, add opening WAP minus closing WAP, it's called as adjusted factory cost. Get into your warehouse area. To this adjusted factory cost, add your administration overheads, you arrive at what? Your cost of production. Right? To this add your opening FG minus closing FG, you get your cost of goods sold. Move outside the factory. Now admin is already considered, so add your selling overheads alone you need to add right now. So if you add your selling overheads, look at this, you arrive at what? Your cost of sales. To this add your profit, you arrive at your sales. This is exactly what I have mentioned here in this format of cost sheet. Clear with this, guys? Are you all able to understand? Now understand one more very important thing. In our entire subject of costing, we only consider the costs incurred in three locations. What are the three locations? Factory, corporate office, sales depot. Only the costs incurred in these three locations are considered in our subject itself. Entire costing subject itself, only the cost incurred in factory, corporate office and sales area are considered. In a factory, what are the costs incurred? Sir, direct costs are called as prime cost components, direct material, direct labor, direct expense. Right? And in the factory, if I incur some indirect cost, it is called as production overheads. Right? So in the factory, it could either be direct material, direct labor, direct wages or production overheads. These are 4 different types of costs that can be incurred inside a factory. In a corporate office, whatever cost I incur is called as administration overheads. In my sales depot, whatever cost I incur is called as selling overheads. What do you mean by administration overheads? Any cost incurred in my corporate office, that's all. Clear with this, guys? Sir, can you give an example? Very simple. Director's remuneration. Right? Then office staff salary. Clear with this, guys? Right? Printing and stationery incurred in the factory, corporate office. Right? Let us say board meeting expenses. whatever it is. Sales depot, sir, any cost incurred for the purpose of sales and distribution. For example, advertisement campaign, right? Distribution cost. For example, salaries to your delivery person, right? And delivery, courier charges, whatever it is, for the purpose of selling the product, whatever is the cost you incur comes under sales and distribution cost. Sir, in my factory, under direct material, what are all the costs incurred, sir? Any cost incurred to bring your raw material to the present condition should be present location to the stores. From the supplier location you bring it to the stores area, right? Whatever cost you incur should be considered as a part of raw material cost, direct material cost. Example, sir, I purchased goods for 100 rupees, sir, right? Plus 10 rupees I incurred for freight inwards, sir. Overall 110 rupees itself is considered as direct material cost. Why? Because the 10 rupees was incurred to bring your raw material to the current location, so it will be classified only under direct material cost. Clear with this, guys? Direct wages or direct labor, any cost that is directly, any labor cost which is traceable on a per unit level. For example, assembly line worker, sir, to produce every unit I need to spend 5 hours of labor of an assembly line worker. For every hour I will pay him, let us say 10 rupees. So to produce one unit I need 5 hours. For every hour I need to pay them 10 rupees. So 5 into 10, 50 rupees is the direct labor cost per unit. Clear with this, guys? If I'm able to trace the labor cost on a per unit level, I call it as a direct labor. Direct expenses, what are all the compositions of direct expense? We'll be seeing it separately. In fact, we have a separate chapter for direct expenses. What is it? We will be seeing. Or in other words, any cost which is directly traceable on a per unit level, but if it is not a direct material or a direct labor, we classify it under direct expense. Example, royalty. Sir, for every unit produced, Maruti should pay Suzuki Incorporation, let us say 50,000 rupees. So which means it is readily traceable on a per unit level, but I can't call it as a material or labor. Hence, I put it under direct expenses. Then production overheads, sir, any indirect costs incurred inside a factory. For example, factory rent. Is it traceable on a per unit level? Sir, if I produce one unit, I will incur rent of so much. I can't come up with a relationship. It's a cost you incur, 1 lakh per month, sir. Whether you produce 1 unit or 10,000 units, the cost remains to be the same. It is not directly traceable on a per unit level, but it is incurred inside the factory. So indirect cost incurred inside a factory will be called as production overheads. Example is your supervisor salary. The supervisor, who is this guy? He will just stand like this and supervise. Can I say, sir, to produce 1 unit, the supervisor need to stand like this? No, you can't come up with a relationship. This guy does not produce the product, right? Under him, there will be workers who work. Workers' wages will come under direct wages, readily traceable on a per unit level. Whereas a supervisor's salary is an indirect manufacturing cost, should be classified under production overheads, right? How to convert this into per unit? We will be seeing it in a separate chapter called as overheads. So we have a concept of absorption using which we actually convert this bulk figure into per unit figure. We'll be seeing it there. Clear with this, guys, right? Administration cost, I gave an example. Selling and distribution cost, I gave an example. This is all you need to understand. So basically, guys, in our subject, we only consider the costs incurred in these 3 locations. So sir, there are certain costs which are incurred outside of these 3 locations. Example, interest on funds borrowed. Now, where is it incurred? It's not incurred in factory. It's not incurred in corporate office. It's not incurred in sales depot also. Clear with this, guys? Now, this is not considered in our subject. Sir, which means you will ignore that? Yes. But then how will the profit match, sir? Wait, the profit we report in our subject costing is only an operating profit. It is not your net profit. Are you guys clear with this? Because we only consider the expenses that are incurred for the purpose of manufacturing and selling the product. That's about it. So the profit we report is only your operating profit, also called as EBIT. Clear with this, guys? From this earnings before interest and tax, if you subtract interest, you get EBT. If you subtract your tax, you get your EAT, right? And further your preference dividend and all that. Guys, clear with this? So our subject stops here at reporting EBIT. So from EBIT, below that, whatever is covered is a subject matter of discussion in your financial management. It is not a subject matter of discussion in our subject costing. Are you guys clear with this? Now, financial accounting also considers, right, your interest and other charges and all these things, right? But our subject will not consider all these things. That's why the profit we report is not the final net profit. It is only called as operating profit. Are you guys able to understand? Yes, clear with this, guys, right? So these are all the the nitty-gritties of this particular area or this particular subject, costing. Certain really very important useful hacks. These are the things which you need to understand as a base to get into this particular subject. Clear with this, guys, right? Now look at this. This is a note given in CMA Institute study material. It is imperative to note that the cost of goods sold is the cost assigned to the unit sold, whereas the cost of sales is the total of the production cost assigned to the unit sold plus selling and distribution expenses. Look at this. It is interesting to note that as per paragraph 13C of AS2, AS2 stands for accounting standard, not cost accounting standard. Accounting standard is prescribed by CA Institute. They are saying administrative cost does not form part of cost of production. Ideally, what they are saying, sir, as per accounting standard 2, your administration cost is ideally a P&L item. However, CMA Institute has considered that as a part of trading item, trading account. That is the reason why they are considering it inside the factory itself. This has been clearly mentioned in the CMA Institute study material. Clear with this, guys? Is it correct? In my opinion, no. Administration cost should only be treated as a P&L account item. However, our CMA Institute wants to consider it as a part of your trading account item. Hence, all the sums have been calculated keeping in mind that your administration overheads is only a trading account item. Are you all able to understand this? Yes. Now, there are a few things which I want to tell you. In exam, if they have given you prepare a cost sheet and write down the cost heads of a cost sheet. Cost heads is nothing but prime cost, cost of production, cost of goods sold, cost of sales. These four are called as your cost heads. Don't worry. Subtotals are called as cost heads. Prime cost is nothing but direct material plus direct wages plus direct expense. Cost of production, what is it? Adjusted factory cost plus AOH. We saw here, no? Sum total of this two is called as cost of production, right? Then cost of goods sold, cost of production plus opening FG minus closing FG is called as cost of goods sold. Cost of goods sold plus SOH is called as cost of sales. Suppose if they ask you for cost heads, you can just write down all these things. Are you guys clear with this? As simple as that. Next one. Now, every line item we have mentioned, we have already seen this. Direct material cost. What forms what of direct material cost? Simple. All the costs incurred to bring your direct material to the current location. Clear with this, guys? One very important thing. Suppose, let us say, I purchased a raw material for 100 rupees. Now, this guy has given me a trade discount of, let us say, 10 rupees. Now, what will I do? So, from 100, I will subtract 10 and I will say 90 rupees is only my direct material cost. Clear with this, guys? Suppose I purchased raw material for 100 rupees. This guy has given me a cash discount of, let us say, 5 rupees. He has given cash discount. Now, please remember, it's a very important thing. Cash discount should never be a part of our subject. Look at this. Cash discount is treated as a non-operating expense and hence should not be considered for calculations. Are you guys clear with this? Are you guys clear with this? So literally what they are saying, now there was a cash discount which, let us say, I gave to my customer. It is a cost for me. Yes. Now, let us say I am making sales worth 100 rupees, right? And I am giving my customers a cash discount. This cash discount should not be treated as a cost, right? For the purpose of costing. Why, sir? Understand one thing. Why do we give cash discount? Cash discount I give because, now, let us say I can give a credit period of 30 days. Clear with this, guys? I'm telling customers can pay me after 30 days. But suppose if you are paying me today itself, day 0, then you are eligible for a 5% discount. Literally, why do we give this cash discount? This cash discount is given for making an early payment. It is not related to business, but it is because of time value of money. If I get this money a little early, literally I can put it somewhere and earn some interest, right? So similarly, for that purpose, I am incentivizing you to pay the money early so that I can park it somewhere and generate money out of it. Clear with this, guys? Very strictly speaking, speaking, this is a finance cost, once again not considered in our subject. This is a very, very important thing that you need to have in your mind. That's why I've kept it as doubt buster. I've created this doubt buster and I've kept it here for a very, very simple reason. These are the areas I know where you will make a mistake. Clear with this, guys? Labor cost, direct labor cost, we know. Direct expenses. What are all the components of direct expenses? Cost of utilities such as power and fuel. For every unit produced, right, I can say, okay, 1 unit of power is consumed. 1 unit of power I need to pay to the electricity board 8 rupees, right? Royalty paid, I told you. Higher charges paid for hiring specific equipment for one project. For this project alone, exclusively if I hire an equipment, the higher charges on that I will actually be treating as at a direct expense. P for technical assistance, that will also be treated as a part of your direct expenses. For a specific contract or for a specific project, if I hire some technical person and I pay him some fees, that is also considered here. Amortized cost of molds, patterns and patents. What is this? For example, let us say during Vinayak Chaturthi, Ganesh Chaturthi, right? Now if you see in Ganesh Chaturthi, right, during that festival we have this idol of Lord Ganesha, right, that is made out of clay, no? So how do they make that? They put that clay on a mold, a plastic mold that actually looks like Lord Ganesha, no? They will put it first, and once they take it out, automatically this clay will take the shape of the idol. Mold is basically nothing but that plastic, no, which has the shape of this particular product, right? That is called as mold. So for a particular project, if I'm taking some mold patterns, etc., exclusively for a project, only then it will be treated as a direct cost, direct expenses. If it is general in nature, then it will not come under your direct expense. Anything which is indirect comes under production overheads. Clear with this, guys? Right? Another thing, cost of product or service specific design or drawing. Once again, it has to be specific for the project. Cost of product or service specific software. Once again, any software which I take exclusively for this project. Other expenses which are directly related to the production of goods or services. Any other thing which is directly traceable on a per unit level, or for a particular job or a contract I'm taking up a particular cost, then that is also considered as a part of what? Direct expenses. Are you guys clear with this? This is what is seen under direct expenses, right? Production overhead, simply any indirect cost incurred in the factory is called as production overheads. Administration cost, any cost incurred in the corporate office. All the explanation given, I've just put it here. Selling overheads, literally, guys, what we have, any cost which are incurred in your sales depot or for the purpose of distribution. That's about it, right? So now, treatment of certain items in your cost sheet. Look at this. Subsidy, grants, incentive. If you're receiving any subsidy from the government, simple. So if you're receiving something, reduce it from the cost. That's all, no? Because it is not a cost for me, right? Let us say I purchase raw material worth 100 and government is giving a subsidy of 20 rupees. Net of my cost is only 80. So take only 80 as the cost. For this, the subsidy should be reduced. Penalty, fines, damages. Now, this should not form part of cost in our subject. Why? These are non-operating in nature. In your financial accounting, you will consider to arrive at the net profit. We are only reporting operating profit in our subject. Hence, any non-operating related costs are not considered. Simple. Where are all these fines, penalty, where are they incurred? Simple. They are not incurred in the factory. They are not incurred in the corporate office. They are not incurred in the sales depot. Since they are not incurred in these three areas, I will not consider it. As simple as that. Interest and other finance cost, I told you, so they are actually not a part of our subject. And one more thing, guys, I want to tell you, in the question if they have given conversion cost, what do you mean by conversion cost? Conversion cost is nothing but direct labor plus direct expense plus POH. Sir, what are you saying, sir? Very simple, guys. In the factory, what are the costs I incur? Direct material, I incur direct labor, I incur direct expense. Sum total of these three is called as prime cost, we know. Plus I also incur sum total of all my indirect manufacturing costs called as production overheads. Now, conversion cost means the cost incurred to convert my raw material into FG. Clear with this, guys? Or in other words, what is the cost that I incur to convert my RM into FG inside my factory? These four costs, correct? Now, conversion cost means the cost incurred for converting my RM direct material into FG, or in other words, all the cost excluding my material cost. So because on the material I should incur labor, direct expense and production overheads. These three are the costs incurred to convert my raw material into FG. Clear with this, guys? So the costs incurred in the factory that are meant to convert my RM into FG is called as conversion cost. Literally, the sum total of these three costs is called as conversion cost. In the exam, this could be an MCQ. Clear with this, guys? Or in other words, all the costs incurred in the factory except material. Why is it except material? Because material is only going to get converted. So the cost I incur to convert the material into FG is called as conversion cost. Are you guys clear with this? As simple as that, guys. So it is nothing but sum total of these three: direct labor, direct expense, and production overhead. That's what I mentioned. Direct labor, direct expense, production overhead. Sum total is called as conversion cost. I've specifically mentioned this in the doubt busters segment. Clear with this, guys? Now with this, let's go and do one numerical problem about the format of cost sheet, and with that we have completed the revision of this particular chapter. Now let's go and do one numerical problem. Now please take your solved question bank, right? Please take your solved question bank. So this is your solved question bank, which once again you can download it from your you can once again download this solved question bank from your from the free resources of our website. So let me go to this solved question bank. So please take page number 6. Right, we will do the first sum in the cost sheet. Now look at this. M&Q LLP submits the following information on 31st of March 2022. Based on the given data, prepare a statement of cost. Now, what is the format of cost sheet? Once again, right? So, opening stock of raw material. Visualize that flow of cost. Don't mug it up. Opening cost of raw material plus purchases, including all the incidental expenses, right? Minus closing stock of raw material gives you what? It gives you your direct material consumed. To this add your direct wages plus direct expense gives you prime cost. To that add your production overheads gives you your factory cost or works cost. Add opening WAP minus closing WAP, adjusted factory cost. Now go to your warehouse area. Adjusted factory cost plus administration overheads gives you cost of production. To this add your opening FG minus closing FG. You arrive at your cost of goods sold. Move outside the factory. Now add only selling overheads. Why? Because overheads is already added. So add selling overheads, you arrive at your cost of sales. To this add your profit, you arrive at your sales. You just need to remember the format, right? The format of cost sheet, and wherever is the line item given, plug it in the right place. Now you will see it here. Sales for the year is given. Perfect. 2,75,000. Inventories at the beginning. Opening stock of FG is given. Opening stock of WAP is given. Respective line item. Purchases of material. This figure is also given. Next, material inventory, opening stock, closing stock. Opening and closing stock of raw material is also given. Direct labor is given. Factory overheads is 60% of direct labor cost. Direct labor is how much? 65,000. 65,000 into 0.6 gives you how much? 39,000 rupees. So 39,000 rupees is my cost of factory overheads or production overheads, right? Then inventories at the end of the year. Closing stock of FG, closing stock of WAP is there. Other expenses. Selling expenses is 10% of sales. 10% of sales is how much? So 2,75,000 into 10% is 27,500 rupees. So 27,500 rupees is here. Then admin expenses is going to be 5% of sales. So 2,75,000 into 0.05 gives you how much? 13,750. At the appropriate location, you need to add it, right? What you need to do first, prepare the format of cost sheet and just plug the figures and you are done with this. Clear with this, guys? Let's do this. First, opening stock of raw material. How much is that? Opening stock of raw material 3,000, right? 3,000. Add purchases. How much was the purchase? 1,10,000. So add this 1,10,000, right? Minus closing stock of raw material. How much was the closing stock of raw material? 4,000 rupees. So minus is 4,000. Net you get is what? Direct material consumed. 1,13,000. So 3,000 plus 1,10,000 minus 4,000 gives you 1,09,000. To this, add your direct labor. How much was this? 65,000. Add 65,000. In this question, there is no direct expense, so leave it. So subtotal, you get your prime cost 1,74,000. Clear with this, guys? Now to this, add your factory overheads or production overheads. We got 60% of 65,000. It was 39,000. Just add this 39,000. You get what? Your works cost, also known as factory cost. To this, add opening WAP minus closing WAP. Opening WAP was how much? Beginning opening WAP 4,000, closing WAP end. How much was that? 6,000. So add 4,000 minus 6,000. So 2 lakh. So literally the adjustment for this is 2,000. So 2 lakh 13,000 plus 4,000 minus 6,000 gives you 2 lakh 11,000. Now you enter into what? You enter into your warehouse area. Now our CMA Institute here wants you to add what? They want you to add administration overheads also. Right, so add your administration overheads. How much is your administration overheads? We calculated 5% of 2,75,000 came out to 13,750. So add 13,750 here. Then subtotal, call it as cost of production. 2,11,000 plus 13,750 gives you 2,24,750. Now to this, add your opening stock. What's your opening stock? 3,000, right? And sorry, opening stock of FG. Opening stock of FG is 7,000, right? Minus closing stock of FG. How much is my closing stock of FG? 8,000. So plus 7,000 minus 8,000. So how much you get? So 2,24,750 plus 7 minus 8 gives me 2,23,750. Right, now I have moved out of my factory. To this I need to add my selling overheads. 10% on sales we've already computed. How much is that? So 27,500 I need to add 27,500. You arrive at your cost of sales. So 2,23,750 plus 27,500 gives you 2,51,250. Right, add profit gives you sales. Now in this question we don't have the profit, but we have the sales figure. How much is my sales figure? 2,75,000 here. So put up 2,75,000 in the end. So literally my total sales is 2,75,000. My total cost is how much? 2,51,250. So 275,000 minus 251,250. You get how much? 23,750. This is the balancing figure is your profit. Are you guys clear with this? Literally what you had to do is that you had to know the format of cost sheet. For that, you don't mug up, you remember the logical flow of cost. With that, you will be able to prepare the statement of cost and just plug the figures available in the question. And that's about this area. Are you guys clear with this? This is why I said, if you give me 6 hours to chop down a tree, I will spend the first 4 sharpening the axe. Literally, if you see, we took 1 hour, we have taken approximately 1 hour now. Out of this 1 hour, the first 50 minutes we took on learning the concept behind it, and just 10 minutes we could solve the entire question. That's about it. Clear with this, guys, right? This is the power of conceptual learning. This is the power of conceptual learning. Trust me, this is exactly how all the practical papers should ideally work. Clear with this, guys? So this is what we follow in our lectures as well. But literally in our in our regular and exam oriented batch, every single question I do it right here for the purpose of marathon. Since though the question is given there in our regular and exam oriented batch, I literally do it. I solve it in this this OneNote. I just solve it here. Right, so literally I do it along with the students, and that's how we do it here in a marathon. Since we are revising due to lack of time, so we are revising it again. So I'm not doing every single thing, but of course the it's all printed here, but we do that in-depth discussion. Clear with this, guys, right? So that's about this particular question. So please go and update your library of adjustment. Write down format of cost sheet. Please write down format of cost sheet. Format of cost sheet. Right, guys? Fine. So with this entire chapter of cost sheet has been revised, right? So I took one representative question and we actually completed this particular chapter as well. So now let's move on to the next one. Now let's move on to the next chapter called as direct expenses. Now guys, actually we learned the concept of direct expenses in the previous chapter cost sheet itself. Despite this, Institute has given it as a separate area, hence I want to discuss it separately. Now, what do you mean by direct expenses, right? It is basically one of the components of your prime cost, right? Basically, direct expense means what? It covers all the expenses which are directly traceable on a per unit level, but they are not classified under direct material or direct labor. So all the direct costs which are not direct material or direct labor comes under the category of direct expenses. Clear with this, guys? All expenditure other than those incurred for procurement of material and labor are termed as expenses, right? And generally expenses can be classified into direct and indirect. If it is directly traceable on a per unit level, it is called a direct expense. If it is incurred in bulk, right, not directly traceable on a per unit level, for example factory rent, supervisor salaries, repairs and maintenance, depreciation on plant and machinery, these are all indirect manufacturing costs called as production overheads. Whereas if it is directly traceable on a per unit level, for example royalty paid, right, for every unit produced I'm paying a royalty, in that case that is called as a direct expense. Basically we know all these things. And there is a separate cost accounting standard, which is cost accounting standard number 10, right, that has been issued by the Council of Institute of Cost Accountants of India, that talks about treatment of direct expenses. It's very simple, but anyways let's cover this also. It can come here and there in your exam, so let's do this, right? CAS 10 defines direct expenses as expenses relating to manufacturing of a product or rendering a service which can be identified or linked with a cost object other than material and direct labor cost. Basically what they are saying, cost object means the object for which we are computing the cost, basically one unit of output. So all the costs, expenses relating to manufacture which can be identified on a per unit level, however it should not be your direct material or direct labor. So all the direct costs other than material and labor are called as direct expenses. Clear with this, guys? Other than material and employee cost, this is what they have given. Example, cost of utilities, right, payment for bought out services or job processing charges. You need not mug it up. Any cost that is directly traceable on a per unit level other than material and labor. That's about it, right? Quickly let's go here and see what they have given here. Direct expenses, this particular cost accounting standard number 10, it says nature, it forms part of prime cost, right? Examples they have given, we have seen all these things. Cost of utilities like power and fuel, steam, etc. Royalty paid, then higher charges for specific equipment, fee for technical assistance and know-how for a specific project, fee of this is what we saw, cost for a product or service specific design or drawing for a particular project, cost of a product or service specific software, other expenses which are directly traceable, right, for the production of goods and services, right? Cost accounting standard number 10, what they are saying, sir, how do we identify your direct expenses? How do we measure it? Simple, right? If I'm paying royalty, I'll get an invoice, right, from the person to whom I'm making the payment, right? So measured from the invoice or agreed price. Clear with this, guys? R&D costs, in case you have R&D costs, you include it only if it is directly linked to production. Lump sum payments, sir, it's direct, sir, for this project, but I'm paying in bulk, then in that case you can amortize. Means what? In that project, if you're having, let's say 10 units you are producing or 100 units you are producing in that project, maybe overall cost divided by 100 units, you can amortize or unitize it. Future benefit items, right? Suppose if a particular cost I'm incurring for a specific project, let us say technical know-how, patent, I'm paying some cost, right? If I expect to get some benefit in future, maybe how will I apportion it, sir? Maybe you apportion it based on, okay sir, I paid 1 lakh rupees, using this 1 lakh I can produce 100 units, so 1 lakh divided by 100, 1000 rupees the cost, direct expense per unit, I can arrive at it. Immaterial items, if it is a small amount in nature, take it to your overheads, right? Any finance cost, we know it should not be included in our subject. Imputed cost means what? Opportunity cost and all, it is excluded, right? Standard costing variances, what are they? We will study in your standard costing, not a problem. Any grants or subsidy if you receive should be deducted. Abnormalities definitely should be excluded. For example, fines and all these things we pay, we should exclude it. We have seen that our subject deals only in operating items. Penalty damages, we know it should not be considered. Recoveries, suppose there are some direct expenses I use, right, and out of which, let us say I could have recovered some amount, so any recoveries, right, for example scrap income I'm generating, it should be subtracted from the cost, right? And any changes in cost principles are allowed if legally they are allowed for compliances. Now with respect to this cost accounting standard number 10, what should I disclose? The basis of distribution of direct expenses, quantity, rates wherever applicable, price, usage, related party transaction, grants, abnormal direct expenses, and penalties and damages and all these things. These are just meant for your disclosure purpose, core theory area. Now guys, direct versus indirect expenses, we know any cost directly traceable on a per unit level, we know that it should be taken as your direct expenses. Indirect costs, they are not traceable on a per unit level, right? It is not directly traceable on a per unit level. Direct expenses, right? Ideally speaking, both direct and indirect are trading account items only, but here I don't know why they have given debit side of trading, here they have given debit side of P&L. It's ideally wrong. Clear with this, guys, right? Examples of direct costs are direct labor, direct material, power, etc. Here it's printing cost, utility bills, basically your all your indirect manufacturing cost comes under your indirect expenses. Clear with this, guys? Basically beyond this there is nothing great here. So now let's quickly go and do some numerical problems here. Measurement of direct expenses, right? Now question number 1, the royalty paid on sales 30,000 rupees, royalty paid on units produced 20,000 rupees, higher charges of equipment used for production 2,000 rupees, design charges 15,000 rupees, software development charges related to production 22,000 rupees. Compute the direct expense. Simple. Royalty paid on sales, is it direct expense? Yes. Royalty on production, yes, that is also direct expense, right? Higher charges on a specific equipment, yes, 2,000 rupees. Design charges, yes. Software development, yes. Sum total of all these things, 30,000 plus 20,000 plus 2,000 plus 15,000 plus 22,000, add up, you will arrive at what? You will arrive at your direct expenses. That's about it, guys. Nothing great. There are only two sums given in the study material. We will do both. Expenses are related to either manufacturing the product or rendering a service, and these costs are directly identifiable and can be linked with the cost object and are not related to material or labor, hence considered as a part of direct expense. Add up everything, that's your direct expenses. Clear with this, guys, right? Go and update your library of adjustment. Write down question number 1. Write down measurement of direct expenses. Please write down measurement of direct expenses. Write down measurement of direct expenses. Right, guys? Perfect. Now let's go on to the next question, which is question number 2. Now, measurement of direct expenses, allocation of cost object. We will see this. A manufacturing unit produces two products X and Y. The following information is furnished. What are they? Products X and Y. So how many units are produced? 15,000. Out of this they have sold 15,000, 12,000 respectively. Perfect. Machine hour utilized is given. Design charges is given. Software development charges is given. Royalty paid on sales 54,000 rupees they have paid at the rate of what? 2 rupees per unit sold on both the product, right? Literally for every unit I sell, whether be it X or Y, I pay a royalty of 2 rupees. Right, totally how many units have they sold? 15,000 of X and 12,000 of Y. If you add the two, how much do you get? You get 27,000 units as a whole. 27 into 2, 54,000. That's the royalty paid on units sold. Royalty paid on units produced 35,000 at the rate of 1 rupee per units produced. If I produce one unit, be X or Y, I'll have to pay 1 rupee. Right, so 20,000 plus 15,000, overall 35,000 units have been sold into 1, so 35,000 rupees. Higher charges of equipments used in the manufacture of product X alone, 5,000 rupees. So 5,000 rupees is a direct expense for product X. Compute the direct expense. So now look at this. Royalty paid on sales, literally 15,000 into 2. How much is that? 30,000 rupees is the royalty on sales for X. For Y, 12,000 into 2, 24,000. Guys, clear with this? Royalty on production, 20,000 into 1, 15,000 into 1 respectively. 20,000 into 1, 15,000 into 1 respectively. Next, higher charges, right? Only for product X, 5,000 rupees. 5,000, you put it here alone. Next, what else is there? What else is there? Design charges, 15,000, 18,000. Put it here, 15,000, 18,000. Then, what do you have? Software development charges, product X, product Y, 24, 36, 24, 36. So you add up everything. So the direct expenses for product X is 94,000. The direct expenses for product Y is 93,000. As simple as that. Clear with this, guys, right? Note the royalty on production and royalty on sales are allocated on the basis of units produced and units sold respectively. Royalty on production is on the basis of units produced. On sales is on the basis of units sold. These are directly identifiable and traceable to the number of units produced and sold. Hence, it is not an apportionment. No adjustment has been made with respect to closing stock. Why should you make, right? Royalty on units sold. Royalty on sales is on units sold. Royalty on production is on units produced. As simple as that. Clear with this, guys, and that's about it. Please go and update your library of adjustment. Write down measurement of direct expenses. Measurement of direct expenses in a multi-product situation. What do you mean a multi-product? A company deals in two different products. So in a multi-product situation, please write down measurement of direct expenses hyphen in a multi-product situation. Here with this, guys, right? And with this, we have finished this small chapter, direct expenses as well. Literally, we have covered both the numerical problems in this particular chapter. Now, with this, let's move on to the next chapter. So now, let's get started with the revision of a brand new chapter called as overheads. Now, before we get started with this chapter, first, I want to tell you all that this is a common chapter in your CA Intermediate Paper 4 Cost and Management Accounting and in your CMA Intermediate Paper 8 Cost Accounting. So for both CA and CMA students, this particular chapter is common, exactly the same, right? So for this particular marathon purpose, right? So it is a common marathon or a revision with respect to this chapter, but please be very clear. So we have separate books. I have prepared separate concept decoder as well as solved question bank for CA Intermediate, your cost and management accounting paper 4, as well as for CMA Intermediate. Separate books are prepared, and even in our paid courses, be it your regular or exam oriented classes, the recordings are separate for CA and CMA Intermediate, right? For marathon purpose alone, this particular chapter, which is common, right, I am making it as a common recording. Now, on this note, let's get started with this particular chapter, overheads. Now, guys, our subject, cost and management accounting, costing, right, has three objectives. What are the three objectives? Number one, stock valuation profit computation. Number two, decision making. And number three, control, right? Now, this particular chapter, overheads, helps us achieve the first objective, which is stock valuation and profit computation. This is the objective which this overheads chapter helps us achieve. Clear with this, guys? And to put it even more precise, this chapter, the objective of doing this chapter is to calculate the overhead cost per unit. This is what we are going to calculate in this chapter. Sir, why, sir? Now, every unit we know is valued at full manufacturing cost, right? So manufacturing cost basically represents what? Your direct material, direct labor, direct expenses, right? These three collectively is called as prime cost plus production overhead. If you add up, you get your total manufacturing cost. Now, while the first three components, which are called as prime costs, are readily available on a per unit level. Sir, to manufacture 1 unit of, let us say, a pen, I know how many grams of plastic or refill I need, right? And what is the rate per gram? So which means this direct material cost can be readily available on a per unit level. Direct labor, sir, to produce 1 unit of pen, I need 1 hour of labor. For 1 hour of labor, I pay 5 rupees. So 1 into 5, 5 rupees is the labor cost per unit of output. Direct expense, sir, for every unit of pen, I pay 7 rupees as the royalty. So direct expense is also available. So all these prime cost components are readily available on a per unit level, whereas the production overhead figure is not readily available on a per unit level. It is actually an indirect manufacturing cost which is available only in bulk. For example, your factory rent, repairs and maintenance, depreciation, supervisor salary, etc. These are all costs available in bulk. Clear with this, guys? Now, only if I arrive at the per unit cost, what can I do? So out of the overall units produced, I can segregate the total manufacturing cost into, right, my cost of goods sold and closing stock. Cost of goods sold will be units sold into the manufacturing cost per unit, and closing stock will be units unsold into manufacturing cost per unit. Or in other words, I need to calculate the manufacturing cost per unit. only then I can classify my cost into cost of goods sold and closing stock, and only if I do that I will be able to achieve my objective of stock valuation and profit computation. Or in other words, for me to arrive at the full manufacturing cost, the prime cost components are readily available on a per unit level, whereas the production overheads alone is not available on a per unit level. Hence, the objective of this chapter is to first calculate the overhead cost per unit. If we calculate the overhead cost per unit, anyways my prime cost components are available on a per unit level and waiting for me. To this, if I add the overhead cost per unit, I'll get the full manufacturing cost per unit. With this, I can segregate my overall manufacturing cost into cost of goods sold and closing stock, by which I can achieve my overall objective of stock valuation profit computation. So first, place yourself right and understand why you are studying this particular chapter overheads. Clear with this, guys? Now, you might have a question, sir. Perfect, sir. We understood. So the objective of this chapter is to calculate production overheads, overhead cost per unit. By the way, remember, whenever we say overheads in this chapter, overheads represents your production overheads, right? Sir, fine, sir. So we need to calculate the overhead cost per unit. Perfect, sir. Now, for this, why do we need a full-fledged chapter, sir? What do? Take the total overheads divided by the total units. You will get the overhead cost per unit. For this, why do we need a separate chapter called overheads? And why are you actually troubling us with a big chapter? No, it's not that simple. Now, what you are saying is right, provided a company is dealing in only one product. Let us take an example of a company like Titan. Okay. Now, let us say the full overall production overheads incurred by Titan is, let us say, for example, it is going to be 1 lakh rupees. Now, it is incurred in a factory. Now, in this factory, Titan produces, right, watches. Titan also produces, they have this eye gear, that is Titan Eye Plus. They have the spectacles, right? So they have this eye gears. And let us say they also produce, example, I'm telling you, wallets. Now, using the common factory facility where they have incurred 1 lakh rupees, for example, let us say Titan has produced 4,000 watches, right? And 3,000 units of eye gears, and let us say they have also produced another 3,000 units of wallets. Now, you guys tell me, can I add 4,000 watches plus 3,000 eye gears plus 3,000 wallets, and then I will say, sir, 4,000 watches plus 3,000 eye gears plus 3,000 wallets is equal to 10,000 what? No, or in other words, basically, can you add dissimilar items? 4 donkeys plus 5 monkeys is equal to what? You can't add dissimilar items, right? In this case, you can't say I have produced 10,000 units totally. 1 lakh divided by 10,000 units, it is going to be 10 rupees per unit. Give all these products 10 rupees share of overheads. It doesn't work like that, because these are all dissimilar items. They cannot be added as such. Are you guys clear with this? So which means I need to have a proper system in which this particular 1 lakh rupees, the bulk figure, needs to be meaningfully apportioned, and I use a procedure called as overheads absorption costing system, through which what happens at the end of the day, I find out what is the overhead cost per unit of watch, what is the overhead cost per unit of eye gear, and what is the overhead cost per unit of wallet. Or in other words, the objective of this chapter is to calculate the overhead cost per unit of each of the type of product the company deals in. Once I do that, then obviously I will be able to achieve the objective of this particular chapter. Are you guys clear with this? So this is the big picture of this particular chapter. Sir, how do we do this, sir? That's why this chapter actually seeing, right, I'm taking the concept decoder of your CA intermediate concept decoder. Separate concept decoder is there for CMA intermediate, but for the purpose of marathon, I'm using CA intermediate concept decoder. Do not worry. whatever we are seeing here is equally applicable even for CMA intermediate students. So look at this. This is what it is. Overheads are the expenditure which cannot be conveniently traced or identified with any particular cost unit, and such expenses are incurred for the output generally and not for a particular work order. And it also represents expenses that have been incurred in providing certain ancillary facility of services which facilitate or make possible the carrying out of the production process. Overheads are incurred not only in the factory but also in administration, selling, distribution. These are separate, it's just an introduction which has been mentioned here. Now, what are the steps involved in overhead absorption costing? The name of the chapter itself is overheads hyphen absorption costing method. So we use a procedure called as absorption costing system. Now guys, basically this entire chapter is divided into three. This entire chapter, overheads accounting system, is divided into three. The first one is called as primary distribution. The second phase or the step is called as secondary distribution. And the third phase or the step is called as absorption. Clear with this, guys? So overall, there are three steps involved in this overhead accounting process. Primary distribution, secondary distribution, absorption. Right? That's about it, sir. Now, once these three steps are over, the absorption costing system, right, gets completed, but there are certain advanced levels of absorption which we will be seeing here. If you notice here, right, we have primary distribution of overheads, then another concept, secondary distribution of overheads, then we have another concept, absorption of overheads, and then once absorption is done, we will also be seeing there are 6 types of absorption rates. This is another learning objective of this chapter. Predetermined rate versus actual absorption rate, then treatment of under or over absorption, then we will also be seeing blanket rate versus departmental rate, then machine hour rate method. These are all, and of course one more theoretical thing, capacity determination, then core theory topics. Literally whatever I have mentioned here, right, in this particular font, these are all the different concepts we are going to see. Of course, in this revision of this particular chapter, we will also be doing certain numerical problem. All the concepts will also be covered, and with the help of some numerical problems also we will be doing, right, in our regular and fast track, or regular and exam oriented batches. Basically what we will be doing is every single sum we will be doing, right? For marathon purpose, I have handpicked a few questions. I just didn't want to do only the concept part. So concept with some numerical problems, I've handpicked some questions which will represent predominant portion of the concept. That will also be done so that even if you're watching this the day before your exam, you can effectively revise the entire chapter along with me. Now guys, now let me just get back here. Now sir, primary distribution, secondary distribution, absorption. Sir, how does it look like? Quickly, let me just recapitulate this. Now, first of all, the first step is I should identify what are all the line items of production overheads that are available, right? So the first thing I do is maybe some 20-30 line items will be there. For example, I'll be having factory rent, right? Then I'll be having supervisor salary, repairs and maintenance, depreciation on machine, so on like that. I will be having multiple line items, right? Now what will I do with these line items? So first what will I do is that now I will identify, sir, in our company how many departments are there. For example, let us take an example of Tirupur textile belt, right? We have a textile industry. Let us say in our textile company, right, manufacturing company, I have the following departments. Spinning department, right, I call this as P1. Why P1? I will tell you. Then I have weaving department, this is P2. Then I have printing department, this is P3. Then let us say I also have a factory canteen. So canteen, I call this as S1. And let us say I also have stores, right? I call this as S2. Now, these are all the departments available in my factory. Clear with this, guys? Now, Now, spinning department, what do? I'm a textile company. Basically, raw cotton is there. We spin this cotton and take the threads. Now, once I take out the threads, what will I do? I will weave it and make it into a t-shirt or a pant accordingly. Once the weaving is done, what will we do? Now we give that coloring and printing and all that is done in the third department, P3. So these three are production departments. What do you mean by production departments? The departments through which every product actually passes through. Clear with this, guys? So every product passes through spinning, weaving and printing department. Clear with this, guys? That's why I called it as P1, P2 and P3. Now over and above these production departments, I also have two service departments. What do you mean by service departments? These are the departments which are present in the factory only, but my products will not pass through the service departments. These departments are meant for providing service to the production department. For example, here, canteen. My products will not pass through the canteen, but this canteen will provide food for all the workers working in the production departments. So only if this canteen is there, my production department can run smoothly. Similarly, stores. Stores is basically a place where whatever material they're asking for, the production department are asking for, I will give it to them. Clear with this, guys? So my products don't necessarily pass through them, but stores is required for providing services to the production departments. Clear with this, guys? So now, under the first phase of this overhead accounting procedure, which is basically primary distribution, right? So now what we do in primary distribution is that, so every single line item of expense, why do we incur all these line item of expense? Because we have all these departments in our factory. So now, for example, factory rent, I will allocate, I will distribute or apportion it to all the departments of the factory. Next, supervisor salary, once again, apportion it to all the departments of the factory. Repairs and maintenance, apportion it to all the departments of the factory. Depreciation, apportion it to all the departments of the factory, and so on. So every single line item of expense, indirect manufacturing cost, gets apportioned to all the departments of the factory. Clear with this, guys? Why? Because I incur this expense for the benefit of all these departments of the factory. Are you guys clear with this? This procedure of apportioning the line item of expenses to all the departments is called as primary distribution. Sir, why do we do this, sir? Fine, because all these line items of expenses are incurred only for the benefit of departments. Okay, sir, on what basis will I do? For example, factory rent. Use some reasonable basis of apportionment. In a common factory, one area is their factory. Inside this, only all these departments are there, right? On the basis of square feet occupied by each and every department, you apportion the entire factory rent. Clear with this, guys? Sir, supervisor salary, sir. How will I apportion? Maybe on the basis of number of workers working in each of these departments, you apportion. Or in other words, use a reasonable base to allocate or apportionment the respective line item to all the departments of a particular factory. Clear with this, guys? Now, at the end of primary distribution, what will happen? This 20 line items of expenses will vanish and it will turn into just 5 figures. P1 overhead, P2 overhead, P3 overhead, S1 overhead and S2 overhead. So 20 line items will vanish and become into just 5 figures. Clear with this, guys? In our example, 5. Now, companies can have 4 production departments and 10 service departments also they can have. It could be anything. In our example, which I took, I've just taken 3 production departments and 2 service departments. Clear with this, guys? So, apportioning your line items of indirect manufacturing cost to all the departments of the factory is called as primary distribution. Clear with this, guys? Next, the second phase or the second part of overheads accounting is called as secondary distribution. Now, what do we do in secondary distribution? Now, if you notice here, now P1 department, first all these line items of expenses vanish. Now I have P1 department overheads, P2 department overheads, P3 department overheads, and S1 department overheads, S2 department overheads. Now you tell me, this S1 department and S2 departments are basically present only for the purpose of providing services to these three production departments? Yes. Hence, what we need to do is we need to reapportion back the S1 department overheads and S2 department overheads back to the production departments P1, P2, P3. Clear with this, guys? So in the secondary distribution, what we need to do, S1 department and S2 department would have got a share of overheads that needs to be redistributed back to the production departments. Sir, in what ratio, sir? In the ratio of the services provided by each of these service departments. Clear with this, guys? For example, Canteen provides services on the ratio of the number of employees working here. Are you guys clear with this? So accordingly, on the basis of services rendered ratio, what I will do is I will reapportion back the service department overheads to the production department. Are you guys clear with this? So literally here in secondary distribution, what happens? S1 overheads, S2 overheads, these two will be reapportioned back to P1 department, P2 department and P3 department. Are you guys clear with this? So, or in other words, at the end of secondary distribution, now what happens? Beginning I had 5 figures, now these 2 figures will vanish and I will redistribute this back to the production department. So at the end of secondary distribution, in our example, we will only have P1 overheads, P2 overheads and P3 overheads. Clear with this, guys? See how gradually we are reducing the line item, but the total figure will remain to be the same. The sum total of 20 line items here will be equal to the sum total of the 5 line items here at the end of primary distribution. Why? Because all these costs have been apportioned here. The manner of apportionment alone is different. Now, at the beginning of secondary distribution, you have 5 figures. Now, S1 and S2, we are reapportioning it back to the production department. So here, at the end of secondary distribution, the total will continue to be the same, but now it is being shared only by 3 people. Are you guys clear with this? So, secondary distribution, what we do, the secondary department, the service department overheads are reapportioned back to the production department overheads using the services rendered ratio. But remember, secondary distribution, you have different methods of redistributing the the service department overheads back to the production department. What it is at the relevant point of time, I will just tell you. So clearly understand, look at this, in the concept decoder book itself I've clearly mentioned secondary distribution, that is service department overheads, I need to redistribute it back to my production departments, right? There are broadly 3 different methods of apportionment of service department overheads back to my production department. What are the 3 methods? One is called as a direct redistribution method. The second one is called as step ladder method, also popularly called as non-reciprocal method, and the third one is called as reciprocal services method. And under reciprocal services, you have 3 different methods: simultaneous equation, repeated distribution, and trial and error method. Sir, when to use which method, I will come to this, do not worry. We will also be doing numerical problems in the marathon itself. Clear with this, guys? But understand, I'm just giving you guys an overview right now. Secondary distribution, sir, how do I distribute service department overheads to my production department overheads? Broadly, there are 3 different methods: your direct redistribution method, step ladder method, and reciprocal services method. And under reciprocal services method, you have 3 different methods: simultaneous equation method, repeated distribution method, and trial and error method. What are they? When to use which method? I will come back to it with a numerical problem. Right now, I'm just giving you guys an overview. Clear with this, guys? I will do sums for each primary distribution, secondary distribution, absorption, everything. I will be doing some numerical problems in the marathon itself. Nothing to worry about that. Clear with this, guys? So now what happens at the end of secondary distribution? I have all production department overheads, P1, P2, P3 overheads. Clear with this, guys? Now comes the last phase called as absorption. Now in absorption, now what do I do? The starting point is obviously the secondary distribution, right? So P1, P2, P3 overheads I have. Now, what is the objective of this chapter? I need to calculate the overhead cost per unit of each of the product the company deals in. Let us say this is a textile company, right? So let us say this particular company deals in, let us say, 4 different products, men's wear, ladies wear, kids wear, and footwear. Let us say the company deals in 4 different types of products: men's wear, ladies wear, kids wear, and footwear. Now, on one side, I have P1 department overhead, bulk figure, P2 department overhead, another bulk figure, P3 department overhead, bulk figure. Now, I need to convert these 3 bulk figures into, so overhead cost per unit of menswear, overhead cost per unit of ladies wear, overhead cost per unit of kids wear, and overhead cost per unit of footwear, right? How do I do this is the subject matter of the third and the last step in this overhead accounting process called as absorption. How do we do that? I will come back to that with one numerical example. Right now, I am just giving you guys a broad overview for the purpose of understanding this particular chapter. So, primary distribution, what do? We list out all the line items of expenses. Every line item is apportioned to all the departments using what? The ratio of benefits derived, or what we do is we use a reasonable basis, right, to apportion every single line item to all the departments. Clear with this, guys? This is called as primary distribution. After this, we do secondary distribution. In secondary distribution, what do? We take the service department overheads and redistribute it back to the production department, right, using services rendered ratio. How do we do it, sir? We have different methods. When to use what method, we will be seeing under secondary distribution. And finally, now we have P1, P2, P3 overheads. Now, and we need to convert this into overhead cost per unit of menswear, ladies wear, kids wear, footwear, all the products a company deals in. How do we do is a subject matter of study in the third step called as absorption. Clear with this, guys? What to do, how to do is what we are going to study and revise in this particular chapter. With this, let's get started with the first step called as primary distribution. Now, in primary distribution, what do? List out all the line item of expense, and now we need to apportion all the line item of expense to all the departments using a reasonable basis. Correct? That is what I have mentioned here in our concept decoder. Look at this. Primary distribution. Here, what do? The basis of primary distribution of overheads, rent and other building expenses. Sir, what is the basis of apportionment? Floor area or a particular volume of a department. Right? Now, let us say labor welfare expenses, supervisor salary, all these things. How will I apportion, sir? Maybe on the basis of number of workers. Sir, please don't mug it up. Sir, should I mug up all these things? Absolutely not. In the question, based on the data given, you know which line item has to be apportioned using which base. Whatever you find reasonable, use that. Clear with this, guys? Right? General overheads. Suppose if they have given general overheads, generally, guys, we use direct wages or direct labor hour as the base. Why? If it is general in nature, we always assume human beings are the reason for that expense. So hence we apportion it on the basis of direct wages or direct labor. Depreciation on the basis of capital values of the or the asset value in the respective department. Clear with this, guys? Like this, it just goes on and on. Clear with this, guys? So this is the format of primary distribution, right? Do not worry, we will just go and do a numerical problem. With the help of this numerical problem, right, we will clearly be able to summarize and we will clearly be able to revise and understand the concept of primary distribution. Now, please go to your solved question bank of your CA intermediate syllabus, solved question bank of CA intermediate, and please take question number 1. It's on page number 49. So please take question number 1. Now, the following figures are extracted from the accounts of a manufacturing concern, right? From the accounts of a manufacturing concern of the month of September 20x1. What have they given? Particulars. Now, indirect materials in department P1, P2, P3, S1, S2. Department wise, how much is the indirect material cost? This is not a common cost. Department wise, readily they have given us the figures. Clear with this, guys? Generally, what do? One line item common cost will be that we need to apportion between multiple departments, but we need not apportion the indirect cost, the indirect materials. Why? This is readily available department wise. Clear with this, guys? Right? This figure is given. Next, indirect wages. This is also readily available, sir. P1 department indirect wages is so much. P2, P3, S1 and S2. Department wise indirect wages figure is also available here. Clear with this? So indirect material, indirect wages, these two figures are readily available department wise. Next, power and light. This amount, how much is it? 6,000 rupees. Now, this amount needs to be apportioned between all the departments P1, P2, P3, S1, S2 using a reasonable basis. Insurance on assets 1,000. Common cost needs to be apportioned between all the departments. Rent and rates 2,800. Once away needs to be apportioned. Meal charges 3,000 rupees needs to be apportioned between all departments using some basis. Now, depreciation on capital value of assets is 6% per annum, right? So now look at this. Over and above these line item, they also have depreciation, which is charged at the rate of 6%. From the above information, prepare a primary distribution summary with the following departmental data. First one, what have they given? Now look at this. Look at this. They have given area in square meter. Department wise, how much is the area given? Now, area, for what purpose will we use? Rents and rates 2,800 rupees is a common cost incurred for all the departments put together. Now, if we have to apportion this 2,800 rupees of rent and rates to all the departments, now the most reasonable base using which we should apportion the rent cost is going to be area. Clear with this, guys? So area is useful. These figures are useful for apportioning my rent cost. So the rent and rates should be apportioned on the basis of 4:4:3:2:1. Clear with this, guys? That's all it is. Nothing more. Next one. Next. Capital value they have given. So capital value, first, for the purpose of insurance, 1,000 rupees, right? I can use capital value as the base. So 100:120:80:60:40. And also for the purpose of depreciation, capital value can be used. Next one. Kilowatt hours is given. Now for what kilowatt, for what will be used is power and light, right? Power consumption, power cost and lightings. Kilowatt hours is the basis for apportionment. Next, number of employees is also given here. Number of employees. Now yes, meal charges is available, right? 3,000 rupees, the total meal charges incurred for all the departments put together. So department wise, how much, sir? Use number of employees as the base to apportion. 90:120:30:40:20. Are you guys clear with this? As simple as that. Now use these bases and apportion. Your line item of expense now gets converted into departmental overheads. P1, P2, P3, S1 and S2. Clear with this, guys? As simple as that. Beyond that, nothing is there in this sum. Now, these are common costs. We used some basis to apportion this, right? It is called as apportionment of overheads. Whereas indirect material and indirect wages are readily available on a department level itself. This need not be apportioned. These costs are called as allocated overheads. What do you mean by allocated overheads? If a particular cost, a line item of cost, is readily allocated or available on a department level itself, where you need not use a basis to apportion, it's called as allocated overheads. If it is a common cost that needs to be apportioned between the departments using some reasonable basis, only that is called as apportioned overheads. Clear with this, guys? So these are all some small terminologies which you can actually, which you should learn in case they might ask an MCQ or somewhere they might ask. So you should be in a position to answer, or a theory question can also come here. Apportioned overheads means a common cost that needs to be apportioned using some basis, whereas allocated overheads means what? So an overhead which is readily available on, right, departmental level. So now look at this. Look at this. So first, indirect material. So how much was the figure? The total of all these things is available department wise. Just copy paste the figure. So here the template is going to be statement of primary distribution, particulars, total. Should write down the basis also. Then list out all the departments P1, P2, P3, S1, S2. Now indirect material, indirect wages. These two are direct allocation. Now these figures you just need to copy paste. 950, 1200, 200. 1500, 400, you just need to write down here 950, 1200, 200, 1500 and 400. Similarly here for indirect wages, so 900, 1100, 300, 1000 and 650. The 900, 1100, 300, 1000 and 650. Copy paste. So the sum total is being written here. Clear with this, guys? Next one, power and light. So the next line item is going to be what here? Power and light. Now how much is the figure? The figure is going to be 6,000 rupees. Now, on what basis will you apportion? Kilowatt hours. So, kilowatt hours, right? What is the basis of apportionment? 4,000 is to 4,400 is to 1600 is to 1500 is to 500. Right, guys? Correct? So now literally what we can do here, we can just remove these zeros. We can just remove these two zeros in the end. So I can say this is nothing but 40 is to 44 is to 16 is to 5 is to 5. Sorry, 15 is to 5. Right? So look at this. 40 is to 44 is to 16 is to 15 is to 5. Right? Now, so basically we need to apportion this 6000 in this particular ratio. Right? How do we do it? First add up all these things. So 40 plus 44 plus 16 plus 15 plus 5. So it comes out to how much? 120. Right? Now there is a calculated trick to do this. Right? If you've already attended my Evo classes or regular batch, then obviously I would have taught you that. You must be knowing it. If not, if you're learning this for the first time, right, or if you're looking at my lectures for the very first time, there is a calculated trick to do that. Now ideally, guys, if you add this up, how much you get? 120. Right? Now literally what will you do? 6000 divided by 120 into 40 will be P1 share. 6000 divided by 120 into 44 will be P2 share. 6000 divided by 120 into 16 will be P3 share, and so on. Now simple. 6000 divided by 120 is a common figure, right? So take your calculator. 6000 divided by 120 is equal to how much you get? 50 rupees. Now this 50 rupees needs to be multiplied with 40. You get P1 figure. 50 needs to be multiplied with 44. You get P2 figure. 50 needs to be multiplied with 16. You get P3 figure, and so on. Guys, correct? So now what we need to do, instead of doing 50 into 40 is equal to, once again 50 into 44 is equal to, instead of 50 into 16 is equal to, no need. Common number 50 needs to be multiplied with multiple figures. What you can do is, 50 is there in your calculator. Yes, just click the multiply button twice. Into. Right? Then what is the first figure? 40. Type 40 and click is equal to, how much you get? 2000. Right? Now don't do anything. What is the second number? 44. Just type 44. That's all. Don't do anything. Just type 44 and click is equal to. Now you get the second figure. So 50 into 44. So 50 was there. Into you clicked 2 times. 40 is equal to, you get the first figure. Right? Next 44 is equal to, you get the second figure. Next type the third number. 16. 16 is equal to, you get 800. Next 15 is equal to, you get 750. 5 is equal to, you get 250. That's about it. So when you want to multiply a common number with multiple other numbers, just take that common number 50, click into. First number is equal to, you get the answer. Second number is equal to, you get the answer. Third number is equal to, you get the answer. Instead of doing 50 into 40, once again 50 into 44, once again 50 into 16, no need. 50 into 40 is equal to, write down. 44 is equal to, write down. 16 is equal to, write down. 15 is equal to, write down. 5 is equal to, write down. One line, you will get all the numbers. Clear with this, guys? This way you can save a lot of time in your examination. Clear with this, guys? Right? Now the third line item, what is it? Insurance on assets. How much is that? 1000 rupees. All right. Now insurance on assets should be apportioned on the basis of what? Your capital value. So 100 is to 120 is to 80 is to 60 is to 40. So you can just remove 1 0 everywhere. So it's 10 is to 12 is to 8 is to 6 is to 4. Right? So 10 is to 12 is to 8 is to 6 is to 4. So clearly mention. So what is the line item? What is the total? What is the basis for apportionment? And then you can apportion it properly. So 10 plus 12 plus 8 plus 6 plus 4. How much is it? If you add it up, you get 40. Now what do we need to do? So 1000 divided by 40 is equal to, how much you get? 25. So this 25 needs to be multiplied with all these figures. Now 25 into 10 is equal to, you get 250. Next 12 is equal to, you get 300. Then 8 is equal to, you get 200. 6 is equal to, you get 150. 4 is equal to, you get 100. Clear with this, guys? Very simple. In exam, you don't have the luxury of time. Use these small tricks and hacks so that you can maximize your time in your exam. Right? Next one, rents and rates. So what is the figure here? 2800. It should be apportioned on the basis of area. Right? So 4 is to 4 is to 3 is to 2 is to 1. So that's going to be your manner of apportionment. So look at this. It's going to be 4 is to 4 is to 3 is to 2 is to 1. So 4 plus 3 plus 2 plus 1. How much is that? 14. Right? So now what do we do? 2800 divided by 14 is equal to, you get 200 into 4 is equal to 800, 4 is equal to 800, 3 is equal to 600, 2 is equal to 400, 1 is equal to 200. Are you guys clear with this? That's about it. That's about it. So literally I'm also sharing you the way in which you can do the calculations, use your calculated trick, and save a lot of time in your exam. So all these things are printed and given. Still I'm doing it and showing it to you so that you will be in a position to actually use these calculated tricks in your exam. Next one is the meal charges of 3000 rupees. It should be apportioned on the basis of number of employees, right? So number of employees, what is the basis here? It's 90 is to 120 is to 30 is to 40 is to 20. Right, that is the basis for apportionment. So, or you can also remove 1 0. It's 9 is to 12 is to 3 is to 4 is to 2. Right, guys? So look at this, meal charges. So it's going to be 9 plus 12 plus 3 plus 4 plus 2. It's going to be 30. Right? So what do we do here? So 3000 divided by 30 is equal to, you get 100 into 90 is equal to 900. Sorry, 9 is equal to 900. 12 is equal to 1200, 3 is equal to 300, 4 is equal to 400, and 2 is equal to 200. Clear with this, guys, right? Or if you don't want to remove the zeros, you can also do it like that. Absolutely no problem. Clear with this, guys. And finally, do not miss this out. You have depreciation on capital values. So capital value of assets, how much is that? 6% has been given. So now what do we do here? Now very simple, the capital value of all the assets are also given here properly. So now what do we need to do? Be very, very clear, guys. Be very, very clear. Here we are calculating all the overhead costs for the month of September. So 1 month's depreciation is what we need to calculate, or in other words, it is going to be 6%, right, into 1 by 12 into the respective capital value. This is 100,000, means 1 lakh, right? 1,20,000, 80,000, 60,000, 40,000. You will be getting the depreciation. I mean, you will be getting the depreciation figures. Are you guys clear with this? So how much will be the monthly depreciation? It is going to be 6%, 0.06, right, into 1 by 12, right? You get 0.005 into the respective values of assets. You will arrive at the figure, guys. Correct? Right? So how we did 0.06, right, into 1 by 12 is equal to, you get 0.005. Now that amount we need to multiply the respective value. So into 1 lakh, 100 means 100,000. 1 lakh is equal to 500. Here 120,000. So 1,20,000 is equal to 600. 80,000 is equal to, you get 400. 60,000 is equal to, you get 300. And 40,000 is equal to, you get 200. Are you guys clear with this? So literally the depreciation amount for the month of September we have calculated department wise: 500, 600, 400, 300, 200. Look at this. 500, 600, 400, 300, 200. The respective capital value into 6% into 1 by 12, right? If you want, you do it separately also, but that takes a lot of time. That's why I said very simple. So take 6% into 1 by 12. This is a common number that needs to be multiplied with the respective capital values of every single department. You'll get the answer. Clear with this, guys? So now if you total it up, P1, P2, P3, S1 and S2, if you total, you will get what? P1 department overheads is how much? 6,300. P2 department overheads is 7,400. P3 department overheads 2,800. S1 department overheads is 4,500, and S2 department overheads is going to be how much? 2,000 rupees. Clear with this, guys? So with this, what has happened? The multiple line items of expenses have lost their identity. In turn, each and every line item has been now converted into P1, P2, P3, S1 and S2 overheads. Are you guys clear with this? So now literally, guys, the total of these line items was how much? 23,000. If you want, you total all these things. This will also be equal to 23,000. 6,300 plus 7,400 plus 2,800 plus 4,500 plus 2,000. If you calculate exactly, this will also be equal to how much? 23,000. Are you guys clear with this? So literally the total overheads will not change. The apportionment is what we are doing here. So at the end of primary distribution, all the line items of your indirect manufacturing costs will lose their identity, and it will now become what? It will now turn into all departmental overheads. Clear with this, guys? That is the objective of primary distribution, successfully achieved. Clear with this, guys? With this, please go and update your library of adjustments. Write down primary distribution. That's all. Please write down primary distribution. That's about it. Clear with this, guys? Now let's move on to the next one. Let's move on to the next question. The next concept, which is secondary distribution. So that is the second concept that we are going to do. Secondary distribution. So what do we do in secondary distribution? Now the service department would have got their share of, overheads that needs to be given back to the production departments. Why? The service department exists only for the purpose of providing services to the production departments. So whatever is the share of overheads they receive should be given back to my production departments. Clear with this, guys? Now there are broadly three different methods. Right? In your concept decoder book, I've clearly mentioned at the end of primary distribution, the overheads are totaled for all the departments. The next step is to distribute the service department overheads back to the production departments. This is referred to as secondary distribution, or also known as redistribution of overheads, which can be broadly done under three methods. What are the three methods? The first method is called as direct redistribution method. The second method is called as step ladder method, and the third method is called as reciprocal services method. Under the reciprocal services method, you have three methods: simultaneous equation method, repeated distribution method, and trial and error method. First, these are broadly the three methods. First, you should know, sir, how to do is one thing, but you should know, sir, when to use which method. Many students do not know this. They randomly use any method. No, you have a rule here. There is a rule of when to use what method. That is very, very important for you, and that is always that is purely conceptual. Clear with this, guys? What is this, sir? When should we use what method? Now, the first method called as what? Direct redistribution method. Now, let us say for example, okay, I will write it down here. So broadly, we have three methods of secondary distribution: direct redistribution method, step ladder method, and finally you have reciprocal services method. Under reciprocal services, you have three different methods. That is fine. First, when to use which method, I will tell you. First one, direct redistribution method. Now, when will I use this particular method? Now, let us say, guys, I have three production departments, P1, P2, P3, and I have two service departments, S1 and S2. Let us say S1 is actually a maintenance department, right? And let us say S2 is a stores department. Clear with this, guys? So S1 is what? A maintenance department. S2 is what? A stores department. Clear with this, guys? Now, what will happen here? Now, you guys tell me, maintenance department, what is their job? Wherever machines are located, whenever there is a breakdown in the machine, this particular S1 department will go and do some repairs and maintenance, correct? Or literally, S1 will provide services only to P1, P2, P3, no? Correct? That is, S1 will provide services only to the production department. It will not provide services to S2. Why? Because only where the machines are located, S1 is going to provide the service. Or literally, S1 is going to provide service only to P1, P2, and P3. So there is no service provided by S1 to S2. Guys, are you guys clear with this? Hence, here in this example, this S1 provides services only to the production departments. How about S2? Stores department, what do? They issue raw material. Obviously, S2 also provides services only to P1, P2, P3. Guys, clear with this? S2 will not provide any service to your S1. Why? Because simply here, sir, S2 is a stores department. It provides services only to the production department. That is where the raw material is required. Why will S2 provide any services to S1? Clear with this, guys? Or in other words, in this particular scenario, S1 does not provide any services to S2. S2 also in turn does not provide any services to S1. I mean, S2 does not provide any services to S1. Or in other words, between the service departments, there is no give or take. Clear with this, guys? Or in other words, each of the service departments are meant only for providing services to the production department. In this case, I will use direct method. Are you guys clear with this? Or in other words, when there is no relationship or give or take between two service departments, in this case, I will use my direct redistribution method. Are you guys clear with this? Clear with this, guys? Right? Now, what is the second method? The second method is called as step ladder method. Right? Step ladder method. When will I use this second method called as step ladder method? Let us say I have three production departments, P1, P2, P3, and two service departments, S1 and S2. Clear with this, guys? Now, let us say S1, let us say is maintenance department, and let us say S2 is canteen department. Now, you guys think and answer. S1, anyways, it provides services. All the service departments, they provide services to production departments. I'm not bothered about that. Anyways, it is meant for that. Now, we are more concerned about the relationship between the service departments. Will S1 provide services to S2? No. Why? Sir, it's a maintenance department. I will maintain only where machines are located. In canteen, machine is not located. Clear with this, guys? So, S1 does not provide any services to S2. Guys, correct? So, S1 does not provide any services to S2. But look at S2. What is S2? Canteen. Now, will S2 provide services to S1? Yes. Why? Canteen. What is the purpose of a canteen? To provide food. Now, will the canteen say, if you are from the maintenance department, I will not provide food? Absolutely not. For all the people in the factory, including the workers working in the maintenance department, the canteen provides food only. Guys, clear with this? So, or in other words, in this case, S2 provides services to S1. Are you all able to understand? In this case, what happens? There is a one-way traffic. I call this as a one-way traffic. There should either be a give or a take between two service departments. Or in other words, look at this here. S2 provides services to S1, but in turn, it does not receive services from S1. Clear with this, guys? So between any two service departments, there should either be a give or a take. Are you guys clear with this? Or in other words, if there is a one-way traffic, in that case, I will go and use this second method called as step ladder method. How to do, sir? We will be seeing. Don't worry. One numerical problem, all the different variants or the varieties of secondary distribution methods will be seeing. You just listen here right now. So when to use step ladder method? When between any two service departments, there is either a give or a take, or in other words, there is a one-way traffic. In that case, you use your step ladder method. Are you guys clear with this? Right now, let me give you a scenario. You guys tell me whether you will use a step ladder method or not. P1, P2, P3 are there. Let us say I have S1, S2, S3. I have three service departments. Here, S1 provides services to S2. Right? S2 provides services to S3. Right? And S3 provides services to S1. Now tell me, is this a case of one-way traffic? And can I use step ladder method? Think and answer. Now, if you notice, some of you might feel, sir, there is no one-way traffic. Why? Look at this, sir, S1. The problem is with S1. S1 provides a service and it also receives service. Two-way traffic is there, sir. So you cannot use this method. No. Understand one thing. Between two service departments, there should either be a give or a take. Here, if you see, S1 provides services to S2, but S1 receives services from a different department, S3. So between S1 and S2, there is only a give, right? Between S2 and S3, here there is only a give. And between S1 and S3, there is only a take here. S1 is not giving anything. So between any two departments at a time, there should either be a give or a take, or there has to be a one-way traffic between any two service departments at a time. Clear with this, guys? Hence, this is very much a one-way traffic method only, so you can use your step ladder methodology of apportionment or reapportionment of service departments. Guys, are you all clear with this? A very, very trick question here. Clear with this, guys? Are you all able to understand? So step ladder method will be used when you have a one-way traffic. And the third and the last method of secondary distribution is called as reciprocal services method. Reciprocal services method. Now, let us say I have P1, P2, P3. Three departments and three production departments, and S1, S2, two service department. Sir, S1 is, let us say, housekeeping, right? They will sweep the place, they will do the cleaning and other works. And S2 is, let us say, a canteen department. Now, anyways, S1 provides services to the production departments. S2 also provides services to production departments. Now, I'm not bothered about that. To understand which method to use, we are more concerned about the relationship between the service departments. Now, here, will S1 provide services to S2? Sir, housekeeping, will they go and clean canteen? Yes, they will have to go clean the canteen. And will S2 provide services to S1? Sir, S2 is a canteen department. Will they provide food for the housekeeping staff? Yes. Or in other words, here, there is S1 provides services to S2 and S2 also provides services back to S1, or in other words, guys, there is a two-way traffic, correct? There is a true two-way traffic when there is both a give and a take between two service departments. In this case, you will go on to use your reciprocal services method. Are you guys clear with this? Under reciprocal services method, you have three different methods. You can use any of the three methods. All the three will only give the same result. Are you guys clear with this? So we are in secondary distribution, where the objective is to reapportion the service department overheads back to the production departments. So we have broadly three methods of redistributing back the service department overheads to the production departments. Direct redistribution method, when will you use? When there is ideally a no traffic. No traffic means what? Between the service departments, there is neither a give nor a take. Or in other words, all the service departments provide service exclusively to the production departments. Between the service departments, there is no give or a take. Only then you will use direct method. Step ladder method, between the service departments, you take any two service departments at a time. There should either be a give or a take. Or in other words, if there is a one-way traffic, use step ladder method. And when there is both a give and a take between two service departments, that's when we use the two-way traffic, which is nothing but your reciprocal services method. Clear with this, guys? Now, with this clarity, you can just go around and crack any kind of sum. Look at this. This is what I have mentioned. Everything here, whatever we've seen, direct redistribution. So I have clearly condensed and put it here in your study material. It is, everything is there, but it is not in in a very, very structured format. There are things, it runs into paragraphs. I've neatly condensed and look, put it here. So the day before your exam, you're revising direct redistribution, no traffic. Step ladder, one-way traffic. Reciprocal services, two-way traffic. And under reciprocal services, you have simultaneous repeated distribution, trial and error method. I've quickly explained what is what, but how to do that, clearly we will just go and look at one numerical problem. Are you guys clear with this? So on that note, let's get started with one more numerical problem. This is there in your CA Inter solved question bank. It's in volume 1. So please go and take question number 2. Yes, there are all methods here. Okay, guys. Yes. Now, look at this. Question number 2. Now, A Limited manufactures a number of products. It has two production departments, P1 and P2, and the service departments are S1, S2. Clearly, guys, understand, two production and two service departments. The estimated overhead costs for 20x1 and the interdepartmental relationship matrix are as follows. Now, what have they given? Now, look at this. P1, P2, S1, S2. 4 departments overall. 2 production, 2 service. S1, service provided by. S1 provides services to P1, P2 as well as S2. Clear with this, guys? What is the ratio of providing service? Sir, overall, sir, S1 department, right? Overall, it provides 40% of its service to department P1, 50% of its service to department P2, and the balance 10% service it provides to whom? Department S2. Clear with this, guys? Now, how about S2? S2 provides 50% of its service to P1, 30% to P2, and 20% of its service to S1. Now, wait. S1, it provides services to S2? Yes, sir. 10% of its overall services is being provided to S2. How about S2? Does it provide services to S1? Yes, sir. 20% of the entire department S2 is actually provided. I'm providing service to actually S1. Or in other words, S1 provides services to S2. S2 also provides services to S1. So clearly there is both a give and a take. This is a clear case of two-way traffic. Ideally, this sum you need to redistribute back the secondary distribution. The secondary distribution, that is a service department overheads, need to be redistributed back to the production department using which method? Reciprocal services method. Under the reciprocal services method, you have 3 methods. You have your simultaneous equation method, or your repeated distribution method, or your trial and error method. Using any of these 3 methods only, you should apportion, or in other words, this is a clear-cut case of two-way traffic. Right, so you should only use reciprocal services method. Right, now what have they given? Estimated overheads. P1 department overheads, P2 department overheads, S1 department overheads, S2 department overheads. Or in other words, they themselves have done the primary distribution here. Sir, multiple line items have now been converted into all department overheads. So the primary distribution is actually the starting point for secondary distribution. So right now they have given all these departments. Right now they have given what? They have given all departmental costs. Right now P1, P2, S1 and S2 has been given. What is the objective here? After we conduct the secondary distribution, now S1 and S2 should vanish and I should redistribute it back to P1 and P2. At the end of secondary distribution, I should have only P1 department overhead and P2 department overhead. S1 and S2 should vanish. Correct? That is the objective of secondary distribution. Whatever is the service department overheads should be redistributed back to my production departments. Now, ideally, this sum needs to be solved under what method? Under reciprocal services method. Now, look what they've asked. You are required to calculate the overhead cost for P1 and P2. Or in other words, at the end of secondary distribution, you only have production department overheads, right? Now, using first direct apportionment or direct redistribution method. So first, sir, this is a two-way traffic, sir. Direct method, I will use only when there is no traffic. You are absolutely right. But still they have asked you, despite it is a two-way traffic question, they have still asked you to use direct method, right? Since it is asked, we will do. Single question, all the methods are covered. How to do it, we will be seeing. Next, using stepladder method. And stepladder method by apportioning S1 department overheads first, and number 2 by apportioning S2 department overheads first. How to do that, I will tell you. Next one, reciprocal services method. And under reciprocal services method, you literally have repeated distribution, simultaneous equation, trial and error. So ideally, guys, these 3 come under your reciprocal distribution method. Your reciprocal services method. Ideally, these are all subcategories of reciprocal services method. Clear with this, guys? Or in other words, one question, all the different varieties of your secondary distribution will be done here. Shall we get started? Yes. First one, guys, direct redistribution or direct apportionment method. What should you do? Very simple. Now, the starting point is what? Primary distribution summary. Sir, how much is the departmental overhead, sir? 7,000, 6,000, 18,000, 8,000. So 7,000, 6,000, 18,000, 8,000. Clear with this, guys? P1, P2, S1, S2. Now, what they are saying, sir, ideally, when will I use, sir? When will I use my this one, direct redistribution method? When there is no traffic between your S1 and S2. That is, there is no give or take between your service departments. Only then I will be using direct redistribution method. In this case, what we need to do, sir, S1, what is the cost? 18,000. Now we are saying, look, direct redistribution method, we only assume, in direct redistribution method, we only follow it when my service departments exclusively provide services to production departments. So here, sir, S1, sir, it has provided its services. Overall, this 18,000 ideally should be apportioned in the ratio of 40:50:10, right? But here, since we are doing this sum under direct method, we will just ignore the inter service. The services provided between the service departments will be ignored. Why? Because in direct method there is no traffic, no. So forget this. Ideally, what we need to do, sir, 18,000 rupees is the departmental overheads of department S1. Apportion it between P1 and P2 in the ratio of 40:50. As simple as that. Why? Because direct method is used only when there is no give or take between the service departments. Clear with this, guys? Sir, this is ideally a two-way traffic sum. Yes, this is a two-way traffic sum. Still, they have asked you to actually do the sum under direct method. In that case, you should ignore the services provided between the service departments. Are you guys clear with this? Or in other words, this 18,000 needs to be apportioned in the ratio of 40:50. Right? So what happens here? Look at this. 18,000 you subtract, apportion it in the ratio of 40:50. So 4 plus 5 is 9. So 18,000 divided by 9 is equal to, you get 2,000 into 4 is equal to, you get second. So 18,000 divided by 9 is equal to, you get 2,000 into 4 is equal to 8,000. 5 is equal to 10,000. So what we did here, so S1, we removed 18,000 and distributed it between P1 and P2 in the ratio of 4:5. Now what has happened? S1 department overhead has become 0. Clear with this, guys? Next, go on to S2. How much is S2 department overheads? 8,000. Now apportion it between P1 and P2 in the ratio of 50:30. This is to be ignored. Why? We are using direct method, and under direct method, the services provided between the service department should not be considered. Clear with this, guys? So apportion this in the ratio of 50:30. Clear with this, guys? So here, what do we do here? 8,000 minus 8,000 we need to do should be apportioned the ratio of 50:30. 5:3. So 8,000 divided by 8 is equal to, you get 1,000 into 5 is equal to 5,000. 3 is equal to 3,000. So now at the end of this secondary distribution, what happens? S1 also becomes 0. S2 also becomes 0. And P1 and P2 will now get the share as well. So P1 value will be 7,000 plus 8,000 plus 5,000. How much is that going to be? 20,000 rupees. And how much is P2? 6,000 plus 10,000 plus 3,000. It is going to be 19,000 rupees. So at the end of secondary distribution, what has happened? The service department overheads, service departments have lost their identity and they have become 0, and whatever was the service department overheads have been redistributed back to the production departments. Are you guys clear with this? That was the objective of secondary distribution, and we have completely done it. So direct method is fairly simple. What you need to do, apportion your service department overheads between the production departments only. If there is a service between the service departments, ignore it and directly do it. Are you guys clear with this? As simple as that. Next one, sir. What is the next one? The next one is called as step ladder method. Now what have they asked? First apportion S1 department cost. Very simple. P1, P2, S1, S2. Clear with this, guys? So now what do we do? First apportion what? S1 department cost first. So first, sir, I'm going to apportion, right? S1 department. How much is S1 department cost? 18,000. You reduce it from S1. Right? Now it needs to be S1 provided services to whom? P1, P2 as well as S2. Correct? So it provides services to P1, P2 and S2. But before that, first you tell me, when will we use step ladder method? When there is only a give or a take. Correct? Or in other words, there is a one-way traffic. Only then we will be using step ladder method. Clear with this, guys? Now they have asked us to apportion S1 cost first, which means first S1, sir, I am reducing it. What will we do? So S1 should be apportioned between P1, P2, P3 in the ratio of 40:50:10. Clear with this, guys? Let's go and do it. Right? So 40:50:10. So 18,000 divided by, so 40 plus 50 plus 10, literally you get 100. So 18,000 divided by 100 is equal to 180 into 40 is equal to 7,200. 50 is equal to 9,000. 10 is equal to 1,800. Clear with this, guys? Now what has happened? S1 became 0. Now what happened to S2? S2 had its own share of 8,000 plus now it's got how much? 9,800 rupees. I mean 1,800 from S1. Now what do I do? Totally from S2, I need to apportion how much? 9,800 rupees. Guys, clear with this? Clear with this? Now I will reduce 9,800. Now, guys, understand this is very important. Now, S2, right? This is S2. Now, once again, actually seeing S2 provides services to P1, P2 as well as to S1. Guys, correct? But in stepladder method, what do? We follow stepladder only when, right, there is a give or a take. So S1 has already received from S2 has already received something from S1, so it cannot provide back to S1. Guys, correct? If you are following stepladder, so what we do, since we apportioned S1 department overheads first, now when we are redistributing S2 department overheads, we will ignore this 20%. Why, sir? Because S2 has received from S1. If you are following stepladder, you can only receive or give. Guys, correct? Since I have received, I will not give anything, so I will ignore this. So whatever is the share of S2 will now be redistributed back to P1 and P2 in the ratio of 5:3. Are you guys clear with this? Why do we do this? Because ideally speaking, guys, ideally speaking, this is a two-way traffic sum, but still they asked us to follow one-way traffic. Hence, first we apportion to S1, but S2 received from S1, so it can't give back anything to S1. That's why this 20% now we need to ignore. And whatever is the balance in S2 needs to be apportioned between P1 and P2 in the ratio of 5:3. Clear with this, guys? That's what we are going to do. So now here we have 9,800. It needs to be apportioned between P1 and P2 in the ratio of 5:3. So 9,800 divided by 8 is equal to, so 5 plus 3 is 8, 1225 into 5 is equal to 6125, 3 is equal to 9635. So now what happens at the end of S1, at the end of secondary distribution, S1 18 minus 18 0, S2 8000 plus 1800, right? So you get what? Totally 9800 minus 9800, so this becomes 0. So S1 and S2 becomes 0, and P1 gets a value of how much? 7000 plus 7200 plus 6125, you get 20,325. S2 6000 plus 9000 plus 3675, you get 18,675. This is the value of P2. Are you guys clear with this? So now we have P1 and P2 value only, which means at the end of secondary distribution, the service departments will lose their identity and all the costs are given to production departments. Now, the same question, now we will do it once again under stepladder method, but this time we will apportion S2 first. Clear with this, guys? Now what happens? P1, P2, S1, S2, the primary distribution summary is available. First, you distribute what? S2, right? So first we need to distribute S2 and then only we will distribute S1. So now first let us distribute S2. What will happen here? Sir, S2 we are going to distribute, right? Which means S2 provides services in what ratio? To P1, P2 as well as S1 in the ratio of 50:30:20. So right, so 5:3:2 is the ratio. Now what do I do? 8,000 rupees I have. Reduce this 8,000 and redistribute it to P1, P2 as well as S1 in the ratio of 5:3:2. Right? So how much you get here? 5 plus 3 plus 2 is 10. So 8,000 divided by 10 into 5 is equal to 4,000. 3 is equal to 2,400. 2 is equal to 1,600 rupees. Are you guys clear with this? So the S2's cost has been apportioned between P1, P2 and S1. Now I have to distribute S1's share of overheads. S1, how much is it going to be? 18,000, it had its own share. Plus now it has received 1,600 rupees, which means overall it would have received 19,600 rupees. So this 19,600 rupees needs to be apportioned. But since I have already received from S2, now I cannot give back anything to S2. Why? Because I'm following one-way traffic method, which is stepladder method. Hence what we do here, S1 now, so though it provides services to P1, P2 as well as S2, we ignore this because since we are following stepladder method, I can either give or take. I have already taken from S2, so I cannot give anything to S2. So whatever is the balance lying in S1 needs to be apportioned only between P1 and P2 in the ratio of 40 is to 50 or 4 is to 5. So now this 19,600 should be apportioned between P1 and P2 in the ratio of 4 is to 5. So 19,600. So 4 plus 5 is 9. So divided by 9 is equal to, you get something, 2177.7777 into 4 is equal to, you get 8,711, and 5 is equal to, you get 10,888.8888, or it's rounded off to 10,889. Clear with this, guys, right? And with that, S1 and S2 will be 0, and literally you will only get your P1 and P2 value. But remember, the answers will be different. So why our answers are different? Ideally, guys, this sum should not be solved under your step ladder method, only because this ideally is a two-way traffic. But a two-way traffic sum, we are solving it under a one-way traffic method. Hence, we had to take this particular assumption. First, if you apportion S1, what will happen? Because the second apportionment we are ignoring this S1 value. Here, if you are apportioning S2 first, right? Here we are actually, here we are ignoring S1's services provided to S2. Guys, correct? So that needs to be ignored. Whatever you are actually apportioning next, the last, that needs to be actually ignored for the purpose of calculation here. Clear with this, guys? All these things are happening here because a two-way traffic sum is being solved under one-way traffic. But here, ideally, I wanted to do a single sum that covers everything and show it to you how this works. Are you guys clear with this? And one more very important thing, it's called a step ladder because, can you see this step here? Right? As and when you apportion, look at this. Can you see the step? It forms a step as and when you keep apportioning, and that's the reason why this method is called as step ladder method. Now, let's go on to the third and the most important part of this particular question, which is reciprocal services method. Guys, what do you mean by reciprocal services method? Basically, when there is both a give and a take, reciprocity as they call it, right? You use reciprocal services method. Now, under reciprocal services method, you have repeated distribution, simultaneous equation, trial and error method. There are three different methods under reciprocal services method. In this question, is there a give and a take? Yes. Is there a one-way traffic, two-way traffic, or no traffic? There is a two-way traffic. So the correct method is going to be reciprocal services method. So reciprocal services method can be solved under either of these three methods, right? All the three methods will give you the correct answer only. Right, guys? Now let's go and solve this particular question under the first method of reciprocal services, which is called as repeated distribution method. Shall we go and solve it? Yes. Let's get started here. Let's get started. Repeated distribution method. How do we do it? Very simple, guys. P1, P2, S1, S2. Right? We have these things. Now, this is the question given. This is given in the question. Primary distribution summary is already given. 7,000, 6,000, 18,000, 8,000. These figures are all given in the question. Now, first, what do we do? Now, look at this. Sir, S1 provides services to P1, P2 and S2 in the ratio of 40 is to 50 is to 10. Correct? It provides services in the ratio of 40 is to 50 is to 10. Right. First, apportion the costs of all the cost of S1 department overhead should be apportioned, remove it and distribute it back to these three guys in the ratio of 40 is to 50 is to 10. Let's do that first. So first, what we need to do here, so this 18,000 we need to subtract and apportion in the ratio of 4 is to 5 is to 1. So 4 plus 5 plus 1 is going to be how much? 10. So 18,000 divided by 10 is going to be 1800 into 4 is equal to 7,200. Right? 5 is equal to 9,000 and 1 is equal to 1800. Clear with this, guys? I have distributed my entire amount of S1 department overheads. So literally 18,000 minus 18,000, S1 value becomes 0. Right? I have given my share to P1, P2 and P3. Clear with this, guys? Now let's go to S2. Now what happens with S2? Sir, S2 provides services to P1, P2 as well as S1 in the ratio of 50 is to 30 is to 20. Right? This is what happens here. So 5 is to 3 is to 2. Now what we need to do, S2 department, it had 8,000 plus now it has received 1,800. Overall it has how much? 9,800 rupees here. Clear with this, guys? So this 9,800 needs to be apportioned between P1, P2 as well as S1 in what ratio? In the ratio of 5 is to 3 is to 2. So 5 plus 3 plus 2 is 10. So 9800 divided by 10 gives you 980 into 5 is equal to 4900, 3 is equal to 2940, 2 is equal to 1960. So which means what happens at this point, what happens, S2, it had totally 9800, it gave away the entire 9800, S2 became 0. Now if you notice what happened, S1 was earlier 0, 18 minus 18, it was happy, but now once again it got a share of how much? 1960. Clear with this, guys, right? S1 was happy that it gave away all its cost to the other departments, but once again it has received back a share from S2. Why? Because there is both a give and a take, right? So S1 gave to S2 initially. Now S2 gave something back to S1. Clear with this, guys? Now S2 value is 0, but S1 got a share of how much? 1960. Are you guys clear with this? Now what do we need to do? Sir, we can't have this 1960. Once again, repeat the distribution. Right? Once again, sir, S1 now got a balance, redistributed once again to all the departments in the ratio of 4:5:1. That is your services rendered ratio. So once again, redistribute 1960 in the ratio of 4:5:7. This is why it's called as repeated distribution method. Clear with this, guys? So 1960 divided by 10 is equal to 196 into 4 is equal to 484, 784. 5 is equal to 980, 1 is equal to 196. So now what happened at this point? Now whatever I had with me, S2, S1, 1960, I redistributed back. Now I became 0. But what happened? Now once again, S2 got a share. S2 was 0. Now it got how much? 196 rupees. Guys, clear with this? Now what should I do? Sir, since S2 got 196, once again repeat the distribution back. S2 provides services once again to P1, P2 and S1 in what ratio? 5:3:2. So once again, apportion this 196 rupees back to each of the other three departments in the ratio of 5:3:2. So 196 divided by 10 is equal to 19.6 into 5 is equal to 98. 3 is equal to 58.8 rounded off to 59. 2 is equal to 39.2 rounded off to 39. Now what happened? S2 became 0, but S1 got a share of how much? 3.9 rupees, 39 rupees. Once again, this 39 rupees needs to be apportioned. So S1 provides services to P1, P2 as well as S2. Right? So in what ratio? 4:5:1. Go ahead, repeat the distribution. That's why the method is called as repeated distribution. You need to keep on doing it, right, till you arrive at a minimum value. It can never be 0 because there will always be a give and a take. So I will always, there is a loop here. S1 gives services to S2, it will receive something back. Once again, that you should give it back to S2. Once again, you will receive something back. It keeps on going till the amount is very small. Once it becomes small, then you can give all the amount to the production departments and close it. Now, in this case, 39 rupees, apportion it back in the ratio of 4:5:1. 4 plus 5:1 is going to be 10 rupees. So 39 divided by 10 is going to be 3.9 into 4 is equal to 15.6 rounded off to 16 rupees. 5 is equal to 19.5, right? They have kept it as 19 rupees, and then 1 is equal to 3.9. They have rounded off to 4 rupees. Clear with this, guys? So now finally S2 got a share of 4 rupees. Now what they did, so this 4 they subtracted and they are giving it to P1 and P2 equally. Meager amount. Or if you want to, once again, one more iteration you can do. S2, sir, it will also provide services in the ratio of 5:3:2. Once again, you do. If you do that literally, so 5 into 2 by 10, if you do, 0.8 is what you will get as S1's share. That anyways, you can give it off to the production department. Finally, if the amount is small, it can be apportioned between your production departments and you can close it off. Right? Are you guys clear with this? So should I do it equally? No, if you want, you can also apportion it in the ratio of 5:3 and close it off. This rounding off is not a problem. It will not take much of a difference. So finally, what happens in the last part, when the amount is minimum, we actually close it off between the production departments. We don't give anything a share because it is a meager amount. So now what happens? S1 and S2 become 0, right? If you notice here, 8,000 plus 1,800, so 9,800 minus 9,800, it became 0. But once again it got 196, and that 196 was apportioned back. Once again it got 4, and this 4 was apportioned back. Literally it is 0. Similarly here, 18,000 I gave 18,000, became 0. Once again I received a 1960 that I gave back. Right? It became 0. I received 39. Once again, I gave back 39. So literally, there was a give and a take, give and a take, give and a take, and we kept on doing this repeated distribution. So literally, in the process, P1 and P2 got getting something or the other. Guys, clear with this, guys? So now overall, if you see, P1's share of overheads was 20,000 rupees. P2's share of overheads was 19,000 rupees. S1 and S2 became 0. This is called as repeated distribution method. So ideally, the correct way of doing this particular sum with the two-way traffic is only reciprocal services method, and under the banner of reciprocal services method, the first method we saw is repeated distribution method. Simple. Keep on repeating the distribution till the service department overheads become minimum. Once it becomes minimum, apportion everything to your production department and close it off, round off. Clear with this, guys? Are you all able to understand this? So now P1 department share is 20,000, P2 department share is 19,000, S1 and S2 each are left with how much? Nil and nil. Are you guys clear with this? This is called as your repeated distribution method. The next method is called as simultaneous equation method. The next method is called as what? Simultaneous equation method. In my opinion, this is the best method to be followed because it saves a lot of time in your exam. Repeated distribution is also the correct. It gives the same answer only, but it takes a lot of time in your exam. Now, simultaneous equation method. How do you do this? First, it's a three-step approach. Step number 1, forming of equation. Now, guys, if you see, originally as per the secondary distribution, primary distribution summary, S1 department had a share of how much? 18,000 rupees, the S1 department overheads. S2 department overheads is how much? 8,000 rupees. Clear with this, guys? Right? Now, let us say S1 departments, let us keep it as X. S2 department, let us keep it as Y. Right? So, S1, let S1 be X and let S2 be equal to Y. This is for the purpose of framing an equation. Now, guys, think and answer. Can I say X, that is S1 department's total overheads, how much is it? Can I say it is going to be 18,000 rupees plus it will receive 20% of Y, that is S2 department overheads, guys, correct? Or S1 department's total overheads is going to be its own share 18,000 plus the share it's going to receive from Y, so 18,000 plus 0.2 Y. Guys, clear with this, right? So can I say here S1 is what? X is equal to 18,000 plus 0.2 of Y. Guys, agreeing with me? Because I have my own share plus I don't know, I will also be receiving 20% of Y. Okay, perfect. So then what is Y, sir? Y is equal to its own share 8,000 plus it will receive 10% of S1, so 0.1x. Guys, are you clear with this? So here literally, sir, what is S2 department? Y's overheads, how much is it? Sir, its own share 8,000 plus it receives 10% of S1 department overheads. Are you clear with this? So now for me to get the X value, I need to know the Y value. Okay, so how much is the Y value? For me to know the Y value, I need to know the X value, or in other words, it is a loop. That is why we kept on doing this repeated distribution. Now, instead of wasting the time, if we frame the equation and solve it, we will now be able to clearly arrive at how much is the X value, how much is the Y value. Directly, it can be apportioned. Sir, how to do that? I will tell you. Do not worry about it, right? So now, these two are the equations which you first need to form. So X is equal to 18,000 plus 0.2 Y. Y is equal to 8,000 plus 0.1 X. Are you guys clear with this? So the first step here is to frame the equation. X is equal to 18,000 plus 0.2 Y and Y is equal to 8,000 plus 0.1 X. Are you guys clear with this? Now, sir, how can I solve the equation, sir? Simple. This is the first equation. Let us take this as the first equation and let us take this as the second equation. Now, simple. X is equal to what? 18,000 plus 0.2 Y, correct? Right? And Y is equal to what? 8,000 plus 0.10 X. Guys, now instead of X, I will rewrite, sir, X is equal to anyway, sir, 18,000 plus 0.2 Y only, no, sir. So I will substitute the equation 1 in equation 2. If you want, you can also substitute equation 2 in equation 1. So equation 2 is what? Y is equal to 8,000 plus 0.1 X, right? Instead of X, I will know that X is equal to 18,000 plus 0.2y. So instead of x in the second equation, replace it with 18,000 plus 0.2y. So here, so the second equation will look like y is equal to 8,000 plus 0.1 of x, no, instead of x I will write it as 18,000 plus 0.2y. Are you guys clear with this? So now y is equal to 8,000 plus, so 0.1 into 18,000 becomes 1800, and 0.1 into 0.2, it becomes how much? 0.02y. Are you guys clear with this? So literally y is equal to 8,000 plus 1800 plus 0.02y. So the entire equation is written in terms of y. So now solve and arrive at the y value. So literally guys, 8,000 plus 1800 gives you 9,800, right? And y you have here 0.02y you have here. So 0.02, if it goes to the other side, it becomes minus 0.02. So y minus 0.02y, or 1 minus 0.02 becomes 0.98. So 0.98y is equal to 9,800, or y is equal to 9,800 divided by 0.98. You get how much? 10,000 rupees. So y is equal to 10,000. Clear? Now we got this value. Sir, what is this 10,000? Wait, I will tell you. Don't worry. Right? So y is equal to 10,000. Now, how much is x? X is equal to 18,000 plus 0.2 of y. Now, anyways, y value we got. So, x is equal to 18,000 plus 0.2 of 10,000. So, 0.2 of 10,000 is 2,000. So, x is equal to 18,000 plus 2,000, which is equal to 20,000 rupees. So, literally, we got y value 10,000, x value 20,000. Sir, with this, what should I do, sir? Now go to the last and the final step, apportionment. Step 1, forming the equation. Step 2, solving the equation. Step 3, now go to the apportionment sheet. Simple, guys. Now what do we do? P1, P2, S1, S2, primary distribution, summary, given figures. Now first, S1, you need to distribute, right? S1 provides services in the ratio of 4:5:1. Now here, how much is the S1 value? 18,000. You don't distribute 18,000. You distribute, what is the X value we found out? 20,000. That 20,000 you now need to distribute in the ratio of 4:5:1. How much is it? So 20,000, 4 plus 5 plus 1 is 10, divided by 10 is equal to 2,000, into 4 is equal to 10,000, 8,000. 5 is equal to 10,000, 1 is equal to 2,000. So you distribute this 20,000 rupees, right, between P1, P2 and S2. Clear with this, guys? Next, S2. Now, what is the S2 value? 10,000 rupees. Now, put this 10,000. Now, actually seeing 8,000 plus 2,000, exactly it is matching with 10,000, right? How? That's why by doing this equation, we predicted that, look, y is 10,000, means what? It has its own share of 8,000, plus it will be receiving 2,000 from x. We predicted. How? Mathematically we calculated with the equations. That is the y value. Clear with this, guys? So now we are going to distribute 10,000 and apportion to the ratio of 5:3:2. So that's nothing but 5,000, 3,000 and 2,000. Clear with this, guys? Now look at this. S1, it originally has how much? 18,000, plus it receives 2,000 rupees from S2 in future. Guys, correct? Now, this 2,000 rupees which it is going to receive from S2 in future was already predicted using these equations, and that's why initially itself we actually distributed how much, guys? 20,000 rupees. Are you all able to understand? So, overall, S1 we had to distribute 20,000. Why? It has its own share of 18, plus this equation, mathematically it predicted that it is going to receive 2,000 from S2. This way we calculated, and straight away one apportionment we actually distributed S1 and S2 and arrived at the P1 P2 value. Are you guys clear with this? How much is P1 and how much is P2? 20 and 19,000. This was the same answer we got under repeated distribution method, or in other words, guys, very simple. Here x is equal to 20,000, no, right? What is this 20,000, sir? I will tell you. This 20,000 is nothing but very simple. Look at this, or let me just take y. Y is equal to how much? 10,000. This 10,000 is nothing but, look at this, the sum total of all the repeated distributions here. S2, 9,800 plus 194 plus 4. I did 3 distributions, right? Right? So 9,800 plus 196 plus 4. How much is it coming out to? 10,000 rupees. So totally Look, first I distributed 9,800, I received back something. Once again, that 196 I redistributed. Once again, I received 4. That 4 rupees I redistributed back again. Guys, clear with this? So whatever I'm going to redistribute it, get back, and once again redistribute and get back. All these things were predicted through this equation, and directly it said, look, you have 8,000 plus totally you are going to get 2,000 from your S1. So overall, you need to distribute 10,000. Directly you distribute. Similarly, X value is 20,000. How did you get this 20,000? Look at this. Look at this. 18,000 first we distributed, right? Then we distributed 1960. Then we distributed 39. Add up. 18,000 plus 1960 plus 39. How much you get? 19,999. This 1 rupee round off for that was there. Actually, this is 20,000. Or in other words, this equation, simultaneous equation method predicted, look, S1, I know you have 18,000 rupees as your share, but in future you will be receiving something from S2 also. I am factoring everything in no account and clearly telling you, look, totally 20,000 is the amount you are going to apportion as a whole. Right now itself you distribute it in a single line item. Are you guys clear with this? So what is going to be the total amount that I have to redistribute is what we calculate with the equations, and a single shot we actually go ahead and do the apportionment. Are you guys clear with this? And that is exactly what your simultaneous equation method does for you. Clear with this, guys? Answer is going to be exactly the same. Clear with this, guys? So that is all about it, right? Now this trial and error method is actually one mocha method, right? It is not a very great method and all. Why? Because this is nothing but a mixture of your repeated distribution method and your simultaneous equation method. I will tell you what they do. Trial and error method, what they do? They do the repeated distribution only on what they do. They carry out the repeated distribution on your service departments. What are the service department? S1, S2. Now you guys tell me, what is the share? S1 has a share of 18,000. S2 has a share of how much? 8,000. Correct? Now look at this. S1 provides services to S2. How much? 10%. S2 provides services how much? 20%. Guys, correct? So look at this. We know here. So between S1 and S2, S1 provides 10% of its services to S2. S2 provides 20% of its services to S1. Right? Now what we did? First, now S1, right? What is the share of service that S1 provides to S2? So 10% on 18,000. So S2 will get how much? 1,800 rupees. Or in other words, overall, literally, I will reduce 18,000 here in S1, right? And I will give S2 a share of how much? 1,800. Balance I will give to P1, P2, P1, P2. Yeah, that I am not bothered here. In trial and error, I am only capturing S1 and S2 first. Clear with this, guys? So I actually apportion 18,000, and how much S2 will get a share? 1,800. Now S2 would have got how much? 8,000 plus 1,800, 9,800. Out of this 9,800, 20% once again goes to S1. So 9,800 into 0.2. How much is it? 1960. So now S1 gets how much? 1960. Now once again, out of this 1960, what happens? S1 will give 10% to S2. Guys, so 10% of 1960 is 196. Are you all clear with this? So now once again, what happens? This 1960 gets reduced, right? And out of this 10% goes to S2. Here also S1 we had 9,800. We reduce it. Clear with this, guys? So out of this 20% we gave to S1. Now S1 got 1960. Out of this, the entire amount we reduce, apportion it to P1, P2 and S2, right? But S2 share alone we are capturing. P1, P2 we separately do it, right? How much is the share? 196. Now once again, 196 who has received? S2 has received. Now out of this 196, so 20% they will give it to whom? They will give it to S1. So S1 gets how much? 39.2 rupees roughly here. I mean, it's not roughly, it's not approximate, it is the correct figure, right? So 196 gets removed and S1 gets a share of 39.2. Now once again, what happens? 10% of this 39.2 I remove. 10% of that, what happens? I receive back. S2 receives back from whom? S2 receives this back from your S1. Guys, clear with this? And once again, on this 3.92, what happens? 20% I provide. So roughly it's 0.784. So roughly it's around 0.8. Clear with this, guys? And here you round off and give back the remaining to your production departments. Or in other words, overall, if you notice, what is the sum total that you need to redistribute S1? 18,000 plus 1960 plus 39.2 plus 0.8. If you add, overall you will get how much? 20,000 rupees. Clear with this, guys? How about S2? 8,000 plus 1800 plus 196 plus 3.92 plus 0.08. Literally you get how much? 10,000. So here, using repeated distribution, they first calculate how much is the amount of S1 and S2, right? So calculating the amount of S1 and S2, it is like X and Y value. This is a concept actually similar to your simultaneous equation method, but the manner of calculating S1, S2 is through repeated distribution method. Are you guys clear with this? Right here, first they calculate what? Under repeated distribution method, they calculate the S1 and S2 value. Guys, clear with this? And having found this, they apportion it and they'll say, okay, sir, finally I now found out S1, though it has 18,000. Right? It will give and take, give and take, give and take. Finally, S1 has a share of 20,000 rupees, sir. Right? And S2 has a share of how much? 10,000. This is what we calculate there. X is 20,000. Y is 10,000. This is nothing but S1 and S2 value. Here we used mathematical equation, algebra to calculate. Here they are using repeated distribution to calculate the X and Y value. And once they calculate, now they apportion it. Clear with this, guys? What do they do? Simple. P1 and P2 has how much? 7,000 and 6,000. Guys, clear with this, guys? Right? Now, what happens here? Now, how much is S1 value? 20,000. Now, out of this 20,000, right? Literally, 10% will be given to S2. Only the 90% component will go to the production departments. Guys, correct with this? So, the 90% of the 20,000 is apportioned in the ratio of 4:5. Where did you get this 4:5? This 4:5 is the services rendered ratio here. Are you guys clear with this? This is one roundabout method. Guys, instead of this time waste method, look, you did all these things, right? In your trial and error method, while doing this under repeated distribution, you could have added two more columns, P1, P2. Whenever you are distributing, calculate parallelly P1, P2 value also. By the end here itself, you would have got P1 value, P2 value. But they are saying they will do the repeated distribution only on S1, S2, arrive at the S1, S2 value, then they will do the apportionment. It is one waste method. Literally, it's one waste method, right? But anyways, in exam, my preference, I would tell you, please follow simultaneous equation method if the question is silent, because two-way traffic, any of the three methods under your reciprocal services can be used. In my opinion, I would suggest you to use your simultaneous equation if the question is silent. So literally, how much is this? 90% of 20,000. So 20,000 into 0.9 is 18,000, right? In the ratio of 4:5. So how much does that come out to? So 4 plus 5 is 9. So divided by 9 is equal to 2,000 into 4 is equal to 8,000. 5 is equal to 10,000. You get this. Similarly, S2. Sir, 10,000 rupees is the value of S2. Out of this, so 20% I will give to S1, which means the remaining 80% is only available for my P1 plus P2. So, which means 80% of 10,000 is 8,000. This 8,000 should be apportioned in what ratio? In the ratio of 5:3. Look at this, the ratio of 5:3. Clear with this, guys? So 8,000 in the ratio of 5:3 is how much? 5,000, 3,000. So 5,000, 3,000. You add up. So P1 share is 7,000 plus 8,000 plus 5,000. It's 20,000. P2 share is 6,000 plus 10,000 plus 3,000. It's going to be 19,000. So literally P1 and P2 gets a share of 20 and 19. That is exactly what we calculated under the previous method, 20 and 19, which is going to be what? Your simultaneous equation. And once again, the same is the answer under your repeated distribution method also. Guys, clear with this? So under the three different models of your secondary distribution method, right, you only get the same answer. Are you guys clear with this? So with this single question, we have covered all the different methods of secondary distribution, and that's about the area of your secondary distribution. So please go and update your library of adjustments. Write down, please write down secondary distribution hyphen all methods. Secondary distribution hyphen all methods. Now let's move on to the next and the last part of our overhead accounting process, which is called as absorption. Now here, what do we do? Now, on one side, we have all the production department overheads, P1, P2, P3, right? And on the other side, we have all the products. In our example, it was menswear, ladies wear, kids wear, and footwear, right? I'm just going back to the example which I had given you. So, at the end of secondary distribution, I have all the production department overheads. Using a procedure called absorption, I need to convert these bulk figures into overhead cost per unit of menswear, overhead cost per unit of ladies wear, overhead cost per unit of kids wear, and overhead cost per unit of footwear. Clear with this, guys? How am I going to do this is what we are going to see in this particular third phase called as absorption. Now, guys, let me just take a different example, right? A numerical example with figures. Now, let us say at the end of secondary distribution, this was the figure which I had, that is secondary distribution summary. So line item of expenses got distributed to all departments, primary distribution. Then the service department overheads got reapportioned back to my production department, secondary distribution. Now at the end of secondary distribution, I got, sir, P1 department overhead was, let us say 20,000, and P2 department overheads was, let us say 15,000 rupees. Now, in my P1 department, what is the total share of P1 department's overheads? 20,000. P2 department overheads, what is the total share of your overheads? It was 15,000 rupees. Now, let us say I noticed that the total labor hours spent in department P1 was 5,000 labor hours. And let us say in department P2, I spent a total of 3,000 labor hours, right? Now, can I say, right, sir, for every hour spent in department P1, what is my overhead cost? 20,000 divided by 5,000. How much is it? It is going to be rupees 4 per hour. And here it was 15,000 department P2 divided by 3,000. It was rupees 5 per hour. Clear with this, guys? Sir, how can we do like this, sir? Simple. Now, guys, in department P1, I noticed that overall 20,000 rupees is the cost incurred in overhead cost incurred in department P2. I also noticed, sir, department P1, I'm talking about department P1, 20,000 rupees the cost incurred in department P1, and 5,000 hours were actually spent in department P1, right? Now, somewhere I have to use some reasonable basis to actually apportion these P1, P2 costs to my and arrive at my overhead cost per unit. So now first I identify labor hour as the base, because as we saw here, now look at this, we have P1, P2, P3, or in other words, we have production department overheads. These are bulk figures which needs to be converted into overhead cost per unit of the products I deal in. Now, for me to bridge this gap, I need to use some basis to actually convert these bulk figures into per unit figures, right? Now, let us say this particular company feels that labor hours, let us say they are labor centric, they are more driven by labor hours. So manual labor is more that drives the overhead cost for this company. They find labor hours as the basis for incurring your overheads. So they are saying, sir, in department P1, I incurred 20,000 rupees, and totally in department P1, 5,000 hours were spent, which means for every hour spent, I should apportion, or I should give a share of 4 rupees as overheads, which means for every hour spent, 4 rupees is the overhead cost which is charged. Guys, clear with this? Now, sir, exactly, sir. Every hour 4 rupees is only incurred. It's not like that. But I'm using some basis to arrive and express overhead per something. Clear with this, guys? When you are expressing overhead per something, it is called as absorption rate. Are you all able to understand? So absorption rate means what? Expressing your overhead per something, it is called as absorption rate. Now in this question we used labor hours as the base, or as the base quantity as we call it. Now please understand. Overall, sir, can I only use labor hours? No, there are 6 different base quantities that can be used as your basis for absorption rate, right? What are they? We will be seeing it in a few minutes from now. But as of now, you just understand. Labor hours was one example I took. It could be machine hours, or you can even take material cost, labor cost, prime cost, or you can take units. There are 6 methods. What are they? We will be seeing it, in a few minutes from now. But first of all, this company identified labor hours as the basis, or the base quantity for apportionment of overheads. And P1 department, they are saying, sir, for every hour a product spends in P1, I will give it a share of 4 rupees. For every hour a product spends in P2 department, I will give it a share of 5 rupees. Clear with this, guys? Now, what we do here is, now let us say I manufacture 2 products, A and B. Now, every unit of A passes through both P1 and P2. Let us say every unit of A spends 3 hours in department P1 and 2 hours in department P2. Clear with this, guys? Now, what will I do? Sir, product A, it spends 3 hours in department P1. Every hour spent in P1 will be given a share of how much? 4 rupees. Guys, correct? So I will give it a share of 4 rupees, and every hour spent in P2 will be given a share of how much? 5 rupees. So which means product A, what is the overhead here? P1 overhead is 3 into 4, which is 12 rupees. P2 overhead is 2 into 5, which is 10 rupees. Or in other words, overall, the overhead cost per unit of product A is going to be 12 plus 10, which is going to be 22 rupees. Now, how about product B? Sir, every unit of product B, this also passes through both the departments P1 and P2. But let us say it spends 2 hours in P1, 3 hours in P2. Simple. Every hour spent in P1 will be given a share of 4 rupees. Every hour spent in P2 will be given a share of how much? 5 rupees. So it's going to be 8 here, 2 into 4, and here it's going to be 3 into 5, which is going to be 15 rupees. Overall, your product B will be given a share of how much? 23 rupees is the overhead cost per unit. Are you guys clear with this? So now what we did, we took labor hours as the basis. Step number 1, we calculated the absorption rate. Guys, are you clear with this? Now we calculated the absorption rate and found out, right? So overall, production department P1 overheads is 4 rupees per hour. P2 department is 5 rupees per hour. Step 1, we calculated absorption rate. Step 2 was charging of overheads to products. Now, product wise, I knew how many hours they spent, every unit of product, how many hours they spent in the respective department. I charged it with the respective absorption rate, and this way I calculated the overhead cost per unit of A. With this, the objective of this chapter has been achieved. Guys, are you all clear with this? So now what we did, the bulk figures now got converted into overhead cost per unit. Clear with this, guys? And with this, the objective of this chapter is to calculate overhead cost per unit. So I calculated the overhead cost per unit of A, overhead cost per unit of B. Like if suppose they have 4 products, menswear, ladies wear, kids wear, footwear. For each of the 4 products, we would have calculated. Are you guys clear with this? And that's about this particular process of absorption, which is the third phase here. So please understand here, in this case, what we do, absorption is a 2-step procedure. Step number 1, calculating the absorption rate. Step number 2, charging of overheads to the products. How do you charge it? Sir, product A spent 3 hours in P1, 2 hours in P2. So 3 into 4 plus 2 into 5. Overall, I get the share of overhead cost per unit of the respective products. Are you guys clear with this? As simple as that. Beyond that, there is nothing great here. Now, sir, why did we use labor hours here as the basis? If you notice, this figure was readily available both in bulk total as well as it was also readily available on a per unit level. Now, in absorption, what was our objective? We had to convert these bulk figures into overhead cost per unit. Now, we used it using a particular bridge, right, which was readily available both in bulk as well as on a per unit level. In this case, labor hours was readily available both in total as well as on a per unit level. We use that as a base to charge the overheads, the product. So in this case, labor hours was used as a base to charge your overheads, the products. Are you guys clear with this? So now the labor hours only, sir, is labor hours the only base that can be used? No, there are overall 6 different base quantities that can be used for absorption of overheads. What are they? I'll be telling you in a few minutes from now, but understand this is the third step of overhead procedure, which is going to be your absorption, wherein first, step 1, you calculate the absorption rate, and step 2, you charge the overheads, the products. This is what I have clearly explained in our concept decoder. Absorption of overheads. Absorption is the last step in overhead accounting and is the process through which overheads in the production department is given to the products produced. I've neatly condensed and put it here. Now look at this. The absorption process has 2 steps. Step number 1, calculation of absorption rate. What is this? Overheads divided by base quantity. And step number 2, charging of overheads to products. What is that? Absorption rate into the base quantity consumed by the respective product. Simple. Absorption rate into the base quantity consumed. So product A spends 3 hours in department P1 and every hour should be charged with an overhead cost of 4 rupees. So 3 into 4, 12. Here it's going to be absorption rate is 5 rupees and every unit spends 2 hours in department P2. So 2 into 5 is going to be 10 rupees. Guys, are you all clear with this? So here step number 1, calculation of absorption rate. Step number 2, charging of overheads to products, which is nothing but absorption rate into your base quantity consumed for this particular product. Instead of labor hours, it could also be machine hours. In that case, overall, sir, what do I have? So your departmental overheads divided by your base quantity, machine hours, you will arrive at the absorption rate per machine hour. Guys, clear with this? And then you will absorb it accordingly to the product. So product wise, how many machine hours I spend in the respective departments, based on that you apportion it. Are you guys clear with this? And that's about the concept of absorption. Are you all able to understand? Yes. Now clearly, guys, product A, let us take. Now product A's full manufacturing cost is what? Material, labor, direct expenses, and the production overheads. Now the first 3 are prime cost components readily available on a per unit level. They are waiting with the figures. Now to this, if I add this 22 rupees, I will be able to get my full manufacturing cost. And once I get my manufacturing cost, now with this I can properly value every unit of my stock and apportion my total manufacturing cost into cost of goods sold and closing stock. With this I can achieve the overall objective of stock valuation and profit computation. Similar thing goes for product B also. So product wise, you will be able to arrive at your stock valuation and all, and overall you will be able to compute what is the profit for the company. Are you guys able to understand? This is the third step of your overhead accounting, which is called as absorption. Are you all able to understand? Yes. Now one very important thing that I want to tell you here, this overhead absorbed, right, this figure that we saw, this is the figure. Absorbed overheads is actually the figure that ideally appears in your cost sheet. So this is what I have kept in this particular segment called as doubt busters. It should be noted that production overhead absorbed and not the production overheads incurred is considered while preparing the cost sheet. Clear with this, guys? So the overhead absorbed, is only considered in your cost sheet. More details about that we will be seeing in the next segment of discussion, wherein I will be talking about your predetermined rate, actual rate, and all. What is that? We'll be seeing quickly. We will recapitulating that. Clear with this, guys? With that, we have completed the third step of the overhead accounting process, which is called as absorption. So 3 steps in your overhead accounting process. What are they? Step number 1. This is going to be your step number 1, which is your primary distribution. Line items of all your indirect manufacturing costs are apportioned between all the departments. Then step number 2, secondary distribution, where the service department overheads are redistributed back to the production departments. And step number 3, your production department overheads are apportioned to all the products. We calculate the overhead cost per unit by using a base quantity, which can be any of the 6 base quantities which we are going to see. Clear with this, guys? It's a 2-step procedure. The last step is called as absorption. We have a 2-step procedure. What are they? Step number 1, calculate the absorption rate. Absorption rate, how will you calculate your overheads, departmental overheads divided by the base quantity, right? Where you get the absorption rate, and step number 2, your absorption rate into base quantity consumed. So this way you charge it to the products and you arrive at the overhead cost per unit of the product. Now for each of the products, the prime cost components are readily available. To this you add your overhead cost per unit, you will arrive at the full manufacturing cost, and with that you are achieving the objective, the first objective, which is going to be what? It is going to be the first objective of this entire subject, which is stock valuation and profit computation. As simple as that. Clear with this, guys? Right? Now, technically speaking, procedural aspect, this is about it. But now when it comes to absorption, there are some advanced level, there are some advanced concepts with respect to absorption. What are they is what we are going to see here. This is where the concept of absorption costing comes into picture, which is very, very important and critical from an examination perspective, as well as this forms as one of the backbone for this entire subject. Right? Now, before that, first I told you this base quantity in our question, we took it as labor hours in this example. Now, can we only take labor hours? I told you, instead there are 6 different base quantities which can be used for the purpose of absorption. What are they? We will clearly go and see this in our concept decoder book. Now look at this. 6 different base quantities that can be used. Labor hours, machine hours, material cost, labor cost, prime cost, production units. Now what I will do is, I will put a bracket here, labor hour, machine hour. These two are hours. Material cost, labor cost, prime cost, these 3 are figures, rupees, and production units, it is in units. Now guys, what is it? Labor hour rate. How will you calculate the absorption rate? Very simple. So just now we saw overheads, right, divided by labor hours. You will arrive at what? The absorption rate. 5 rupees per labor hour is what you will get. Guys, clear with this? Right? Next, sir, instead of labor hours, I want to use machine hours. Yes. Who will use? Maybe if a particular company is heavily mechanized, they have advanced level of production where they use robotics and all. Sir, manual labor is less. Significant portion of my overheads is actually driven by my, by your machine hours, sir. Right? In that case, I use machine hour as the appropriate base quantity for charging overheads to products. In that case, how will I calculate my absorption rate? Overheads divided by machine hours. I arrive at the absorption rate per machine hour, 5 rupees per machine hour, or so on. Right? Let us say every product spends, let us say product A spends 3 hours in my department. So 3 into 5, 15 rupees will be the overheads I will charge. Are you all clear with this? So in this case, how will you charge your overheads here? Simple. So first you will arrive at the absorption rate per machine hour. Right? And this needs to be charged to the overheads. So to the particular charge the products by using the appropriate base quantity, which is the machine hour. So if a particular product spends 10 hours in my department, 10 machine hours, so what I will do, for each of the 10 hours, I will charge it with my absorption rate. Are you guys clear with this? Exactly the same. What we saw here, exactly the same. Instead of labor hours, you can use machine hours. Right? Basically, guys, only one thing. Whatever you use as the base quantity should be available both in total as well as on a per unit level. If it is available, it can bridge the gap of converting these bulk figures into per unit figures. As simple as that. That is the logic. Next one, guys. Next one. Now, material cost, labor cost, prime cost. What is this? You can also calculate the absorption rate as a percentage of material cost. In this case, what will you do? Simple. How will you calculate this overheads? It's going to be overheads divided by material cost. Now, how do we do it, sir? For example, let us say it is just an example which I am giving you, right? Let us say in P1 department, right? Now, I'm just giving you guys an example of one department, P1 department. Let us say the secondary distribution summary, or in other words, the overheads, right? I'll put it as overheads here. Overheads of this department was 20,000 rupees. Right? And let us say, sir, in this department overall, sir, the cost is significantly driven by material cost. Example, I'm telling you. So the overall material cost spent in this particular department is, let us say, 10,000 rupees. Clear with this, guys? Now, I want to use material cost as the basis for apportionment of this particular overheads. Now, what will I do? I will calculate the absorption rate. Absorption rate is overheads divided by material cost. Now, the numerator is in 100, the denominator is also in, the numerator is in rupees, the denominator is also in rupees. Guys, correct? So when you use the same expression, the numerator and denominator, then you will express it as a percentage. So I will say, sir, overheads is 20,000 when my material cost is 10,000. So which means the absorption rate is 20,000 divided by 10,000 into 100. So I will say, sir, overheads is going to be 200% of my material cost. Are you guys clear with this? This is how I express my absorption rate. How much is it going to be? 200% of my material cost. Now let us say I have a product A. Now product A, the direct material cost per unit of product A is, let us say, 6 rupees, which means the production overheads, right, of department P1 share is going to be 200% of material cost, which means for this product A, what is the material cost? 6 rupees, sir. So its share of overheads is going to be 200% of 6, which is going to be 12 rupees. Are you clear with this? Or in other words, literally here, the bridging factor, the base quantity that I used was material cost. This figure is readily available in total as well as available on a per unit level. So using this, I expressed the absorption rate, and I found out absorption rate is generally, sir, P1 department overhead is 200% of the material cost, which means what will I do? Right, I arrive at the absorption rate. So product wise, how much ever is the material cost, apply 200% of that. That is going to be the product wise share of overheads. As simple as that. Are you all clear with this? And this is how we need to calculate. Clear with this, guys? Since both the numerator and the denominator are in rupees, we express this as a percentage. Look at this. So material cost rate, how will we calculate? My overheads divided by material cost into 100. So the expression is percentage of direct material cost. No, sir. Suppose my company is labor driven, right? In that case, I want to use labor cost as the basis. Perfect. What will be the formula? Overheads divided by labor cost into 100. So you will say absorption rate is 200% or 100% or 150%, whatever it is, of your direct labor cost. On a per unit level, you have the direct labor cost also. On that, you apply this percentage, you will charge the overheads to products. Are you guys clear with this? Or, sir, I want to use both material plus labor as the base quantity. Why? Because my overheads is driven by both material and labor. If you add that, you get prime cost. You can also use prime cost as a base quantity. In that case, how will it look like? Overheads divided by prime cost into 100, and you will arrive at the absorption rate, which is expressed as a percentage of your prime cost. Clear with this, guys? So literally, these three are expressed as a percentage of rupees. Are you clear with? Are you guys clear with this? Are expressed as a percentage of material, labor, or prime cost. Reason being that you use the same unit of measure, which is being rupees, in both the numerator and denominator. As simple as that. And finally, you can also use production units method, which means what? Sir, I don't want all these things. Units itself is the base quantity. Perfect. You can use simple instead of this. Let us say in department P1, the total overheads is 20,000 rupees. 20,000 rupees. Let us say the total units that I manufacture in department P1 is going to be, for example, I am telling you, for example, let us say it's going to be 2,000 units. Which means per unit, how much is going to be my absorption rate? So 20,000 divided by 2,000. So 10 rupees per unit is going to be my absorption rate. So every unit that passes through my department, I will charge it with an overhead cost of 10 rupees. So here directly the absorption rate is expressed as per unit. Are you clear with this? As simple as that. So there are 6 different base quantities that can be used for your absorption purpose. What are they? The first 2 are in hours, machine hour and your labor hour, machine hour rate. Then 3 rupees, what are they? Material cost, percentage of material cost or labor cost or prime cost. And finally you have production units method. Are you guys clear with this? With this, you can actually perform your absorption. You can perform the third step, which is your absorption. So there are 2 steps inside this absorption. What are they? Step number 1, calculating of absorption rate. Step number 2, charging the overheads to products. And as simple as that. Clear with this, guys? Now on this note, let us go and do one numerical problem, right? So in your CA Inter solved question bank, so please take question number 7. Please take question number 7. See, for marathon purpose, I'm selectively picking and doing only a few sums which are kind of comprehensive, or maybe which represents the concepts, right? I think it's 1 second. Sorry, question number 6. Question number 6. Right. So please take question number 6. So in our regular and exam oriented batches, we do all the questions. So here we are doing some selective questions just for the sake of revision. I take some good questions which cover the concepts predominantly, right? Now look at this. AC Limited is a small company that undertakes a variety of jobs for its customers, right? And the budgeted P&L statement for the year ended 31st of December is as follows. Sales figure is given. Cost, material, wages, subtotal, prime cost, fixed production overheads, you add it, you get your production cost. Then if you add your selling, distribution and admin, you get your total cost. Sales minus total cost gives you your profit. Now budgeted data is available. Labor hours for the year, machine hours for the year, number of jobs. Basically, it could be a unit or a job costing. Basically, it's number of units or jobs, 300 units or 300 jobs. An inquiry has been received and the production department has produced the estimates of the prime cost involved and of the hours required to complete one particular job, A57. Right? So now what are they asking? Now guys, now this is the total data, right? And for one job, they are giving this data. For this particular job, how much is the material, direct wages, subtotal, prime cost, and for this job, how much is the labor hour required, machine hour required, and all is given. Step number 1, you are required to A, calculate by the different methods 6 overhead absorption rates. What are the 6 methods or 6 base quantities we have? So labor hour, machine hour, then percentage of material cost, labor cost, prime cost, and production units method, right? And number 2, B, calculate the cost estimate for this job A57 using in turn each of the 6 overhead absorption rates which we computed in A. So first one guys, what we need to do here is that we need to compute this absorption rate. Now first method is what? Labor hour rate. What is that? Overheads divided by labor hour. Now what they have, so the total data is available, sir. What is the total overheads here? Total overheads is 3 lakh rupees. Now I want to calculate, sir, how much is the overhead attributable to the single job? Now I want to convert a bulk figure into a per unit figure or a per job figure. How will I do that? Using this absorption only, right? Now how do I do that? How do I do that? Now using any of the 6 different absorption rates. Now in this particular question, so the first thing we need to do is what? In all the cases, the overheads amount is going to be 3 lakhs. Now what is the first method? So it is going to be labor hour rate. So how will you calculate the absorption rate? So 3 lakh divided by 25,000 hours, I get the absorption rate expressed per labor hour. So how much is this? 3 lakh divided by 25,000. So 3 lakh divided by 25,000, how much you get divided by 25,000? You get 12 rupees per direct labor hour. So if I use labor hour as the base quantity, the absorption rate is 12 rupees per labor hour. Okay, if you are using machine hour as the base quantity, so divide 3 lakh with 15,000 machine hours. So 3 lakh divided by 15,000 machine hours, I get how much? 20 rupees per machine hour. Clear with this guys? Now a company can follow any one of these 6 methods at a time. Clear with this guys? I can't use everything, right? But this is like your different methods of depreciation. It's an accounting policy. Here it's a cost accounting policy, right? So you can't use SLM and WDV. You can either use SLM or WDV. Clear with this guys? Similarly here, you can either use labor hours or you can use machine hours or you can use material cost as a basis or whatever it is, any of the 6 base quantities. Next, sir, if I want to use my direct materials as the base quantity, then it's going to be 3 lakh divided by 1 lakh into 100. Clear with this guys? So production overheads divided by direct material cost into 100, 3 lakh by 1 lakh into 100, which is going to be overheads is going to be 300% of my direct labor cost. This is how we compute it. Yes, 300% of direct labor cost. The next one, labor cost. How much is that going to be? Now, if I'm going to use labor cost as the basis, so 3 lakh divided by 50,000 into 100. How much is that? 3 lakh by 50,000 into 100 is 600% of labor cost. Clear with this guys? Or if you want to use prime cost as the base quantity, 3 lakh divided by 1 lakh 50 into 100, I will say overhead, sir, is 200% of my prime cost. Look at this, 200% of prime cost. Or directly, if you want to use production units method, your overall production overheads divided by the total number of units. Here it's not units, it's jobs. So 3 lakh divided by 300, sir, per job, how much is it going to be? 1 lakh rupees per job. Are you guys clear with this? 1 lakh rupees per job is going to be your absorption rate. So using the 6 different base quantities, now we have computed what? The 6 different absorption rates. Any one only the company can follow. Now what have they asked? Sir, for this particular job, A57, I have given how much is the material, how much the wages. Prime cost components are readily available. To this, if you add the particular job's share of overheads, you will arrive at the total cost of this job. Guys, clear with this? Now they are asking us to calculate what the total cost estimate for this job using each of the 6 different rates calculated above. Right? Now how do we do it? So simple. First one, guys. So charging of overheads to this job, right, and calculating the total cost of this particular job A57. Now, whether I use labor hour rate or machine hour rate or material cost, labor cost, prime cost or production units method, it is not going to change my prime cost component. So how much is my direct material? 250. How much my direct wages? 200. So total prime cost is 250 plus 200, 450 rupees. So now this 450 rupees will not be changing. Why? Because all these 6 different base quantities are used only on my indirect manufacturing cost, namely my overheads. So my overheads calculation will never impact my prime cost components. Clear with this, guys? Now only my production overheads figure will change. Now first, if I use labor hour as the base quantity, right? Now in that case, what is the absorption rate? Sir, for every labor hour you should charge the product with you should charge it with 12 rupees. Now this particular job use how many labor hours? 80 labor hours. So the overheads for this particular job is going to be 80 labor hours into 12 rupees. So 80 into 12, it's going to be how much? 960 rupees is the cost, overheads cost for this particular job. So 960 plus 450, how much you get? 1410. Are you guys clear with this? So here I get what? 960 rupees. Clear with this, guys? Next one. Machine hour rate if I use. Now in this case, what is the absorption rate? 20 rupees per machine hour, and this job use how many machine hours? 50 machine hours. So here it's going to be, so absorption rate 20 into the actual base quantity consumed, which is 50 hours. So it's going to be 50 into 20 is 1000. So 1000 plus 450. Overall, if I use machine hours as the base quantity, the total cost of this job is going to be how much? 1450. Clear with this, guys? Next, sir, no sir, I'm using material cost as the basis, percentage of material cost. How much is my absorption rate? 300 percentage of the material cost. Sir, for this job, how much is going to be the material cost, sir? 250 rupees. Guys, correct? So 250 into 300% is 3 times of 250. So now the overheads for this particular job in this case is going to be how much? 750 rupees. So what will be the total cost? Prime cost 450 plus 750 of production overheads. It comes out to 1200 rupees. Are you guys clear with this? Next one. Sir, I am going to use labor hour as the base quantity. I mean labor cost, percentage of labor cost as a base quantity. How much is it? 600 percentage of my direct labor cost. How much my direct labor cost? 200 rupees. So 200 into 600 percentage, that is 6 times of 200, is going to give me how much? 1200 rupees. Are you guys clear with this? So in this case, it's going to be how much? 1200 rupees. So 450 plus 1200. 450 plus 1200, you get how much? You get 1650 as the total cost of this particular job. Suppose I am using 200 percentage of prime cost as a base quantity. So the absorption rate is 200 percentage of prime cost. Simple. What is the prime cost for this product? 450. So 450 into 200 percentage, that is absorption rate into base quantity, right? So 450 into 200 percentage, it's 900, and 450 prime cost plus my production overheads of 900 gives me how much? 1350. Are you all clear with this, guys? And finally, you get your production units method. So now in this case, directly, how much is that going to be? Sir, per job, 1000 rupees the cost. Directly, this is for one job only we are calculating. So 1000 into 1 is going to be 1000. So 450 plus 1000, you get how much? 1450. Are you guys clear with this? Right? So now, depending on what method you use as the base quantity, it affects the total cost of this particular job. Guys, are you clear with this? So you have to be very, very careful while picking the method. You need to provide the justification. Randomly you can't use methods. I'm talking about real life. So companies need to disclose this in their cost audit report as to why they are using a particular method of absorption and doing it. For example, if I'm using machine hours, I need to justify, sir, I am a company which uses a lot of machines and I have a lot of mechanization, automation that happens. Manual intervention is less. Hence, for me, it makes sense to use machine hours. Like this, they need to give a justification because the selection of method will affect the cost of the product. Are you guys clear with this? Hence, look at this. If I use labor hour as the basis, it's 1410. If I use labor cost as the basis, it's 1650. If I use prime cost as the basis, it's going to be 1350. So randomly, all these costs are changing. But remember, the costs will change not because of the prime cost. It remains same. But purely because of what? It changes purely because of production overheads, which is actually calculated depending on the method of your choice. Are you guys clear with this? Hence, it needs to be clearly disclosed on the face of your cost sheet. I mean, on the face of your cost audit report. Are you guys clear with this? Yes. And with this, literally, we have also completed the 6 different types or the 6 different types of base quantities. So please just go and update your library of adjustments. Write down 6 types of absorption rates. 6 types of absorption rate. So in our regular and in our exam oriented batches, I'll actually be doing an even more in-depth explanation and also solving more number of sums. Every single sum we will be solving here. But here in a marathon, since we are revising, this is meant for revision, right? I am condensing it and presenting it. There also, I'm trying to provide you every single concept, right? And I'm not providing any kind of dilution here. I'm not making any dilution. I'm trying to condense it and present it. So predominantly the assumption here is that you would have already studied it once. Still, wherever possible, I'm starting from the scratch and I'm building the subject. So with this marathon itself, right? So a lot of complicated concepts we are covering, because overheads is not a straightaway easy area, right? It has a lot of other complexities, especially the ones we are going to see, after the sum, right? Whatever we are going to see, predetermined rate versus actual rate, under or over absorption. That's a very critical discussion of overheads, which we'll be seeing, right? So please go and update your library of adjustments. Write down 6 types of absorption rate. 6 types of absorption rates. Right? So with this, we will now move on to the next segment of discussion in this particular chapter. Now, the next concept is predetermined rate versus actual rate. Now, one of the most important aspect of this chapter, from here the chapter gets very technical. In fact, in our regular and exam oriented batches, right, this is a very detailed discussion. However, I will condense it for the purpose of revision without diluting on the core concept. Now guys, what is the next concept that we are going to talk about? Predetermined rate versus actual absorption rate. Simple. What do you mean by predetermined rate? What do you mean by actual absorption rate? Absorption rate, how do you calculate? Overheads divided by the base quantity. Let us take, for our example purpose, labor hour. But remember, it can be any of the 6 base quantities. Now, predetermined rate, or it's also known as budgeted rate, means if I use budgeted figure in the numerator and budgeted figure in the denominator, it is called as budgeted absorption rate or predetermined absorption rate. Are you clear with this? Predetermined means what? Already fixed, budgeted. That is, predetermined rate is equal to budgeted overheads divided by budgeted base quantity. Clear with this, guys? That is what I've mentioned here in our concept decoder. Budgeted overheads divided by budgeted base quantity. Whereas actual absorption rate means what? Actual overheads divided by actual base quantity. Simple, guys. Now, your absorption rate is what? Your overheads divided by the base quantity. If you calculate the absorption rate using the budgeted data, it is called as predetermined rate. Clear with this, guys? And if I calculate the absorption rate using the actual data, it is called as actual absorption rate. Sir, what is the big deal here, sir? Now, let me give you guys an example, and with the help of this example, we will understand the issue here in this particular concept. So, predetermined rate versus actual rate. Let me take you an example. Let me give you guys an example. Let us say the budgeted overheads is equal to rupees 3 lakhs. Okay, and the budgeted labor hours, let us take labor hours as the base quantity. The concept is equally applicable for all the 6 different types of base quantity. Let us say I budgeted to have 20,000 labor hours in this period, right? So this data is available before the start of the year itself. Now, which means the predetermined absorption rate, which means the absorption rate calculated using my budget data is equal to 3 lakh divided by 20,000. How much is that going to be? Rupees 15 per hour. Clear with this, guys? So the absorption rate calculated on the basis of my budgeted data is going to be equal to 15 rupees per hour. Let us say once the period is over, I got to know, sir, actual overheads was how much? Actual overheads was rupees 3,20,000. Let us say actual overheads was rupees 3,20,000, and in this period actual labor hours spent were 16,000 hours. Clear with this, guys? Which means the actual absorption rate overheads per labor hour, actual overheads per labor hour is equal to how much? 3,20,000 divided by 16,000. How much is that going to be? So it is going to be, so 3,20,000 divided by 16,000, it gives you how much? Rupees 20 per hour. Clear with this, guys? So with this we can say, look sir, the budgeted rate or the predetermined rate, or it is also called a standard rate. These are interchangeably usable terminologies, or in other words, the absorption rate calculated using the budgeted data is going to be 15 rupees per hour. Whereas, sir, actually, I plan to incur 15 rupees per hour. That is the overheads. Whereas, actually seeing, I ended up incurring how much overheads? 20 rupees per hour. Are you guys clear with this? Right? So this is called as predetermined rate. This is called as actual rate. Fine, perfect. Now, let us say I am a pen manufacturer, right? Now, I have to produce every unit of a pen. Let us say to produce 1 unit of a pen, let us say it takes 2 hours, right? So to produce 1 unit of pen, it takes 2 hours. Now, for this, every hour, I need to charge the product with an absorption rate, correct? Yes. Now, you guys tell me, will I charge or will I use my predetermined rate for charging the overheads to products, or will I use my actual rate for charging overheads to product? Sir, every time I produce 1 unit of pen, it takes 2 hours, sir. So for every hour actually taken by this pen, should I charge it with an overhead of 15 rupees or should I charge it with an overhead of 20 rupees? Right? Now, many of you will be thinking that, sir, we should charge it only with 20 rupees actual rate. Why? Sir, because 20 rupees was the figure which was actually incurred. Guys, clear with this. 20 rupees was the amount which was actually incurred. So for every hour taken by the pen, I should charge it with the 20 rupees of overheads. Guys, clear with this. This is what many of you might think. But the answer is no. You should always use predetermined rate only. Clear with this, guys? Sir, why, sir? Why should we use the budgeted rate or the predetermined rate for the purpose of carrying out absorption? Right? Now, there are 3 reasons. Now, let us not get too technical. One main reason I will tell you, right? And that is the core of the concept of absorption costing. Very, very important. Only if you know this, you can move on to the next concept of under or over absorption. Now, first, guys, we are in what subject? We are in cost and management accounting. Right, guys? Now, in costing, what is the objective of this chapter, of this entire subject? We have 3 different objectives, right? Stock valuation, profit computation, decision making, control, and all these things. Now, always remember, our subject, costing, cannot wait till the year end, right? Costing is a concurrent process, right? Whereas financial accounting, that is a post-mortem work. Once the year gets over or once a transaction happens, I record it, because the objective of financial accounting is completely different. Whereas in our subject, costing is a concurrent process. Sir, what do you mean by concurrent process? Simple, guys. Now, the moment this particular raw material is fed into my machine and my raw material gets converted into FG, the moment my FG comes out of my machine, now I should be valuing every unit produced. I should charge it with an overheads also. Prime cost components are readily available on a per unit level the moment my pen or the product FG comes out of the machine. Whereas now my overheads is the only figure that is not readily available on a per unit level. That's why we use the concept of absorption. Now, concurrently, as and when a particular product comes out of the machine, now will I be having my actual rate? No, I will not be having my actual rate, because actual rate is what? Actual overheads divided by actual hours. Now, if I charge it with actual rate, I need to wait till the end of the year, because only then this total actual overheads is known, and only then the actual hours is known. If I divide the two, only then I will get my actual rate. But costing cannot wait till the end of the year. Then and there, whenever a product is moving from stores to WAP area, from WAP to FG area, wherever it is moving, it has to move along with the cost. Hence, costing is a concurrent process, and I need to value every unit of my stock produced then and there. Hence, since costing is a concurrent process and it cannot wait till the end of the year, the only solution for me available is to mandatorily use my predetermined rate. Sir, how will I use predetermined rate? Simple. Budgeted overheads divided by budgeted hours. These two are already readily available as and when my particular output comes out of my machine. Yes, so this 15 rupees per hour is readily available, right? I need not wait till the end of the year to arrive at this figure. Hence, what I do is, so I can definitely use this amount. Predetermined rate can be used, and using the predetermined rate, I charge my overheads to the products. Are you guys clear with this? So always remember, this is a very, very important and a critical understanding of this entire overheads chapter. Sir, it is wrong, sir. I have actually incurred 20. How can I charge it with 50? Wait, at the end of the year, we do some rectification of error. Ideally, it's not called rectification of error, but for you to understand, I'm using the word rectification of error. That is only called as under or over absorption. We compare it with the actual and we do the adjustment. Do not worry. Right now, what is the figure available? 15 rupees, sir. Every time a product passes out of my machine, right, what I do is I charge every hour with the predetermined rate of 15 rupees. Are you guys clear with this? This is a very, very important discussion here. Are you guys clear with this? So literally guys, always remember, when absorption, I told you, is a two-step process. Step number one, calculation of absorption rate. When we say calculation of absorption rate, it is always the predetermined rate that we calculate. Clear with this, guys? So 15 rupees is what we calculate. In our example, we never calculate the actual rate. Now, having calculated the predetermined rate, so what is step two? Charging of overheads to products. So what is the formula there? Predetermined rate into actual base quantity consumed. Now this 15 rupees, I actually multiply it with 2 hours. Sir, this 2 hours, this is budgeted? No. When I am charging to the product, step 2, here I use the actual base quantity consumed. Sir, every unit, sir, it has come out of the machine. We know how many hours it has actually spent inside the machine. Yes, sir. So that actual data, actual base quantity consumed is readily available. Yes. So predetermined rate into actual base quantity consumed is what is your overhead absorbed. Are you guys clear with this? If you just look at it, look, this is what they say here. If you notice the previous thing here, step number 1, calculation of absorption rate, which we saw earlier. This absorption rate always refers to what? Predetermined rate, right? And having calculated the predetermined rate, we charge it to the products, right? So what is the formula here? The absorption rate, predetermined rate into the base quantity consumed, right? Which means it's the past tense, which means actual base quantity consumed. Or in other words, sir, I produced one product, sir. Every unit requires 2 hours. Actually, it has spent 2 hours. For every hour it has actually spent, I will charge it with the predetermined rate. In our example, 15 rupees. Clear with this, guys? Like this. As and when I produce a product, I charge it with a predetermined rate. Are you guys clear with this? This is a very, very important and a critical understanding that you need to have. So in absorption, right, so 2-step procedure. Step number 1, calculation of absorption rate. It is always the predetermined rate that we use. We never use the actual rate, right? And step 2, while charging of overage the product, it is predetermined rate into the actual base quantity consumed by the respective product. So here, sir, 1 unit of FG has actually consumed 2 hours. For every hour it has actually consumed, I should charge it with how much? 15 rupees. So the overheads absorbed will be 30 rupees per unit. Clear with this, guys? Like this, let us say at the end of the year, overall, all the units put together has actually consumed totally how many hours? Sir, 16,000 hours is what all the units put together have actually consumed. So I will say, sir, the overheads absorbed or the absorbed overheads is equal to, how much will I say? Each and every unit, right, put together all the units have consumed a total of 16,000 hours, and for every hour actually spent I would have charged it with a predetermined rate of how much? 15 rupees. So 16,000 into 15, how much you get? So the total absorbed overheads is going to be 2,40,000 rupees. And please be very, very clear, this absorbed overheads 2,40,000 is the figure that appears in your cost sheet. In your cost sheet you have this format, right? So your direct material plus direct labor plus direct expense gives you prime cost. These prime cost components are actual figures. Why? They're readily available on a per unit level as and when a product comes out of the machine. Plus production overheads I had. So production overheads is always, the figure is absorbed overheads. Clear with this, guys? So it is not a budget overheads. It is not an actual overheads. Also, it is an absorbed overheads. Are you guys clear with this? So it is always the absorbed overheads that gets recorded in your cost sheet. So that's why we call absorbed overheads as nothing but overheads accounted. This is the figure that has been considered in costing. This is a very critical discussion in our entire chapter of your overheads. Clear with this, guys? Or in other words, now at the end of the year, now we have three figures. So what are the three figures we have? One is budgeted overheads, then we have absorbed overheads, and then we have actual overheads. Sir, budgeted overheads, how much is it? Simple, budgeted hours 20,000 into budgeted rate or the predetermined rate, correct, right, which is nothing but 3 lakh rupees. Guys, literally we have 3 lakh rupees of budgeted overheads, right? How did you get this? This is nothing but budgeted hours into predetermined rate or budgeted rate. Clear with this? This is how you get it, 20,000 into 15. Right? Whereas on the other side you have actual overheads. How much was that? Rupees 3,20,000. Or you can say actual overheads 3,20,000 is nothing but, sir, actual hours into actual rate, 16,000 hours into 20. This way also you can say it's actual hours into actual rate, right? And in between you have absorbed overheads. We got it. How much was it? 2,40,000. So 2,40,000. So now how did you get this 2,40,000? Simple, sir, we used the budgeted rate, predetermined rate, right? Predetermined rate we applied on the actual hours consumed. So here into actual hours. Clear with this, guys? That's what we did. We took the predetermined rate and applied it on the actual hours. Right? So for every hour actually spent in the factory, I charged it with how much? 15 rupees. Or in other words, a hybrid thing. I take the rate from the budgeted data and multiply it with the actual base quantity consumed. This way, this is nothing but 2,40,000 of overhead accounted for. Clear with this, guys? So now literally budgeted overheads is nothing but overheads planned. Actual overheads is nothing but overheads incurred, and absorbed overheads is nothing but overheads accounted. Are you guys clear with this? Are you guys clear with this? So now, guys, what happens? So as and when in our example I told you, sir, one unit takes 2 hours, right? Let us say at the end of the year overall I have produced 8,000 units, right? 8,000 into 2, that's why we consumed a total of 16,000 hours. Clear with this, guys? So now what happened? Every unit took 2 hours, right? And every time I consume 1 hour, I was charging the product with 15 rupees of overheads. Like that, at the end of the year, actually I produced 8,000 units, and these 8,000 units put together actually consumed 16,000 hours. And for each of the hours actually consumed, I charged it with 15 rupees, 15 rupees, 15 rupees. And like that, overall, I accounted for an overheads of how much? 2,40,000. So our subject costing would have accounted for an overheads to the extent of how much? 2,40,000 rupees. Now at the end of the year, so this kept on going, and every time a product got produced, for every hour spent, we were charging it 15 rupees. Like that, we kept on accumulating, and we overall at the end of the year, we noticed that we have accounted a total overheads of how much? 2,40,000. Now, at the end of the year, I also got my actual figures. Actual overheads incurred was how much? 3,20,000. Now I can't just leave it like that. I have till now accounted only for 2,40,000, but look at it. Actually, I have incurred how much? 3,20,000 rupees of overheads, which means this difference now needs to be accounted for. Guys, clear with this, guys? Yes. So now the difference between absorbed overheads and actual overheads is what we call as under absorption or over absorption. Are you guys clear with this? So in order to calculate the under or over absorption, you need to compare absorbed overheads, which is the overheads accounted, with the actual overheads, which is the overheads incurred. I have accounted only for 2,40,000, but at the end of the period, I noticed that I've actually incurred how much? 3,20,000 rupees. Are you guys clear with this? So now, what do we do with this? Now, in this case, you should have accounted an overheads of how much? 3,20,000. You have only accounted for how much? 2,40,000. So your absorbed accounted overheads is less than the actual overheads. So I call it as under absorption, because the absorbed overheads is less than the actual. So here it is called as under absorption. So in this case, how much is the under absorption? 3,20,000 minus 2,40,000. Overall, the under absorption amount comes to 80,000. I have accounted overheads less to the extent of 80,000 rupees, which I now need to bring it into the books. Are you guys clear with this? Now, there could also be a case of over absorption. Yes, absolutely. Suppose based on the predetermined rate and all, I kept on charging more. Right? Let us say at the end of the year, I noticed that the actual overheads absorbed was 4 lakh rupees. Right? Overheads absorbed is 4 lakh. Actually incurred is only 3,20,000. In this case, there is an over absorption to the extent of 80,000. 4 lakh minus 3,20,000. So now I need to reduce or bring down my overheads. It's called as over absorption. Clear with this, guys? So now, how are we going to treat this under or over absorption is the subject matter of study in the next upcoming concept, which I'm going to do right now. But for you to understand this, first you need to understand the concept of predetermined rate versus actual rate, and you need to know that necessarily I need to use predetermined rate because costing cannot wait till the end of the year. Costing is a concurrent process. As and when a product gets produced, I need to charge it by using the predetermined rate. If I want to use the actual rate, I necessarily have to wait till the end of the year, which cannot be done in costing. Clear with this, guys? That defeats the objective of our subject, because that's how we are able to value the stock. The stock movement, the cost needs to move or flow along with the products. Clear with this, guys? Hence, costing is a concurrent process. It cannot wait till the year end. Clear with this, guys? And because of usage of predetermined rate, I use my absorbed overheads is different from my actual overheads. Hence, at the end of the year, I compare my absorbed with the actuals. If my absorbed is less than actual, now I need to add the cost, right? I would have accounted less by 80,000. I need to introduce this cost. If my absorbed is more than actual, it's called over absorption. Now I need to go and reduce the cost, which I have already accounted for. Are you guys clear with this? That is the concept of under or over absorption. Now, guys, how are we going to treat the under or over absorption? But before that, here I have clearly mentioned in our concept decoder as well. So under or over absorption is nothing but you need to compare the actual overheads with the absorbed overheads. Don't think positive, negative and all. Don't do it like that. If my absorbed is more than actual, it's over absorption. If my absorbed is less than actual, it's called as under absorption. Now we are going to study, right? Look at this. If my actual is more than absorbed, which means absorbed is less, it's an under absorption. If my absorbed overheads is more than actual, then it is called as over absorption. Clear with this, guys? Now, how are we going to treat the under or over absorption is the subject matter of study right now. Now, let's get started. So, treatment of under or over absorption, the most critical point here. So once we do this, literally this entire chapter's core concept is now getting over. So this is the most important part of discussion in this entire chapter. Now guys, now I told you that this 2,40,000 rupees is nothing but the overheads accounted, correct? Or in other words, if I were to prepare the cost sheet of this company. If I were to prepare the cost sheet of this company, we have direct material, direct labor, direct expense. This gives us the prime cost. Now all these prime cost components are actuals, right? Plus production overheads. Now how much is my production overheads? Now I would have only accounted for 2,40,000 because absorbed overheads is the figure that is getting accounted. 2,40,000 rupees. Clear with this, guys, right? Now at the end of the year, I noticed that, look, your actual overheads is how much? 3,20,000, but the overheads absorbed is only 2,40,000, which means you have under accounted or under absorbed to the extent of how much? 80,000 rupees, right? Now I need to now account for this 80,000 rupees, right? Now guys, the question is, should this 80,000 rupees be treated as a product cost or should I treat it as a period cost? Clear with this, guys, right? Or in other words, simply put, this cost sheet, if I were to present this in a trading and a P&L format, right? Now this 2,40,000, right, appears in your trading account because it is a product cost considered for the purpose of stock valuation. Now the question is, this 80,000 rupees of under absorption here, right, which means I need to introduce this 80,000 as a cost. My actual was 3,20,000, but as of now I've accounted only for 2,40,000. This 80,000 I need to account right now as cost. Should I take it to my trading account or should I take it to my P&L account, or in a format of cost sheet, should I add it here itself, right, before my cost of goods sold, or should I treat it at par with my AOH, SOH and all, is the subject matter of discussion here. Sir, what is the big deal, sir? If I treat it as a product cost, it will impact my stock valuation. If I treat it as a period cost, P&L item, it will not impact my stock valuation. Directly it gets transferred to my costing P&L account, so no problem at all. Clear with this, guys? Now the subject matter of discussion is what? How do I deal with my under or over absorption? Clear with this, guys? Now globally there were two arguments. One set of people said, look, production overheads is a trading account item, it is a product cost item, so any under or over absorption of this particular production overheads should be treated as a product cost only. This was globally one argument put forth, but it is not a very logical argument. Clear with this, guys? Why? I will tell you. There was another set of argument which said, look, always under or over absorption should be treated as a P&L account item, or in other words, it should be treated as a period cost. This is what another set of people globally, they argued. It should always be treated as a period cost taken to your P&L account, or in other words, in a format of cost sheet, it should be taken along with AOH, SOH, then one more line item which is under or over absorption of your production overheads. Why this seemed to be more logical? Sir, why, sir, this was more logical? Now, you understand, I'll tell you one example. I'll give you an example. With the help of this example, let us understand. Let us say on the 1st of January of a particular year, right, on 1/1, a board meeting happened where they finalized the budget. Let us say the budgeted overheads was 3 lakh rupees, right, and the budgeted hours were, let us say, 20,000 hours, which means how much is the predetermined rate? 3 lakh divided by 20,000. For every hour spent, I will charge it with an overheads of 15 rupees per hour, right? Now what happened? The board meeting got over. First 1/1 of this year, right? The board meeting got over. Now what happened? The moment these guys stepped out of the board meeting, they noticed that the entire factory was on strike. Some labor issue was there. Entire factory was on strike. Now the strike continued so long and it got over on 31st of December, which means at the end of the year, one full year, zero production. All the workers were on strike on 31st of December at 11 p.m. in the evening. Now what happened in the night, 11 p.m.? What happened was, sir, finally this board and all this board members and the workers and all, somehow they peacefully agreed for a wage rate and all these things, some wage related problem. So the workers also got convinced and they said, okay sir, now the dispute has been resolved. From tomorrow, new year onwards, the next year, fresh year sir, we will start our production. Now our managing director asked, look, this year, right now it's already 11 p.m. One more hour is left. One more hour is left. Now, I don't want to close this year without producing anything. Sentimentally, please send one worker. Ask him to produce only one unit and give it. That's all. Right? Because let us not close this year without producing anything. So what happened? What happened during this year? During this year, what has happened? The actual overheads, let us say, was 3 lakh rupees. Right? Let us say this 3 lakh rupees was factory rent. Whatever they budgeted, it was incurred, because irrespective of actuals, the rent needs to be paid. Now, what is going to be my actual hours spent? Only 1 hour was actually worked. Guys, correct? Right? Now, if I calculate the actual rate, how much is my actual rate? 3 lakh divided by 1. Right? That's going to be 3 lakh rupees per hour. Anyways, forget it. Forget it. We are not bothered about this. We are convinced that we need to use predetermined rate. Now, what would have happened? Now, during this year, in my trading account, what is my production overheads absorbed? Sir, predetermined rate for every hour actually worked, I will charge it with 15 rupees. So 15 into 1, my overheads absorbed would have been 15 rupees. Guys, correct? Now, absorbed overheads was how much? 15 rupees. Actual overheads is how much? 3 lakh rupees, which means how much is my under absorption? Sir, I have actually incurred 3 lakh, but overheads accounted was only 15 rupees. How much is my under absorption? My under absorption is 2 lakh 99,985 rupees. This is my under absorption. Right. Now, suppose if I treat this also, under absorption also, as a product cost, now what would have happened? I will take it to my trading account. I will consider the under absorption 2,99,985 as a part of my product cost. Now what would happen? Now this is the total cost of production. I have not sold anything, so my closing stock will be valued at 15 plus 2,99,985. I will value my closing stock at 3 lakh rupees. Now how many units of closing stock is there? 1. So now what happens? 1 unit will be valued at 3 lakh rupees. Are you guys clear with this? Now at the end of the year, the auditor, right, he is coming for a stock audit, stock count. Now the manager, this particular manager of the company, saying, sir, you don't come, sir, I will bring the stock to your location. So this particular manager goes to the auditor's office, right, and the auditor saying, what, you have come empty handed? Where is the stock and all? Right? What is the lorry waiting outside? Our manager will say, no sir, only 1 pen has been produced, carefully count and give it back. Now the auditor will be shocked. What? Only 1 pen has been produced? I mean, only 1 pen is there in closing stock, but why is the closing stock valued at 3 lakh rupees? Guys, are you understanding the issue here? Now, if I treat this under absorption, right, as a product cost, under or over absorption, as the case may be, my stock valuation will go for a toss. 1 unit of stock gets valued at 3 lakh rupees, or in other words, my actual overheads incurred might be having my efficiencies or inefficiencies. Guys, clear with this? There could be inefficiency that gets captured in my under absorption. Now, if I treat my under absorption as a part of product cost, inefficiencies will get into my stock valuation. Hence, always remember what they are saying. Stock is not valued at actual cost. It should only be valued at standard cost. Are you guys clear with this? Hence, for this purpose, the correct thing to do is that now what you need to do globally, this is what they follow. So they don't take the under absorption here. Look, what they do is only 15 rupees, right? Absorbed overheads is only taken to your, considered as a part of your product cost. Any under or over absorption, 2,99,985 in our example, is taken to your P&L and always treat it as a period cost. In this case, my stock gets valued only at 15 rupees, that gets carried forward the next year. Sir, this difference 2,99,985, sir, it's a benefit lost. Don't consider it as a part of your stock, right, and value your stock more. This gets knocked off. I will book a loss of 2,99,985 in this year. This cost should die. It should expire in this year itself. Are you guys clear with this? Hence, globally, what they say is they treat under or over absorption as a part of period cost. They take it as a P&L account item. Are you guys clear with this? Now, sir, is this what we need to do? No. Now, always remember, in India, we Indians are extremely clever and we are extremely intelligent. In India, we follow a slightly different approach. What do we do? Now, extraordinary treatment, this is covered in your cost accounting standards, right, which is ideally a part of CMA intermediate syllabus. Cost accounting standards are prescribed by your CMA institute. Now, in India, what we follow is, now, how much is the under or over absorption, right? Forget this particular question. Now, going back to our original example, sir, under or over absorption, how much is it? 80,000 rupees, in this case, under absorption. Now, globally, what they do, they treat it as a period cost. In India, what they do is, okay, 80,000 rupees in our example is under absorption. Similar treatment for over absorption. Now, they don't jump to a conclusion and say, look, this 80,000 should be treated as a product cost, or this 80 should be treated as a period cost. They don't do that. Now, what they do, they classify this into two. Now, tell me, out of this 80,000, now, let us say, for example, 5,000 rupees, sir, right, has been actually incurred because of normal price level changes, inflation. Look, how much was the overhead absorbed? Going back to our original example, only 2,40,000. But actual was how much? 3,20,000. Sir, why was the actual more? What is the difference between overheads absorbed and overheads actually incurred? 80,000, which means actual is more. Guys, correct? Now, by 80,000, now, out of this 80,000, they are saying, sir, to the extent of 5,000 rupees, genuinely, sir, on account of price level changes, inflation was there. When we budgeted, the inflation we didn't factor. Suddenly in this year, this inflation also happened. So, 5,000 rupees increase in actuals was genuinely on account of inflation, sir. The balance 75,000 rupees of difference is because of any abnormal reasons or maybe because of inefficiencies in the management. Are you guys clear with this? So hence a strike or other example. Clear with this, guys? So out of this 80,000 rupees of difference between my absorbed and actual, or in other words, actual was more, the 5,000 rupees was genuinely because of inflation, right? And the balance 75,000 rupees was purely because of any abnormal reasons. Are you guys clear with this? Abnormal reasons. Are you all clear with this? So now in India, what they are saying, to the extent of 5,000 rupees, you treat it as a product cost. To the extent of 75,000 rupees, you treat it as a period cost. Are you guys clear with this? Right? Why? Sir, 5,000 rupees genuinely on account of price level changes. So if there is genuinely a price increase, it should go and impact my stock valuation. Whereas the 75,000 rupees is because of inefficiency, strike and all, there is an under absorption, over absorption. No, take it to your P&L account. It should fully expire in this year itself. A classic treatment is what we follow in India. Are you guys clear with this? This is the most intricate part of discussion in the entire subject, in fact, right? And once again, generally in our regular and exam oriented batch, I take a lot more examples, explain, and we do a lot more sums. But since we are doing a marathon here for revision purpose, still I didn't want to dilute. Wherever possible, I'm still taking examples and figures and explaining it. Trust me, guys, I'm trying to condense a very, very complicated and a very big area. So this is for the purpose of revision. Clear with this, guys, right? So what they are saying, so first, if there is an under or over absorption, split it into two. If it is because of normal reasons, it should be treated as a product cost, or to put it in understandable words, take it to your trading account. We don't have a trading account and all in our subject, but I'm telling you for your understanding, to the extent of 75,000, you take it as a product cost. It's a P&L account item. Clear with this, guys? Or in other words, if I were to put this on your cost sheet, if I were to put this on your cost sheet, right, you have direct material, direct labor, direct expense, gives you prime cost, right? To this add production overheads. Till now we would have accounted for 2,40,000, right? Now here itself you can add your under absorption due to normal reason. How much is it? 5,000 rupees, right? And this gives you your gross works costs and opening WIP, closing WIP, all these things you do it, right? And finally you arrive at your cost of goods sold, right? All the stock gets valued and all, add opening FG minus closing FG, everything. And finally here what do? We add our AOH, SOH, right? Along with that SOH, now you can add one more line item, under absorption due to abnormal reasons, 75,000. Clear with this, guys? Are you all clear with this? So here this 5,000 is treated as a product cost, the 75,000 is treated as a period cost. Or if you want to put it in trading P&L account format, literally guys, in this case what I do, so here I add 5,000, right? And here I will be adding 75,000. So to the extent of normal reasons, I will treat it as a product cost. It should impact my stock valuation. To the extent of abnormal reasons or due to inefficiencies, it should be taken to my P&L account. Are you guys clear with this? Now the final touch to this area. Now there is no problem with respect to this 75,000. That is, if I'm treating it as a period cost, there is no problem at all. P&L, the entire amount will die in this year. Clear with this, guys? But suddenly, if I am introducing a line item of cost at the end of the year as a product cost, now there is one big problem. Sir, what is the problem, sir? Now, recall the flow of cost concept which we have studied in cost sheet. Now, guys, in your WIP area, right, this is where all your line items of cost will appear, right? You have direct material consumed, you have direct labor, direct expenses. Now here is where you will be incurring production overheads, guys, correct? Now having incurred all these costs, now what will happen? Some units will be produced and completed, some units will be completed and transferred to FG, right? Units completed and transferred to FG. Some units will lie in your closing WIP, guys, correct? Now in your FG area, ideally whatever units that got completed, right, now it could either be sold, right? You have cost of goods sold, it could either be sold or it could remain unsold, closing FG. Guys, are you clear with this? Or in other words, if I suddenly add one line item here, it is going to impact my closing WIP and my units produced, correct? Now whenever I say units produced, the units produced could either be sold or it can remain unsold. Or in other words, suddenly if I impact one line item here, three figures will take a hit. What are they? The value of units sold, that is cost of goods sold, the value of units unsold, which is your closing FG, and the value of units incompleted. Are you guys clear with this? Because basically whatever I do here will impact units completed and units incomplete, and units completed are represented by either units sold. Whatever units I produce can either be sold or it can remain unsold. Or in other words, suddenly if I introduce 5,000 rupees as a cost here, now this cost now needs to be shared or borne by my units sold, units unsold, and units incompleted. Literally, I need to apportion this cost between these three guys. Are you all clear with this? Are you all clear with this? So now, in this case, our under absorption due to normal reasons is how much? 5,000 rupees. Now this I need to apportion between three guys. Who are they? So goods sold, right? Then goods unsold, that is closing FG, and goods incomplete, WIP. Guys, clear with this? Let us say I have a total of 4,000 units sold, right? And I have a total of, example, 800 units of closing FG, and let us say I have a total of 200 units of WIP, right? Or in other words, 400 units, 50% complete, right? Equivalent units. Sir, 400 units were there, 50 percentage complete. 400 units 50 percentage complete is equivalent to 200 units fully complete. Guys, clear with this? So now what I need to do, this 5,000 rupees, I need to apportion it between this goods sold, closing FG and closing WIP in the ratio of 4,000 is to 800 is to 200. Guys, clear with this? Sir, what about that 75,000 rupees of under absorption attributable to your abnormal reasons? No problem at all. That you can directly take it to your costing P&L. That will not impact anything because it's a period cost. Only if I am having an impact on the product cost, three figures will take an it. Simple. This 5,000, you apportion it between these three figures in the proportion in which they have actually, the units are there. Guys, clear with this? So ideally, I can say 5,000, I need to apportion it between these three in the ratio of 4,000 is to 800 is to 200, right? Ideally, if you do this, this is over. But our institute, they want to do it in a structured format. What they are saying is, first, you compute something called a supplementary rate. What do you mean by supplementary rate? It's nothing but under absorption or over absorption. In this case, under absorption divided by total units. Now, what is under absorption here? 5,000 rupees due to normal reasons divided by, what is the total units? 4,000 plus 800 plus 200. How much is it? 5,000 units. So literally you get how much? 1 rupee per unit. Now this 1 rupee per unit you get as a supplementary rate that you multiply with these respective figures. So you get how much? So 4,000 into 1, right? So you get 4,000 into 1 and 800 into 1 and 200 into 1. Literally you get all these line items right now. So you get how much? It's going to be rupees 4,000. You get rupees 800. And here you get rupees 200. Clear with this, guys? Right? Or in other words, sir, directly if I do it, 5,000, if I apportion it in the ratio of 4,000 is to 800 is to 200, directly I would have got the same answer only. No, sir. 4,000, 800, 200. Yes. But our institute, what they are saying, separately they want to actually compute this and they want to show that it is a supplementary rate and then they want you to apportion. Right? There is one movie comedy in Tamil. Say இதுக்கு பருத்தி மூட்டை கோடவுன்லயே இருக்கலாம், right? Literally instead of doing all these things directly you could have done it, right? But institute wants you to show your supplementary rate, பருத்தி மூட்டை godown, right? Supplementary rate and show that it is 1 rupee per unit and then apportion it to the respective units. So now literally what happens? Sir, 5,000 rupees I'm treating it as a product cost. Because of this, my cost of goods sold will increase by 4,000 rupees. The value of closing FG will increase by 800 rupees. The value of closing WIP will increase by 200 rupees. Are you all clear with this? And all these issues, sir, why are they arising? Because I am forced to use my predetermined rate. Clear with this, guys? Quickly, I will summarize. Predetermined rate versus actual rate we saw. So literally, guys, a company or every company needs to necessarily use predetermined rate because costing cannot wait till the year end. Costing is a concurrent process. Every time as and when a product gets produced, I need to charge it with an overheads. Because of using that, what happens? Absorbed overheads at the end of the year, you compare it with actual, will not be the same. So absorbed overheads, if it is less than actual, I call it as under absorption. If it is more than actual, I call it as over absorption. Now, how do I treat it, sir? This under or over absorption, it's like a rectification of error. Now we need to introduce it into the books. Yes. How will you do that? Simple. Now overall, under absorption, whatever figure is there, classify it into two. If it is happening because of normal price level changes, right, to that extent you treat it as a product cost, and whatever it is, you actually apportion it between three people: units sold, closing FG and closing WAP, using something called as supplementary rate. Parthi mutta go down, right? And on the other side, if it is due to abnormal reason, you should treat it as a period cost, directly take it to costing P&L account. Clear with this, guys? And this is the story of your overall absorption, the concept of absorption costing. With this, the concept of absorption costing completely gets over even from an accounting perspective. A very important and a technical discussion, right? And generally in a marathon purpose, for marathons, I'm sure not many will explain this in a marathon itself because it's the core piece of the entire subject, to be very honest, right? But I wanted to once again give you guys the perspective and complete this also so that you have a complete conceptual clarity as to why we do it here. Fine, guys. Now with this, we will just go and do one numerical example, numerical question. Please take your solved question bank, right? So please take question number 7. Please take question number 7. I think this was a past exam question, right? So it came in for about 7 or 8 marks. So it was a past exam question, a very good question. But for you to crack this, you should have all the knowledge that we have seen till now. Whatever we've seen till now, so quickly it's being summarized in this particular numerical example. Let's get started. So question number 7. ABC Limited manufactures a single product and absorbs the production overhead at a predetermined rate of 10 rupees per machine hour. So 10 rupees per machine hour. So here, simple. Look at this. Predetermined rate they have given. So budgeted rate, this is the absorption rate per machine hour. So the base quantity used is machine hour. See, whatever we have learned, we are literally applying in this question. It's a past exam question, by the way. At the end of the financial year, it has been found out that the actual production overheads incurred was 6 lakh rupees and it included 45,000 rupees on account of write-off of obsolete stores and 30,000 rupees being wages paid for a strike period under award. Clear with this? So now basically actual over at 60,000 that included 45,000 and 30,000 in it. Now literally guys, this 45,000, 30,000 and all, they are not production overheads, they are some abnormal items. So ideally you should reduce these two figures from this, right? And only the net amount you can call it as overheads actually incurred, because these two are not overheads incurred, they are write-off of obsolete stores. Obsolete means they are non-usable, right? Obsolete stores written off, then some wages paid for strike period and all. These are some abnormal items which should ideally not form part of your overheads. Clear with this guys? So it should be removed. Next one, we will see how to do it. The production and sales data for the year are given below. FG produced was 20,000. Be careful. WIP stock 8,000 units, and each of these 8,000 units were 50% complete, which means 8,000 units 50% complete is equal to 4,000 equivalent units. Goods sold was 18,000. Be very careful. How many units were produced? 20,000. So literally out of this, they have sold 18,000 units, which means the balance 2,000 units are lying in your closing stock. So closing FG is 2,000 units, 18,000 units were actually sold, and 4,000 equivalent units are lying in your closing WAP. This clarity you should have. Next one. The actual machine hours worked during the period was 48,000 machine hours, and it has been found that 1/3 of the under absorption was due to lack of production planning and the rest were all attributable to normal increase in the cost. You are required to number 1, calculate the amount of under absorption and show the accounting treatment for under absorption. A full-fledged past exam question. Now first one, what is the actual overheads? What is the actual overheads incurred? Sir, 6 lakh rupees. Don't say 6 lakh is the overhead. That included this two items which were ideally not production overheads. They are some, extraordinary items and all. Remove that. 6 lakhs minus 45,000 minus 30,000. Literally 5 lakh 25,000 rupees is the amount of overheads actually incurred. Clear with this, guys? This is the actual. Now, to compute the under or over absorption, you should compare what with what? You should compare your under absorption with you should compare your absorbed overheads with your actual overheads. Right. So now, what do we do here? Absorbed overheads needs to be compared with actual overheads. So now, actual we know it is going to be 5,25,000. So how much is the absorbed overheads? Simple. Predetermined rate was 10 rupees per machine hour. And actually, how many machine hours were consumed? 48,000 machine hours, which means 48,000 into 10, 4,80,000 rupees is what that is going to be your absorbed overheads. Are you guys clear with this? Absorbed overheads. So now I would have accounted for overheads of how much? 4,80,000. But at the end of the year, I noticed how much was actually incurred? 5,25,000. The difference between the two, how much is it? 45,000. What is that? It's going to be under absorption. Clear with this, guys? So the first part of the question, clearly we have computed. Sir, it is an under or over absorption? It is an under absorption. Clear with this, guys? Now, having computed the under absorption, the next thing, what should we do right now? Treatment of under absorption. Now, clearly in this question, they have mentioned, look at this. Look at this. They have clearly mentioned 1/3 was due to lack of production planning and the balance was due to normal increase in the cost. which means 1/3 of this under absorption should be, it is due to lack of production planning inefficiency, treat it as a period cost, right? And the balance you should treat with 2/3 should be treated as a product cost. Look at this. So 45,000 out of this 1/3, 45,000 into 1 by 3, that is going to be how much? 15,000 rupees should be treated as what? Should be treated as a period cost. Okay, it's given here. Period cost, right? Now the balance 2/3, that is 30,000 rupees, should be treated as a product cost. Now, period cost 15,000, what will you do? You will take it to costing P&L account, right? And now with respect to the balance 30,000, what will you do with this? This needs to be apportioned between 3 items. This is a product cost. Now I'm introducing it. It will impact my stock valuation. 3 items. Who are they? So units sold, right? Units unsold, closing FG and WAP. Clear with this? And how will I do it? Using something called as supplementary rate. By the way, guys, each and every solution here, so in your study material, all this chart they have not done. So I have personally improvised a solution in your solved question bank. These were actually done by me so that the presentation is enhanced and you can quickly absorb the concept and practice it the day before your exam, and even during your practice, right? Maybe if you are even 4-5 months away from your exam, even then, right, this book is actually super sufficient. That's how we have actually come up with this particular book, and all these things, the solutions are all actually improvised personally. Clear with this, guys? Now what do we need to do? With respect to this 15,000, I don't have a problem. With respect to this 13,000, what should I do? I should apportion it between my units sold, closing FG, and closing WAP. Simple. How many units were sold? 18,000. And how many units were lying in my closing FG? It's 2,000. And how many equivalent units in my closing WAP? 4,000 units. That is 8,000 into 50%. If you add up everything, so 18,000 plus 2,000, that's going to be 20,000, plus 4,000, it's going to be 24,000. Guys, clear with this? So now what we need to do? So overall, look at this. FG sold, FG unsold, closing stock, and WAP. If you add 24,000 rupees, it's coming out to, so 30,000 divided by 24,000. So how much you get? So it's going to be 1.25 per unit. So 1.25 into 18,000 is equal to, you get 22,500. 2,000 is equal to, you get 2,500. 4,000 is equal to, you get 5,000. Are you guys clear with this? So now if you add up, you get 30,000, or in other words, this 30,000, since I'm introducing it as a cost, now my cost of goods sold increases by 22,500 rupees, my closing stock of FG increases by 2,500 rupees, and my closing stock of WAP increases by 5,000 rupees. Are you guys clear with this? So now the accounting treatment, how will I do it? This is by way of journal entries, right? Ideally, we cover this journal entry in our cost bookkeeping or your cost accounting standards, right? In the cost bookkeeping, that chapter, the cost accounting standards chapter, cost accounting systems chapter, cost accounting systems or cost bookkeeping chapter, we do it. So now what was the total under absorption here? 45,000. So here, 45,000 I account, right? Now out of this 45,000, 15,000 rupees is a period cost taken to my costing P&L. So what do I do? 15,000 rupees should be taken to my costing P&L. Now I incur more cost, hence it gets debited, right? And the balance, look at this, 22,500 increases my cost of goods sold. Ideally, my cost of goods sold goes to my cost of sales account only, right? More details about it we'll see in a cost bookkeeping or cost accounting systems area. Right, so 22,500 gets debited because it increases my cost of goods sold, right? Then closing stock of FG value increases by 2,500, so FG account debit 2,500, and my WAP value increases by 5,000, so 5,000 rupees debited to your WAP account. Are you guys clear with this? So these three are because of your product cost, this one is because of period cost. The two put together is your total under absorption now being accounted for. Are you guys clear with this? Now what happens literally, so because of this under absorption treatment, sir, what is the impact on profit? Very simple. Now my profit falls by 22,500 plus 15,000, right? So because of this, so 22,500 plus 15,000, how much is this? 37,500. So my profit reduces or falls by 37,500. How, sir? Simple. Cost of sales is an expired cost, yes, and this period cost component, that is also an expired cost, fully expires, right? These two actually increases my stock valuation only. So literally these two are unexpired cost. It escapes the next year. Are you guys clear with this? So only these two are expired, right, in the current period. These two remain unexpired. So only that cost which expires in the current year gets knocked off against your revenue. Hence my profit falls by the sum total of this is 37,500 rupees. Are you guys clear with this? A very good numerical problem. But for us to do this numerical problem, we had to see a background concept for the last 1 hour in this marathon itself. Clear with this, guys? That is the beauty of this particular chapter, the most technical area of this entire subject itself, I can say. Not just this particular chapter, the most technical area, not only in this chapter, of the entire subject, in my opinion, is this particular concept of absorption, right? Fine. Anyways, so that's about this particular question. Please go and update your library of adjustments. Write down treatment of under absorption. Please write down treatment of under absorption. Treatment of under absorption. Clear with this, guys? Now, with this, let's move on to the next one. Look at this, all this explanation I've given here. Treatment of under or over absorption due to normal price level changes should be treated as a product cost. Apportion it to the entire production using supplementary rate. If it is due to inefficiency, take it to your costing P&L, treat it as a period cost, right? What is supplementary rate? How to compute? All these things I've given, and even the journal entry I've given it here. All these things have been neatly summarized, and it has been properly given in your concept decoder book. The question and answers for that I have given it in your solved question bank. Here, that too, solutions personally improvised. Literally beyond this, you don't need anything at all. Trust me, if you do this properly, that is super sufficient in exam. Out of the entire 120 or whatever marks, including the choice questions they ask, literally everything you will be able to solve, right? That's my open challenge to you, because literally I have not omitted anything. Every single thing has been covered here. Clear with this, guys? The next one, the next concept, this is called as blanket rate versus departmental rate. Sir, what is this, sir? Now, I will give you guys an example here, and with the help of this example, quickly we will understand or revise this area. Blanket rate versus departmental rate. What is this particular concept? What is this particular concept? Now, I'm giving you guys an example. Let us say I have two departments in a factory, P1, P2. Departmental overheads, let us say P1 department 20,000, P2 department 15,000. This is the overhead. Let us say the labor hours, I'm using that as the base quantity. Department 1 labor hours is 5,000 hours. Department 2 labor hours is 3,000 hours. Right? Now, I have two products, product A and product B. Right? I have two products, product A and product B. Right? Now, product A, it spends 2 hours, right? Sorry, it spends 3 hours in department P1 and 2 hours in department P2. Product B, this also passes through both the departments, but it takes 2 hours in department P1 and 3 hours in department P2. Now, first, if I use something called as a blanket departmental rate, now, how will I calculate the absorption rate? Blanket rate is nothing but another way of calculating the absorption rate. What do? I take the total. Look, I am not bothered in which location or in which department of the factory how much is incurred. In the factory, totally blanket. If you put a blanket, what happens? Inside it, what is there is not known, right? So the identity is not known. So totally in this factory, what is the total overheads? 20,000 plus 15,000, sir. 35,000 rupees the total overheads. Okay, fine. And in this factory, what is the total labor hours? 3,000 plus 5,000 plus 3,000. 8,000 labor hours, sir. So now what is going to be the blanket absorption rate? So 35,000 divided by 8,000. So for every hour spent in the factory, I'm going to charge the product with how much? 4.375 rupees. Clear with this, guys? Now, whether that hour is spent in P1 or in P2, I am not bothered about it. Every unit, right? For every hour that a product spends in the factory, it should be charged with an overhead of how much? 4.375 rupees per unit. Are you guys clear with this? So now in this case, if I use a blanket rate, you tell me product A spends a total of how many hours in the factory? Forget P1, P2. Totally it spends how many hours? 5 hours in the factory. Every hour I will be charging it with how much? 4.375. Right? So how much the overheads? 4.375 into 5. How much is that? So 21.875 rupees the overhead cost per unit of A. How about product B? Sir, product B also overall it spends 2 plus 5, 2 plus 3, 5 hours in the factory. Right? Every hour I charge it with 4.375. So how much is that? Once again the same, 21.875 rupees is the overhead that I'll be charging for every unit of product B. So whether it is product A or product B, both the products are going to be charged with an overhead cost of 21.875 rupees per unit. So in a blanket rate system, what we do is we don't retain the identity of departments. We take the total factory overheads divided by the total base quantity, arrive at a blanket or a single absorption rate, and using that we charge the absorption to the product. Clear with this, guys? If I do the absorption procedure in a total basis, that is called as what? That is called as blanket rate system. Whereas if I follow a departmental rate, what happens? Department wise I compute the absorption rate. Sir, P1 department overheads divided by P1 department labor hours. How much is it? So 20,000 by 5,000, it is going to be 4 rupees per hour. Right? Which means for every hour a product spends in P1 department, it should be charged with 4 rupees. For P2, it's going to be how much? 15,000 by 3,000. So how much is that going to be? It's going to be 5 rupees per hour. Clear with this, guys? So for every hour spent in department P2, the product should be charged with how much? It should be charged with 5 rupees. So here I will say, sir, product A, it spends 3 hours in P1, 2 hours in P2. So multiply this with 4 and 5 respectively. How much you get? So 3 4s are 12 and 5 2s are 10. So overall, the overhead cost per unit is going to be of A is going to be 22 rupees. How about product B? So here I will multiply this with 4, here I will multiply this with 5, so here it's going to be 8, here it's going to be 15. So overall the overhead cost per unit of B is going to be how much? It is going to be 23 here, and it's going to be 22 here. Clear with this, guys? Whereas if I use a blanket rate system, both the products are charged at a same overhead rate in the overhead cost in this particular question. Clear with this, guys? So, or in other words, calculating the absorption rate department wise is called as departmental rate, whereas calculating the overheads on a total basis, factory basis, is called as what? It is called as blanket rate. Now you tell me, between the two, departmental rate versus your departmental rate versus blanket rate, which is a better way of computing overheads? Now obviously departmental rate is better to compute overheads. Why, sir? There are multiple reasons. Reason number one, if I use departmental rate, right, the overheads is accurately charged to the product. Why, sir? Now you guys tell me, for every hour spent in P1, what is the overhead rate? 4 rupees. Every hour spent in P2, what is the overhead rate? 5 rupees. Now between the two, which is a costlier department? Obviously P2. Now product A spends lesser time in a costly department, or in other words, product B spends more time in a costlier department. Right? Obviously, hence it has to be given a more share of overhead cost. Right? That is the reason why if you use departmental rate, product B has a more overhead cost per unit, 23 rupees, whereas product 2 has only 22 rupees. Why? Because B spends more time, 3 hours instead of 2 hours, it spends 3 hours in a costlier department. Clear with this, guys? Whereas if I use a blanket rate, I am not bothered about where it is incurred. I just total and say, look, A also spends 5 hours in the factory, B also spends 5 hours in a factory. Every hour I should actually charge it with 4.375 rupees, and I do it here. So both the products get a same share of overheads, while ideally product B spends more time in a costlier department. It should ideally get a more share of overheads, which has been properly captured only in your departmental rate, not in your blanket rate system. Are you guys clear with this? This is reason number one, and the most important is reason number two. If I use departmental rate, I have the flexibility to choose a different base quantity for every single department. Clear with this, guys? For example, department P1 is a machining department, right? Now for department P1, it makes more sense for me to use machine hour as the basis to apportion my overheads. Whereas if department P2 is an assembly department, it makes more sense to use labor hours as a basis. So if I use departmental rate, I can appropriately pick that particular factor which drives my cost, right? And I can use the appropriate base quantity to apportion my overheads properly. Clear with this, guys? Whereas if I use a blanket rate system, I necessarily have to use only one denominator. Clear with this? Because I don't retain the identity of the departments, so I don't have the flexibility to choose a department-wise base quantity that actually drives the cost of the respective department. I necessarily need to use only one particular base quantity. Clear with this, guys? Right? So because of these broad two reasons, right, it is better to follow departmental rate than following your blanket rate system. Clear with this, guys? Right? So this is the concept of departmental rate versus blanket rate system. Clear with this, guys? So this was something that I wanted to revise once again here. Look at this. When a single overhead absorption rate is calculated for the entire factory, such an absorption rate is called as factory-wide rate or plant-wide rate or blanket absorption rate. The formula is total overheads divided by total base quantity. Suitable for multiple products requiring different resources and costly but accurate. When overhead absorption rate is calculated for each production department using the appropriate absorption base, it is called as departmental rate. So what is the formula here? Departmental overheads divided by departmental base quantity. Clear with this, guys? Which is more better? Obviously your departmental rate is better than your blanket rate system. Are you guys clear with this? Right? So, and there is one more thing here, which is called as machine hour rate. Machine hour rate is nothing but, it's nothing but your overheads divided by machine hours. Clear with this, guys? There's something called as a direct machine hour rate. There's something called as comprehensive machine hour rate. Now let us take and do one sum in this concept of comprehensive machine hour rate, and that would be the final discussion in this particular marathon for this particular chapter. Now please go and take question number 9. Please go and take question number 9. We will do something called as comprehensive machine hour rate. Directly we can get into this sum. Comprehensive machine hour rate means what? The total overheads divided by the total machine hours. That's about it. That's about it. So numerator by denominator you need to compute. Look at this. Question number 9. So let's get started here. Let's get started here. So, yes. Now, a machine shop has 8 identical drilling machines manned by 6 operators. There are 8 drilling machines, and 8 machines overall is being managed only by 6 operators, machine operator. The machines cannot be worked without an operator wholly engaged in it. Means what? So only if an operator is engaging, right? Only if an operator is there, the machines will run. Else, the machines will not run without an operator engaging on it. The original cost of all these 8 machines works out to 8 lakh rupees is the total cost. Next, these particulars are furnished for a 6-month period. What are they? Normal hours available per month. In a month, how many hours are available? 208 hours. Absenteeism without pay. So how many hours are leave without pay, for which I am not going to pay them? 18 hours. Leave with pay. How many hours are there? 20 hours, which means 20 hours they don't work, but I have to pay them for this 20 hours. Normal idle time unavoidable. 10 hours. These are normal idle time, like lunch break, etc. Right? Then average rate of wages per day of 8 hours. How much is it? 20 rupees, which means 20 rupees the labor cost per day of 8 hours, which means per hour how much is it? 20 divided by 8. Clear with this, guys? Next, production bonus estimated on wages. 15% on the wages will be the bonus. Value of power consumed, the figure is given. Supervision and indirect labor, figure is given. Lighting and electricity, figure is given. All these are for a period of 6 months. Now, the following is for a period of 1 year. Repairs and maintenance, 3% of the value of machines. Insurance, 40,000. Depreciation, 10%. Other sundry expenses works out to, work sundry expenses is 12,000 rupees. The general management expenses allocated 54,530. You are required to work out the comprehensive machine hour rate for the machine shop. Basically, what do you mean by comprehensive machine hour rate? The total costs of this running this particular machine, right? That includes the salary payable to whom? This machine operators. We need to pay the 6 operators, right? So the total cost. So machine operator salary plus power, supervision, lighting, repair, insurance, everything put together, right, divided by the total hours for which the machine is running. Now guys, now there are two things involved here. First, now the total time for which the machine hours, the total machine hours, how will we compute? Simple. They've clearly given the machines cannot be worked without an operator wholly engaged on it, which means the effective working hours, the effective time for which the 6 operators work is equal to my machine hours. Guys, clear with this, which means normal hours minus absenteeism without pay, with pay, normal idle time. We subtract all these things, the effective time I get is equal to the machine hours. Clear with this, guys? However, for the purpose of computing how much is the amount salary that I need to pay to them, now for that purpose I need to separately compute the hours for which I need to pay them, no, because leave with the pay means what? For these hours they are not working, however I need to pay them for this. Clear with this, guys? So we need to compute the hours for which I'm going to pay them and the hours for which effectively they have worked. Why do I need to compute the hours for which I'm going to pay them? Because in the numerator, one of the costs is going to be my machine operator salary. Why do I need to compute the effective hours for which they have worked? Because this is equal to my machine hours. Are you guys clear with this? Which is useful for my denominator. You need to have this clarity. With this, you can crack this sum. Clear with this, guys? So first, what is the normal available hours, right, for 6 operators in 6 months? Now look at this, the normal hours available per month is how much? 208. It's given per month, so which means you need to do what? 208 hours are available for one operator, right, for 1 month, which means 208 hours are available, right, for 6 months, right? So 208 is the machine hours, the total hours available per operator per month. So into 6 months, 1248 is the total hours available per operator, but 6 operators are working on it. So into 6 once again, so the total normal hours available is how much? 7488. Now clear with this, guys? Next, what have they given? Absenteeism without pay. How much is it? 18. Now understand here, have they given per month? No. Which means totally every operator takes 18 hours for this 6-month period put together, which means totally how much is the absenteeism without pay? 18 hours into 6 operators, so 18 into 6, it's going to be 108. Clear with this, guys? Now, so this normal hours minus absenteeism without pay, if you subtract 7488 minus 108, you get how much? 7380. So I need to pay them. The paid hours is going to be 7380. I will have to pay them for 7380 hours. Clear with this, guys? From this, further subtract leave with pay. Means what? Sir, 20 hours. Every operator will not work for a span of 6 months put together. So 20 into how much? So 20 into 6 operators, 120 hours I need to subtract. Wait, for this 120 hours also I will pay them. Clear with this, guys? That's why I already calculated paid hours. From the paid hours, further I am subtracting leave with pay and normal idle time to arrive at the effective working hours. Means what? This is the number of hours for which I am going to pay them, useful for calculating my machine operator salary. Whereas the 7200 hours is the effective working time, which means this is equal to my total machine hours. Are you guys clear with this? Right? This is why we are computing it after the paid hours. Clear with this, guys? So leave with pay is 20 to 6. And what is the normal idle time? Sir, 10 hours, sir. In a span of 6 months, every worker, normal idle time, unavoidable is 10 hours. So 10 hours into 6, it is going to be 60. So 7380, I'm going to pay them for 7380. Minus 120 minus 60, effectively you get they work only for 7200 hours, which means for only the hours effectively worked, the machine will be functioning. So this is equal to the machine hours. However, I need to pay them for 7380 hours. Why, sir? For these two components, though they are not working, I have to necessarily pay them the labor cost. Are you guys clear with this? Right? So now, as the machine cannot be worked without an operator wholly engaged on them, therefore the effective working hours of the 6 operators for 6 months are the hours for which the machines can be used. Hence 7200 hours represents machine hours. This note clearly indicates the understanding of concept here. Now, next one, what is going to be my operator's wages? Simple. I am paying them 20 rupees for every 8 hours worked. Correct? 20 rupees for 8 hours worked. So 20 divided by 8. So that's going to be 2.5 rupees per hour. This is the wages that I'm going to pay him. Guys, clear with this, guys? Yes. So which means totally I'll have to pay them how much? So for all the 6 operators put together, I have to pay 7380 into 2.5. How much is that? That is going to be 18,480. So 18,480 rupees is actually my machine operators wages for 6 operators put together for a period of 6 months. Are you guys clear with this? The first line item is sorted. Clear with this, guys? Next, what have they given? Production bonus is 15% of wages. So on this 18,450, apply 15%, you get 2767.5. That's rounded off to 2768. Clear with this, guys? The next one, all these figures: power 8050, supervision 3300, lighting and electricity 1200. These 3 line items have to be updated as it is. So these are all the costs incurred for 6 months directly given. Next one, repairs and maintenance is going to be 3% of the value of machines. How much is this? 8 lakh. So 8 lakh into 0.03. How much is it? 24,000. But be very, very careful. It is for 1 year. We are only doing the computation for 6-month period. Guys, it's given on the top for 6-month period. So which means half of 24,000, which is 12,000 rupees. Look at this. 3% on 8 lakh into 6 by 12 is going to be 12,000 rupees. Similarly, insurance. How much is insurance going to be, guys? 40,000 per annum. So which means for 6 months it is going to be half of this. It's only going to be 20,000 rupees. Look at this. Insurance 20,000. Next, depreciation. How much is depreciation? 10% on the original cost. So 8 lakh rupees, the total cost of all the 8 machines put together. So 8 lakhs into 10% is 80,000. On this 80,000, only for half a year, it's going to be 40,000 rupees is the depreciation for this period. Clear with this, guys? Why is it 6 months? Because the denominator also we are going to take the effective machine hours for 6 months. In the numerator, take only the cost incurred for 6 months. Clear with this, guys? Then what other thing is given? Sundry expenses works out to 12,000 per annum, which means 6,000 per year. 6,000 for the 6 months, right? And general management expenses they have given 54,530 for this year. So 54,530, right, by 2, or you can say 6 by 12 into 6 by 12, you get 27,265. Add up all these costs, you'll get the numerator. How much is it? 1,39,033. This is the total overheads that you need to that needs to be charged, right? Divided by the total machine hours. So what is the total machine hours? 7,200. So this needs to be divided by 7,200. So 139,033 divided by 7,200, you get what? 19.3101 something. So 19.31 approximately is going to be the machine hour rate. So the absorption rate per machine hour is going to be the total overheads divided by the total machine hour, which comes out to 1,39,033 divided by machine hours, which is the effective working time for of these the machine operator, which comes out to 7,200 hours. So now it's going to be how much? 19.31 machine hours. Are you guys clear with this? And as simple as that. For us to do the sum, what happened? We had to do this. This is one variety of question. There's no separate concept as such. This is machine hour is just one of the 6 base quantities, but separately they are testing this area alone, where the catch is with respect to the wordings of the problem, nothing beyond that. Clear with this, guys? Right? There are many other questions with respect to comprehensive machine hour rate. It's not concept driven. It's just about the catch, the wordings of the question, which we do all the sums in our regular and exam oriented batches. But here, in a revision purpose, I wanted to take one representative question for this concept and solve that also. And with this question is over. So please go and update your library of adjustments. Write down comprehensive machine hour rate. Comprehensive machine hour rate. Clear with this, guys? Clear with this? So with this, we have literally completed all the concepts of this particular chapter, right? So primary distribution is done. Then we did secondary distribution. Look, the format also I've given here. Once you do that and come back, it's easy for you to revise, right? So we have done secondary distribution. Then the different methods and all of secondary distribution I've mentioned here. Absorption. What are the steps involved? We have seen 6 types of absorption rate, base quantities. Predetermined rate is actual rate. Then under or over absorption. We have seen this as well. then blanket rate versus departmental rate, then machine hour rate problem also, and we have also solved about 5-6 numerical problems, and I've also given many numerical examples as well for the purpose of this particular chapter, and that's a comprehensive revision of this overheads chapter. Guys, clear with this, right? So with this, we have completed this entire revision of this overheads chapter. Now let's move on to the next one. So now let's get started with the revision of one of the most important chapters called marginal costing, right? So now, before I get started with the revision of this particular chapter, there are a few things which I want to clearly mention before we start into this particular chapter. Number one, now this is a common chapter, exactly the same chapter, marginal costing. The concepts are all exactly the same in your CA Inter Cost and Management Accounting paper number 4. And in your CMA Intermediate, there are two papers, paper 8 Cost Accounting and in paper 12 Management Accounting. Now, this chapter, marginal costing, whatever we are going to learn in this chapter exactly is applicable in your CA Inter Costing and in CMA Intermediate, paper 8 as well as in paper 12, whatever we are going to study. So this is a common marathon, right, or a revision video of this chapter, marginal costing, for both your CA as well as your CMA Intermediate courses. But let me tell you one very, very important thing. Now, when it comes to all the paid courses, be it your exam oriented batch or your regular batch, now I have done separate recordings for CA Intermediate, separate recordings for CMA Intermediate. Even there, for paper 8, I have done it separately. Paper 12, I have done it separately. I'm talking about the paid courses, be it exam oriented or your regular batch, right? So I have done separately. This entire chapter has been done separately 3 times. Though the learning objectives, the concepts are all exactly the same. Now, this has been done strictly based on the respective institute study materials as well as the past exam questions and all of that. But when it comes to a marathon, for the purpose of marathon alone, I'm combining it so that the same marathon or a revision video will be useful across all the students. For all the students, they can use the same marathon purpose. So for marathon purpose alone, I am doing this particular chapter in a combined manner. Now guys, if you notice, I have listed out all the concepts which are applicable in this particular chapter: your income statement, profit volume ratio, break-even point, margin of safety, profit, cash break-even point, indifference point, volume analysis, sales mix, sensitivity analysis, limiting factor analysis, shutdown point, marginal costing versus absorption costing. These are all applicable for all the 3 subjects, that is one paper in your CA Intermediate and both paper 8 and paper 12 in your CMA Intermediate. This last concept, number 14, accept or reject of a special order. This alone is applicable for CMA Intermediate paper 8 students alone. So I am pushing this to the end so that in case you are a CMA Intermediate paper 8 student, you can watch this. Else this part alone you can skip it, right? So clearly I have bifurcated in such a way that this is applicable for all the students. Exactly the same concepts are applicable for all the students, right guys? Fine. Now one more thing I want to clarify. With respect to the books, right, we have a concept decoder book and a solved question bank, as you guys know. Now, for CA Intermediate Costing, we have a separate concept decoder, solved question bank. For CMA Intermediate, paper 8, we have a separate concept decoder, solved question bank. And paper 12, we have a separate concept decoder, solved question bank. Every single thing is separate. Paid courses, your books, everything is separate. Marathon purpose alone, I'm combining for the benefit of all the students, so that because the concept is going to be the same, right? We will be covering, and in this marathon itself, I will be covering a few sums from your CA, few sums from your CMA. Now, do not think that, sir, then you are mixing the two, so CA students need not work out CMA questions, CMA students need not work out CA questions, nothing like that. These are all common questions. We are in a professional course, so if there is a particular concept, any which way they can frame the questions. So I am only doing things which are applicable everywhere. In case something is exclusive, I will clearly tell you it is exclusive. The last concept alone is exclusive for CMA Intermediate Paper 8 students. So this is also one thing which I want to clearly clarify before we get started into this particular chapter. Now on that note, let's get started with this revision of marginal costing. Now guys, the first thing we will do here is with respect to the basics of this chapter. Quickly we will revise. Now I will be starting from the scratch. Now marathon, so I will be in the marathon itself, I will be constructing the formulas and all these things. It will be a super reviser for you, so that you will be in a position to appreciate all the concepts, and a few sums also we are going to do in the marathon itself. Now let's get started. Now these first 5 concepts, I call it as the basic concepts. Now we will understand this basic concepts, revise this basic concepts with the help of a numerical example. Now let us say that the selling price is 10 rupees, the variable cost is 6 rupees, fixed cost is 10,000 rupees, the volume is 6,000 units. Now with this data we need to prepare an income statement, marginal costing income statement, calculate the profit volume ratio, calculate the break-even point, calculate the margin of safety, and calculate the profit. Now quickly let's get started here. Now solution. Now guys, first the marginal costing income statement format looks as follows. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now in this case, what is going to be my sales? How many units am I selling? 6,000 units I am going to sell, and every unit is being sold at a selling price of how much? 10 rupees. So which means overall my sales value is going to be rupees 60,000. Now what's going to be my variable cost? 6,000 units each at the rate of rupees 6. It's going to be how much? Rupees 36,000. Right? Now from your sales, if you subtract your variable cost, you get your contribution, or in other words, this contribution is nothing but your variable profit. Every time I sell a unit, I get a revenue of 10 rupees. I need to incur a variable cost. Means what? So only if I produce the next unit, I'll be incurring this cost, 6 rupees. Or in other words, every time you sell every unit, you get a variable profit of how much? 10 minus 6, which is going to be 4 rupees. So 60,000 minus 36,000, so gives you how much? It gives you rupees 24,000. Or I can also say this 24,000 is nothing but 6,000 units at the rate of rupees 4 each. Right? Now this 24,000, is this your final profit? No. Why? Because fixed cost is there, we have not yet adjusted that. So now from this, subtract your fixed cost of 10,000 rupees, you will end up with a profit of how much? 14,000 rupees. Clear with this, guys? Now guys, basically, now every time I sell one unit, I will earn a revenue of 10 rupees. For me to earn this revenue of 10, I need to incur a variable cost of 6, which means the variable profit is going to be 4 rupees, popularly called as contribution per unit, is going to be 4 rupees per unit. We know that, right? Now, why do we use the word contribution, sir? Now, we can rather use the word variable profit. Simple. Now, what happens? Every time I sell one unit, I earn a variable profit of 4 rupees. Like that, I keep on selling multiple units. Overall, now I've sold how many units? 6,000 units into 4. I have built up a total variable profit of how much? 24,000 rupees. Is this 24,000 rupees my profit? No. Now, what do I do with this 24,000 rupees? First, it contributes towards recovery of fixed cost. With this 24,000, I try to recover my fixed cost of 10,000 rupees. After recovering the fixed cost of 10,000, whatever is left over is called as my profit. Or in other words, this variable profit goes on to contribute towards recovery of fixed cost and then towards building my profit. Since it contributes towards two things, recovery of fixed cost and building your profit, we call this as a contribution. Clear with this, guys? So in this case, 10 rupees is my selling price, 6 rupees is my variable cost per unit, and then I can say the contribution per unit, short form is CPU. So contribution per unit is going to be how much? 4 rupees. 10 minus 6, 4 rupees. Clear with this, guys? Right? Now, this is how your marginal costing income statement looks like. So this is your A, marginal costing income statement. That's about it. Fine, guys. Clear with this? Next one. Let's move on to part B of the question. Now, in this part B of the question, what have they asked? Calculate the PV ratio. Now, very simple. Very simple. Now, let us say on a per unit level. Now, what is the format of your marginal costing income statement? Basically, it's sales minus variable cost gives you contribution, right? From that, minus fixed cost gives you profit. We know that. Now, on a per unit level, how much is the sales? Basically, my selling price is 10 rupees. My variable cost is going to be how much? 6 rupees, which means my contribution is going to be how much? 4 rupees, right? Or if you want it in value, for 6,000 units, we know that if I'm going to sell 6,000 units, my total sales is going to be simple, 10 into 6,000, 60,000 rupees, right? And my variable cost is 6 into 6,000, it's going to be 36,000 rupees. And my contribution is going to be 4 into 6,000, that's going to be rupees 24,000. Right, guys? Fine. Now, if I want to express everything as a percentage of my sales, or in other words, if I keep my sales as the base, and if I say, right, keep your sales as a base, that is going to be 100%. Now, if I want to express my variable cost as a percentage of sale, now can I say when my sales is 10 rupees, my variable cost is 6 rupees, or in other words, the variable cost is generally 60% of my sales. Yes, so 6 divided by 10 into 100. So can I say this is nothing but 60% of sales. So variable cost, if expressed as a percentage, I can say that it is 60% of my sales. Clear with this, guys, right? So this is called as variable cost ratio, BC ratio. What do you mean by variable cost ratio? Variable cost divided by sales into 100. Variable cost expressed as a percentage of sales into 100. Next, now I can also express my contribution as a percentage of sales. That is, contribution 4 rupees divided by 10 into 100. I can clearly say, so contribution expressed as a percentage of sales is how much? 40%. Now I can call this as PV ratio. What do you mean by PV ratio? Profit volume ratio. Are you clear with this, guys? Sir, why is this called as profit volume ratio? Basically, your contribution is nothing but variable profit. So your variable profit expressed as a percentage of sales is called as PV ratio. Are you all able to understand this? Yes. Now, guys, now always remember one thing. Your variable cost ratio plus your profit volume ratio will be equal to 100. Why? Obviously, your sales is made up of what? Your variable cost and contribution, right? If variable cost ratio is 60%, then obviously 100 minus 60, 40% will be my PV ratio. Now, this way you can easily approach any kind of question which has everything expressed as a percentage. Are you all able to understand? Or in other words, guys, profit volume ratio is nothing but contribution divided by sales into 100. Now, don't think this can be calculated only on a per unit level. Now, on a per unit level, it is 4 divided by 10 into 100. Suppose if you want to take at 6,000 units level, no problem. You can take 24,000 divided by 60,000 into 100. You calculate and see. So 24,000 divided by 60,000 into 100. Once again, you will get 40%. How, sir? Simple. Contribution 24,000. How did you get? Simple. It's going to be rupees 4 into 6,000 units, right? Divided by what is the sales? 60,000. How did you get? Rupees 10 into 6,000 units. Anyways, both the numerator and the denominator are multiplied with the same units, effectively you will get only contribution per unit divided by selling price per unit. Are you all able to understand? So the proportion will not change because both the numerator and the denominator are multiplied by the same number of units. Are you all able to understand? So literally you can say PV ratio is equal to contribution by sales into 100 at any given volume level or a per unit level or on a total level. Fine, guys. So this is your story about profit volume ratio. With this, we have also completed the second part of the question. Third part of the question, what is this? Calculate your break even point. So point C is your break even point. Now, by the way, guys, as I told you earlier, separately I have mentioned all these things in the concept decoder book of the respective subjects. So your CA intermediate costing, CMA intermediate paper 8, CMA intermediate paper 12. Everywhere, everything is mentioned separately. And in the question banks, all the questions with past examination, your study material questions, past exams, everything is covered here. Now, for instance, I will just open and show it to you. This is your CA intermediate, your paper 4. Cost and management accounting. Here everything has been neatly condensed and presented here, right, for marathon purpose. So I'm mentioning it in such a way that quickly you'll be able to recapitulate everything. Now similarly for paper 8, once again the separate chapter we have in a separate book, right? This is a separate book, in fact, exclusively for paper 8. And similarly for paper 12, if you see, so here paper 12 management accounting, once again it is chapter number 3. Separately I have mentioned everything. These are all different books. All these books you can download it from our website, right? So I've made it clearly applicable. I mean, I've bifurcated it separately in the respective books. Nothing to worry about that, right? Only for marathon purpose I'm merging it, just so that in a common recording every student will get a proper learning objective. Right, guys? So now let's move on to the next one, which is called as break-even point. Now what do you mean by a break-even point? It is that point of sale where you will be left with zero profit. That is, there is neither a profit nor a loss. The profit is not positive nor negative. It is exactly zero. Or in other words, how many units should I sell so that my profit is exactly equal to zero? Those number of units is called as break-even point. Now guys, how will you compute this break-even point? Simple. Now, if I want to earn exactly zero profit, can I say it will happen at a point when my contribution exactly recovers my fixed cost and I am left with zero profit, correct? So I should be left with zero profit. When will you be left with zero profit? Only when your contribution exactly recovers your fixed cost, correct? Yes. So now can I say this break-even point happens at a place when my contribution is equal to my fixed cost. So we need to calculate how many units should you sell so that your profit is exactly zero. So, or in other words, at that point, my contribution will be exactly recovering my fixed cost, right? It will not recover more. If it recovers, if my contribution is more, then over and above recovering the fixed cost, I will be left with profit. If my contribution is less, I will not be even able to, I will not even be able to recover my fixed cost. Hence, I'll be left with a loss. So, exactly it should be equal to your fixed cost. Only then you'll be left with a zero profit or loss, right? Now we need to calculate how many units should we sell. Now, can I say, let us keep the number of units to be sold as X. So now contribution is equal to nothing but the number of units to be sold. Let us keep it as X into every time I sell a unit, I know I will be earning a contribution of how much? 4 rupees. So can I say X into rupees 4 should be exactly recovering my fixed cost. How much is my fixed cost? In this question, they have clearly given the fixed cost is going to be 10,000 rupees. So exactly I should be recovering how much? 10,000 rupees. Or in other words, can I say X should be equal to rupees 10,000 divided by rupees 4. Or in other words, it's going to be how much? 10,000 by 4. We will say it is 2,500 units. So if you exactly sell 2,500 units, so 2,500 into 4, you will generate a contribution of 10,000 rupees. From that contribution, subtract fixed cost, which is 10,000. Exactly, you will be left with zero profit or zero loss. Or in other words, we can clearly say your break-even point is 2,500 units. How did we calculate? 10,000, which is nothing but fixed cost, divided by 4, which is nothing but contribution per unit, or in other words we can say the break-even point formula. The break-even point formula, if you want to compute that in units, is going to be fixed cost divided by contribution per unit. As simple as that. Clear for this, guys? So why do we need to mug it up? So simple and logical. Beyond this, there is nothing that you will need. Clear with this, guys? Yes. Now, suppose break-even point is nothing but point of sale. How many units? What is the volume I should sell so that my contribution exactly recovers my fixed cost? That's my break-even point. Now, this break-even point can also be expressed in values because it is sales. No, sales can be expressed in units or in values. Now, suppose if I want to find out the break-even point in value, how can I do that? Very simple. Similar thing. So break-even point is a point at which what my contribution should be equal to my fixed cost. Correct? So it is a point where my contribution should be equal to my fixed cost. Now, how much is the fixed cost? 10,000 rupees. Now, can I say contribution is nothing but, now contribution is nothing but, one way of arriving at the contribution is number of units, X number of units into rupees 4, contribution per unit. Or can I say contribution is nothing but sales in value into PV ratio? For example, in this case, PV ratio was how much? 40% in this question. So this 24,000 was the contribution when my sales was how much? 60,000. Or in other words, can we say 60,000 into 40%? Can I say will be 60,000 into 40% will exactly be 24,000. So can I say another way of computing contribution is your sales in value multiplied by PV ratio. So now we can say here, we can keep this as sales in value, or in other words, I can say this is your required sales X in value. I'm putting a rupee symbol here into PV ratio should be equal to 10,000 rupees. Correct? Now, or in other words, X, that is sales, required sales in value, into how much is my PV ratio in this question? 40% into 40% is equal to rupees 10,000. Or in other words, X in rupees or in value is going to be rupees 10,000 divided by 40%, or this is nothing but how much is it? 10,000 divided by 0.4. You get how much? Rupees 25,000 is going to be my break-even point in value. Or in other words, guys, very simple. Now I can say if you want to calculate the break-even point in value, the formula is fixed cost divided by PV ratio. Are you all able to understand? Now, sir, logic for this. So once again, I will just put it here. Break-even point in value is going to be fixed cost divided by PV ratio. What is the meaning of this? If you generate sales worth 25,000, now what will happen? Sales is 25,000 in this case. So now what will be the contribution? 25,000 into 0.4. You will be exactly generating a contribution of how much? 10,000 rupees. Now from this 10,000 contribution, subtract your fixed cost 10,000, you will be left with zero profit or zero loss. Are you clear with this? Or in other words, another way of doing simple, sales minus variable cost gives you contribution minus fixed cost gives you profit. Now I want to calculate how much sales I should make, right, to exactly earn a zero profit or zero loss. So now your profit is zero. Now fixed cost is given. I need to recover 10,000 rupees, which means my required contribution is how much? 10,000 rupees. Correct? Reverse work. Right? Only if I exactly generate a contribution of 10,000, my fixed cost of 10,000 can be recovered and I'll be left with a zero profit. Right, guys? Fine. Now we know this PV ratio concept. Now if I generate sales of 100, my contribution is generally 40. That's the concept of PV ratio. We know that. Now simple, if 10,000 should be equal to 40, how much should be 100? It is nothing but simple formula you can use mathematically. 10,000 divided by 40 into 100, or in other words, this is nothing but 10,000 divided by 40%, or this is nothing but this formula, fixed cost by PV ratio. Are you clear with this, guys? Logically you can arrive anything and you will be able to clearly complete this chapter. Not even a single formula needs to be mugged up. That's the beauty of marginal costing. Right now, guys, mugging up in costing and in FM also, I'm telling you, not even a single formula in the entire subject should be mugged up, right? Mugging up in our subjects is not even a sin, it's a crime. It's a crime. You should not mug up because everything is so logical here. Now, look at this. This is about the formula. Simple, guys. Break-even point, if you want it in units, fixed cost by contribution per unit. Suppose if you want the same in value, denominator, instead of contribution per unit, you put it as PV ratio. Always remember this. If you want the answer in units, it is going to be contribution per unit. If you want the answer in value, put it as PV ratio. You will get it. Are you all able to understand? This is all about the logic, and all these things in detail. I have just explained it in a neat manner in the concept decoder of the respective CA and CMA books. Separately, they are all mentioned. Clear with this, guys? That's about this area. So basically, what do you mean by a break-even point? It is that point of sale where your contribution exactly recovers your fixed cost and you're left with a zero profit or zero loss. That is all about this area of break-even point. Formula, if you want the break-even point in units, the formula is fixed cost by contribution per unit. If you want the answer in value, it's going to be fixed cost by PV ratio. As simple as that. Now let's move on to the next one, D. Let's move on to the next one, D. Now what is D? They have asked for something called as margin of safety. Now, how do you compute this margin of safety? Now guys, very simple. Now, in this question, you guys tell me, overall, how many units have been sold? The example that I gave you. They have sold a total of 6,000 units, correct? Right. So they have sold a total of 6,000 units. So I'm keeping it here. The total sales made was 6,000 units. Right, guys? Fine. And what was the break-even point? The break-even point we just now computed. Let's put it in units. 2,500 units. So the break-even point was 2,500 units. Right, guys? So this is nothing but your break-even point. This is nothing but your total sales. Perfect. Now, what do you mean by margin of safety? Very simple. You've totally made sales of how much? 6,000 units. Now, if you sell 2,500 units, you generate a contribution that exactly recovers what? Your fixed cost, and you're left with zero profit or zero loss. Correct? Now, any sale that you make over and above your break-even point generates a contribution that goes on to contribute towards building your profit. Are you guys clear with this? So overall sales 6,000 units is broken up into two. First 2,500 units, it generates a contribution that is meant for recovering your fixed cost. Once entire fixed cost is recovered, whatever contribution you earn goes on towards building your profit. So the number of units sold over and above my break-even point is called as margin of safety. Now, in this particular scenario, how many units have we sold over and above the break-even point? So we have sold, literally, so 6,000 units minus 2,500 units. Literally, guys, in this case, we have sold 3,500 units over and above my break-even point. This is called as margin of safety. Clear with this, guys? Or in other words, total sales minus break-even point gives you margin of safety. Are you all able to understand this? Now, a very, very important thing that I'm going to tell you, I call this as marginal costing jodies. A very, very important understanding that you need to have. These are all basics of marginal costing. So once you strengthen this up, automatically the remaining part of the chapter will be easy for you to appreciate. Now, guys, first one. Now, let me just write on the format of this, marginal costing income statement. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Right? Now, in this particular example, what was the total sales we made? Right? 6,000 units into 10 rupees. How much was that? Rupees 60,000. Right? What was the variable cost? Now, 6,000 units into 6. It was how much? Rupees 36,000. If you subtract the two, Now, or in other words, what is the contribution? 6,000 units, each unit generated 4 rupees of contribution. So it's going to be 24,000, right? From this, subtract your fixed cost, 10,000 rupees. Literally, you are left with what? A profit of how much? A profit of rupees 14,000, right? Now, remember this for a lifetime. It's a very, very important understanding. Now, guys, the total contribution generated out of the total sales, that is 6,000 units, generated a contribution of how much? 6,000 units into 4. So the contribution generated by 6,000 units is nothing but the total contribution, 24,000 rupees. Are you all clear with this? So can I say my total sales is linked to my contribution, right? Next. Now, the contribution generated by the break-even point units, first 2,500 units, what was the contribution it generated? 2,500 into 4, 10,000 rupees, right? Or in other words, that is nothing but equal to your fixed cost, right? So, the contribution generated by break-even point is going to be equal to your fixed cost, right? Simple. Why? Because break-even point is nothing but that point where my contribution exactly recovers my fixed cost. Nothing less, nothing more. If it is less, then you will be having a loss. If it generates a more contribution, then you will be left with a profit. Exactly at 2,500 units, what you have is you generate a contribution equal to your fixed cost. Suppose I'm selling only 2,400 units, which means if I'm operating below the break-even point, the contribution that I would have generated would not even be able to recover your fixed cost. Suppose if I'm selling above my break-even point, it means after recovering the fixed cost, I have some extra contribution that goes on to build my profit. This way you can clearly analyze. Now over and above my break-even point, how many units have I sold? 3,500 units. The contribution generated by these 3,500 units now goes on to build my profit. 3,500 into how much? 4 rupees. 3,500 into 4, how much is that? 14,000 rupees. So this is going to be equal to my profit. Are you guys able to understand? Or clearly make a very important note of this. My total sales is linked to my contribution, right? Now my break-even point is linked to my fixed cost, and my margin of safety is linked to my profit. Are you all able to understand? So the contribution generated by total sales is going to be the total contribution. The contribution generated by break-even point is nothing but your fixed cost, and the contribution generated by your margin of safety is going to be called as your profit. Are you all clear with this? Now, one more very important thing. Now, these are all ideally your volume levels. This can be expressed in total values also. For example, 6,000 units. If you want to mention in units, it is 6,000 units. If you want to mention it in value, it's going to be how much? 6,000 into 10, 60,000 rupees. I can call this as 60,000 rupees. Correct? Similarly, break-even point, sir, 2,500 units, sir. If you want to express this in value, 2,500 into 10. This is going to be 25,000 rupees. Correct? Worth of sales. And margin of safety, 3,500 units. If you want to express this in value, it's going to be 3,500 into 10. It's going to be 35,000 rupees. Correct? 35,000 rupees. Right? Now, very simple, guys. Now, can I say my total sales, right, 6,000 units into contribution per unit gives me my total contribution, or my total sales into value into PV ratio gives me my contribution, right? Now, you can calculate this 60,000 rupees into 40%. Take your calculator and do. You get how much? 24,000 rupees. Or break-even point. In units, break-even point units into contribution per unit gives you fixed cost 2,500 into 4 gives you 10,000. Or break-even point, if it is in value, then use PV ratio into PV ratio 40%, 25,000 into 0.4, how much is it? 10,000 is equal to your fixed cost. Or margin of safety, similarly, in units into contribution per unit, that is 4 rupees, you will get a profit. Or margin of safety into in value into PV ratio 40%, you try and do, you will get what? Profit. Are you guys clear with this? Or in other words, total sales is linked to total contribution, break-even point is linked to fixed cost and margin of safety is linked to profit, the linking factor is what? The linking factor is ideally your contribution per unit, the contribution per unit, or you can also say PV ratio. It is contribution per unit or PV ratio. Sir, how or sir? If these are in units, if these three, the top figures are in units, then the linking factor is contribution per unit. If these are in values, the linking factor is PV ratio. Are you guys able to understand this? Are you guys able to understand this? Right? Now, coming to the discussion of margin of safety. Coming to the discussion of margin of safety. Now, guys, can I say margin of safety once again can be expressed either in units or in value, correct? Now, if you want to express this in units, now I can say simple. One formula is what? Total sales minus break-even point, correct? In this case, how much is it? Sir, totally I've sold 6,000 units. Sir, break-even point is how much? 2,500 units. How many units have I sold over and above the break-even point? 3,500 units. Clear with this, guys? Next, another formula. Now, use this marginal costing jodis. Now, can I say margin of safety into contribution per unit gives me the profit. The profit generated out of these extra units only went on to build my profit, correct? So can I say margin of safety into contribution per unit is equal to profit, or in other words, margin of safety is equal to profit divided by contribution per unit. Are you all understanding? This 14,000 rupees is a profit that I earned, right? By selling how many units? Sir, every time I sell one unit, I earn a contribution of how much? 4 rupees in our example. So how many extra units have I sold over and above the break-even point to generate this profit of 14,000 is the calculation. So another formula here is going to be what? It is going to be profit divided by contribution per unit. Are you guys able to understand? Every single thing is derived, right? In the marathon itself, I'm deriving so much. In our regular or exam oriented batches, it will be done with much more explanation and other things. Since this is revision, still I want to set the context and I'm doing it for you. Clear with this, guys? Because there might be some students who might not have listened properly, or maybe some freshers who have not at all attended the lecture. Since to set the context, I'm just giving all these explanations once again, so that the remaining part of discussion in this marathon itself will be very, very easy for you to understand. Clear with this, guys? Now, very simple. If you want the figures in value, margin of safety, once again, guys, so the formula, one of the formula is going to be total sales in value minus break-even point in value. Look at this. Total sales in value. How much was that? 60,000 rupees minus 25,000 rupees. If you subtract, you get 35,000 rupees, right? Or another formula is simple. Use this formula, right? Profit divided by, now I want it in value instead of contribution per unit, use PV ratio. One more jodi, no, right? So simple. So margin of safety 35,000 into PV ratio gives me my 14,000 rupees of profit, or profit divided by PV ratio gives me the margin of safety. Are you guys clear with this? So it is going to be profit divided by PV ratio. This is another formula for your margin of safety. As simple as that, guys. This is the power of conceptual learning. Beyond this, you don't need anything at all. That's all about it. That's all about it. Fine, guys. Now, that's about this particular area of margin of safety. Clear with this, guys? And finally, you can arrive at your profit. I think this profit has been arrived at. In this question, how much is your margin of safety? I think we've arrived 3,500 rupees. I mean 3,500 units. Or if you want it in value, it's going to be 35,000 rupees. We have calculated all of that. And finally, guys, what is the thing they have asked for? So last one is arrive at the profit. Now, guys, in your study material, so many formulas are there, and students mug it up. No need to mug up formulas. Now, profit, what is the formula? Profit is equal to, one formula I can say, use the marginal costing income statement. Sales minus variable cost is contribution. Contribution minus fixed cost gives you what? Profit, correct? This is one formula. Another formula, use your marginal costing jodis. Can I say profit is equal to margin of safety units? Profit is nothing but the contribution generated by the margin of safety units. Or in other words, your margin of safety units into contribution per unit. 3,500 into contribution per unit is 4. This is also equal to your profit, right? So another formula we can say is profit is equal to margin of safety units into contribution per unit, or suppose margin of safety is given in value, multiply that with PV ratio. This way also you can arrive at the profit, right? In this question you look at it, what is the margin of safety in value? 35,000 rupees into PV ratio, how much was that? 40 percentage. So 35,000 into 0.4, how much you get? 14,000 rupees. As simple as that. You can literally play around with the figures. This is the power of conceptual learning. Clear with this, guys? Just we spent some time and look at the variety of formulas we ourselves can arrive. That's about it. You need not mug it up. You need not mug it up at all. Clear about this, guys? So these are different variants of arriving at the the profit formula. That's about it. Now itself, if you notice, we have covered so many formulas, and the best part is that all these formulas on the spot you can derive and arrive it. You need not take the pain of mugging up anything. The formula construction, we spent about 35-40 minutes right now. With that itself, we are getting this much level of conceptual clarity so that you can arrive the formula by yourself. With this, any kind of sums in this basic level, you will be in a position to handle. Clear with this, guys, right? So that is about the basic concepts covered in this particular chapter initially. So with this, we have covered the revision of income statement, PV ratio, break-even point, margin of safety, and profit. Clear with this, guys, right? Now let us go on and cover one more small concept called as cash break-even point. Now guys, what do you mean by cash break-even point? Now let us take this particular example itself for discussion. Now all the facts are same. Only one small additional information. Here fixed cost is given. How much? 10,000 rupees. Now let us say out of this fixed cost of 10,000 rupees, right? Example, I'm telling you, depreciation amounts to rupees 2,000, which means what? The other component is your cash fixed cost. What do you mean by cash fixed cost? Basically the fixed cost which is incurred in cash. For example, your factory rent, that is an amount I need to pay, right? In cash, it's going to be balancing figure 8,000 rupees. Now your total fixed cost is bifurcated into two. Cash fixed cost, those components of fixed cost which are actually incurred and which needs to be paid to some third parties. Whereas your depreciation, this is also a fixed cost, but this is something that I set aside for my accounting purposes, right? Literally, I would have spent the entire amount, capitalized the value, and based on my period of consumption, based on the period of the life of the asset, I amortize, I apportion it, right? Now this is an amount I need not pay out by cash. Now what do you mean by a break-even point? It is that point of sale. How many units should I sell to recover my entire fixed cost? Correct? Now in this question we saw, right, it was 10,000 rupees I want to recover, right? So every time I sell one unit, I earn 4 rupees. Literally I need to sell 2,500 units so that I will be exactly able to recover this 10,000 rupees of fixed cost. This is what we saw. Now cash break-even point means how many units should I sell to recover only the cash fixed cost. I need not recover the full fixed cost including depreciation. So how many units should I sell in order to recover this 8,000 rupees in our example of cash fixed cost? Or in other words, can we say cash break-even point is equal to cash fixed cost divided by contribution per unit, right? Now in this case, I want to recover a total of how much? 8,000 rupees, right? Every time I sell a unit, how much contribution do I earn? I earn 4 rupees, which means how many units should I sell? 2,000 units. If you sell 2,000 units, exactly 2,000 units, each unit will generate 4 rupees of contribution. I will be able to pile up a contribution of how much? 8,000 rupees. From this, subtract your cash, this will be equal to your cash fixed cost. I will be able to recover my cash fixed cost. Are you all able to understand? Now guys, clearly understand, at cash break-even point, you will not be having your profit equal to 0. You will be having a loss. Sir, how, sir? Simple. I will give this particular table and you will be able to understand. Now, guys, let us say in our example we saw the break-even point was how much? 2,500 units. And we saw the cash break-even point right now we saw is how much? 2,000 units. Now, at the cash break-even point, how much contribution you would have generated? You would have generated 2000 into 4, which is equal to how much? 8,000 rupees. However, from my contribution, subtract your fixed cost 10,000 rupees. Literally, in this position, you will be left with a loss of how much? So, literally, guys, at 2000 units level, 2000 into 4, 8,000 rupees is going to be my contribution minus entire 10,000 rupees of fixed cost. Literally, you will be left with a loss of 2,000 rupees. Correct? Whereas at the break-even point, full break-even point means what? It is so many number of units that I need to sell so that my entire fixed cost of 10,000 rupees is recovered. I am left with 0 profit, 0 loss. So here, literally 2,000 into 4, 2,500 into 4, 10,000 rupees the contribution minus fixed cost 10,000. I'm left with a profit or loss of exactly 0. Or in other words, guys, any point operating below the break-even point we know will give you a loss only. Right now, at the cash break-even point, I am selling so many number of units that is exactly able to recover only my cash fixed cost, which means I have still not yet recovered my depreciation. Or in other words, the profit or loss, in this case the loss at the cash break-even point level will be exactly equal to the depreciation, because that is the only amount which I have not yet recovered. Are you guys clear with this? So one small learning objective here, at the cash break-even point, I generate contribution that is sufficient to recover my cash fixed cost, which means I have not yet recovered my depreciation amount. Or in other words, at the cash break-even point, in this example 2000 units, I am left with a loss which is exactly equal to the unrecovered component of your fixed cost, which is nothing but your depreciation amount. Are you all able to understand? At the cash break-even point, the loss is equal to your depreciation, because that is the only amount which is not yet recovered. Are you guys able to get this? This is the concept of cash break-even point. Now, literally, guys, with this we have also covered this concept of cash break-even point. These are all the basic concepts which you definitely need to have in your mind, which you need to know before you can enter into the other areas. That's the reason why I'm giving you guys a background here itself. Right now, all these things I have clearly explained in our concept decoder book. If you open it neatly, a lot of efforts have gone into building these books, because these are, as I told you, these are separately available for CA Inter paper 4 cost and management accounting, CMA Inter paper 8 cost accounting, CMA Intermediate paper 12 management accounting. All the books are separate. All the books are separate, neatly done based on the respective study materials. I have done it, and accordingly all these explanations have been given here. Right, this example I gave you with an illustration so that you can understand. Look at this. Selling price per unit is equal to variable cost plus contribution. Correct? Sales minus variable cost is contribution, or contribution plus variable cost is sales. Any which ways you can play around. Contribution per unit is equal to selling price minus variable cost. Everything is explained here. Basic concepts here. So contribution per unit is selling price minus variable cost. Total contribution is sales into PV ratio, or you can say contribution per unit into units sold. You can play around, or sales minus variable cost, or you can say sales minus variable cost is equal to contribution minus fixed cost gives you profit. So contribution is equal to sales minus variable cost, or if you want to reverse work, you can say it is going to be fixed cost plus profit. So contribution minus fixed cost gives you profit. Now if this goes to the other side, contribution is equal to profit plus fixed cost. This way also you can write. Literally you can play around everything I have mentioned here. The background logics is what I just taught you right now. Like this, every single thing, PV ratio, right? The formula, contribution by sales into 100. Right, required sales, we'll be doing it. Now all these things, literally this is also something that we'll be covering in volume analysis. I will just come up right now. So every single thing, cash break even point, what is the meaning of that? Fixed cost divided by contribution per unit is your break even sales. Right, if you want it in units, if you want it in value, it's divided by PV ratio. Right, now the break even sales You can say it's break-even units into selling price per unit. So cash break-even point is nothing but cash fixed cost divided by contribution per unit or PV ratio as the case may be, right? And I've also given this doubt buster clearly. Doubt buster basically is those areas which you can have a confusion. At the cash break-even point, there will be a loss which is exactly equal to your non-cash expenditure depreciation. Every single thing literally has been mentioned here in the concept decoder book itself. Clear with this, guys? So there is nothing beyond this that you need. This is a very good way to actually, once you cover this conceptual explanation, you just go through it once, you will be able to have a full-fledged understanding the day before your exam. You just need to open your concept decoder and go through it once. You will be able to remember every single thing that I taught you. That is the biggest value addition, because all these things have been carefully designed. All the colorings and other things have been designed in such a way that you will be able to recollect all the important parts, whatever I've taught you during this lecture, when you are revising it. So this is a book which you can use both at the time of preparation, same book at the time of revision also. So I've removed all the unwanted content that runs into multiple paragraphs. We have used some AI tools and all to condense everything in a neat presentation manner. And if you notice, all these formulas are mentioned in a separate font, dark purple, right? So that the day before your exam, you can quickly revisit everything. Clear with this, guys? And the logic for all these things through our lectures is what we cover. Now just imagine in the marathon itself, I'm covering all these things. In our exam oriented or regular batches and all, it will be in a much detailed manner in such a way that we'll be covering so many sums also in the marathon revision. So little bit of sums here also I will cover, but all the sums in detail, all the chapters will be covering in our exam oriented as well as regular batches. Right, guys? Fine. So with this, let us move on to the next concept called as indifference point. So indifference point. Now let's get started with this particular concept. Now guys, we will also do one numerical problem in this particular area, one high level question we will be doing. Now even in the marathon, still it's okay, we will do a high level question, because this will cover this entire concept of indifference point. But before that, quickly, I will walk you through the concept of indifference point with all the formula explanation we will derive and see everything. So indifference point. Now guys, what is this concept all about? Quickly, I will give you guys an example. Now, long ago, right? So now don't think I'm talking about some previous generation, years and decades back. No, a few years back, right? Before 2016, right? Why, sir, 2016 specifically? That was the year when Jio came into this telecom sector. Before that, right? Now, there were multiple players in this telecom sector. Now, they had this concept of prepaid, postpaid. It is still there, but it is not as vibrant as it was before, because Jio has come up with all this unlimited plans. So many people, they don't know the concept of prepaid, postpaid and all nowadays. That's why I started off with saying long ago, master stroke by the Reliance group of companies, master stroke, they wiped off the entire market. And initially they gave all the SIM cards free of cost and everything, and people were actually making fun. They were thinking, why are these guys doing all this, right? And they thought in India people will use free of cost and then they will not buy. Slowly and gradually he introduced all this paid subscription into the market, and literally they swept off this entire telecom industry. Fine, the case study another part, maybe in a separate video I'll make. But right now, let's take this example of telecom sector to understand the concept of this concept of indifference point. Now guys, let's say you have two models. One is called as prepaid, the other one is called as postpaid, right? Now in prepaid, generally what you have, in both the models you have a variable cost and a fixed cost. Let me take an example. Suppose if you are opting for a prepaid SIM, they will say, sir, monthly you should pay us a fixed charges of 100 rupees, right? What is this? This is going to be an amount which you pay them because they are retaining your mobile number. Variable cost, for every call you make, let us say you are supposed to pay them 50 paise, right? So which means if you're taking a prepaid SIM, flat 100 rupees every month, irrespective of your calls you need to pay, plus every call you make you need to pay them 0.5 rupees. Whereas if you're going for a postpaid plan, every month you need to pay them a fixed charges of 500 rupees. But the advantage here is every time you make a call, per call you need to pay only 30 paise, right? Now guys, prepaid plan, this is the cost model, 100 rupees flat every month plus 50 paise per call. Postpaid, 500 rupees every month plus 30 paise per call. Now you guys tell me, which is more beneficial? Which is more beneficial? Will I go for prepaid or will I go for postpaid? Out of the two, which one is the best? Now, you can't come up with a solution like always prepaid is best or always postpaid is best. Why? Because here we need to choose between two different alternatives, and in prepaid, the advantage is lower fixed cost. Instead of 500 here, it's only 100 rupees. Whereas in postpaid, the advantage is by way of lower variable cost. Instead of 50 paise, here it's only 30 paise, that is 0.3. Or in other words, both these options, alternatives, will have one advantage and one disadvantage each. In this case, you can't directly come to a conclusion saying one particular alternative is always better than another particular alternative. Are you guys clear with this? And this concept of indifference point will come into picture only when you are deciding to choose between either of the two alternatives. Between choice of multiple alternatives, only then will you have a concept of indifference point. By the way guys, this chapter goes on to achieve the objective of decision making. Here in this chapter, throughout we are going to take decisions, right? So that is the most important thing that you need to have in mind. Ideally, I should have told this before. This chapter has an objective of decision making, right? And by the way guys, now our subject, right, cost and management accounting, overall it has three objectives. One is your stock valuation and profit computation. The second objective is decision making. The third objective is control. Right now, this chapter helps you achieve the objective of decision making. Every single chapter has its own objective, either of the three objectives. This chapter has the objective of achieving your objective B, the second objective, decision making. However, in one area alone, that is in this concept called marginal costing versus absorption costing, we will also be seeing in this concept alone, it goes on to achieve the first objective, stock valuation and profit computation. This particular segment alone. Everything else in this chapter goes on to achieve your decision making objective. Now coming back here guys, now sir, prepaid is better or postpaid is better? You can't come to a conclusion like that, because each of these two alternatives have one advantage and one disadvantage each. Now but can I say there will be one point when both the alternatives will give me the same cost, same result. Now guys, you all think practically and tell. Let us say you are a missed call party, a conjuice party, right? So you will not make much of calls, you will only make missed calls. Literally, you want a phone number, for that only you actually subscribe to either prepaid or postpaid sim, right? You will not make much of calls. If at all, you make only at emergency purposes, right? Beyond that you will not make. In that case, you tell me, will you go for a prepaid sim card or will you go for a postpaid sim card? Now clearly you will go only for prepaid. Why? Sir, my volume is not less, so I need not commit 500 rupees. Prepaid, I need to commit only 100 rupees. If I make a phone call, only then 0.5 rupees I need to pay. Maximum, sir, my volume is very less. I will not make many phone calls and all. In that case, overall, your significant component of your cost is driven by your fixed cost. So you will go for that option that gives you a lower fixed cost. Generally, when your volume is less, you will go for that alternative that gives you a lower fixed cost. Suppose, let us say, now you are a businessman and you need to make a lot of phone calls every month. Now here, you don't mind paying this 500 rupees, but every time you make a call, your volume is very high. Instead of paying 0.5, you just need to pay 0.30. So if your volume is very high, now overall cost comprised of fixed plus variable. If your volume is huge, then generally the variable cost will be actually the compensation of variable cost will be more. Hence, you will go for that alternative which gives you a lower variable cost per unit. In this case, if you are a person who makes multiple phone calls every month, you will go for a postpaid option because that will give you overall lower cost. Clear with this, guys? But there will be one point of volume where the total cost under prepaid will be exactly equal to the total cost under postpaid, and that volume at which the total cost under both the alternatives are equal is called as indifference point. Are you clear with this? Indifference point means what? I am not different to either alternate A or alternative B because both the alternative gives me the same result. The point of volume at which these two alternatives gives the same total cost is called as indifference point. Clear with this, guys? So now, how will I get this, sir? Simple. Let us keep this indifference point. Indifference point is nothing but volume as X. Now, what will be the total cost of prepaid? Can I say the total cost of prepaid will be 0.5x plus 100, correct? Now at the indifference point, this has to be equal to the total cost arrived under postpaid. What is the total cost of postpaid? 0.3x plus 500, right? Now take x on one side. I will say 0.5x. Now this comes to the other side, becomes minus 0.3x is equal to 500 minus 100. Correct? So I have 500 here. 100 comes to the other side. It becomes minus 100. Clear? Now take x out in common. Can I say this is nothing but x into 0.5 minus 0.3 is equal to 500 minus 100. Or in other words, x is equal to 500 minus 100 divided by 0.5 minus 0.3. This is nothing but 400 rupees divided by 0.20. So 400 divided by 0.2 is equal to how much? 2000, right? 2000 units, or in this case it is not units, it is 2000 calls. Or in other words, if I am going to exactly make 2000 calls every month, then either if I go for prepaid or if I go for postpaid, both the alternatives will give me the same result. Clear with this, guys? Suppose your expected volume for the upcoming month is less than 2000 calls. If I am a person who is going to make less than 2000 calls, then I will go for that alternative. My volume is less. I will go for that alternative that gives me a lower fixed cost. I will go for prepaid. Suppose if my expected volume in the upcoming month is more than 2000 calls, right? In that case, I will go for that alternative that gives me a lower variable cost. I will go for postpaid at 2000 phone calls. In this case, what will I do? It is an indifference point. I am not different to either of the two alternatives because both the alternatives will give me the same result. Are you guys clear with this, right? This is the concept called indifference point. Or in other words, guys, how do we calculate indifference points? Very simple. Now look at this here. Look at this. 500 minus 100 by 0.5 minus 0.3. So 500 minus 100 is nothing but difference in fixed cost. Correct? This is nothing but difference in fixed cost divided by, now what is this? 0.5 minus 0.3. 0.5 minus 0.3 is nothing but difference in variable cost per unit. Are you all able to understand? Are you all able to understand? Or in other words, I will say indifference point is equal to difference in fixed cost divided by difference in variable cost per unit. If I arrive at this, I will get what? The indifference point. Sir, with the help of indifference point, what can we do? Simple, guys. With the help of indifference point, let us say in this case, indifference point is 2000 calls, right? In this case, it is calls. Suppose if we are talking about a manufacturing company, it will be 2000 units, for example. Simple. With this, sir, what decision can I take? Simple. Now, sir, 2000 units is going to be your indifference point. Now, suppose in the next month, you have your expected demand is less than 2000 units. What will you do? You will go for that option which has a lower fixed cost. Suppose in the upcoming month, your expected demand is more than 2000 units, you will go for that option which has a lower variable cost per unit. Clear with this, guys? And sir, exactly it is going to be 2000 units. It is called as indifference point. Whether you go for alternative 1 or you go for alternate 2, in either of the two alternatives, it is going to give you the same result. In this case, I'm going to make 2000 phone calls exactly whether I go for prepaid or I go for postpaid. It doesn't make any difference. Suppose I'm a person who is going to make less than 2000 phone calls every month, then I will go for prepaid option. Why do I go for prepaid option? It is the option which has a lower fixed cost. Whereas if I'm going to make more than 2000 phone calls, I'll go for postpaid option because it has a lower variable cost per unit. So I'll go for postpaid here. Are you all able to understand this, right? So just if you calculate this indifference point, one look at the expected volume for the upcoming month, now upcoming period, you can say, sir, I'm going to make 5000 units, sir, go for postpaid. Why? Lower variable cost per unit, right? Over and above my, it is lying below, it is lying beyond my indifference point. Sir, I'm going to sell only 500 units, sir, go for prepaid. One look at the volume, you can directly say which alternative is going to be better for you, and the deal breaker here is going to be your indifference point. For that purpose only, we have computed this indifference point. Are you all clear with this? How do I compute indifference point? Difference in fixed cost divided by difference in variable cost per unit. I proved this formula and showed it to you. As simple as that, guys. You need not even mug this up. Clear with this, guys? So by one look at the expected output for the next period, you will be able to clearly tell which option is going to be working out for you. Are you all able to understand this? Yes. Now, sir, now in this case, if you notice, here we have 100 rupees of fixed cost. Here we have 500 rupees of fixed cost. Right? Now, out of these two alternatives, which one has a lower fixed cost? Obviously, your prepaid. Correct? And here the variable cost is 0.5, here the variable cost is 0.3. Out of these two alternatives, which has a lower variable cost per unit? Absolutely postpaid. Clear with this, guys? So if my volume is more, right, I will go for postpaid. More means what? Beyond 2000 units, 2000 calls, right? If my volume is less, what do you mean by less? That is, my expected volume is only less than 2000 phone calls, then I will go for prepaid. One look at this itself, you will be able to understand. For example, if I am going to make 1000 phone calls, lies below indifference point, prepaid will be better for you, right? If you want, you can check and also calculate. So 1000 phone calls means how much will be the total cost under prepaid? 0.5 into 1000, that's going to be 500 plus 100, it's going to be how much? 600 rupees will be the total cost under prepaid. If I go for postpaid, how much will that is that going to be? It is going to be 1000 into 0.3, that's going to be 300 variable cost. Fixed cost is how much? 500. Overall, it's going to be 800. Clearly, if you notice, now your prepaid is cheaper than postpaid. Why? Because the expected volume lies below your indifference point. Like this, you can take one example of, let us say, 3000 phone calls and try. Obviously, postpaid will give you a lower cost than prepaid. There you will say postpaid is better. So here, now, there is no one best alternative. It depends on the volume. It's all about the volume game in this entire chapter. Clear with this, guys? So this is the concept of indifference point, where you can calculate it using this formula: difference in fixed cost divided by difference in variable cost per unit. Now let me add one more extra information here. With that one more formula we can cover for this indifference point. Let us say I am running a call center, right? And let us say ICICI Bank has hired me, right? I run a call center. ICICI Bank has hired me, and they have told, right? Now I will give you one database which has a list of all the phone numbers of almost all the citizens in this country. Now your duty, the call center's duty, is to call every person and disturb them, ask them whether they want credit card, debit card, whether they want to open a bank account, loan account, whatever it is, right? Now what ICICI Bank tells me is that, or HDFC Bank, whatever bank it is, they are telling me, for every phone call you make and disturb, I will pay you 1 rupee. Clear with this, guys? Now they are not bothered whether me, the call center, is using a prepaid or a postpaid SIM card. Clear with this, guys? This is the scenario. Now, in this scenario, how will the cost figures look like? Now, guys, We have what? Prepaid plan. We have postpaid plan, right? Now, you guys think and answer whether I use a prepaid SIM or I use a postpaid SIM. How much is the amount I will be getting from the bank? 1 rupee. This is the selling price. We are calculating this from the perspective of the call center, right? Now, whereas how much will be the variable cost? If I use a prepaid SIM, we calculated the variable cost was slightly higher, 0.50. Whereas postpaid SIM, it was only 0.30, correct? Now, how much is going to be the contribution per unit, or in other words, contribution per phone call? Here we'll say one phone call is 1 unit. Here, if I use prepaid, it's going to be 0.50. If I use postpaid, it's going to be 1 minus 0.3. It's going to be how much? 0.70. Clear with this, guys? Now, how much is the fixed cost? Now, sir, if I use a prepaid SIM, the fixed cost is only 100. Whereas, if I use a postpaid SIM, how much is going to be my fixed cost? My fixed cost is going to be 500 rupees. Are you clear with this? Now, in this case, which alternative is better? Same situation. Now, option A, that is your prepaid, has an advantage. What advantage? Lower fixed cost. Whereas postpaid, what advantage it has? It has a higher contribution per unit. Are you all able to understand? Now, guys, this is nothing but lower variable cost results in higher contribution per unit. No, because my selling price was the same. Selling price minus variable cost gives me contribution. Postpaid had a lower variable cost, which in turn resulted in a higher contribution per unit. Agreeing with me on this? So literally what I can say, prepaid has an advantage of lower fixed cost, postpaid has an advantage of higher contribution per unit. Which is better? You can't directly say like that. Then you need to compute your indifference point. In this case, once again, guys, if your volume is lesser, you will go for that alternative which has a lower fixed cost. If your volume is more, you will go for that alternative which has a higher contribution per unit. But there will be one point where the profit under the first alternative will be equal to the profit under the second alternative. This point of volume is called as indifference point. Now, in that case, the profit under two alternatives should be equal, right? So now let's compute that. Now, how do we do it? Simple. Let's take the volume as X. In that case, tell me what will be the profit under prepaid plan. The prepaid plan profit is going to be 0.5x, correct? Contribution 0.5 into X is the number of units which we need to compute, indifference point, minus contribution minus fixed cost 100 rupees, right? That's going to be the profit under first alternative should be equal to 0.7x. This is going to be the contribution under the second alternative minus 500 rupees, right? So now what we need to do? So now we just need to take X on one side and the fixed cost on the other side, the values on the other side. So can I say this 500 comes to the other side, minus 500 becomes 500. So can I say 500 minus 100 is equal to 0.7x minus 0.5x. So here we have 0.7x and this 0.5 goes on the other side, it becomes a minus 0.5, right? So now how much will this be? How much will this be? So this is going to be, once again, I'll take x common out here. So I will say x the whole into 0.7 minus 0.5 will be equal to 500 minus 100, or in other words, x is equal to 500 minus 100 divided by 0.7 minus 0.5, right? Here literally x is equal to 500 minus 100 divided by, this comes to the denominator, 0.7 minus 0.5, right? So now I can say, or this is nothing but this is equal to 500 minus 100 is 400 divided by 0.7 minus 0.5 is going to be 0.20. So 400 by 0.2 gives me how much? 2000 units, or in other words 2004 calls. In this case, how did we compute? 500 minus 100. 500 minus 100 is nothing but difference in fixed cost, correct? This is nothing but difference in fixed cost. And 0.7 minus 0.5, so 0.7, this is nothing but difference in contribution per unit. This is nothing but what? Difference in contribution per unit. Or in other words, I can say indifference point is equal to difference in fixed cost divided by difference in contribution per unit. Are you guys able to understand? This is another formula for your indifference point calculation. See how logical it is. Now, sir, with this, what can you come to a conclusion? Simple. Simple. So now I have an indifference point. How much is my indifference point? It's going to be 2000 units. In this case, 2000 phone calls. If my expected volume is less than the indifference point, I will go for that alternative which gives me a lower fixed cost. If my expected volume is more than the indifference point, I will go for that option which gives me a higher contribution per unit. Or in other words, lower variable cost. Because of lower variable cost, you will have a higher contribution per unit, because at the end of the day, selling price minus variable cost is only contribution per unit. If your contribution is less, if your variable cost is less, contribution will be more. As simple as that. Clear with this, guys? In this case, under the first alternative, lower fixed cost, hence I will go for prepaid plan. So if I'm a person who is going to make less than 2000 phone calls, go for prepaid. That will always give you the highest amount of profit. Whereas if you are a person who makes more than 2000 phone calls, go for the option which has a higher contribution per unit, which is nothing but your postpaid plan, because that will give you the highest amount of profit. Are you guys clear with this? And at exactly, if you're going to make 2000 phone calls, whether you go for prepaid or you go for postpaid, both will give you the same amount of profit. Are you guys able to understand? This concept is called as indifference point. So two formulas we saw here. What are they? Indifference point is equal to difference in fixed cost divided by difference in variable cost per unit, or it is nothing but difference in fixed cost divided by difference in contribution per unit. Clearly understand, difference in variable cost, how much is it? 0.5, 0.3. The difference is how much? 0.2. And the difference in contribution, how much? 0.5, 0.7. How much is it? 0.2 only. So obviously, when my selling price is the same, the difference in fixed cost, the difference in variable cost is equal to difference in contribution per unit. Are you guys clear with this? Here, my contribution was 0.5, 1 minus 0.5. Here, what is the contribution? It is 1 minus 0.3. How much is it? 0.7 rupees. Clear with this, guys? Now, literally, why did this happen? Simple. From the same 1 rupee, here I'm subtracting 0.5, here I'm subtracting 0.7. So literally this difference in contribution per unit of 0.2 is clearly because of this difference, variable cost difference, which is 0.2. So literally, guys, the difference in variable cost is equal to difference in contribution per unit when my selling price is the same. Clear with this, guys? That's why it can be calculated using two different formulas: difference in fixed cost divided by difference in contribution per unit, or difference in fixed cost divided by difference in variable cost per unit. Are you guys clear with this? So why do we use this indifference point? At the indifference point, you can use either of the two alternatives, but if your expected demand or the volume is less than the indifference point, go for that option which gives you the lower fixed cost. Always mention the advantage, right? If your expected volume is more than your indifference point, go for that option which gives you lower variable cost per unit, or you can say, in other words, higher contribution per unit. Are you guys able to understand? This is all about the concept of indifference point. Now, with this in mind, let us go and do one numerical problem. This sum is as per our CA intermediate. It is in our CA intermediate. I have kept it in our solved question bank. This is very much applicable even for CMA paper 8 and paper 12 students. You guys can also use it. It is not something out of syllabus. Absolutely. If there is something that is not applicable, I will clearly tell you. So here the reason why I'm merging the marathon is because this is very much applicable for you guys, right? That is the reason why I'm doing it. But please remember, all our courses and all are separately recorded. Even P8 and P12, I don't merge. Every single thing is separate only. Clear with this, guys? On this note, please take our solved question bank. This is in volume 2. This is our solved question bank looks like. This is CA intermediate solved question bank. So you can download all the materials I'm using here. You can download it from our website free of cost. All these things are available, right? In case you want a hard copy, that you can buy. We are just recovering whatever is the printing cost and the courier cost and other things. But if you want, you can even download this free PDF and use it. Now, please take this question number 12. It's on page number 412. It's in the volume 2. So please take this question. Right. So now, let me just read this question. It's a high-end question, high-level question. With this question, the entire concept of indifference point can be covered very easily. Now guys, what are they saying? The following are the cost data for 3 alternative ways of processing clerical work for cases brought before LC court system. That is a court like magistrate court or high court. They are saying there are 3 different ways in which they can process some clerical work. Some files are all coming, so they need to process the files. So there are 3 different ways in which they can process the files. One is called as a manual way. Then the second option is called semi-automatic processing. The third one is fully automatic. 3 different alternatives are there. Now what have they given? Particulars, monthly fixed cost, occupancy, maintenance contract, equipment lease. Now if I'm going for manual, there is only one fixed cost, 15,000 rupees. Second alternative, if I'm going, I have 15,000 plus 5,000 plus 25,000. 3 different fixed cost I have. So literally, what is the total fixed cost? Let us keep this as alternative A. We will keep this as alternative B. We will keep this as alternative C. Each of the 3 alternatives tell me how much is the fixed cost. Manual, that is alternative A, fixed cost is 15,000 rupees. Alternative B, how much is the total fixed cost? 15 plus 5, that is 20,000. 20 plus 25, it's going to be 45,000 rupees. Right? So it's going to be 45,000. And alternative C, fully automatic, 15 plus 10,000 plus 1 lakh, it's going to be 1 lakh 25,000. This is going to be what? The total fixed cost under the third alternative. Fine guys. Now they have also given us the unit variable cost. 1 unit is 1 report. Clear with this guys. Now per unit or per report, what is the variable cost? Here there are 2 different variable costs here. Supplies, labor. Simple, add the 2. Alternative 1, my variable cost is going to be 40 plus 200. How much is this? 240 rupees is my variable cost. Alternative 2, 80 plus 60. How much is it? 140 rupees. And alternative 3, 20 plus 20. How much is it? 40 rupees. Clear with this guys. Now what we need to do, for every alternative we have the total fixed cost, total variable cost. Like that, for each of the 3 alternatives we have the fixed cost, variable cost. Now they're asking, calculate the cost in different points and interpret your results. And part number 2, if the present case load, which means the number of files, is 600 cases and is expected to go up to 850 cases in the near future, select the most appropriate option, that is alternative, on cost consideration. They are saying if I have a total of 600 cases, 1 case is 1 unit, so 600 cases means which is the best alternative. Suppose if I'm going to have 850 cases or 850 units is going to be the volume, in that case which is better? Now guys, first of all, in whatever I have taught you till now, we have seen clearly indifference point is nothing but difference in fixed cost divided by difference in variable cost per unit. Sir, we had only 2 alternatives, sir, but in this particular question, if you see, we have 3 alternatives. How can we do this question? Now simple guys, always remember, indifference point calculation can be solved only by taking 2 alternatives. In this case, what we need to do, we need to take 2 different alternatives at a time and take up all different combinations. For instance, first A and B, calculate indifference point of A and B. Then calculate indifference point of A and C. Then calculate indifference point of B and C. Right? So 3 different indifference point we need to calculate. AB, AC, BC. 3 different indifference point. First we need to calculate. And once we calculate this, then we need to interpret the results. Clear with this guys. Now the first part of the question is fairly simple. Calculation of indifference point. So AB, AC, BC, 3 different indifference point we need to calculate. Once we calculate this, then sir, we will be having 3 different indifference point. With this, sir, what do we do? Right? I will tell you what needs to be done. Clear with this guys. Let's quickly do this particular question here. Okay, the solution is given here, but anyways, I would like to do this question in detail. So it's going to be let me just put it up here. This was question number 12, right? So question number 12 from our CA intermediate. right guys? Now, so first let me list out the options we have. Option A, option B, option C. That is your manual, semi-automatic and fully automatic. Then you have variable cost and you have fixed cost. How much was our variable cost? Now I'm just putting it up here. It was rupees 240, rupees 80 plus 60 was 140, and then rupees 20 plus 20 it was 40, right? Just now we calculated all of this. 240, 140 and 40. And how about the fixed cost? 15,000, 45,000 and 1,25,000. I'm putting it up here. It was 15,000. Then we had 45,000. And then we had 1,25,000. Right? So I think this is what we had. Yes, 1,25,000. Now, what do we need to do? We need to compute the indifference point separately for each of the three different possibilities. A, B first, then A, C next, then B and C, right? In whichever order you want, you can calculate. So indifference point for A and B first I'm doing. Now, guys, we know the formula for indifference point. What is the formula for indifference point? It is basically difference in fixed cost divided by difference in variable cost per unit. So in this case, indifference point between A and B, difference in fixed cost 45,000 minus 15,000. How much is the difference? It is 30,000 rupees divided by how much the difference in variable cost 240 minus 140. How much is that going to be? 100 rupees, right? Divided by rupees 100. So how much does it come out to? 30,000 divided by 100. Just remove two zeros. That's about it. It's going to be how much? 300 units. Clear with this, guys? Clear with this, guys? Basically, what is the meaning of that? Now, exactly at 300 units, or in this case, the court, if it gets 300 cases, whether you go for A or you go for B, both will give you the same result. Suppose if your number of cases is less than 300, go for that alternative which gives you a lower variable cost. Which one? This one. Sorry, if it is less than your indifference point, you go for that alternative which gives you a lower fixed cost, which is alternative A. Suppose if your number of cases is going to be more than 300, you'll go for that option which gives you a lower variable cost per unit. You go for alternative B. Are you guys clear with this? This is what we need to do. Yes, we will come back to that later. Next one. Next is indifference point calculation for A and C. Let's do this. Once again, indifference point is equal to difference in fixed cost divided by difference in contribution per unit. Now A and C. What is the difference in fixed cost? Here 1,25,000. Here you have 15,000. The difference 1,25,000, 15. How much is the difference? It is going to be rupees 1,10,000 divided by how much the difference in variable cost? 240. Here you have only 40 here. The difference is going to be 240 minus 40, rupees 200. Or in other words, 1,10,000 divided by 200. How much is it? 550 units. Or in other words, 550 cases is my indifference point. If my expected volume is less than 550, right, you will go for that alternative which gives you a lower fixed cost. Go for A. If it is more than 550, go for that option which gives you a lower variable cost per unit, which is going to be option C. Clear with this, guys? This is the interpretation. Next, we need to calculate indifference point between B and C. This is the last alternative. What is this, guys? What is this? Here, once again, indifference point is equal to difference in fixed cost divided by difference in variable cost per unit. We're talking about what and what? B and C. What is the difference in fixed cost? 1,25,000 and 45,000. How much is the difference? 1,25,000 minus 45 gives you 80,000, right? So it's going to be rupees 80,000 divided by how much is the difference in variable cost per unit? 140 minus 40 is going to be rupees 100. How much is this, guys? It's going to be 80,000 divided by 100. It is going to be 800 units. Clear with this, guys? What is the meaning of that? So if I'm planning to have an output of exactly 800, You go either for B or C. It doesn't make a difference. If your expected demand is less than 800 units, you go for that option which gives you a lower fixed cost. Which one? Go for B. If your expected demand is more than 800 units, go for that option which gives you a lower variable cost per unit. You go for C. This is the interpretation. Now, sir, I have three, sir. I have three different alternatives, A, B, and C. Because of that, I have three different indifference points. Now, sir, with this, how can I arrive at a proper conclusion? Now, let me clearly put this on a line and clearly explain what it is. This explanation is not there in your study material also, but based on this only, they have arrived at the answer. Now, look at this. Look at this, guys. Now, plot this on, let me plot this on a graphical presentation. The first indifference point is what? 300 units, right? So the first indifference point was at, yes, 300 units. Perfect. The next indifference point happens at 550 units. Okay, let me put it up here. It's going to be 550 units. And the next indifference point comes in at 800 units. Let me put it here. It's going to come at 800 units. Now 300 units is the indifference point between A and B, correct? I'm plotting it here. This is between A and B, right? Next, 550 is the indifference point between A and C, correct? A and C. And 800 is the indifference point between B and C. Now, we have plotted everything on this graph. Now, clearly, let us settle the score. Now, sir, 300 units, at 300 units, exactly if my demand is going to be 300, you can either go for A or you can go for B, right? Now, if it is less than 300, now we are just talking about A and B, you will go for what? The one with a lower fixed cost, which is A, correct? So here I will say, if I'm going to operate at less than 300 units, I will go for what? A. More than 300 units, I will go for what? B. Correct? This is the meaning of that, because it has a lower variable cost per unit. B has a lower variable cost per unit between A and B. Next is the clash between A and C. At 550 units level, exactly 550 units, sir, either go for A or you go for B. But sir, below 550, now which one will you go? We're talking about what? A and C. Between A and C, if my volume is less than my indifference point, I'll go for that option which gives me a lower fixed cost. I will go for what? A, right? So here, less than this, I will go for A, as per this indifference point between A and C. So more than 550 units, I will go for C. Why? Because between these two, A and C, it has a lower variable cost per unit. Next, the last indifference point, 800 units, B and C. Now, if my expected volume is going to be less than 800 units, I will go for that option which gives me a lower fixed cost. Between what? Sorry, this is between B and C. B and C. Which one has a lower fixed cost? This one, right? So I will go for B, correct? More than this 800 units, I will go for C because it has a lower variable cost per unit. So here I will say, go for B. Beyond this, you can go for option number C. Clear with this, guys? Now, this is how each of the three indifference point comes to a conclusion. Now understand one thing. What is the issue here? Less than 300 units, you have only one player. A. Always A is best. More than 800 units, always C is best. There is no problem here. The problem arises only in this region, that is between 300 units to 800 units. Why? Look at this. As per this indifference point A and B, more than 300 units, they have nominated whom? Option B. Whereas, as per this indifference point between A and C, less than 550, they have nominated whom? A. Or in other words, between 300 and 550, which is better, B or A? As per this indifference point, they have nominated B. As per this indifference point, they have nominated A. Sir, which one is better, sir? There's a confusion once again. Correct? Right? Similarly, in this scenario also, as per this indifference point, more than 550, they have nominated C. Here, less than 800, they have nominated B. Which means, sir, for this range, should I select C or should I select B? This is one issue. There is a clash. Right? Now, how will I resolve this conflict? Very simple. Now, first, guys, now for this range we will talk. Who are the nominees for this range? Right? B and A. Correct? The nominees for this range are B and A. Now, guys, between B and A, whatever was the conflict was clearly clarified here only. Right? Between B and A, in this case, this was nominated between A and C. Because of that, A came into this picture. Correct? Now, once again, we are having a conflict between B and A. Go down and check A and B. Between these two guys, where the indifference point clarification happened here. Now, clearly between A and B, we already found out anything beyond 300, B should only come. A should not interfere there because A's territory is below 300. Clear with this, guys? Whenever you have a conflict on the top, go refer between these two where the indifference point was actually calculated. It is calculated here. Now, what does this say? Sir, above 300 units, go for B, not for A. Hence, what I will do in this case, so obviously A will not come in this area, only B will come into picture. Are you guys clear with this? Why this conflict was resolved in this scenario? Once again, don't create a conflict because of another indifference point. More than 300 units between A and B, only B should come. Sir, once again, because of another indifference point, A has come back, sir. No, this area is actually clarified by this fellow. Are you all able to understand this? So only B will come. Next, in this area, the conflict is clashes between where? C and B. So between C and B, where did we compute the indifference point? Where was this conflict resolved? Sir, C and B or B and C, it was actually resolved here, sir. Right? So once again, because of this indifference point, C got nominated here. But as per the indifference point between C and B or B and C, as the case may be, less than 800, if there is a clash between C and B, always B should only come because this conflict was resolved here. So less than 800 units, only B should be nominated. This was clarified as per the indifference point clash between B and C. So here what I will do, C will not come. In this case, once again, B is only selected. Or in other words, if at all you want me to build a range and tell me, sir, when to go for which alternative, I will clearly say this is the final conclusion. What we will say is, if your expected demand or the number of units, in this case, in the court, number of cases, if it is less than 300 cases, always go for option A. At 300 units or cases, you can either go for option A or option B. Now, this itself is not relevant because this entire place is ruled by B, right? Now, more than 300 cases up to less than 800 cases, it is always B. Clear with this, guys? Always, if you check, B will give you the least total cost. At 800 units or 800 cases, you can either go for B or C because both of them will give you the same cost. Now, if your number of cases or volume is more than 800 units or 800 cases, C, it's better to go for C because that will always give you the least possible cost. Are you guys able to understand? So in this question, a high level question, why we calculated 3 indifference point and there were a clash between multiple indifference points. So we also saw how to resolve this conflict. Are you guys clear with this? So this is the one line summary of this particular area, of this particular question: volume and decision. If your expected volume is less than 300 units, go for A. If your volume is exactly equal to 300 units, you go for what? You go for A or B. If your volume is, I'm putting my volume here, if your volume is greater than 300 units but less than 800 units, right? Then look at this. I'm talking about this range. Sir, 550 will not come. No. What is the point of keeping 550 here? because less than 550 B, more than 550 once again B. So there is no point at all. So the conflict got resolved here. So this is never one threshold point at all for you. Clear with this, guys? This entire place is ruled only by one particular alternative B. So it's going to be B. Now, if your volume is exactly equal to 800 units, you come here, it is either B or C. And if your volume is expected to be greater than 800 units, always go for this particular alternative. Clear with this, guys? Clearly, if you build the range now, you just name your expected output that will give you the least possible total cost. Clear with this, guys? So with this, one look at this range itself, you will be in a position to come up with the correct answer out of the three alternatives, sir. Which one is best? Directly you can say. Now in this question, what have they mentioned? In this question, at present, they have a caseload of how many units? 600 units or 600 cases. Go back here and check here. So 600 means, where does it fall? It falls in this range. 600 falls more than 300 but less than 800. Clearly, option B will give you the least total cost. You yourself can check and calculate. Clear with this, guys? The answer will be that. Look, this is what they have done. Less than 300 cases, it is A. Ideally, it's not correct fully, because at 300 it is either A or B. They have not computed the indifference point. The second one, if you see, 300 to 800 only they have taken. In between, we had this 550 that was not considered. Many students are struggling to understand, sir, why, sir? This is also an indifference point. The conflict resolution is not clearly mentioned in the study material. Final answer they have just given, but clearly understand this is how it needs to be done. Clear with this, guys, right? So look at the range. 300 is one threshold. The next threshold is only 800. Right? And after that, so it's going to be less than 300, at 300, greater than 300, less than 800, at 800, above 800. Clear with this, guys? So now, in this particular question, your answer lies between 300 to 800. Hence, option B, alternative B, will give you the least total cost. Clear with this, guys? So it gives you the least total cost. Present caseload is 600. Therefore, alternative B is best. That's all. Answer is done. That's all you need to write. Suppose, sir, our cases are expected to go up to 850 units. In that case, which one will you go? 850 means above 800. You go for alternative number C. Clear with this, guys? Have a look at this. You go for alternative number C. Clear with this, guys? That's about it. So this is what they have mentioned. As the number of cases expected to go up to 850, alternative C is more appropriate. One look at this range table, you will be in a position to clearly say, sir, this is the output. This is going to be the best alternative for you. If you want, you can check and compute out of the three alternatives, whichever alternative I'm telling you as the answer will give you the least possible cost. Clear with this, guys? But in your study material, as well as in your past exam searched answers, directly they have given this range. Many students struggle to understand how to build the range. Clearly, I've told you right now, this is how you need to build the range, by resolving the conflict. Are you guys clear with this? Right? With this, we have completed this particular question. So this I wanted to cover. This is applicable even for CMA students. Please don't think it's not applicable for you. It's a high-end question, one single question. I'm handpicking certain comprehensive questions. I'm doing it so that your entire revision is going to be super comprehensive. So please go and update your library of adjustments. Write down. Please give the cross-referencing and all. Write down indifference point hyphen indifference point hyphen calculation of 3 IDPs for 3 different alternatives, semicolon, range building. So calculation of 3 indifference points for 3 different alternatives, semicolon, range building. We saw the conflict resolution, how to build the range and all that. A very good question to revise this entire concept of indifference point. It has been coming in a lot of exams, past exams as well, both in CA as well as in CMA intermediate level. Clear with this, guys? So with this, we have finished this particular question, and with this, we have also quickly revised this entire concept, right? Not quick, in fact, we've done in a very elaborate manner as well. Now, with this, we are done with the concept of indifference point. Now let's move on to the next concept called as volume analysis. Now, what is this concept all about? Quickly, I'll just give you guys an example, and with that we will also revise this particular concept of volume analysis. So, volume analysis. What is this about? The explanation, everything has been neatly mentioned here. Volume analysis and all, clearly I have mentioned separately. Indifference point, look at this volume analysis. Whatever is the formula mentioned, all these things are here. But how do you arrive? What is the underlying concept here? This is there in our concept decoder for you to understand the logic. I'm quickly recapitulating here. In our courses, we do it in a much more elaborate manner. Since this is a revision, there is a time constraint. Even here, I'm trying to maximize out of the limited time available. Let's quickly get started here. Now, guys, let me just take an example. Our signature style of learning, always we take up examples that, even the complicated things can be easily understood. Now, let us say our selling price is 10 rupees, right? Your variable cost is going to be rupees 6. Your fixed cost is going to be rupees 10,000. Just an example, right? Now, I'm going to prepare an income statement for two different levels of output. First, I'm going to prepare an income statement for 5,000 units of output. Then I'm going to prepare another income statement for 7,000 units of output, right? Now, let us take this example. Now, what's your format of income statement and marginal costing? Come on, tell it along. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? Now, what's going to be your total sales? 10 rupees per unit. So 5,000 units means sales of 50,000, and 7,000 units means 70,000 rupees of sales. What's going to be your variable cost? 6 into 5,000, that's going to be 30,000. And here it's going to be 6 into 7,000, that's going to be 42,000. Right? Next, what's going to be your contribution? It's going to be what? 10 minus 6, 4 rupees is the contribution per unit. So 4 into 5,000, it's going to be 20,000. And here it's going to be how much? So 4 into 7,000, it's going to be 28,000, right? Or you can even say 70,000 minus 42,000. That way also you can arrive. It's going to be 28,000. Next one. Fixed cost, in both the cases, it's going to be 10,000, 10,000. Right, guys? Now, what's going to be the profit here? 20,000 minus 10,000, going to be 10,000. And here it's going to be 28 minus 10, it's going to be 18,000. Sir, this is something we know, no, sir. Why are you doing this particular example? I mean, why are you giving all this scenario? Now, one small observation. At 5,000 units level, how much was the contribution? 20,000 rupees. At 7,000 units level, how much was the contribution? 28,000 rupees. My contribution has increased by how much? 8,000 rupees. Correct? My contribution has increased by how much? 8,000 rupees. Now, or in other words, this contribution increase 8,000, right? Now, if you carefully observe, at 5,000 units level, what was your total profit? 10,000. At 7,000 units level, how much was your total profit? 18,000. Now, guys, in this case, your profit has increased by how much? 8,000 rupees. Conclusion, can I say? The difference in profit is purely on account of the difference in contribution. Agreeing with me on this. Sir, overall, my profit increases purely because of the increase in contribution. Absolutely. What do you mean by profit? Contribution minus fixed cost. Here, fixed cost has not changed. So clearly, the change in my contribution is exactly equal to the change in my profit. Are you guys understanding this? Or in other words, can I say the change in profit is exactly nothing but the change in my contribution. Sir, this 8,000 rupees, sir, why it has increased? There's nothing but the contribution. Increase in contribution. Sir, why has my contribution increased? Because, sir, now I am not selling 5,000 units, I am selling 7,000 units. Or in other words, here I have increased my volume by 2,000 units. Or in other words, the contribution pertaining to this 2,000 units is only the increase in my profit. Are you all understanding this? So guys, one small summary here. The increase in profit is purely on account of increase in contribution. Why is there an increase in the contribution? Because there is an increase in the volume. So contribution per unit remains to be the same, but your overall volume will, because the overall increase in the volume, sir, for every unit I'm earning a contribution of how much? 4 rupees. Now from 5,000 units, now I'm jumping to 7,000 units level extra. How many units have I sold? 2,000 units. Every unit extra gave me a 4 rupees of contribution. So 2,000 into 4 extra contribution, how much I earned? 8,000 rupees. That extra contribution itself adds to my profit. Are you guys able to understand this? Are you guys able to understand? Sir, why are we doing this, sir? Why are we doing this, sir? Simple. The difference in profit is nothing but the contribution generated out of the difference in the units, a difference in the volume. Are you agreeing with me on this? If you know this, the entire concept of volume analysis can be mastered. Suppose in exam, they have not given all this data. They have only given you the top line and the bottom line. Sir, what is this, sir? Example, in your exam, they have just given you this scenario, right? They have just given you volume, right? And they have given you, let us say, for example, they have just given you volume, profit. Now, how much is the volume? 5,000 units volume. What is the profit? 10,000 rupees. Now, next, if your volume is 7,000 units, your profit is going to be 18,000 rupees. In exam, let us say this is all they have given. They have asked you to compute the contribution per unit, the fixed cost. This is all they have asked. Or in other words, they have asked you to prepare income statement for 10,000 units volume level. Sir, nothing has been given in this question. How can we calculate? Simple. What you can do is simple. My profit is how much? 10,000. At how many volume? At what volume level? 5,000 units level. If I increase my volume by 2,000 units, my profit increases by how much? 8,000 rupees. Or in other words, the 8,000 rupees, the delta profit, the difference in profit is nothing but the difference in contribution. Or in other words, this 8,000 rupees is nothing but the contribution generated out of this incremental units of 2,000 units. Or in other words, can I come to a conclusion and say contribution per unit is equal to difference in profit? It is called as delta profit. Delta means what? Difference divided by difference in units, that is volume. Correct? In this case, how much is the delta profit? The difference in profit is how much? So from 10,000 it has increased to 18,000, which means 8,000 rupees is the extra profit, right? This is the contribution generated on account of increase in volume. How much is the difference in volume? 2,000 units. Or in other words, can I say 8,000 rupees is the contribution generated out of 2,000 units. How much is the contribution generated per unit? 8,000 divided by 2,000. This is rupees. 8,000 divided by 2,000. It is going to be how much? Rupees 4 per unit. Are you guys able to understand? Now you got the contribution per unit. Right? With this, you can calculate your fixed cost. Sir, how can we calculate the fixed cost? Simple. We know the marginal costing income statement. Sales minus variable cost is equal to contribution. So we can say, look at this. Contribution minus fixed cost gives me profit. Take any one volume level. Sir, 7,000 units volume level you want to take. Simple. At 7,000 units volume level, what will be the contribution? Just now we computed the contribution per unit. So 7,000 into 4. How much is that? So 7,000 into 4 gives you, so it's going to be 48,000. All right. So you get 48,000. Sorry, 7,000 into 4 gives you 28,000. So sorry guys, 7,000 into 4 gives you 28,000 minus fixed cost gives me, what is the profit at 7,000 units level? 18,000 rupees. Right? So how much the fixed cost? This goes to the other side. I will say fixed cost is equal to 28,000 minus 18,000. It's going to be how much? It's going to be 10,000 rupees. Are you all able to understand? So now with this, we calculated the contribution per unit, we calculated the fixed cost. With this, at any volume level, you can prepare the marginal costing income statement. Suppose they are asking you the question for 10,000 units level, how much is going to be your overall profit? Simple. You just say contribution minus fixed cost gives you profit. What is the contribution? So 4 into 10,000, 40,000 minus fixed cost. Just now we calculated 10,000. You get a profit of how much? 30,000. Clear with this, guys? That's all. So they had just given us the total volume. They had just given us the total profit for two different volume levels, the top line and the bottom line. That is just the top line and the bottom line. If they have given, you can prepare the entire marginal costing income statement for any output level. For this, you need to understand the concept called volume analysis, where here we found out the contribution per unit is equal to delta profit divided by delta units. Sir, why, sir, this logic? No need to mug up. The delta profit, the difference in profit is nothing but the difference in contribution, and that difference in contribution of 8,000 rupees is nothing but the contribution generated out of the extra units, difference units, that is 2,000 units, which means per unit how much the contribution. We calculated the contribution per unit. With that, we can do all the other calculations and arrive at the fixed cost. Are you guys able to understand this? Are you guys able to understand? Suppose in this question, right, the sales, instead of volume, they have given it in value. Example, I'm telling you, suppose in this question they had given the sales in value, right? So the sales in value here, 5,000 hints of 5,000 units they have given 50,000 rupees. The profit is 10,000. If my sales is 70,000 rupees, the profit is going to be 18,000. Suppose this data alone they had given. Now what you need to do, very simple. So instead of contribution per unit, I can calculate the PV ratio here. So can I say PV ratio is equal to delta profit divided by delta sales in value. Clear with this, guys? So I can say simple, this 8,000 rupees is the contribution pertaining to the incremental sales. How much was the incremental sales here? So 20,000 rupees of incremental sales. From 50 it became 70,000, right? So 8,000 rupees is the contribution pertaining to a sales of how much? 20,000 rupees, which means in this case, how much is the PV ratio? I can say the PV ratio is simple, 8,000 rupees divided by 20,000 into 100. It's going to be how much? It's going to be 40%. Are you guys understanding this? You can just play around with the figures. You can literally play around with the figures. So here we saw two formulas. One, contribution per unit is equal to delta profit divided by delta volume, sales in units, or PV ratio is equal to same formula, only instead of units you use sales in value, delta profit divided by delta sales in value. Are you guys able to understand this? Are you guys able to understand this? That's about this area. Fine, guys, clear with this? Similar thing you can also do on the cost side. On the cost side, literally the same question they can also give you, right? 5,000 units, 7,000 units are there, right? I will just put it up here. Let us say in the question, this is all they have given, right? So I'll mention it here. Volume and cost. Volume and cost. So what are the two different volumes we have? 5,000 units, 7,000 units, and let us say they are just given cost 40,000 rupees, right? Sir, at 5,000 units level, the total cost is 40,000. At 7,000 units level, the total cost comes out to 52,000. Now, in this case, they are asking us to find out how much is the variable cost, how much is the fixed cost. Will you be in a position to calculate? First, you tell me, is this a fixed cost? No. Why? Had it been a fixed cost, it would have remained constant in total, right? Is this a variable cost? Let us check. Now, variable cost, what is the behavior pattern of variable cost? It remains constant on a per unit level. So 40,000 divided by 5,000, how much you get? It's going to be 8 rupees. Whereas 52,000 divided by 7,000, you get how much? 7.4 something. So literally this is not constant on a per unit level. This is also not constant in total, which means it's a semi-variable cost. It has one component of fixed, one component of variable in it. Now in this case, how will you calculate? How will you arrive at the fixed component, variable component? Very simple, using this formula. Variable cost is equal to difference in total cost divided by difference in the total units. Right, sir? How will we do that, sir? Simple. whatsoever, if I was selling 5,000 units, what was my total cost? 40,000 rupees. Now, if I increase my volume by 2,000 units, my overall cost increases by how much? 12,000 rupees. Now, why does my cost increase by 12,000 rupees? This cost comprises of variable plus fixed. Now, the increase in cost is purely on account of the variable component, because fixed component will not increase my total cost, right? Now, can I say this 12,000 rupees is nothing but the variable cost pertaining to this extra 2,000 units, right? Or in other words, how much the variable cost per unit? 12,000 divided by 2,000. This is the variable cost for the extra units of 2,000, which means on a per unit level, how much is it? Delta cost by delta units. Here I will say it is nothing but how much the delta cost here. So the difference in cost is going to be 12,000 rupees. The difference is in units is going to be 2,000 units. It's going to be 12,000 divided by 2,000 units. You get how much? It's going to be rupees 6 per unit, right? Now with this, you can calculate the fixed cost. So now how much will your fixed cost be? Simple, take any one volume level. From there, the total cost minus the variable component is going to be your fixed component. So the total cost minus variable cost gives you fixed cost. Now take any one volume level. 5,000 units volume level will take, what is the total cost? 40,000. From that, subtract your variable component. How much the variable component? 5,000 units into 6. So 5,000 into 6 is 30,000. So 40,000 minus 30,000 gives you how much? A fixed cost of 10,000 rupees. Are you guys able to understand? So literally guys, the variable cost is nothing but variable cost per unit is equal to delta cost, difference in total cost, divided by difference in total units. Are you guys clear with this? Are you guys clear with this? Suppose the same thing goes here. The volume, if it is not expressed in units, if they have expressed this in sales, right? If they had mentioned this in sales value, let us say this is going to be rupees 50,000 and this is going to be rupees 70,000. Let us say they had mentioned, when my sales is 50,000 rupees, my total cost is 40,000. When my sales is 70,000 rupees, my total cost is how much? 52,000. In this case, what I will say, sir, this extra 12,000 rupees of variable cost is something that I incur because my sales has increased by 20,000 rupees. Or in other words, this 12,000 rupees is the variable cost attributable to the sales of how much? 20,000 rupees. Or in other words, 12,000 by 20,000. Here you get variable cost ratio. Are you guys able to understand? So here I can say VC ratio is equal to delta cost divided by delta sales in value. Are you all able to understand? This study is called as volume analysis. What we are doing for a change in volume, we are analyzing for the change in volume, the impact it has on your profitability or your cost side. Are you guys clear with this? Literally guys, how did I arrive at this figure? 5,000 units, total cost is 40,000. How did I arrive? Simple. I took the total variable cost plus fixed cost, I added it up and I put it here. Similarly, 7,000 units, what is the total cost? 42,000 plus 10,000, it becomes how much? 52,000. Suppose in exam only this data is given, will you still be able to calculate and do all the workings? Yes, that is what I have just taught you right now. So if you just have the top line and the bottom line, you will be in a position to crack this entire area. So these are all the formulas which we saw here. PV ratio is equal to delta profit by delta sales, or contribution per unit is equal to delta profit by delta units. On the cost side, variable cost ratio is equal to delta cost, difference in total cost by difference in sales value, or variable cost per unit is equal to delta cost divided by delta units. The formula is mentioned here. The logic for that, literally, we learned with the help of this particular example. Any sum that comes in this area, you will be able to handle it. Clear with this, guys? And that is all about this particular concept of volume analysis. Simple, neat, and that's about it, guys. Beyond this, you need not take the pain of mugging up anything, right? This is once again a common concept in your CA intermediate as well as in your CMA intermediate, both in paper 8 and paper 12, right? So with that, we have finished this particular concept of volume analysis, right? So this particular concept is also now over. Now let's go ahead to the next concept called as sensitivity analysis, right? So first we will complete the sensitivity analysis and then we will come back to sales mix. Now guys, this sensitivity analysis, what does this talk about? What does this segment of discussion deal with? Now guys, if you notice in this chapter as of now, we talked about four different types of input. That is, there are four different factors which can affect our profit. What are these four factors? Simple. Selling price, variable cost per unit, right? Then fixed cost, obviously in total, and finally your volume, right? There are four different factors which can affect your overall profit, right? Now, which can affect your overall profit. Now, we have studied how these four factors impact my profit through certain tools like PV ratio, right? Your break even point, your margin of safety. Literally, guys, this is a summary of what we have learned till now. Literally, marginal costing is all about studying how these four different inputs can impact your profit through these three tools called as PV ratio, break-even point, and margin of safety. Now, in this concept, sensitivity analysis, what we are going to revise is that now keeping the out of these four variables or the inputs, let us say I am keeping these three inputs constant, I don't change it. Suppose if I increase or decrease my selling price alone, keeping my variable cost per unit, fixed cost and volume unchanged, how is it going to impact my profit is the study called as sensitivity analysis, or in other words, the study of change in impact or the study of change in one variable while keeping the other variables constant and how it impacts my profit is called as sensitivity analysis. Literally, guys, this is what I would have mentioned even in our concept decode. Sensitivity analysis is a study of rate of change in one variable with respect to change in another variable, keeping the other variables constant. Sir, what is this? Quickly, I will just give you guys a practical flow chart and a practical case scenario. It's not a case scenario basically. So I will open up and I will show you a practical flow chart. With this, you will have a crystal clear clarity. Now, sensitive. What do you mean by sensitive? We say, my friend is very sensitive. Means what? While other things being constant, suppose if one thing alone happens, how he or she reacts to that is called as sensitivity. Right here, let us say I don't change my variable cost per unit, I don't change my fixed cost, I don't change my volume. Suppose selling price alone, if I increase, how is it going to impact my profit? Will it increase or decrease my profit? We will study the impact of increase in selling price through the impact it has on PV ratio, break even point, margin of safety. Suppose I keep the other three things constant, variable cost alone I increase, how it impacts my profit. This is a study of sensitivity analysis. Now, no problem. Let me just open this chart and show it to you. Now, we will do it together, and this way, entire thing we will be completely finishing it off. Now, guys, now, what are the three tools that we study in this particular chapter? Basically, I told you PV ratio, break even point, and margin of safety, right? Perfect. Now, yes, now look at this. Let us say I am keeping everything constant. Selling price alone, what I do, I am increasing. For example, let us take the same example which we saw. Selling price at present is 10, variable cost is 6, which means contribution per unit is going to be 4, right? Let us say my fixed cost is going to be 10,000 rupees. I mean 10,000 rupees. Yes. In this case, what is going to be my break even point? My current break even point is going to be how much? 10,000 divided by 4. It is going to be 2,500 units, right? At present, my volume, let us say, is 6,000 units, which means at present my margin of safety is how much? 6000 minus 2500, which is going to be 3500 units. This is my current data which I am presenting it to you. Now, let us say I don't change my variable cost per unit, which means my contribution is also remaining. I mean, my contribution will not change because of variable cost. Fixed cost I'm not changing. Let us say the total volume I'm not changing. Selling price alone, let us say I am increasing. Now, what happens to my PV ratio? At present, what is the PV ratio? 4 by 10 into 100. 40% is my current PV ratio. Example, suppose if I change my selling price, if I increase my selling price to 12 rupees, variable cost continues to be 6, which means my contribution per unit becomes how much? 6 rupees, right? So now what is the PV ratio? 6 divided by 12 into 100, obviously PV ratio becomes 50%. Or in other words, if I do not change the other three variables, an increase in selling price will actually increase my PV ratio, correct? It will increase my PV ratio. Now, what impact will it have on my break-even point? Simple. Now, every time I'm selling one unit, right, obviously I am able to generate more contribution. In this case, now I will be able to recover my entire fixed cost quickly. Guys, clear with this, which means my break-even point will reduce. Are you guys clear with this? Right? So in this case, my break-even point will reduce. Why? Because I've increased the selling price. Every time I sell one unit, I will be able to generate more contribution, which means that in this case, now I will be able to recover the same fixed cost. Now, how much is the fixed cost? 10,000 rupees. Every time I sell one unit, I will generate 6 rupees. So literally, if you see 10,000 divided by 6, you get your break-even point is 1,666.66 units or 1,667 units. Earlier, it was taking me 2,500 units to actually recover 10,000 rupees. Now it only takes me 1,667 units to recover the same 10,000 rupees. Or in other words, every time I sell one unit, I recover more contribution, which means it takes lesser time for me to actually recover the entire fixed cost. My break-even point is less. It drops. Clear with this, guys? Now, what happens to margin of safety? Simple. My total volume remains unaffected, 6,000 units, but my break-even point is now reduced, which means the balancing figure, the number of units sold over and above my break-even point, it's obviously the balancing figure. So this will increase. Are you guys clear with this? So my margin of safety increases, and when my margin of safety increases, margin of safety is nothing but profit generating sales. Obviously, my profit increases. Are you guys clear with this? So the impact of change in one variable, right? So what impact it has on my profit, we are studying through these three tools called as PV ratio, break-even point, and margin of safety. This study is called as sensitivity analysis. Are you guys clear with this? That's all it is, guys. So an increase in selling price, what will happen? So it increases my PV ratio. So now, because my contribution per unit will increase, now what happens? Since every unit gives me more contribution, I'll be able to recover the entire fixed cost quickly. So my break-even point will fall. Now, volume remains unchanged, break-even point reduces, the balancing figure, which is basically my margin of safety, will now increase. And when my margin of safety increases, profit will automatically increase, because after all, margin of safety is nothing but your profit generating sales. Are you guys clear with this? Similarly, suppose there is a reduction in your selling price. In this case, what happens? Think and answer. Now, my selling price reduces. Let us say here, instead of 10 rupees, my selling price becomes 8. Variable cost continues to be 6, which means contribution per unit is 2 rupees, right? So now obviously my PV ratio falls 2 by 8 into 100, which is 25% only. Obviously, guys, my PV ratio will fall. Now, what happens to my break-even point? Every time I sell a unit, now I'm generating lesser contribution. It means I will take more time to now break even. So break-even point increases. Now, what happens to margin of safety? Total number of units sold, volume is same, but break-even point has increased, which means now the balancing figure, margin of safety, will fall. And when my margin of safety falls, what happens to your profit? The profit also drops. Are you guys clear with this? That's all it is. That's all it is. Next, now let's go to the second variable. What is the second variable? The second variable is your variable cost. The second input factor is variable cost. Suppose other things remaining constant, I am increasing my variable cost. Visualize. Now, selling price is same, variable cost I am increasing. If I increase my variable cost, what happens to my contribution per unit? My contribution per unit will fall. So when my contribution falls, obviously my PV ratio will fall. Clear with this, guys? Now, every time I sell a unit, I am generating lesser contribution, which means now it takes more time for me to recover the entire fixed cost. So break-even point will increase. Are you guys clear with this? Now, volume is same. Break-even point is more, which means the balancing figure, margin of safety, will fall. If my margin of safety falls, my profit will also fall. Are you guys able to understand an impact which a change in one variable has on my profit is studied through these three tools called as PV ratio, break-even point, margin of safety. This study or analysis is called as sensitivity analysis. Now you guys are getting it right. Now the other one, next one, suppose other things remaining constant, variable cost reduces. Now per unit variable cost reduces. In this case, what happens? Selling price remains the same, variable cost reduces, which means my contribution will increase. When my contribution increases, PV ratio will increase. Right now, every time I sell a unit, I'm able to generate more contribution, which means now I will be able to recover my entire fixed cost quickly. So my break-even point falls. Volume is the same, but my break-even point is less, which means my margin of safety balancing figure will now start to increase. So margin of safety is more. When my margin of safety is more, my profit will also increase. That's all, guys. That's all. It is very, very, very simple. Next one. Next one. Now, what is the third variable we've got? Fixed cost. Now, carefully think. Suppose other things remaining constant. Sir, selling price per unit, I'm not changing. Variable cost per unit, I'm not changing. Fixed cost alone, let us say I am increasing. First, you tell me what will be the impact on PV ratio. What is PV ratio? Contribution per unit divided by selling price. Now, fixed cost I am increasing. Because of this, will my PV ratio change? Absolutely not. So with respect to my PV ratio, there will be no change at all. Now what happens to my break-even point? Sir, every time I'm selling one unit, contribution per unit remains to be the same. But suddenly fixed cost alone is more. Now break-even point is fixed cost divided by contribution per unit. Now in my break-even point, now what happens? The numerator, fixed cost has increased, which means I need to recover more amount right now. Obviously because of this, what happens? So now I take more time to recover because right now the fixed cost has increased. Are you guys clear with this? So my break-even point increases. Now what happens? The total volume remains to be the same, but break-even point has now increased, which means the balancing figure, margin of safety, now reduces. Are you guys clear with this? This is all it is. Now, exactly the opposite of this. Suppose my fixed cost falls down. What will happen in this case? If my fixed cost falls down, now what happens to PV ratio? No change, because PV ratio is nothing but contribution divided by sales, right? Contribution per unit divided by selling price. This will not, fixed cost will not impact my PV ratio. But what happens to my break-even point? Now I need to recover only lesser amount as fixed cost, which means now the break-even point will fall, because now by selling lesser number of units, the entire fixed cost can be recovered. Volume is same, your break-even point is reduced, which means now the balancing figure, margin of safety, will increase. When my margin of safety increases, my profit will automatically increase. Are you guys clear with this? The last one, which is your volume. The last one, which is your volume. Now, other things remaining constant. So selling price per unit, I'm not changing. Variable cost per unit, I'm not changing. Fixed cost in total, I'm not changing. Volume alone, I am increasing. Now, think and answer. What will happen to PV ratio? Absolutely no change. Why? Because obviously PV ratio is what? Contribution per unit divided by selling price. Now, on a per unit level, the contribution is not changing. Right? My selling price is not changing. Even variable cost is not changing. Obviously, here, the PV ratio will remain unchanged. Guys, correct? Now, what happens to my break-even point? Break-even point is fixed cost divided by contribution per unit. Now, fixed cost is not changing. Contribution per unit is also not changing, which means even my break-even point will not undergo a change. But now, what happens to my margin of safety? Now, volume alone has increased right now. Let us say now, instead of 6,000 units, I am selling 8,000 units. Now, what happens? Now, what happens, guys? Break even point remains to be the same 2500 units, but volume alone has increased, which means the balancing figure, margin of safety alone, increases. Are you guys clear with this? In this case, your increase in volume will only impact what? Your margin of safety, and because of this, automatically you will be able to generate more profits. Are you guys clear with this? This is all it is. Suppose my volume drops, what will be the impact on PV ratio? Absolutely nothing, right? Break even point, nothing. Why? Break even point is fixed cost by contribution per unit, numerator denominator remains unchanged. What happens to my margin of safety? Now break even point is the same, but the total number of units sold is less. Because of this, the balancing figure, margin of safety, falls. Clear with this, guys? This is why generally they say if you sell more number of units, overall profit will increase. Why? Purely because break even point is a point. Anything excess sold in excess of the break even point is going to be margin of safety. So if the volume increases, margin of safety will increase. The volume decreases, margin of safety will reduce. Because of that, the profit will increase or decrease as the case may be. This will not impact your break even point and other things. Are you guys clear with this? This study is called as sensitivity analysis. If you put this arrow and study this entire area, you'll be able to master. And that's about this area, guys. Clear with this, guys? So literally what we have seen, your profit can be impacted by only these four variables, and what we have seen is a change in any one of these four variables will impact your profit, and we studied the impact of the change in any one of these four variables or inputs through PV ratio, break-even point, and margin of safety. And this entire study is popularly called as sensitivity analysis. As simple as that. Clear with this, guys? Now we will just go and solve one numerical problem. Once again, we'll be doing this from our CA Inter solved question bank. It's in volume number 2. So please go to question number 15A. Please go to question number 15A. I just want to take this. Yes. Right. Now look at this. This was, I think, I'm not sure if this was a past exam MTP question or an RTP question, but somewhere it was once asked. By noting PV ratio will increase or PV ratio will decrease or PV ratio will not change as the case may be, state how the following independent situations will affect my PV ratio. They are asking independent. They have asked about 10 scenarios, right? In each of the scenario, just they have asked for the impact on the PV ratio, nothing more. Conceptually you learn, please do not mug up anything, try to attempt it, and that's about this particular question. First, how will your PV ratio be affected? Will it increase or will it decrease or will there be no change? Right, this is what they have asked, right, in each of the following situation. Number 1, an increase in the physical sales volume. Now if I increase my physical sales volume, how will it impact my PV ratio? Now we all know PV ratio is nothing but contribution divided by, or contribution per unit divided by selling price, right? Now if there is a change either in the numerator or the denominator, only then PV ratio will change. Now first, an increase in the volume. Now tell me, will it impact my PV ratio? Absolutely not. We just saw an increase or decrease in the volume will only impact my margin of safety. Nothing else will be impacted, guys, correct? So in this case, what happens? An increase in the physical sales, it will not impact my, there will be no change. It will not impact what? It will not impact my PV ratio. Look at this. My PV ratio will not change. The ratio of sales value and the variable cost will remain the same irrespective of the change in the sales volume. Obviously, what happens? My numerator denominator does not change. Now, how will my PV ratio change? The next one. If there is an increase in fixed cost, will this change? Will this impact my PV ratio? Absolutely not. This will only impact your break-even point. When your break-even point gets affected, the balancing figure, margin of safety, will also get affected. Definitely, this will not impact your PV ratio. No change. Clear with this? Why? Because obviously here in the numerator or the denominator remains unaffected, right? Contribution per unit is not changing. Selling price per unit is also not changing, right? So obviously in this case, what happens is that your PV ratio will not change. Clear with this, guys? There will be no change. Next one. a decrease in the variable cost per unit. Now, if my variable cost reduces, what will happen? My contribution per unit will increase. Guys, clear? So, because of that, obviously my PV ratio will now start to increase. Clear with this? Now, look at this. PV ratio will increase. Are you guys clear with this? This is what we have studied in a chart format. Now they're asking this, easily you will be in a position to answer. The next one, a decrease in contribution margin. Now obviously if my numerator reduces, contribution per unit reduces, what happens in this case? Obviously my PV ratio will also fall. Look at this, PV ratio will decrease. Next situation, an increase in the selling price per unit. Now, if my selling price per unit has increased, what will happen? Because of this, contribution per unit will increase. If my contribution per unit increases, obviously my PV ratio will also increase. Now, look at the fifth one, PV ratio will increase. Then a decrease in the fixed cost. Fixed cost will not impact my numerator or my denominator. Hence, my PV ratio will not change. No change here. Question number 6, no change. Next, a 10% increase in both the selling price and the variable cost per unit. Now, in this case, now they are not changing one variable, they are changing two variable. How can you answer? You should take a scenario and do it. For example, selling price, variable cost, and then your contribution per unit. At present, let us say 10 minus 6 is equal to 4. What have they said? A 10% increase in both the selling price and the variable cost. 10% in selling price will be what? So 10 plus 1, it is going to be 11. Variable cost, 10% increase. What is this? 6 plus 10% of 6 is 0.6. So it's going to be 6.6. What will happen to the contribution per unit? So 11 minus 6.6 gives you 4.4. So what is the PV ratio at present? 4 by 10 into 100, it's 40%. Here it's 4.4 divided by 11 into 100. Once again, it's going to be 40%. Now, here what happens? There is no change when there is exactly a 10% increase in both the selling price as well as the variable cost per unit. You can take any one factor, any one figure right here. Model data you can take, on that you can increment and apply the change and check it out. So here there will not be any change. Clear with this, guys? Right? This is what you can just go ahead and update. Next one, a 10% increase in the selling price per unit and a 10% decrease in the physical sales volume. First one, understand here also two inputs are changing. One is an increase in selling price, the other one is increase in the volume. Now, first of all, understand, there is a decrease in the volume. Any change in the volume will not affect my PV ratio. So the only impact here is on the selling price per unit. Clear with this, guys? Now, a 10% increase in selling price. What will happen here? Now, if my selling price increases by 10%, obviously my contribution will also increase, and because of that, my PV ratio will only increase. This will not have an impact on PV ratio. This will have an impact on profit. Here in this question, they have only asked for the impact on PV ratio. So my PV ratio will increase. That too, it's purely only on account of what? An increase in your selling price. So point number 8, look at this. PV ratio will increase. Clear with this, guys? The increase in selling price will increase the contribution margin, but the change in volume in any direction will not affect the PV ratio. You should write the reasoning in exam. How will you write it? Just visualize whatever chart which we did, and this is more than sufficient for you to crack these kind of questions, right? Thus, an increase in selling price will decrease your sales volume. With the decrease in sales volume will only increase your PV ratio. Anyways, decrease in sales volume will never affect your PV ratio. So the increase in PV ratio is purely on account of increase in your selling price. The next one, a 50% increase in a variable cost per unit with a 50% decrease in the fixed cost. First of all, understand, a change in fixed cost will not impact your PV ratio. It will impact your overall profitability by way of break-even point and all that. But here in this question, they have only asked for the impact on PV ratio. PV ratio will get impacted in this case only on account of change in the variable cost. Variable cost is increasing. So if my variable cost increases, selling price remains constant, contribution per unit will decrease. When my contribution per unit decreases, what happens? My PV ratio will also fall. So point number 9 here, PV ratio will decrease. Are you guys clear with this? Logically think and answer. That's all it is. An increase in the angle of incidence. Oh, what do you mean by angle of incidence, I will tell you very simple. This is actually presented in a graphical format. I will tell you here. One second. Now, look at this. This is basically your break-even chart, right? Where here on the y-axis you have rupees, and on the x-axis you have the number of units. Now, simple. As you increase the number of units, this is your variable cost line. What is this variable cost line? Now, if I produce 0 units, variable cost is also 0. That's why it starts from here. If I slowly increase the number of units, parallelly my variable cost will also increase. Clear with this, guys? Right? Now, ideally speaking, here you have a fixed cost line. All these things you would have studied in your foundation or even in your school days economics. Fixed cost line is flat. It will not change with the number of units, right? Let us say fixed cost is 2 lakh rupees, 200,000. Now, if I produce 0 units, still I will be incurring fixed cost alone. That's why your total cost basically is nothing but fixed cost plus variable cost. This line starts from here and it slowly increases, right? Here, this is your fixed cost line. Any increase in volume will not impact your fixed cost. So, your total cost alone, what happens? Increases, because parallelly your variable cost line is your, and parallel to this variable cost line you will be having the total cost line, because total cost is fixed cost plus variable cost. That's why it is running parallel here. Now what we need to do here, this is your total cost line, basically your fixed cost plus variable cost. This is your sales line, right? Sales line, basically it starts from 0. So if I don't sell any units, my revenue is 0. If I keep on increasing my units, obviously my turnover will also increase. Now what happens, guys? This is going to be my sales line. This is going to be my cost line, total cost. Now break-even point is a point where my total sales is equal to total cost. Only in that case, exactly I will be earning a profit of 0. Right? So this is my break-even point, right? Now, if you notice, this is going to be my sales line, right? Now, if you notice, below the break-even point, my cost is always greater than sales. This is the reason why you are reporting a loss. At the break-even point, my total cost is equal to total sales. Hence, there is a 0 profit or 0 loss. And above this break-even point, my sales, right, is greater than my total cost. Hence, above the break-even point, you are always making a profit. This is a graphical presentation. Now, from the break-even point to above, there is an angle that has been generated here, right? This angle is called as angle of incidence. Simple, guys. Now, if the angle is wider, obviously it means the difference between my sales and cost is more, or in other words, my profit is more. So if this angle is more wider, let us say if the angle is like this, then what happens? The difference between my total sales and total cost will be more, and it indicates a more profitability. Or in other words, if there is an increase in the angle of incidence, my profit will increase. Are you guys clear with this? If there is a reduction in the angle of incidence, in that case my profit will reduce. So this is something that you need to understand in a graphical presentation. So now in this question, if you notice, they have asked what will happen, what will be the impact on PV ratio if there is an increase in the angle of incidence. An increase in the angle of incidence indicates that the company is earning at a higher rate, or in other words, there will be an increase in your PV ratio. This is all you need to know. Are you guys clear with this? This is once again logical, provided you know this particular graphical format, and as simple as that. So here we've seen, so my PV ratio will only increase if there is an increase in my angle of incidence. Angle of incidence represents the rate of profit earning after reaching the break-even point. Just now I taught you, right? And increase in the angle of incidence means the rate, there is an increase in the rate of profit earning, which is nothing but the PV ratio that contributes towards the profitability after recovering your fixed cost. Are you guys clear with this? So this is all about it. 10 different scenarios, right? We have just learnt it. I mean, we have just revised all these things with a conceptual revision of sensitivity analysis. Now, for this particular question, I request you to please go and update your library of adjustments. So please go ahead and update, write down sensitivity analysis, hyphen impact on PV ratio in 10 different situations. In 10 different situations. An excellent question to summarize and revise the entire concept of sensitivity analysis. So this is once again logical. Now, please do not mug up. If you are a person who's been mugging this up, I've just proved it to you how simple and effective you can revise this entire area. We have studied conceptually. In fact, in the marathon itself, I have done one numerical problem, right? That's about it, right? In our batches, in our regular or EVO batches, we'll be doing a few more numerical problems. But here, since this is a marathon and I didn't want to miss this question also, so one full-fledged question we are solving, right? So with that, we have completed this particular concept of sensitivity analysis. So this particular concept of sensitivity analysis is now over. Now let's move. Sorry, there was an issue with the mic. So I'll just repeat this area again. So now we are going to get started with the next concept called as sales mix in marginal costing. Now, till now, in sensitivity analysis, we have learned that these four variables or inputs, namely your selling price, variable cost, fixed cost, and volume, these four variables or inputs will only impact your profit. A change in any one of these four inputs is only going to impact your profit. But now, in this next segment of discussion, which is sales mix, we will learn that ideally there is one more fifth input factor called as your sales mix, which will also impact your profitability. Now, let me take the heading here. Sales mix and marginal costing. Now guys, let me take an example of BMW. Now, as you guys know, BMW is in the business of manufacturing car as well as bikes, right? Now, let me take an example here. Now, I am taking 2 years, let us say in the year 2025 and in the year 2026, right? Now, between these 2 years, BMW did not change the selling price of bike and car. They did not change the variable cost per unit of their products, bikes and cars. They also did not change the fixed cost. It was also constant. And for your information, the volume was also constant. That is, in the year 2025, they sold a total of 1 lakh units. This 1 lakh comprises of, let us say, 60,000 cars and 40,000 bikes. Now, in year 2026 also, they sold 1 lakh units. So here, the volume did not change, but the composition, that is the sales mix alone changed. Here, if you notice, they sold 40,000 cars and 60,000 bikes. So guys, if you notice here, selling price did not change, variable cost did not change, fixed cost did not change, even the total volume did not change, but the composition of the total volume, basically the sales mix alone changed. Now you tell me, the profit reported in 2025 and the profit reported in 2026 will definitely be different. Why? Sir, the four inputs we saw did not change, sir. Still, why was there a change in the overall profit? This was purely because of the change in the sales mix. Or in other words, sales mix represents the composition of the different products that the company is dealing in. Till now, whatever we have learned is all about a concept of all this marginal costing in case the company deals only in one product. But in real life, companies deal in more than one products. Now, in case when company deals in more than one product, in that case, there is a fifth factor which affects your profitability, which is called as sales mix, right? This is something that is very, very important. Now, guys, in this particular scenario, how do we apply the concepts of marginal costing is the study in this scenario called as sales mix. Now, the most important factor here is regarding calculation of break-even point. Now, guys, we all know break-even point formula. What is the formula to calculate break-even point? It is going to be fixed cost divided by contribution per unit, right? Now, there is a common fixed cost, right, that needs to be recovered by way of generating contribution, right? So fixed cost divided by contribution per unit. Now, let us say the company deals in two products, A and B. Now, in the denominator, should I take the contribution of product A or should I take the contribution of product B or should I jointly take the contribution of A as well as B is the study in this particular scenario. Or simply in other words, now there is a common fixed cost which is incurred, right, towards production on sales of two products. In our example, two products. A company can also have three products or any number of products. Now, this fixed cost has to be jointly recovered by both the products put together. In this case, how will you compute the break-even point? And all these things are the subject matter of discussion in this particular scenario. Now, without any further delay, now let's go and take up one numerical problem with the example of, with the help of this particular numerical problem, we will clearly be able to understand the concept of sales mix, and it's a good sum to revisit or revise this entire concept of sales mix, right? So now please go to your solved question bank, CA intermediate solved question bank, and please take question number 19. Question number 19. See, our question bank is comprehensive. Every single question from our study material, right, past exam, RTPs, MTPs, everything has been covered. Beyond this, you don't need any other thing, right, in your exam preparation. Beyond this, there is nothing more you need because everything I've compiled it in a single place, right? There are two similar questions I've grouped and all. You can see the color pattern. For example, it is 18C. So 18 is the main question, A, B, C, and all are questions which are similar to question number 18, something like that. So, right, so here you have MTP2, every single thing has been included here. So now please take question number 19. This is about your sales mix. Now the following set of information is presented to you by your client AB Limited producing the two products X and Y. Now what have they mentioned? Product X, product Y, right? Direct material, direct wages, the cost is given for each of the two products. The fixed expenses during the period was 1,600 rupees, right? The variable expenses are allocated to the product at the rate of 100% of direct wages, and the selling price is given as 40 rupees and 30 rupees each, right? Now there are two products X and Y. What is the selling price? 40 rupees and 30 rupees, right? Now what is going to be my total variable cost? Now for product X, literally if you see, we have 20 rupees direct material, 6 rupees wages, and 100% of direct wages is variable overheads. So another 6 rupees we have here. So literally 20 plus 6 comes out to how much? 32 rupees, right? So it's going to be 32 rupees is the total variable cost of product X. Similarly, for product Y, 18 material, 4 rupees is your direct wages, and 100 percentage of direct wages, that is another 4 rupees is your variable overheads. If you add this up, how much you get? 18 plus 4 plus 4. So you basically get 26 rupees, right? This is going to be your total variable cost of product Y. So literally the contribution per unit of X is going to be 40 minus 32, 8, and contribution per unit of Y is going to be 30 minus 26, which is going to be 4 rupees. Right, guys? Now, now, now in this scenario, they have asked the proposed sales mix scenario number 1. Let us say they are selling 100 units of X, 200 units of Y. What will be the profit? Scenario 2, 150 units of X, 150 units of Y. What will be the profit? Scenario 3, 200 units of X, 100 units of Y. What will be the profit? You need to compute. The total fixed cost is 1600. Now, you tell me 100 plus 200 overall volume is 300 units. 150 plus 150 overall volume is 300 units. 200 plus 100 overall volume is 300 units. Here in these three scenarios, volume is not changing, but the composition mix alone we are changing. Clearly because of that, what happens? Your profitability will change. Why? Because X is a more profitable product. 8 rupees contribution you get for every unit of X. Y you get only 4 rupees. So obviously in that mix, if you are selling more of units X, obviously the overall profit will be high. Are you clear with this? Right? This is how it works here. Right? So in each of these scenario, you need to compute the profit. Nothing great. Number of units multiplied by the respective contribution per unit, you'll get the total contribution. From that, subtract your overall fixed cost, you will arrive at your profit. This is not the great thing. The most important thing is with respect to calculation of break-even point. Now, this also, the first part I will quickly do, and with that, this will be over. Now, look at this, the contribution per unit we have done. Suppose I am selling 100 units of X, 200 units of Y. What will be the total contribution here? 100 into 8, I get 800, plus 200 into 4. How much is 200 into 4? That is once again another 800. So literally the total contribution will be 1600 minus your fixed cost, that is also 1600 rupees. So literally you will be left with a zero profit. Clear with this, guys? Right? So that is the first situation here. Look at this, 100 into 8 plus 200 into 4, that gives you 1600 rupees contribution minus fixed cost 1600, you get a zero profit. Suppose I'm selling 150 units of X, 150 units of Y. Simple, 150 into 8 plus 150 into 4. So 150 into 8 gives you how much? It gives you 1200 rupees, and 150 into 4 gives you 600 rupees. So overall, you get a contribution of, so 1200 plus 600 is going to be 1800. Minus your fixed cost of 1600, it gives you a profit of 200. See, the overall volume didn't change, but just because of the change in the mix, what happens? Your profit is changing. Clear with this, guys? This is not the big deal here. Now, the most important part is calculate the break-even point when the sales mix is 2:1. Now, in this case, now how will we actually calculate the break-even point? This is the most important part of calculation in this entire concept of sales mix. Quickly we will revise. So now what is going to be my sales mix? It is going to be 2:1. Now each of the two products we have got here, now let me put it here. We have two products here. What are the two products? Product X and product Y. Now how much is the contribution per unit of X? 8. Y is going to be 4. 8 and 4. This is going to be my contribution per unit. And what have they given? The sales mix is going to be how much? It's going to be 2:1. So the sales mix is going to be 2:1. Which means what? Sir, every time you are selling 3 units, 2 units come from product X and 1 unit comes from product Y. So for every 3 units sold, 2 units are X and 1 unit is product Y. Clear with this, guys? Now in this case, we need to compute the break-even point. Now what is the formula for break-even point? Fixed cost divided by contribution per unit. Now in this case, will I take the contribution per unit of X or will I take the contribution per unit of Y? Ideally speaking, we should take the contribution per unit of both X and Y. Sir, how will we do that? Very simple. Now, You guys tell me 2:1 is the sales mix, which means for every 3 units sold, right? Now, can you tell me what is the total contribution? Simple, sir. If I sell 3 units, right, 2 units will come from product X, 1 unit will come from product Y. So 8 into 2 plus 4 into 1. Are you clear with this? 8 into 2 units plus 4 into 1 unit. This will be the total contribution generated for 3 units. So on an average, the weighted average contribution per unit will be how much? Divided by 3. So this is the total contribution for 3 units. If you divide it by 3 on an average, what is the contribution per unit? You can calculate. Guys, clear with this? So how much does it come out to? So 8 into 2 is 16 plus 4 into 1 is 4 divided by 3. So 16 plus 4 is 20. So 20 by 3 comes out to how much? 6.6666. It keeps on going. Or in other words, you can also say, sir, this is nothing but weighted contribution per unit. Actually, we call it as weighted contribution per unit, because in this case, this fixed cost is going to be recovered jointly by these two products. Hence, I will have to consider the contribution per unit of both the products. Hence, we don't take the contribution of X or we don't take the contribution of Y. We take the weighted contribution of X and Y. Or in other words, we can also say the weighted contribution can be calculated as follows. So what is product X's contribution per unit? 8. I can say 8 into 2 by 3, that is a sales mix, plus 4 into 1 by 3. This way also you can calculate. The same thing can be rewritten as 8 into 2 by 3 plus 4 into 1 by 3. Are you guys clear with this? This way also you can calculate and show it off, not a problem. Ideally, this is nothing but weighted average, weighted contribution per unit. Now, in case when a company manufactures more than one products, ideally speaking, the formula for calculating the break-even point is nothing but fixed cost divided by weighted contribution per unit. Are you guys clear with this? So in this case, how much the weighted contribution per unit? 6.6666. So now in this case, you tell me what is going to be your break-even point? My break-even point is equal to, how much is my fixed cost? My fixed cost is going to be 1600. We saw that. So rupees 1600 divided by, what is the weighted contribution per unit? 6.6666. So retain the decimals in your calculator. So it's going to be 1600 divided by 6.6666. You get 240 units. So if I have a total volume of 240 units, I will be able to recover my entire fixed cost of 1600 rupees. I'll be left with no profit or no loss. Now you tell me, is this 240 units of X or units of Y? It is jointly units of X plus units of Y. Now what we need to do, this 240 units, split it into 2. So how many units of X, how many units of Y? We know the sales mix. Generally when the company is selling, they will always have the sales mix as 2:1. So which means, so 240 into 2 by 3 will be the number of units of X. 240 into 1 by 3 will be the number of units of Y. So 240 into 2 by 3, how much is that? It's going to be 160 units. 240 into 1 by 3, it's going to be 80 units. Or in other words, if I sell 160 units of X and 80 units of Y, I will be able to break even. That is going to be, I will be able to recover my entire fixed cost of 1600 and I'll be left with no profit or no loss. Are you guys clear with this? This is the way to compute your break-even point when you have sales mix, when you have more than one product for the company and the sales mix ratio is given. Are you guys clear with this? So when a company is having more than one product, in this case, how do we compute your break-even point? Break-even point is equal to fixed cost divided by weighted contribution per unit. How do you compute weighted contribution per unit? The respective contribution per unit multiplied by weight of that particular product. Are you clear with this? As simple as that. Or you can also say the total contribution divided by the total number of units in that particular mix. Are you guys clear with this? It's absolutely logical. Nothing needs to be mugged up here. And this is exactly what I've solved and showed here in this particular solution. Look at this. All these solutions I have improvised, right? So this is not as it is in the study material. It's not a copy paste. This entire question bank, we have revamped it, and literally the presentation also, just like how I've done here, I've presented it. So basically it's going to be 240 units. Ideally, this is wrong. It has to be 240 units, right? So 240 units. So 2/3 and 1/3. Ideally, when the company sells 160 units of X and 80 units of Y, it earns zero profit. That's going to be your break-even point. Are you guys clear with this? Right? This is the most important learning objective here. Suppose if there is a change in your sales mix, accordingly, what happens? Recalculate the break-even point when the sales mix is 1:2. Very simple. Now, suppose it is going to be 1:2. Right? So what happens here? Instead of 2:1, it's going to be 1:2. Then what do? Recalculated the weighted contribution per unit. So weighted contribution per unit is equal to 8 into 1/3 plus 4 into 2/3. Correct? Because 1:2 right now. Right? So 8 into 1/3 plus 4 into 2/3. Now once again, you need to compute. Quickly, let me do this here. Product X, product Y. What is the contribution per unit? Just now read it here, 8 and 4. So rupees 8, rupees 4. The sales mix is going to be 1:2, which means the weighted contribution per unit is going to be 8 into 1/3 plus 4 into 2/3. Alright, so how much is this going to be? 8/3 plus 4 into 2 is 8. So 8/3, right? Or in other words, is going to be 16/3. So 16/3 is going to be what? 5.3333. So here the break even point is going to be fixed cost 1600 divided by weighted contribution per unit 5.3333, right? So now here, how much is that going to be? 1600 divided by 5.3333. You get an overall 300 units. So if I sell 300 units overall, I will be able to break even. Now, what is the breakup of that? X and Y. So X has to be, so 1:2, right? Overall, X needs to be 300. 1 second. So X, number of units of X to be sold is going to be 300 into 1/3. Number of units of Y is going to be 300 into 2/3. So this is going to be how much? 100 units of X, and this is going to be how much? 200 units of Y. Or in other words, if I sell 100 units of X and 200 units of Y, I will be able to break even. This is how you need to arrive at it. Are you guys clear with this? So the most important part when it comes to sales mix is that the calculation of break-even point. So break-even point formula is going to be your fixed cost divided by weighted contribution per unit. And remember one more thing. Suppose in the question contribution is not available, PV ratio is available, I can say simply this is nothing but, so break-even point in sales value is going to be fixed cost divided by weighted PV ratio. As simple as that. If you want the figure in value, instead of contribution per unit, use PV ratio. Clear with this, guys? But that has to be a weighted PV ratio because you need to consider all the products for recovery of your fixed cost. As simple as that, guys. Clear with this? This is all about this particular question, and using this question we learned the concept of sales mix. The other part of the question is fairly simple, right? In fact, we have done that also, right? The most important part is with respect to calculation of your break-even point. So now please go and update your library of adjustments. Write down sales mix hyphen calculation of profit and break-even point in different scenarios. Calculation of profit and break-even point in different scenarios, right? That's about this concept of sales mix. Look at this. We can just knock off all these concepts without mugging up anything. That's the beauty of costing, guys. Trust me. Costing, FM, these subjects should never be mugged up. Mugging up is not even a sin. I told you it's a crime. So you should never mug up in these subjects and all. As simple as that. So here the break-even point is what? Fixed cost by weighted contribution per unit or fixed cost by weighted PV ratio. How will you do that? Simple. The respective contribution per unit into the weights or the respected PV ratio into weights, and as simple as that, guys. Clear with this, right? And that's about this particular concept of sales mix and marginal costing, right? With this we have completed this particular concept called as sales mix. Now let's move on to another concept called limiting factor. We will do one concept called as limiting factor. Quickly, we will revisit this area. So let's get started. So I will take this up here. One second. Okay, guys. So limiting factor. Okay. Now guys, let us say I deal with two products A and B. Let us say the selling price is going to be 10 rupees for product A and 10 rupees for product B. The variable cost is going to be 6 rupees for product A and 4 rupees for product B. The contribution per unit is going to be 4 rupees for product A and 6 rupees for product B. Now, you guys tell me, these two products are there. Which product will I manufacture? Now, you might say, sir, product B, sir, I will manufacture because it gives me a higher contribution per unit. Now, I will say, why only product B? Product A is also giving me some positive contribution. So, I will produce both A and B, no? Who is stopping me? Yes, I can sell as many number of units of B possible. I will also parallelly sell as many number of units of A possible. Guys, clear with this? So why should I limit my production to only one product? I can produce as many products as possible, right? So generally, when there is no constraint, no one is stopping you from producing a product which has a positive contribution. You can produce all the products which will generate a positive contribution. Are you clear with this? Now, let me add one more data here. Let us say both these products are produced by using a common raw material called X. Now this X needs to be imported from, let us say, China, right? Now there is some import restriction and the Indian government has clearly mentioned that you cannot import beyond 10,000 kgs of raw material X, or in other words, raw material X is a scarce product. It is called as limiting factor. Are you clear with this? Any factor that limits your production or output is called as a limiting factor. In this scenario, your raw material is a limiting factor. So now you guys tell me, what is the total kgs of raw material available? 10,000 kgs. Clear with this, guys, right? And let us say to produce 1 unit of product A, I require 1 kg of raw material. To produce 1 unit of product B, let us say I need 2 kgs of raw material. And overall in the Indian market for product A, let us say I have a total demand of 2000 units, and for product B I have a demand of, let us say, 8000 units. This is the scenario. Now guys, first you tell me, in the market I have a total demand of 2000 units of product A and 8000 units of product B. Will I be able to fulfill the entire market demand? Is that possible right now? So to fulfill the entire market demand, sir, to produce 2000 units, 2000 into 1, I need 2000 kgs of raw material plus 8000 units of B, sir. 8000 into 2, 16,000 kgs of raw material. Overall, 2 plus 16, I need a total of 18,000 kgs of raw material. If I have 18,000 kgs of raw material, I can satisfy the entire market demand for product A as well as product B. But now you tell me, how many kgs of raw material do I have? Only 10,000 kgs of raw material, which means raw material is a scarce component. I call that as a limiting factor. This is a factor that limits my production. In this case, what should I do? I should judiciously and very, very carefully, I should use my raw material. Now, how am I going to use it? Which means I need to use this raw material properly and very judiciously towards production, right? Now, you guys tell me, I need to prioritize. Sir, which product should I produce first, A or B? Once I fulfill all the first priority product, then if any kgs of raw material is left, I will go to the second priority product. Now you guys tell me, Which product should I manufacture first, raw material A or raw material B? We should do a ranking. Now, many of you might think, sir, first ranking will go to product B because it has a high contribution per unit. First produce this particular product B. Then if you are left with any raw material, then you can produce product A. So which means product B should get the first rank, product B should get the second rank, priority. The answer is wrong. Why? Now you need to compute something called as contribution per limiting factor. What is the limiting factor here? Raw material. So contribution per kg of raw material. Here, product A, you generate 4 rupees by consuming 1 kg, which means 4 by 1. My contribution per kg of raw material is 4 rupees. Whereas product B, no doubt, you generate a contribution of 6 rupees, but this 6 rupees can be generated by consuming 2 kgs of raw material. 6 divided by 2, you get how much? Rupees 3 per kg. Now you guys logically think. Now every time I lift a particular kg of raw material from my stores and issue it for production, if I use it for producing product A, this kg of raw material, if it gets converted into product A, every kg of raw material used for product A can generate 4 rupees. Whereas every kg of raw material used for producing B can only generate 3 rupees. Why, sir? No doubt product B has an advantage of higher contribution per unit, but product A has an advantage of lower consumption per kg, which may lower consumption per unit. So which means in this case, so you need to consider both the contribution as well as the consumption. Hence, what we do is we do the ranking by considering contribution per limiting factor. In this case, contribution per kg of raw material. Literally, this 6 rupees can be achieved by consuming 2 kgs of raw material, or in other words, per kg of raw material used for producing product B, I can generate only 3 rupees, whereas the same raw material is used for producing product A, I can generate 4 rupees. So now what we do here is, now I do the ranking. So as per the ranking, the first priority will go to product A. So use all the kgs of raw material and try to fulfill the entire market demand of product A. 2000 units of product A you produce. If you are left with the balance kgs of raw material, then you go ahead and use it for producing product B. That is going to be the second ranking product. So the first step in questions which have limiting factor is, doing the ranking. Ranking should be based on what? Contribution per limiting factor. In this question, I told you the limiting factor is raw material. Now, maybe in some question, they could have given you the limiting factor could be labor hours, right? The total labor hours available is 10,000 hours. In that case, what you need to do? Example. So, the labor hours per unit will be given in the question. Arrive at the contribution per labor hour, do the ranking, and then you need to do the allocation. So, basically, guys, the first step that we need to do here is about what? So, the step number 1 is ranking. Now, step number 2 we need to do, which is allocation. Sir, how will I allocate? So, allocation of raw material to the products. Sir, using this 10,000 kgs, what is the best possible combination of product A and B that I can produce so that I will get the maximum possible profit? Now, for this, actually, I have a template here. Rank product kgs per unit, kgs, and cumulative kgs. Sir, what is this? A very, very proper and a structured way of cracking questions here. First, what is the first rank product? Product A, right? 1 second, I think I missed out one thing. Okay, so here I will write it down. Units, kgs per unit, kgs, and cumulative kgs. I will tell you what this is. Product A. Now, what is the maximum possible demand of a product A? 2000 units, right? So 2000 units. Now, to produce 1 unit of product A, how many kgs of raw material do I need? It's given in the question, 1 kg. Which means to satisfy this entire 2000 kgs, 2000 units, how many kgs do I need? 2000 into 1, 2000 units. So till now, cumulative kgs I've consumed is how much? 2000 units. Next, what is the second rank product? B. Now come from the reverse. After I produce A plus B, totally how many kgs of raw material would have been consumed? The total 10,000 kgs, right? The total 10,000 kgs, right? So this is not units, this is kgs. Now, out of this 10,000, already I would have consumed 2,000 kgs for producing first product A, which means how many kgs are available for producing product B? Balance 8,000 kgs only. Now, to produce every unit of product B, how many kgs do I need? 2 kgs of raw material, which means using this 8,000 kgs of total raw material, how many units of B can I produce at max? 8,000 divided by 2. Max, I can produce only 4,000 units of product B. Are you guys clear with this? Or in other words, the most optimum allocation of this raw material is you produce 2000 units of A and then produce 4000 units of B. This combination will only give you the maximum possible profit. Now, if you deviate from this mix, definitely your profit will definitely reduce as compared to this particular allocation. Are you guys clear with this? So there are two steps involved in your limiting factor questions. Number one, ranking your the products based on contribution per limiting factor, and step number 2 is allocation of your limiting factor to the products. Are you guys clear with this? In this scenario, right, what we did, I narrated one particular question, and based on this particular facts, we have seen that the best optimum possible production is going to be to produce 2000 units of A and 4000 units of B. So we are fulfilling entire product A's demand. Product B, out of 8,000, we can only produce 4,000. This is because of the constraint of raw material. Are you guys clear with this? And that is all about the concept of limiting factor. With this, any kind of sum you will be able to do. And in fact, in our courses, in our regular and EVO batches and all the sums we do here. But since this being a marathon revision, right, here also I have taken one numerical example to explain the concept of limiting factor. The same logic you can apply for in case of instead of raw material. Suppose in the question it is being mentioned that labor hours or machine hours is a limiting factor. In that case, automatically instead of raw material you can use your labor hours or machine hours, as the case may be. Calculate the contribution per labor hour or contribution per machine hour, do the ranking and do the allocation. As simple as that. Clear with this, guys? So with this, we have also completed the next concept called as limiting factor. So let's go and tick off the scoreboard, right? So that's about this concept of limiting factor analysis. So now let's move on to the next concept called as shutdown point. Now what is this concept of shutdown point? Now I've clearly explained this in our concept decoder notes as well. The limiting factor is mentioned, shutdown point, right? So I have neatly condensed all the formulas and everything has been mentioned here. So all these things, whatever I've written down here, it was actually done during our, the batch, that is your regular and EVO batches and all. So we use the same book, in fact, for all our, regular batches as well, and even in our exam-oriented batch. But anyways, this concept of shutdown point, right, it is applicable under situation of off-season or recession. A company may need to evaluate whether it should shut down. Remember, it's a temporary closure, or continue with the operations. Now, guys, what are they talking about in this particular scenario? Now, this concept is called as shut down point. Now, guys, now understand, in some extreme cases, the market might be very, very dull. For example, COVID time. Now, what happens? Though my product is very, very good, it has all quality, it provides value addition to my customers, but still, during certain time of recession, a perfect example is COVID, people might not be having the money to buy the product, though my product is very good in all other aspects. Now, in this case, COVID time, let us say for the next 3 months, I am expecting that, there is going to be a complete lockdown. My business is going to be dull. Now, after 3 months, once again, my business will pick up. Till now, my business is very good. Temporarily, for this next 3 months, right now, the market is going to be dull. I need to take a decision whether I should continue my operations for this next 3 months or I should keep my factory shut down. Clear with this, guys? This is called as shut down or continue decision. In this chapter, we're going to take decisions. That's all, right? Shut down or continue decision. Sir, after 3 months, I will continue. That goes without saying. This is a temporary or a short-term decision we are taking. In our subject, we only take short-term decisions. We don't take long-term decisions. Long-term decisions are taken in financial management. Only short-term decisions are taken in cost and management accounting. Now, guys, now, how do we do this? Simple, based on cost benefit analysis, right? What is this? Sir, if I shut down, what is going to be my benefit? What is going to be my cost? We need to compute. If my benefits are going to be more than the cost of shutting down, then I will definitely shut down. If it is the other way around, that is costs are greater than benefit, then I will continue. Are you guys clear with this? Now, let me take an example. Now, let us say I run a coaching institute. Example I'm giving you, right? In a face-to-face model, I have hired one classroom, and on an average, let us say 200 students generally come and attend my class. Now, during COVID, what happens? I got an inquiry only from 8 students. Everyone preferred online, right? I'm talking about a face-to-face batch. Now, only 8 students said, sir, we are living nearby in the same street. We can come, sir. Don't worry. Now, instead of 200 students, now I have a demand of only 8 students. In this scenario, now I'm going to take a call whether this particular batch or for this particular next 3 months, should I shut down or should I continue? Now, if I shut down the batch, what are all the benefits? I will write it down here. If I shut down the batch, because of shutting down, what are all the extra costs? I will write it down here. Now, guys, let us say I'm running an academy with multiple faculties, right? Now, let us say I have fixed costs, right? There are 2 types of fixed costs. One is called as avoidable fixed cost. The other one is called as unavoidable fixed cost. Now, what are these two, sir? Example. Now, the same example of coaching institute. Now, let us say I'm going to cancel the upcoming batch, face-to-face batch. Because of this, can I go ask my landlord, sir, next batch is not going to happen, so I will not pay your rent for the next 3 months? Can I tell him that? Absolutely not. So clearly, rent is an example of unavoidable fixed cost. Whether you shut down or you continue, definitely this rent has to be incurred. Whereas, let us say I have faculties for multiple subjects and I'm going to pay them for every batch. If you take one batch, I will be paying you a fixed amount of so much. It is not dependent on the number of students. Example, I'm telling you. Suppose if I cancel the next batch, I need not pay my faculties, obviously, because the batch is not conducted. Clear with this, guys? Now, the faculty fee payment is an example of avoidable fixed cost. It is fixed cost only. Both rent as well as faculty payment are examples of fixed cost, but your faculty payment is avoidable in nature, rent is unavoidable in nature. Are you guys clear with this? If I shut down, I will be able to save my avoidable fixed cost. Are you guys clear with this? So the benefit of shutting down, there is only one benefit. What is this? Savings in avoidable fixed cost. Are you guys clear with this? Savings in avoidable fixed cost, right? Now, what are the costs if you shut down exclusively? What are the costs you are going to incur? Now, don't say unavoidable fixed cost. Unavoidable fixed cost, example, rent will be incurred whether you shut down or you continue. On the cost side, what you should mention, if you shut down, only because of shutting down, if you are incur specifically some cost, that alone should be captured here, because we're doing a cost benefit analysis. If I shut down, what is the benefit? If I shut down, what is going to be the cost we are going to compute, right? Now, let us say during COVID, right? Now, lockdown was there. Now, we couldn't move around. So lockdown was there, let us say for 1 month. After this 1 month, now what happened? If you are going to start your two-wheeler, right, because you cannot move around, your two-wheeler would have been just like that, you would have kept it down, right, in your garage or in your parking area. After 2 months, if you start this two-wheeler, it will not start. So the first place you will go is the mechanic shed. Or in other words, basically guys, this is the thing that happens for all machines. If you don't use a particular machine, then it requires some extra maintenance. Clear with this, guys? Similarly, if I am planning to shut down my factory for the next 3 months, I need to incur some extra cost which I will not be incurring if the business is running. Clear with this, guys? I need to do some trial run, extra overhaul, maintenance, lubrication, other things I need to do just to make sure that the machine will run after 3 months of shutting down. Clear with this, guys? So, or in other words, this is called as shut down cost. What do you mean by shutdown costs? The costs which are exclusively incurred if I am shutting down my business. Are you guys clear with this? So if I shut down, there is an exclusive cost which I incur. It is called as shutdown cost. So this is one cost which I incur only if I shut down. Clear with this, guys? Next, there is one more cost, opportunity cost. This is nothing but the contribution lost on shutdown period demand. What is this? Now, I told you, instead of 200 students during the shutdown period, or in other words, during this 3 months upcoming batch, I got inquiries from 8 students. Now, because I am shutting down, now what happens? I cannot generate the contribution on this 8 students also. Are you guys clear with this? So, if I shut down, what happens? I am losing out on the contribution that I could have otherwise generated on the shutdown period demand. Whatever less demand it is, on that I could have generated some contribution, that also I will be losing. Clear with this, guys? Right? So now there is one benefit and there are two costs here. If the benefits exceed the cost, then you can go ahead and shut down. If your costs exceed the benefit of shutting down, then do not shut down, go and continue. Clear with this, guys? But there will be one point where the benefits is equal to the cost, that is called as shutdown point, and at that point, whether you shut down or you continue, basically you will get the same result because your benefits is equal to cost. Now let me give you a numerical example. With the help of this, you will be able to understand. Now let us say, guys, right, this is example number 1. So I'm classifying this benefits and cost. Let us say avoidable fixed cost is equal to 1 lakh rupees. Sir, if you shut down, you will be able to save fixed cost of 1 lakh rupees. But what happens? Sir, exclusively for shutting down, you need to incur some extra maintenance. How much is that? 40,000 rupees. And contribution lost, how much is it? Let us say, sir, for the upcoming 3 months, I predict I'm going to get a demand of 8,000 units. Sir, generally, sir, for this 3 months, generally 1 quarter, I get a demand of 70,000, 80,000 units generally. Whereas now I'm getting only 8,000 units. But if you shut down, that 8,000 units also cannot generate a contribution. Ideally, if I sell 1 unit, I could have generated 4 rupees of contribution. But since I'm shutting down, 8,000 into 4, I'm losing how much? 32,000 rupees. Guys, are you clear with this? So now total cost is how much? 72,000. Or in other words, if you see, if you shut down, how much amount you will save? 1 lakh rupees benefits, right? But because of shutting down, extra how much you lose? 72,000 net off. You have a net benefit. If you shut down, you save 1 lakh rupees, but extra you incur is 72 net off. There is only 28,000 rupees of net benefit. So now what will you say? Sir, the decision is please go ahead and shut down. Right? Because the benefit of shutting down exceeds the cost of shutting down. Are you guys clear with this? Now, let me give you a second situation. Sir, if I shut down, benefits, avoidable fixed cost, I can save 1 lakh rupees. This will not change. Cost, shutdown cost is going to be equal to 40,000 rupees. This also will not change. Contribution lost. Suppose, let us say, during the next 3 months, I am predicting a demand of 20,000 units. I'm predicting a demand of how much? 20,000 units. Each unit I will be losing contribution of how much? 4 rupees. So literally the contribution loss is going to be how much? 20,000 into 4, 80,000 rupees. Clear with this, guys? In this case, what is the total amount I'm losing if I shut down? 1,20,000 rupees. But what is the benefit I'm getting because of shutting down? Only 1 lakh rupees. Here, the cost of shutting down exceeds the benefits of shutting down. In this case, what I will do, sir, please do not shut down. It is better to continue. Are you guys clear with this? Right now, guys, why did we change the decision? Why did we change the decision? There is only one factor that played a role. Avoidable fixed cost did not change. Shutdown cost did not change. The entire thing here changed because of the shutdown period demand. Volume. Volume is the biggest hero of this chapter. Now, what happened here? If the shutdown period demand was only 8,000 units, right? Then in that case, I didn't lose much. Overall, I was losing to 72,000, right? But I was getting 1 lakh. Here, now since the shutdown period demand increased, so the contribution lost, opportunity cost increased significantly. Hence, what has happened? The costs exceeded my benefits, and hence what happened in this case? I felt no, please don't shut down, because if you shut down, what happens? You lose 20,000 units, and every unit you generate a contribution of 4 rupees. You have lost 80,000 rupees of contribution. Because of this, the entire decision changed. Are you clear with this? Or in other words, there is one point where my benefit is equal to cost. That point is called as shutdown point. Or in other words, shutdown point is nothing but how much demand of during the shutdown period do you expect, so that your benefit will be equal to cost. That is, the demand level at which my benefits is equal to the cost is called as shutdown point. How will we do this? Simple, equate the two. So at the shutdown point, benefit should be equal to cost. So here I will say 1 lakh should be equal to 40,000 plus 40,000 is this, plus I need to calculate the shutdown point only. I will keep the number of units as x into every unit will generate 4 rupees, or can I say this is nothing but 40,000 plus 4x. Guys, clear with this? So now can I say, I'll put it on to the other side, 4x is equal to, now this goes to the other side, 1 lakh minus 40,000. So 1 lakh minus 40,000, or in other words, x is equal to 1 lakh minus 40,000 divided by 4. Are you guys clear with this? Or in other words, x is equal to 1 lakh minus 40,000 is 60,000 rupees divided by 4. How much is this? 60,000 by 4. It's going to be 15,000 units. Are you guys able to understand? So my shutdown point is equal to 15,000 units. Sir, with this shutdown point, what can we conclude, sir? What can we conclude? Sir, shutdown point is going to be equal to 15,000 units. What can we conclude, sir? Simple. Sir, shutdown point is 15,000 units. Suppose your expected demand, sir, during this next quarter, I am expecting the expected volume is less than your shutdown point. In that case, market is not vibrant. You can just go ahead and shut down. It is better to shut down, right? Suppose your expected demand for this upcoming quarter or the next 3 months or 2 months, as the case may be, is greater than the shutdown point. In that case, what will you do? Definitely you should continue, because the cost of shutting down will exceed the benefits of shutting down. Clear for this, guys? So if your expected demand, right, shutdown period demand is less than the shutdown point, it is better to shut down. If your expected shutdown period demand is less than the shutdown point, better to shut down, because market is not vibrant. Now if your expected shutdown period demand is more than the shutdown point, it is better to continue. And at the shutdown point, whether you shut down or you continue, you will get the same result. Are you guys clear with this? Or in other words, guys, nothing. Shutdown point is nothing but, now in the numerator you had 1 lakh minus 40,000. What is 1 lakh? Avoidable fixed cost. Correct? 1 lakh was avoidable fixed cost. What is this 40,000? This is nothing but shutdown cost divided by 4. What is this 4 rupees? This is nothing but contribution per unit. Are you guys clear with this? Or in other words, my shutdown point is nothing but avoidable fixed cost minus shutdown cost divided by contribution per unit, right? This is all the formula, guys. Or in other words, this is very similar to your indifference points analysis. Difference in fixed cost divided by difference in contribution per unit. But here, look at this. This is nothing but difference in fixed cost divided by difference in contribution per unit. But if I shut down, I don't have a contribution per unit, so there is only one contribution per unit. Directly you can say difference in the two fixed costs. What are the two fixed costs here? Avoidable fixed cost minus shutdown cost divided by your contribution per unit itself. Or in other words, your shutdown point is an extension of indifference point analysis, and directly you can arrive at the shutdown point by using this formula: avoidable fixed cost minus shutdown cost divided by contribution per unit. With this shutdown point, what can you take a decision if during the upcoming 3 months or 2 months, as the case may be, it will be given in the question, for the shutdown period, if the expected demand is less than the shutdown point, market is not vibrant, go ahead and shut down. If the expected demand during the shutdown period is more than the shutdown point, it is better to continue. If your expected demand is exactly equal to the shutdown point, whether you shut down or you continue, you will get the same result. Are you guys clear with this? This analysis is called as shutdown or continue decision using the concept of shutdown point. As simple as that, guys. Beyond this, there is nothing here in this question, in this particular concept. Now if you go and read all these things, you will be able to understand. It is applicable under situation of off season or recession. The company may need to evaluate whether it should shut down temporarily or to continue the operations. Now all these things has been given, and finally the shutdown point can be calculated using this formula: avoidable fixed cost minus shutdown cost divided by contribution per unit. Now shutdown point is also nothing but volume only, demand only. If you want to express this in units, in the denominator use contribution per unit, or if you want to express this in value, use PV ratio. As simple as that. Clear with this, guys? If the expected demand is less than the shutdown point, it is better to shut down. If it is equal to shutdown point, whether you can shut down or continue, it will give you the same result. If the expected demand is greater than the shutdown point, it's better to continue. And in the doubt buster segment, clearly I have mentioned here, what is this? The shutdown point concept is based on indifference point concept, and the formula is derived from indifference point formula: change in fixed cost divided by change in contribution per unit. As simple as that, guys. Beyond this, there is nothing great at all. So now let's quickly go and solve one numerical problem. So please take question number 18. One second. It's okay. We will take question number 18 from our CMA Inter book, right? Paper 8, cost accounting. Please take question number 18. So I have handpicked all these questions. So just so that we cover. Now for CA Inter students, please don't think that, sir, this is not applicable for me and all. Absolutely not. Absolutely not. In fact, in the CA Inter material also, few CMA questions I've kept for a simple reason, right? Separate books only, but still I've kept because in past I've noticed one trend. If a good question comes in CMA Intermediate, now our CA Institute is keeping it here, right? And at times CA Inter questions are being tested in CMA Intermediate. So these kind of shuffling keeps happening. So please do not worry. If I'm doing something, it's absolutely applicable for your syllabus. Clear with this, guys? So now let's go and do this question number 18. Please remember, this question number 18, we are doing it from CMA Intermediate, paper 8, cost accounting. That book, you can please download it. So it's on page number 275, right? So this book, cost accounting, paper 8, cost accounting, question bank. From here we are going to do this question, right? So quickly let's get started. One second, I'm taking out the question for you. Okay, so yes, question number 18. It's on page number 275. Mr. Young has 1,50,000 rupees of investment in business. He wants a 15% profit in his money. From an analysis of recent cost figures, he finds that his variable cost of operating is 60% of the sales. Means what? Variable cost ratio is 60%, which means PV ratio is going to be 40%. And fixed cost is going to be how much? 75,000. Show the supporting computations for each of the solution. Okay, what sales volume is required to break even? What sales volume is required to obtain his 15% return on investment, right? These two are general questions. right? This is on break-even point. This is on calculating the required sales to earn a profit. Now the most important part, shutdown point, comes here in point number C. Mr. Young estimates that even if he closed the doors of his business, he would incur 25,000 rupees as expenses per year. At what sales would he be better off by locking his sales up? Now they are using some technical language and all, nothing great. No, the best part is nowhere in the question they have used the word shutdown point or anything, right? But ideally this question comes from your shutdown point analysis only. Now what they are saying, first of all, understand. Now in this particular question, there is no contribution per unit, so you should use your PV ratio. How much is the PV ratio? The variable cost ratio is 60%, which means my PV ratio is going to be 40%. As simple as that. Perfect. That's all it is. Next. Now, what is the formula for calculating your shutdown point? Shutdown point is going to be avoidable fixed cost minus shutdown cost divided by PV ratio. Correct, guys? Now, carefully read this question. How much is my total fixed cost? 75,000 rupees. Now they have said, even if I closed the doors of his, even if he closed the doors of his business, which means what? Even if he shuts down, he would incur 25,000 rupees per year. Means what? 25,000 rupees is unavoidable fixed cost. Clear with this, guys? So out of the total fixed cost of 75,000, 25,000 rupees is unavoidable, which means the balance 50,000 could be avoided if he shuts down the business, right? So avoidable fixed cost is going to be 50,000 rupees. Are you guys clear with this, right? Now shutdown cost is how much? Don't say shutdown cost is 25,000. Shutdown cost means what? A cost which I will incur only if I shut down. In this case, I am not shutting down my business at all. I mean, in this case, I am not going to incur any specific fixed cost or any specific cost if I shut down. They have not given anything. So in this case, I will take my shutdown cost as 0, right? So by substituting it here, avoidable fixed cost 50,000, right, minus shutdown cost 0 divided by PV ratio 40%. So how much does it come out to? 50,000 by 0.4, you get 1,25,000 rupees as your shutdown point. Are you guys clear with this? Now here they have used a different formula and all, but ultimately the answer matches. But trust me, this is the correct formula. Please write that only in your exam. Now 1,25,000 rupees is the shutdown point. What is the meaning of this? Sir, if in the expected upcoming next few months or in the year, as the case may be, right, for the temporarily in the next period, if your expected demand is less than 1,25,000, please shut down your business. If it is more than 1,25,000, please continue. If it is exactly equal to 1,25,000, whether you shut down or you continue, the result will be the same. Are you guys clear with this? This is the concept of shutdown point, and many students make a mistake in arriving at the correct avoidable fixed cost and the shutdown cost. They generally take a wrong figure. 25,000, they take it as a avoidable fixed cost directly. No, it is unavoidable fixed cost, which means out of the total fixed cost, 25,000 will be continued to incur even if I shut down, which means it is unavoidable, which means only the balancing figure 50,000 is avoidable fixed cost. And shutdown cost would be specifically given in the question. You can't assume anything. If it is not given in the question, take it as 0. As simple as that. Clear with this, guys? That is all about this particular question. Right here we're focusing on the shutdown point analysis, and as simple as that, guys. Very simple. And we have taken one question from CMA intermediate paper 8, right? But don't think it is not applicable. Please do not think. Even CA inter students can definitely follow this question, right? It is 100% applicable for your examinations, because these kind of questions, right, gets tested across different courses, CA, CMA. In fact, I've also noticed in US courses like CMA and all, certain questions, if it gets tested in one attempt, our CA institute or CMA institute are also taking, because globally costing FM, these questions are all, I mean, these subjects are all same, uniform. It is not country dependent. It is globally, it's going to be more or less the same. Hence these kind of question gets tested in all professional courses that are having these subjects in their syllabus. Clear with this, guys? So with this, we have completed this particular question number 18. Please go and update your library of adjustments. Please write down calculation of shutdown point. Please write down calculation of shutdown point. Right? Fine, guys. So that's about this particular concept of shutdown point. So with this, we have completed this concept of shutdown point as well. Now let's move on to the next concept. So now let's move on to the next segment of discussion, which is marginal costing versus absorption costing. Now guys, now this segment of discussion alone goes on to achieve the objective of your profit computation, your stock valuation and profit computation. All other aspects of this chapter will go on to achieve the objective of decision making. Only this segment of discussion goes on to achieve the objective A of our subject, which is stock valuation and profit computation. Now guys, in this segment, right, we are going to see how stock gets valued in marginal costing and absorption costing, and accordingly we will be preparing this income statement under marginal costing and as per absorption costing, and finding out the difference between the profit reported under these two methods. And we will also be seeing the reason why each of these two methods or systems of costing, right, report different profits. Ideally they are not methods, they are called techniques of costing. Now, right, once again guys, this is a common segment in your CA intermediate, your paper 4 cost and management accounting, in your CMA intermediate paper 8 cost accounting, and paper 12 management accounting. It's a common area. Now guys, now basically cost is broadly classified into two: manufacturing cost and non-manufacturing cost. Basically manufacturing cost means cost that is incurred inside the factory, and non-manufacturing cost refers to all the costs incurred outside the factory, basically in your corporate office administration overheads and your sales depot selling overheads, right? Now generally all non-manufacturing costs are considered as period cost, which means they are not considered for the purpose of stock valuation. They are P&L items, they are not trading account items. They are not considered for the purpose of stock valuation, right? However, CMA institute, right, CMA students, generally CMA institute considers administration overheads also as a product cost. However, in this segment of discussion, even in CMA, they have taken it only as period cost. Now administration overheads and selling overheads are always considered as period cost, both under marginal costing as well as under absorption costing, right? Now manufacturing cost, that is cost incurred inside a factory, can be classified into direct material, direct labor, direct expenses, and production overheads. Now this production overheads can be further categorized into two: variable production overheads and fixed production overheads. Now guys, under absorption costing, right, now every unit of stock is valued at full manufacturing cost, or in other words, right, product cost means all the costs incurred inside the factory, that is direct material, direct labor, direct expense, called as prime cost, plus entire production overheads, which means variable as well as fixed component of production overheads. Whereas marginal costing is dead against it. It says, no, every unit of stock can be valued at direct material, direct labor, direct expense, and variable production overheads. However, fixed production overheads should never be treated as a product cost, and it should never be unitized for valuing every unit of output. Who says this? Marginal costing. Clear with this, guys? Because marginal costing is completely against unitizing your fixed cost. Now if you are incurring a fixed cost, even though if it is incurred inside the factory, I should treat it only as a period cost. I should never treat it as a product cost. Clear with this, guys? This is what marginal costing says. Or in other words, direct material, direct labor, direct expense, and variable production overheads, these four components are always treated as a product cost, both under marginal costing as well as under absorption costing. The only issue or the difference between marginal and absorption costing lies with respect to treatment of fixed production overheads. Now, in fixed production overheads, absorption costing consider this as a product cost, whereas marginal costing consider this as a period cost. Marginal costing literally says anything which is fixed should never be unitized, should never be considered as a part of product cost. It should always be period cost. Clear with this, guys? Or in other words, under absorption costing, every unit of stock or every unit produced is valued at full manufacturing cost. Whereas, can we say, marginal costing values every unit produced at variable manufacturing cost. Clear with this, guys? Variable manufacturing cost. Don't say variable cost. Why, sir? Now, administration overhead, selling overheads. Here also, some variable component could be there. But marginal costing says anything incurred outside the factory should never be considered as a part of stock valuation. Clear with this, guys? So, AOH and SOH are always period cost, irrespective of whether it is variable component or fixed component. So, marginal costing is very clear. It says stock should be valued at variable cost, that too incurred inside the factory. So, variable manufacturing cost alone is considered for the purpose of stock valuation. Clear with this, guys? Right? Under marginal costing. So, clearly understand, with respect to non-manufacturing cost, AOH, SOH, always treated as period by both the systems of costing. And with respect to prime cost components and variable production overheads, always considered as a product cost under both the systems of costing. The only issue with respect to treatment of fixed production overheads, now absorption costing consider this as a product cost, whereas marginal costing consider this as a period cost. Simple, guys. Now there is a famous movie dialogue in Tamil. So there is a movie dialogue that says, நண்பன்ல எங்கம்மா நல்ல நண்பன் கெட்ட நண்பன் நண்பனாலே நல்லவன் தான். Right? For those who do not understand Tamil, it's okay, fine, just a movie reference. Now similarly, marginal costing says fixed la engama product period, fixed nale period da. So fixed cost means period cost. Right? Now whether it is incurred inside the factory, outside the factory, marginal costing is completely dead against unitizing your fixed cost. It says simple, if it is fixed, even though if it is incurred inside the factory, I will only consider that as a period cost. Clear with this, guys? Or in other words, in marginal costing, every unit of stock is valued at variable manufacturing cost, whereas absorption costing values every unit at full manufacturing cost. The only difference between the two is with respect to treatment of fixed production overheads. All other areas, marginal costing and absorption costing, are agreeing. The only disagreement is with respect to fixed production overheads. And we all know in absorption costing, what we do is that, right? So we arrive at the predetermined rate and all, budgeted fixed overheads divided by your budgeted base quantity. Using absorption technique, we charge it to the product. At the end of the period, you take the absorbed overheads, compare that with actual overheads, arrive at under or over absorption, give the adjustment. Here in marginal costing, there is no question of absorption itself. Only then will the question of under or over absorption come. So all these things are not even there in marginal costing. Only in absorption costing that issue is that. Clear with this, guys? Now with this background, let us go and do one numerical problem. With the help of this numerical problem, we will clearly understand the difference between your marginal costing and absorption costing. Why will there be a difference in the profit reported? If so, why? And all these things we will clearly understand. This is a masterpiece question, right? It has all the variety combinations, all the different kinds of combinations possible, right? And with this, the entire concept of marginal and absorption costing will be covered here, right? So please go to your CA Intermediate Solved Question Bank, volume number 2, and please go to question number 27. It's on page number 449. This is equally applicable for CMA students. So the kind of questions which I am picking here in the marathon revision is purely which is common for everybody, right? If there is something which is not common, I will clearly indicate. You need not have to worry about that, right, guys? So now on that note, let's get started with question number 27. Now, from the following data, compute the profit under marginal costing and absorption costing and reconcile the difference in profit. Now, the selling price per unit is how much? 8 rupees. The variable cost is 4. Fixed cost is 2. Assume all these are manufacturing costs incurred in the factory. Literally, guys, which means what? The total cost of production, the full cost, full manufacturing cost is how much? 6 rupees. Right? So under absorption costing, every unit of stock will be valued at 6 rupees, whereas under marginal costing, every unit of stock will be valued only at 4 rupees. Perfect. Now, the normal volume of production is 26,000 units per quarter. Every quarter, I plan to produce how many units? 26,000. Normally, this is the production level. The opening and closing stock consists of both finished goods and equivalent units of WIP as follows. Literally what they have said. Q1, Q2, Q3, Q4. 4 quarters they have given. Quarter wise, how much is the opening stock? How much is the production? How much is the sales? How much is the closing stock? Everything is given. Q1, no opening stock. 26,000 units I produced and I sold entire 26,000 units, which means I'm left with no closing stock. Closing stock of Q1 becomes opening stock of Q2, 0. Plus production is how much? 30,000. So I have 30,000 units, out of which I have sold 24,000 units, which means units unsold. Closing stock is 6,000 units. Now this becomes the opening stock for the next quarter. So 6,000 plus 24,000 they have produced in that quarter. Overall, how many units are available for sale? 30,000. Out of this, they have sold only 28,000, which means the balance 2,000 is the closing stock, becomes the opening stock for the next quarter, right? Add 30,000. Overall, 32,000 units are available for sale. They have sold entire 32,000. Hence, closing stock is 0. Clear with this, guys? Quarter wise, they have clearly given opening stock, production, sales, closing stock. All the data is given. Now, what we need to do, quarter wise, we need to compute the profit. First under marginal costing, then under absorption costing. We will see what is the difference between the two. Clear with this, guys? Now, remember, in marginal costing, every unit of stock will be valued at what? 4 rupees. Clear with this, guys? Please have this very, very clearly. Now, one more thing in this question. Now, how much will be the fixed cost? Now, they have not given anything in specific. So, clearly we know normal production volume is how much? 26,000. So 26,000 per quarter. So 26,000 into 2 comes out to rupees 52,000. So quarter wise, 52,000 rupees is going to be my fixed cost in total. Clear with this, guys? Right? I will take this. Now, with this, let us go and prepare the profit statement under marginal costing system quarter wise. Now, first sales figure. How much is the sales figure? Respective number of units multiplied by the selling price 8. So 8 into 26,000 is equal to 2,08,000. So 24,000 is equal to 1,92,000. 28,000 is equal to 2,24,000. 32,000 is equal to 2,56,000. Literally quarter wise sales figure is done. Now from your sales, you should subtract the cost of goods sold, correct? Only then you will arrive at, ideally speaking, only then you will arrive at your correct profitability. So for the units sold, I should subtract, right, whatever is the cost of goods sold. But remember, every unit should only be valued at a variable manufacturing cost. Now first you guys tell me, how will I be valuing my cost of goods sold? Simple. Cost of goods sold is what? Literally this is my FG area. I have my opening stock, plus the current year I have some production. Right, this is the total units available for sale. Out of that, I have sold some units, right? I have sold some units, and the balance is my closing stock. Can I say the cost incurred in respect of units sold is going to be opening stock plus the current year cost of production minus closing stock? Agreeing with me? If I do this, literally, I will be able to arrive at the cost of goods sold. But remember, all these units should be valued at 4 rupees variable cost. Clear with this, guys? So opening stock plus variable cost of production minus closing stock, I will arrive at variable cost of goods sold. Are you guys clear with this? So literally for Q1, opening stock is 0. Right? Now, variable cost, I mean, per unit is how much? 4 rupees. Right? So variable cost of production is at the rate of 4 rupees. Now what we need to do, everything, opening stock should be valued at 4 rupees, closing stock should be valued at 4 rupees. Now come on, tell me, now every quarter how much is the opening stock? The first quarter 0, second quarter 0, third quarter 6,000 units. So 6,000 units each should be valued at 4. So 6 into 4 is 24. Fourth quarter 2,000 into 4, it's going to be 8,000. Clear with this, guys? Similarly, so number of units of production, variable cost of production. So every unit should be valued at 4 rupees. 4 into 26,000 is equal to, you get 1,04,000. 30,000 is equal to, you get 1,20,000. 24,000 is equal to, you get 96,000. And 30,000 is equal to, you get 1,20,000. Clear with this, guys? Similarly, closing stock, first quarter 0. Second quarter 6,000. So 6,000 into 4 is 24,000. 2,000 into 4 is 8,000. And 0 is the closing stock in Q4. That's going to be 0. So literally the variable cost of goods sold is going to be how much, guys? Variable cost of goods sold, right? It's going to be opening stock plus current year cost of, I mean the variable cost of production for that quarter minus closing stock. If you adjust 0 plus 1,04,000 minus 0, it's going to be 1,04,000. Here 0 plus 1,20,000 minus 24, it's going to be 96. So 24,000 plus 96,000, right? You get how much? So 24 plus 96, you get 1,20,000 minus 8,000, you get 1,12,000, right? Similarly, 8,000 plus 1,20,000 minus 0, you get 1,28,000. Literally, quarter wise, now we have arrived at variable cost of goods sold. Clear with this, guys? Are you all able to understand? So now, sales minus variable cost of goods sold, call it as gross contribution. It's not the final contribution. Why? Till now we have only considered the variable manufacturing cost. Now there could also be some variable SOH, AOH and all, right? Only if I subtract all my variable cost from my sales, I will arrive at my net contribution. Till now we have only adjusted for what? The variable cost incurred inside the factory. Hence I call this as gross contribution. So sales minus variable cost of goods sold, 2,08,000 minus 1,04,000 is 1,04,000. 1,92,000 minus 96 is 96,000. 2,24,000 minus 1,12,000 is 1,12,000. And 2,56,000 minus 1,28,000 is 1,28,000. Clear with this, guys? Now from this, further subtract variable selling and distribution cost, right? Variable cost incurred outside the factory, that is variable AOH, variable SOH. In this question nothing is there, hence I am putting this as nil. From this you will arrive at the net contribution. It's nothing but the same figure because there is no variable selling and distribution cost. Clear with this, guys? Now from my contribution, now I should subtract my fixed cost. Fixed cost incurred where? Whether inside the factory or outside the factory. Anywhere you incur, I am not bothered about the location. Fixed means period with respect to marginal costing. So month, quarterly, how much the fixed cost? We saw this 26,000 into 2, it was 52,000. So directly go ahead and subtract 52,000 every quarter. So now what you get is the profit, quarter wise profit reported under marginal costing. Are you guys clear with this? As simple as that. Simple, same statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. The same thing we are doing, but since this has stocks and all, here alone extra thing we are doing, variable cost of goods sold first we are computing. How do we do that? Opening stock plus variable cost of production minus closing stock, you get variable cost of goods sold, right? Sales minus variable cost of goods sold, you get gross contribution. From that further subtract variable cost incurred outside the factory, you get the net contribution. From that you subtract fixed cost, you arrive at the profit. Everything is same, but here the manner of presentation alone differs when you have stocks here. Are you guys clear with this? That's about it, nothing beyond this. Now quarter wise we have arrived at the figures, that is a profit reported under marginal costing: 52,000, 44,000, 60,000 and 76,000. As simple as that. Clear with this, guys? Next, now we need to compute the profits under absorption costing. Now before we do absorption costing, first you should understand one thing. Under absorption costing, every unit of stock is valued at how much? 6 rupees. Now also remember one more thing. In absorption costing, what we use is we use predetermined rate to absorb the fixed production overheads, correct? Now for that we need to know the budget fixed costs, the budget fixed overheads. We need to arrive at it. Clear with this, guys? Now divided by the budget units and all we do. Accordingly we arrive at the predetermined rate. So that is how we need to do it. Now in this question, right, nothing is specifically given with respect to how much is the budget fixed overheads and all. Nothing is given. So we will assume that the budget fixed overheads is 52,000 rupees. How did we get 52,000? 26,000 units per quarter into 2 rupees. You get 52,000 per quarter. Guys, clear with this? And actual overheads incurred was also 52,000 rupees. In the absence of information, generally you can assume, right, your budgeted fixed overheads is equal to actual fixed overheads. Ideally, this is a discussion which is covered in overheads, which we have seen in detail in our regular classes, right? But I just want to set the context right even in this marathon. That's the reason this is a standard assumption you will take. Clear with this, guys? Now with this, first we should compute how much is the under or over absorption. How will you compute under or over absorption? Absorbed overheads should be compared with actual overheads, and based on this you will arrive at under or over absorption. Now The predetermined rate is 2 rupees, right? Absorbed overheads is going to be, right, your predetermined rate into actual production. So quarter wise, you should arrive at the absorbed overheads first. So 2 into 26,000, 2 into 30,000, 2 into 24,000, 2 into 30,000 will be the absorbed overheads for the respective quarters. First, we should compute under or over absorption. So absorbed overheads is going to be actual output into predetermined rate. So actual output we saw here 26,000, 30,000, 24,000, 30,000, right? Multiply that with 2 rupees of predetermined rate. How much you get? Here, if you look at it, it's going to be 52,000 for the first quarter. Second quarter, it's going to be how much? 30,000 into 2, it's going to be 60,000 here. Look at this, it's going to be how much? So it's going to be 60,000. For the third quarter, how much is it going to be? So 24,000 into 2, it's going to be 48,000. 48,000. And for the fourth quarter, how much is that going to be? 30,000 into 2, it's going to be 60,000 rupees. Clear with this, guys? Right? Now, what is the actual fixed overheads for every quarter? In the absence of information, we said budget is equal to actual. Every quarter, it was 52, 52, 52, and 52. Clear with this, guys? Which means how much the under or over absorption we need to calculate. Now, for Q1, actual is 52, absorbed is also 52, which means there is no under or over absorption. In quarter 2, actual was 52, absorbed was how much? 60,000 rupees, which means absorbed is more than actual. There is an over absorption to the extent of 8,000 rupees. Clear with this, guys? For Q3, actual was 52,000, absorbed was only 48,000, under absorption to the extent of 4,000 rupees. And for Q4, 52 is the actual, absorbed was 60,000, over absorbed to the extent of 8,000 rupees. Clear with this, guys? So now literally quarter wise we have computed the under or over absorption, because this is an adjustment we need to do at the end. Now, guys, coming back to the profit statement under absorption costing system. First, sales figure, you can just do it. The respective selling price multiplied by the respective units sold, you will be getting it. Right? From sales, if you subtract the cost of goods sold, right? From the sales, if you subtract cost of goods sold, right, you will arrive at the gross profit. Visualize your trading account, right? From the sales, you should subtract your cost of goods sold. You will arrive at what? Your gross profit. Now, guys, under absorption costing, every unit is valued at how much? 6 rupees, right? So what I will do here, so opening stock is valued at 6 rupees. Current year units produced is also valued at 6 rupees, and even the closing stock is valued at 6 rupees. So the respective units, right, multiplied with 6 rupees, I will arrive at the respective figures. For example, here opening stock value will be 6 into first quarter is 0, second quarter is 0, third quarter is 6,000. So 6,000 into 6 gives you how much? 36,000 rupees is the value of opening stock for Q3. And for Q4, it's going to be 6 into 2,000, it's going to be 12,000 rupees. Clear with this, right? Now, cost of production, here you look at this. So 26,000, so 6 into 26,000 gives you 1,56,000 for Q1. So it's 1,56,000 for Q1. For Q2, how much is that? 30,000 into 6, so how much is that? 1,80,000. For Q3, how much is that? So 24,000. So 24,000 into 6 is 1,44,000. And for Q4, how much is it? It's going to be 30,000. So 30,000 into 6 gives you how much? 1,80,000. Clear with this, guys, right? And closing stock, similarly. So 6 into 0 is 0. 6 into 6,000 is going to be 36,000. Here, look at this, closing stock 36,000. And 6 into 2,000 gives you how much? 12,000 rupees, right? And in Q4, it is nil. So opening stock plus current year cost of production minus closing stock, if you do, you will arrive at the cost of goods sold for the respective quarter, right? Sales minus cost of goods sold, you will arrive at the gross profit. Gross profit is only reported in your trading account. From your gross profit, subtract all the non-manufacturing costs, selling and administrative expenses. Here, variable or fixed, everything, irrespective of the nature of variable or fixed. We don't classify here as variable, fixed. Any cost incurred outside the factory comes in your P&L account. Clear with this, guys? You subtract, in this case, it is nil. But remember, one more very important adjustment you need to do, which is with respect to under or over absorption. Ideally, all these things are a subject matter of discussion in your overheads area. Right? So under or over absorption. Q1, there is no adjustment. Q2, Now, what I would have done, I should have accounted only for 52,000. I have accounted how much? 60,000 already, which means I need to reduce the cost to the extent of 8,000 rupees. Reduction in cost will result in increase in profit. So add 8,000 rupees. So over absorption is added to the profit or reduced from the cost. Since you're computing profit directly, add it. Are you guys clear with this? All these are very technical discussion in your overheads area, right? And I hope, since this being a marathon, I'm not getting into too many details with respect to this area because it's covered in overheads actually. Clear with this, guys? Next one. With respect to quarter 3, you should have accounted for 52. You have accounted only for 48, which means 4,000 rupees is under absorbed, which means now you need to account for, you need to introduce cost to the extent of 4,000 rupees. So adding to the cost will reduce your profit. So 4,000 should be subtracted. Next one, 52,000 actual should have been accounted, but we have already accounted 60,000, which means 8,000 rupees of cost should now be reduced. Reduction in cost will result in addition in your profit. So 8,000 rupees should be added. Clear with this, guys? So from the gross profit, if you make the following adjustments, your net profit ideally that you will get is minus 52,000 in Q1, 56,000 in Q2, 52,000 in Q3, and 72,000 in Q4. Clear with this, guys? So these are all the profits reported under absorption costing, right, for each of the 4 quarters. Clear with this, guys? This is what it is. So now first we have prepared, this is not minus for 52. So this is ideally, this is not minus 52, this is positive only. 52,000 minus 0 is 52,000. 48,000 plus 8 is 56,000. 56 minus 4 is 52, and 64 plus 8 is 72. Clear with this, guys? Now, guys, now what happens? Now you tell me, is the profit reported under marginal costing and absorption costing the same? Here we have different figures. 52, 44, 60, 76. Here we have 52, 56, 52, 72 and all. The profit is different. Now, why is there a difference between the profit reported under marginal costing and absorption costing? Some of you might be thinking, sir, this is on account of under or over absorption. Absolutely not. Now, in marginal costing, right, we subtract the actual overheads. Whereas in absorption costing, we consider absorbed overheads, but at the end of the year, we match the absorbed with actuals. For example, here in Q2, I would have accounted for 60, but I compare it with actual and I say, look, by mistake, I accounted 60. So now I will reduce my cost to the extent of 8,000 and net off, I end up only accounting for actual overheads. Clear with this? So clearly understand, under or over absorption is not the reason for the difference between your marginal costing and the absorption costing profit. Sir, then what is the reason for difference? There is only one reason for difference, which is nothing but your difference in stock valuation. Now, guys, in marginal costing, fixed production overheads is not considered for the purpose of stock valuation. Whereas in absorption costing, the fixed production overheads is also unitized and it is considered for the purpose of stock valuation. Agreeing with me on this, right? Now, what happens? Always every unit of stock is valued more under absorption costing and it is valued less under marginal costing. Do you agree with me on this? Yes, absolutely. Because every unit of stock is valued at 6 rupees under absorption costing, whereas every unit of stock is valued only at 4 rupees under marginal costing. Or in other words, absorption costing always values every unit of stock at 2 rupees more as compared to marginal costing. Right? Now, what happens? In Q1, now, what happens? Opening stock is how much? 0. Closing stock is how much? 0. Now, understand one thing, guys. Opening stock is on the debit side. Closing stock is on the credit side. Now, in this case, there is no opening and closing stock at all, right? Hence, what happens? Net stock is not there. Because of this, there is no more stock valuation or under stock valuation. Hence, in the first scenario, the profit reported under marginal costing, 52,000, is exactly equal to the profit reported under absorption costing, 52,000. Sir, can you elaborate more? Don't worry. The second quarter we will take. The second quarter, what happens? Opening stock is 0. Closing stock is how much? 6,000. Closing stock is on the credit side, right? Now, credit side, 6,000 units are there. Every unit is valued at 2 rupees more, where under absorption costing. So 6,000 into 2, how much is it? 12,000 rupees. So 12,000 rupees is more on the credit side only under absorption costing. Hence clearly absorption costing will be reporting a more profit to the extent of 12,000 as compared to marginal costing. If you want, you can go and check it. Marginal costing profit is how much? 44,000. How about absorption costing? 56,000. 56,000 minus 44,000. How much is this? 12,000 rupees. Why, sir? Because there is a net closing stock and the closing stock is on the credit side and always stock is valued more under absorption costing. So 6,000 into 2, 12,000 rupees is the difference. This is what I would have mentioned here, right? There is a net closing stock of how much? 6,000. So 6,000 into 2, 12,000 rupees is the difference in profit. Clear with this, guys? Let's go to the third scenario. Now, under third scenario, what happens? Opening stock is 6,000, closing stock is 2,000. You have both opening and closing. Now, you guys tell me, opening stock is how much? 6,000 units. Closing stock is how much? 2,000 units. If you net off the two, there is a net opening stock. Correct? The opening stock is more than the closing stock. Net opening stock is how much? 4,000 units. This is on the debit side. And always remember, stock is valued more only under absorption costing. So 4,000 into 2, how much is it? 8,000 rupees is more on the debit side, where under absorption costing, right? Now, when the debit side is more, obviously the profit will reduce. Hence, in this case, your absorption costing will be reporting a lesser profit than your marginal costing, exactly to the extent of 8,000 rupees. If you want, you can check. Marginal costing is 60,000. Whereas absorption costing is only 52,000. The difference between the two is 8,000 rupees. That is nothing but your fixed production overheads sitting inside your net stock. 6,000 minus 2,000. Net opening stock is there. Always stock is valued more under absorption costing. If the stock is on the debit side, the debit will be more, so profit will be less. If the stock is on the credit side, so credit is more, hence profit will be more. Are you guys clear with this? Right? So don't say more stock valuation means always absorption costing will be reporting more profit. No, it depends on where the profit is lying. If there is a net opening stock, right, the debit is more under absorption costing, hence your profit will reduce. If there's a net closing stock, so your credit will be more, again under absorption costing only, but this time since the credit is more, the profit will be higher. Are you guys clear with this? And look at Q4. What happens? Opening stock is how much? 2,000. Closing stock is how much? 0. So there is a net opening stock only. Once again under absorption costing. So always absorption costing value stock more. So 2,000 into 2, how much is it? 4,000 rupees is actually valued more on the debit side. So more debit means a lesser profit. Exactly what happens right now. Absorption costing will be reporting a lesser profit to the extent of 4,000 rupees. If you want, you check. 76,000 is the marginal costing profit. 72,000 is the absorption costing profit. The difference is what? 4,000 rupees, 2,000 into 2, net opening stock into, yeah, right, your fixed cost in sitting inside your net stocks. Clear with this, guys? Or in other words, we can come to a conclusion. When there is no stocks, or when opening stock is equal to closing stock, that is net stock is 0, right? The profit reported under absorption costing is equal to profit reported under marginal costing. Scenario number 1. When opening stock is more than the closing stock, or in other words, there is a net opening stock, right? So the debit side is more under absorption costing, hence the profit of absorption costing is less as compared to your profit under marginal costing. Clear with this? Which scenario is this? Scenario quarter 3 and quarter 4. There is a net opening stock. Clear with this, guys? So always in this case, see, marginal costing was reporting more profit, 60, 76. Here it was only 52 and 72. Clear with this, guys? Right? So when my opening is greater than closing stock, right, that is the net opening stock is there, absorption costing will report a lesser profit. When there is a net closing stock, or in other words, closing stock is greater than opening stock, in this case what happens? So obviously now the credit side is more, hence absorption costing will start reporting more profit as compared to marginal costing. This is quarter number 2. What happened here? So quarter number 2, I had a net closing stock. So here 6,000 into 12,000 rupees was more under absorption costing. 44 in marginal, but what happened? 56 in absorption. Are you guys clear with this? So a simple one-line summary here. A simple one-line summary here. You can say 4 scenarios when there is no opening stock or closing stock, or when opening stock is equal to closing stock, or when opening stock is greater than closing stock, or when opening stock is less than closing stock, or in other words, closing stock is more than opening stock. Clear with this, guys? When there is no opening or closing stock, right, marginal costing profit will be equal to absorption costing. Let us keep absorption costing as the base. Absorption costing profit will be equal to marginal costing profit. When opening is equal to closing, once again there is no net stocks here, absorption costing profit will be equal to marginal costing profit. Next, when opening stock is greater than closing stock, what happens in this case, guys? What happens in this case? So debit side is more under absorption cost. Always absorption costing will only have a more stock. If the net stock is on the debit side, profit will be less. If the net stock is on the credit side, profit will be more under absorption costing. Clear with this, guys? Here, net stock is more on the debit side. Hence, absorption costing will be reporting a lesser profit than marginal costing. Or you can say marginal costing reports more profit than absorption costing. Right? When the opening stock is less than closing stock, or in other words, there is a net closing stock is more, in that case, what happens? Absorption costing will report more profit than marginal costing. Are you clear with this, guys? And always remember, the difference in the profits reported under these two systems are exclusively on account of what? The fixed production overheads sitting inside your net stock. Are you guys clear with this? And that is the only reconciling item between the profits reported under marginal costing and absorption costing. And this question is a masterpiece question that covers all the situations that we saw here. Right? The net opening stock is equal to closing stock, or opening stock is greater than closing stock, or opening stock is less than closing stock. All the scenarios in a single question, it gets covered. That was the reason why I wanted to cover this sum in the marathon itself. Clear with this, guys? Right? And that's about the concept of marginal versus absorption costing. So I hope this completely recapitulated the entire concept. Right? I think ideally, in a marathon itself, we are literally covering all the entire concepts here, right? Even for first timers, it could be useful, right? So please go and update your library of adjustments. Write down marginal costing versus absorption costing hyphen preparation of income statement under marginal costing and absorption costing for 4 quarters and reconciling the profits. So marginal costing versus absorption costing hyphen preparation of income statement under marginal costing and absorption costing for 4 quarters and reconciling the profits. Clear with this, guys? Right? So with this, we have completed all the concepts in marginal costing area. Right? We have completed all the concepts in marginal costing area. The last segment of discussion is exclusively there for students doing paper 8 of CMA intermediate. That will be covered exclusively for them. Right? With respect to others, with respect to your CA intermediate, right, this is all about it, as well as even for CMA Inter paper 12, this is all about it. That's an accept or reject of special order, which is exclusively for CMA Inter paper 8 students. Right? Fine. So now let's move on to the next and the last segment of discussion, which is accept or reject a special order. Right? Ideally, though it is specifically a concept covered, it's not a specific concept as such, it is a variant of a question. Though it is, I've mentioned that it is exclusively applicable for students doing CMA Intermediate Paper 8. Now, I feel this is also a question which you can expect at your CA Intermediate level, right? So definitely this is something even CA Inter students can also expect in their exams, because it is not a separate concept, it is more of an application driven area. So I would rather still suggest students doing the CA Intermediate to follow this with one particular numerical question from your CMA Intermediate Paper 8, right, cost accounting. From that I will take up one question. With the help of that, I will be doing this particular area. Once again, guys, let me tell you very, very clearly, this is not something that is a specific concept as such, but this is one area which even CA Inter students can expect in their exam. On that note, let's get started with one numerical problem from your CMA Intermediate paper 8, right? Cost accounting solved question bank. So please take question number 12 of your paper 8 solved question bank. It's on page number 269. Now, look at this. The operating statement of a company is as follows. Now, what have they mentioned? Sales 80,000 units at the rate of 15. The sales value is given. Variable cost, material, labor, overheads. The total variable cost is given, right? Which means how much is the variable cost per unit? 7,20,000 divided by 80,000. 7,20,000 divided by 80,000. How much is that? The variable cost per unit is rupees 9. Correct? Overall variable cost per unit is how much? 7,20,000 total variable cost divided by the total units, right? Next one. How much is the fixed cost? It's given in the question as 3,20,000. The total cost is variable plus fixed. The profit is sales minus total cost they have given. Right, guys? So literally as of now, what you can make out is that how much is the sales? The selling price is going to be 15. Variable cost is going to be 9. So currently the contribution per unit is going to be how much? 6 rupees, right? That's what it is. The profit of 1,60,000, how did they arrive? 6 into 80,000. So 80,000 into 6. 4,80,000 is a contribution. From that, subtract 3,20,000 of your fixed cost. You will arrive at 1,60,000. Marginal costing income statement you can prepare. Next. The capacity of the plant is 1 lakh units. Overall, I have a capacity of 1 lakh, out of which currently I'm selling how many units? 80,000 units, which means 20,000 units I have an idle capacity. Sorry, 20,000 units I have an idle capacity. Next one. A customer from USA is desirous of buying 20,000 units at a net price of 10 rupees per unit. Now, a foreign customer, special order, he says, look, I am willing to buy 20,000 units from you, but max, the selling price which I will pay you is only 10 rupees. Advise the producer whether or not the offer should be accepted. We need to decide whether this offer should be accepted or not. And will your advice be different if the customer is a local one? This is actually a theory question. What it is, I will tell you. Now, you guys tell me, advise whether or not the offer should be accepted. Very simple. Logically, you think, I have a capacity to produce 1 lakh units. Currently, I'm producing 80,000 units, which means the extent of 20,000 units, I have an idle capacity. One guy is coming to me, US client, he's customer, he's saying, I'm willing to pay 10 rupees for every unit. Now, you guys tell me, to produce every unit, what is the variable cost you incur? 9 rupees, correct? Now, on this extra 20,000 units, each unit, right, you are going to earn how much? He says, he will pay you 10 rupees, right? And variable cost is how much? 9. So literally for every additional unit that you are selling, this 20,000 units, you'll be able to generate 1 rupee of contribution, right? So 1 into 20,000 units. So literally extra you'll be getting 20,000 rupees of contribution that will overall build your profit. Are you guys clear with this, right? That's all it is, no, right? So clearly, can you accept the offer? Yes. Why? Because as long as for this extra units, I am able to recover my variable cost. The selling price is more than the variable cost. So on each of these extra 20,000 units, I'm getting a positive contribution. So whatever I get extra is going to build my profit, guys. Because for this extra 20,000 units, no specific fixed cost is incurred. Already this fixed cost, 3,20,000 units, right, is being recovered by the existing 80,000 units, and I'm already reporting a profit of 1,60,000. Right, the extra 20,000 units I'm going to sell. Each unit selling price is 10, variable cost is 9, contribution is 1. So 1 into 20,000 units is going to give me 20,000 rupees of extra profit. Guys, clear with this, guys, right? So literally speaking, extra profit that you're going to get, the profit will be increased by 20,000 by accepting the order. Hence, it is advised to accept the same. Clear with this, guys? Now, what they have done, simple. They have prepared the entire marginal costing under 80,000 units. Now, for this extra 20,000 units, what will be the sales? So 20,000 into 10, 2 lakh, minus all the variable costs. So 20,000 into 9, if you get, overall variable cost is how much? 1,80,000. So 2 lakh minus 1,80,000 gives you a contribution of how much for this incremental, for this extra 20,000 units? 20,000. No specific fixed cost is incurred for this. So literally your profit will be increased by 20,000. So what they have done, 80,000 units, they have prepared an income statement, marginal costing income statement. For this extra 20,000 units, they have prepared the marginal costing income statement, 80,000 plus 20,000. Overall for 1 lakh units, they have prepared the marginal costing income statement. But in my opinion, directly you can say no, right? So on this extra 20,000 units, I'll be able to generate a contribution, incremental contribution of 20,000 rupees, right? Clearly you can accept the order because your overall profit will increase by another 20,000. So from 1,60,000, add another 20, the new profit becomes 1,80,000. This way also you can answer and you will say, yes, as a profit increases by 20,000 rupees, you can please go ahead and accept the order. Clear with this, guys? Now, will your answer change if the customer is a local one? Yes. Now, this is not from a costing perspective. This is from a non-cost perspective. Now, generally, I sell it locally. 80,000 units, I'm selling. Local sales price is how much? 15. For one customer alone, if I sell it at 10 rupees per unit, obviously the remaining people in the market, they will not be, silent. They will come and ask. For one guy alone, you are giving discount. Why can't you give discount to me also, right? It will create tension and rift in the local market. Since this guy is an outsider, right, an export order or an international customer, whatever sale price I fix for him, right, generally is not known to the local market. Suppose in the local market, if I'm making this distinction, right, it will create a problem in my business. So ideally, if you are, if this customer is a local customer, no, do not encourage that. It's basically a theoretical one. If the order is from local one, it should not be accepted because it will adversely affect the present market. This is what they are saying. It is from a theoretical perspective. Are you guys clear with this? That's all this question is all about. Clear with this, guys? Now, you tell me, is there any specific concept here? No, this is just one variant of testing a particular question in marginal costing. That's why I said even CA intermediate students can just, have a look at this kind of question. You can watch out for these kind of questions in your exam, right, guys? So with this, you can just go and update your library of adjustment. Write down accept or reject a special order. Please write down accept or reject a special order. Fine, guys, right? So with this, we have also completed the last part, though I mentioned it is only for CMA intermediate paper 8 students, but still, in my opinion, other TA inter students can also definitely watch out for this area because it is a common sense driven area. Clear with this, guys? So with this, we have literally covered this entire chapter of marginal costing. In fact, though it was marathon, we actually solved about 5 or 6 exact questions we solved, right? In the marathon itself, we solved the 2 comprehensive questions touching about every single concept covered in this particular chapter, right? It's more than a marathon ideally, in my opinion, because every single thing we have derived it based on concepts and other things. But during our regular lectures and all, right, during our regular or the exam oriented batch, we cover a lot of numerical problems, some 30-40 numerical problems depending on, right, the respective courses, CA, CMA and all, whatever is that we do in detail. Since this being a marathon, here also I didn't condense on the concepts. Every concept was actually revised. Every single concept we did, along with a few numerical problems, which in my opinion were very important for revision. With this, we have comprehensively covered this particular chapter called as marginal costing, right? On that note, let's move on to the next chapter. So now let's get started with the revision of yet another important chapter called standard costing, right? So now, before we get started, so first of all, guys, I want to tell you something very important. This chapter is once again a common chapter both in your CA intermediate and in your CMA intermediate, right? In CA Inter, paper 4, cost and management accounting, and in your CMA intermediate, this chapter is there in paper 8, cost accounting, as well as in paper 12, management accounting, right? Now, what is there in each of the respective courses? Clearly, I will be talking about that in a few minutes from now. But before that, first I want to make one thing once again very, very clear. This marathon is a common marathon. For this particular chapter, the marathon is common for both CA and CMA intermediate students. However, all our courses, right? Be it regular or your exam oriented batch and all that are exclusively recorded separately for CA intermediate, and even in CMA intermediate, paper 8 recordings are separate, paper 12 recordings are separate, and all the books that we use, right, be it your concept decoder as well as your solved question bank, are completely different, right? The recordings are all separately done, right? However, for the purpose of marathon, since the concepts covered are the same, right, so I'm going to revise it in a common lecture. Clear with this, guys? On that note, let's get started with this beautiful chapter called as standard costing. Now guys, this particular chapter, standard costing, goes on to achieve the objective of control. Now, we all know that our subject, cost and management accounting, right, it has three objectives: stock valuation, profit computation, decision making, and the third objective is control. And each of the chapters in our subject goes on to achieve, right, either one or maybe two or maybe all the three objectives. In this chapter, right, it goes on to achieve the objective of control, right? Sir, how, sir? How does it help achieve the objective of control, right? What is this chapter standard costing about and all that, right? Quickly, we will just brush it up here. Now guys, now what happens? Every company, before the start of the year or before the start of the period, they prepare a budget. And once the budget gets prepared, the employees of the organization are clearly assigned their respective duties and they are made to perform the task, right? And at the end of the period, the targets, right, are compared with the actuals, and they analyze the differences between what they were supposed to do and what they have actually done. And once they analyze the difference, obviously certain differences could be favorable for the company, right? Or maybe in certain places the employees would be efficient, in certain areas they might be inefficient. So accordingly, they will reward the employees or punish them. Reward in case they are efficient, or punish in case they are not efficient. Punishment could be a salary cut, or maybe a cut in the bonus, or as the case may be, dismissal, or maybe even a suspension, or as the case may be. So clearly guys, control involves 4 steps in this particular chapter. Number 1, the company establish standards or targets. Number 2, these targets are evaluated, right? They are compared with the actual performance, and they analyze the variance. Variance means the difference between your target and actual. And finally, they are rewarded, or the company takes corrective actions in case they are not able to meet the targets. This is how control is being established by standard costing. How and all these things, in a few minutes from now, we will start with this chapter in detail, and that's when you will be able to have a crystal clear clarity. Now guys, always remember, at the beginning of every period, the company prepares a budget. They will say budgeted sales is so much. These are all the budgeted cost I'm planning to incur. So sales minus cost, they will arrive at the budgeted profit. Now, at the end of the period, now all the actual performance is done, and actual sales minus all your actual costs gives you your actual profit, right? Now, the budgeted profit and the actual profit will not be the same most of the cases, right? Now, there will be a difference between my budgeted profit and my actual profit, right? This difference is called as profit variance, the variance between my budgeted profit and my actual profit, right? Now guys, now, sir, this variance, is it good or bad? It depends. For example, if my budgeted profit, I wanted to earn a profit of 80 crores, whereas my actual profit was 100 crores, I will say there is a 20 crore rupees of variance. Yes, but is this variance good or bad? Sir, you wanted to earn a profit of 80, but you've actually earned a profit of 100. So this is a very good variance for me. So I will call this as 20 crore favorable variance. So I will say the variance is 20. Within bracket, I will put this F. This F stands for a favorable variance. Suppose I plan to have a profit of 80 crores. The budgeted profit was 80, but the actual profit was only 60. In this case, once again, there is a variance of 20, but this variance of 20 is actually not a good variance. I want to earn more, but I've actually earned only less. So we call this as adverse variance. Clear with this, guys? So in exam, if you just mention the variance alone, it is not, it is not relevant. This variance should be suffixed right after this number. You should always write whether it is a favorable variance F or an adverse variance A. Now, please don't think some students mug up, sir. If it is positive, it's a favorable variance. If it's negative, it's an adverse variance. Absolutely not. Simple. The variance which has the impact of increasing your profit is always a favorable variance. A variance which has an impact of reducing your profit is an adverse variance. Here, profit we're talking about 80 crores I planned, I have actually earned 100, right? So obviously here it is a favorable variance. Here I plan to earn 80, but I've actually earned only 60. It has an impact of reducing my profit, hence I call it as an adverse variance. Clear with this, guys? Now, sir, profit variance, I say, for example, 20 crores adverse. Now, if I go to my managing director and tell him, sir, the profit variance is 20 crore. Now, the next question he'll ask me is, who is responsible for that? Why did I have a 20 crore rupees of adverse variance? Now, the variance in profit can broadly happen because of two reasons. One is variance happening on the sales side. And number two, the variance is happening on the cost side. Once again, the variances happening on the cost side can be further bifurcated into material related variance, labor cost related variances, variable overhead related variances, and fixed overhead variances. Clear with this, guys? So the variance in profit is nothing but sales minus cost. So, sir, the variance in profit can happen because of variances happening on the sales side and variances happening on the cost side. So sales related variances and cost related variance. Further, sir, cost, what are the costs I have? Material, labor, variable overhead, and fixed overhead variances. So literally what we do in this entire chapter, we find out the reason for the variance in my profit, that is budgeted profit and actual profit. We split it out and find out how much is my sales related variance and how much is my cost variance. Cost variance is further bifurcated into material, labor, variable overhead, and fixed overhead variances. Clear with this, guys? So this is the overall objective and big picture of this chapter. And once we find out all these variances, we now know the actual reason why actually the profit has been varied, why there is a difference in between my budgeted profit and actual profit. With this, even a reconciliation statement can be prepared. Are you guys clear with this? Overall, this is the big picture of this chapter. Now, guys, sir, what is applicable for my exam? For CA intermediate students, you have all the cost variances, material variances, labor variances, variable overhead variances, fixed overhead variance. CA intermediate, in your syllabus, you have only these 4 variances. That's about it. With respect to CMA intermediate students, 2 papers are there. Paper 8 cost accounting, paper 12 management accounting. Paper 8 cost accounting, you have only material variances and labor variances. That's all you have, right? And with respect to paper 12 students, right, management accounting, literally, guys, this entire chapter is applicable for you, right? You have all the 4 cost side variances, plus you also have your sales side variances. Literally, this chapter is very, very extensive for CMA intermediate paper 12 students, group 2 students of CMA intermediate. Clear with this, guys? So this is how your syllabus has been bifurcated. But trust me, guys, every single thing, concept are all one and the same, right? And once again, I'm telling you, this marathon is a common marathon for everybody, CA and CMA inter students. However, right, our course recordings are completely different. All our paid batches, be it your regular or exam oriented, are exclusively recorded for CA inter, CMA intermediate paper 8 and CMA intermediate paper 12. Even in CMA intermediate, between the 2 papers, we don't have a common recording, exclusively done. The books are all separate. Clear with this, guys, right? Since it's a common topic that is done here, for the purpose of marathon alone, I'm doing it in a common manner. Right, guys? So on that note, let's get started with this particular chapter. Right, guys? Fine. Now, Now, before we enter into this particular chapter, once again, let's quickly recapitulate what is the meaning of standard cost, right? So I will recapitulate the meaning of standard cost with a small example, right? Understanding the concept of standard cost. This is very important to set the context. Now, guys, now let us say I plan to incur a cost of 1 lakh rupees, right? Budgeted cost was 1 lakh. But actually, I ended up spending, let us say, rupees 96,000. Now, you guys tell me how much is the variance, and if so, that variance, is it favorable or adverse? Sir, you could have incurred 1 lakh. You have actually incurred only 96,000. Sir, 4,000 rupees you have incurred less, sir. So it is 4,000 favorable variance for us, right? This is what you might think. Now, let me add one more data here. Let us say this 1 lakh rupees you are allowed to incur for a budgeted output of 10,000 units, right? So I thought you are allowed to incur 1 lakh rupees if you are producing 10,000 units. You have actually incurred 96,000 rupees for producing 8,000 units. Now you guys tell me. First question. Now, can this 1 lakh be directly compared with 96,000? The answer is absolutely not. Why? Because this 1 lakh is pertaining to a completely different output and 96,000 is completely pertaining to a different output, right? Actually, I have incurred a cost of 96,000 for producing 8,000 units, right? Now, this 96,000 cannot be compared with a cost pertaining to a completely different output level, right? Now, sir, how will we be then able to compute the variance, sir? Now, what I will do, based on the budget, I can understand, sir, you are allowed to incur 1 lakh rupees to produce how many units? 10,000 units, which means per unit, how much is the cost you are allowed to incur? 1 lakh divided by 10,000, it's going to be rupees 10 per unit. Clear with this, guys, right? Now, actually, how many units you have produced? Sir, you have actually produced 8,000. So, for the 8,000 units which you have actually produced, right, what is the cost you should have incurred? So, for each of these 8,000 units, you were supposed to incur 10 rupees. So, overall, you should have incurred 80,000. Right? However, you have actually incurred how much? 96,000 rupees. Now this 80,000 can be compared with the 96,000. Why? This 80,000 is the cost which you are supposed to incur for the actual output, whereas this 96,000 is the cost you have actually incurred for the actual output. Here, the two outputs are the same. So, for the actual output, what is the cost you should have incurred should only be compared with the cost which you have actually incurred for the actual output. Clear with this, guys? So, here, this 80,000 is what we call as standard cost. Clear with this? Are you all able to understand this? Yes. So now basically, guys, standard cost, always remember, means the cost which you are allowed to incur for the actual output. So for the actual output, what is the cost you are allowed to incur is called as standard cost. Or in other words, now if you notice here, this 8,000 units is nothing but actual output, right? And this 10 rupees is nothing but standard cost per unit, right? Where did I get this 10 rupees? Using the budget data. So this budget was pertaining, 1 lakh was pertaining to a total of 10,000 units, but using the budget data, I could unitize and understand per unit what is the cost I am allowed to incur. Ideally, this is nothing but budgeted cost per unit, but when we unitize, we don't call it as budgeted cost per unit. When we are unitizing, we call it as standard cost per unit. So standard cost per unit was how much? 10 rupees. So now for the actual output, what is the cost you are allowed to incur? 10 rupees. So now here I will say that, look, you were supposed to incur 80,000, but what has happened? You have actually incurred 96,000. In this case, there is a variance of how much? 16,000 rupees. That too adverse. You have incurred 16,000 rupees more. So don't compare 1 lakh directly with 96,000 and say 4,000 you have saved. No, for the actual output, you are only allowed to incur 80, but you actually end up incurring 96,000. This is a fundamental understanding before we enter into the standard costing area, because this is a very, very important chapter, as well as you need to have all this background concepts before we get into this particular area. Clear with this, guys? Perfect. Now understand one more thing. The concept of standard means what? For the actual output, what is the cost allowed, right? Or in other words, we can say budgeted cost. This 1 lakh rupees is nothing but the cost planned, whereas actual 96,000 we can say is the cost incurred, and the standard 80,000 is the cost allowed. Are you clear with this? There has to be a clear-cut distinction between understanding the concept of budget, standard, and actual. Clear with this, guys? And always standard only gets compared with actual, and that is the reason why the name of the chapter is standard costing, not budgeted costing. Clear with this, guys? Perfect. Now, I want you all to understand one more thing. The concept of standard is not only applicable on cost, right? For example, you can even apply the concept of standard on your labor hours. For example, now you were allowed to, let us say, take a total of 1 lakh labor hours to produce 10,000 units, which means per unit you are allowed to take 10 labor hours, right? But actually I have taken 96,000 hours to produce 8,000 units, right? Which means what is the standard labor hours? Means what is the labor hours you are allowed to take? Actually 8,000 units. Into every unit you are allowed to take 10 hours. Overall you could have taken 80,000 hours, but actually I have taken how many hours? 96,000 hours, which means 16,000 hours I have actually taken more. So, or in other words, the concept of standard can be applied on cost. The concept of standard can be applied on labor hours. The concept of standard can be applied on kgs of raw material consumed, on anything. Clear with this, guys? Basically, what do you mean by standard? For the actual output, how much of cost is allowed, or how much of labor hours is allowed, or how much of kgs you are allowed to consume, and so on. Clear with this, guys? So basically understand one thing, the concept of standard always keeps the actual output as the base to do all the computations. Clear with this, guys? So with this backdrop, let's get started with the first cost variance, called as material cost variances. Clear with this, guys? So first we will get started with material cost variances. Right now, this material cost variance, right, is applicable for, of course, CA intermediate students as well as CMA intermediate paper 8 as well as paper 12 students. So I told you in CA intermediate all the 4 cost variances, material, labor, variable overhead, fixed overhead variances are there. CMA intermediate, only in paper 8 we have only the first 2 variances, material and labor variances, and in paper 12 all the 4 cost variances plus the sales variance, entire chapter is there. Clear with this, guys? Have this in your mind, and with that we will get started. Now, guys, material cost variance, right? So is the formula for calculating material cost variance is standard quantity into standard price minus actual quantity into actual price. It is bifurcated into 2: material price variance, material usage variance. Material price variance, the formula is standard price minus actual price into actual quantity. Material usage variance is standard quantity minus actual quantity into standard price. Now, this usage variance can be further classified into 2: material mix variance and material yield variance. Material mix variance, the formula is revised actual quantity minus actual quantity into standard price, and material yield variance, the formula is standard quantity minus revised actual quantity into standard price, or actual yield minus standard yield into standard cost per unit, or standard loss minus actual loss into standard cost per unit. Sir, so many formulas are there, sir. How do we actually remember? Trust me, guys, you need not even mug up a single formula. Quickly, I will recapitulate every single thing that we are going to do here. Not even a single thing needs to be mugged up. Now, let me take an example. Let us say, guys, my actual output, I actually produced 100 units, right? Now, to produce 100 units, let us say, for example, let me tell you, to produce 1 unit, you are allowed to consume 1 kg of raw material, which means to produce 100 units, how many kgs of raw material you are allowed to consume? Sir, 100 into 1, so 100 kgs of raw material I am allowed to consume. Yes, every kg of raw material you should have purchased at a price of 10 rupees per kg. So I call this as standard price. Means what? The price at which I should purchase every kg of raw material. But however, if you see, actually I was able to achieve this output of 100 units by consuming only 90 kgs of raw material. So the actual quantity consumed was how much? 90 kgs only. Clear with this, guys? And every kg that I actually consumed, right, I purchased it by paying an actual price of how much? 12 rupees per kg. Clear with this, guys? So basically you only need 4 data here: standard quantity, right, standard price, that is the kg of raw material you are allowed to, you are supposed to consume, and every kg you are supposed to pay 10 rupees. Actual quantity, you consume 90 kgs, and every kg you have actually incurred a cost of 12 rupees. So now material cost variance is what? Standard material cost, the material cost you are allowed to incur minus the actual material cost, the material cost you have actually incurred. What is the formula? Material cost you are supposed to incur is what? Standard quantity into standard price. You are supposed to incur, or you are supposed to consume 100 kgs, each kg at a cost of 10 rupees. So 100 into 10, that is nothing but standard quantity into standard price. Literally 100 into 10, the total material cost should have been how much? 1000 rupees. Whereas actual material cost was how much, sir? Actual quantity, I actually consumed 90 kg, each kg I paid 12 rupees. So actual quantity into actual price, that's what is being mentioned here. So 90 into 12, so how much does that come out to? 1080 is the actual material cost which we have incurred. Or in other words, guys, you were supposed to incur a material cost of 1000 rupees, but you have actually ended up incurring a material cost of 1080 rupees. So 80 rupees you have incurred more than what you are supposed to incur, right? So I call the material cost variance as 80 rupees adverse. Clear with this, guys? Of course, because if my actual cost is more than the standard cost, so it will actually reduce my profit. Correct? No, right? It has an impact of reducing my profit. I call it as an adverse variance. Are you guys clear with this? Now, this is why I said don't mug up. Some people, what they do, sir, 1000 minus 1080, which means it is negative, sir. Negative figure, which means I need to definitely go, and negative means adverse. Please don't mug it up like this, right? So here, logically think, actual cost is more than standard cost, which means it has an impact of reducing my profit. Hence, I call that as an adverse variance. Now, I go and tell my managing director, sir, material cost variance is 80 rupees adverse. Now he will ask me, who is responsible for this? Now, guys, if you notice, material cost comprises of 2 components. One is the quantity, the other one is the price, the rate, or the price at which I purchase every kg. Guys, correct? That is the reason why material cost variance is split into 2. One is called as material price variance, the other one is called as material usage variance. Now, material price variance, right? Who is responsible for the pricing of this particular raw material, right? Now, actually, in a factory, the purchase manager is only responsible for the price, right? Now, every kg, right, he was supposed to purchase by paying 10 rupees to the supplier. He had to negotiate and make sure that he purchases every kg at 10 rupees only. It is his responsibility. However, due to his inefficiency, what he has done, he has ended up negotiating a deal by paying 12 rupees for every kg of raw material purchase. Clear with this, guys? So this particular purchase manager is responsible for the price, right? So here what I do, he is responsible for what? Price. Hence within the bracket I say standard price minus actual price, right? You are supposed to incur only 10, but you have incurred how much? 12 rupees. Clear with this, guys? Into, I multiply this with actual quantity. Sir, why is actual quantity? If you notice, purchase manager is responsible only for the price decision. quantity he will not decide. Whatever quantity the production manager asks the purchase manager to purchase, all those quantity he needs to purchase. And on every quantity that he has purchased, right, he is only responsible for the price. Clear with this, guys? Now, my production manager asked me to purchase how much? 90 kgs, because he's consuming only 90 kgs. On each of these 90 kgs, this purchase manager is responsible for the pricing decision. Are you clear with this? Hence, the material price variance will be what? Your standard price minus actual price into actual quantity. That is, the purchase manager is dependent on the production manager for the quantity decision. Hence, I multiply this with actual quantity. So, 90 kgs, sir, I purchased. On each of these 90 kgs, I ended up paying 2 rupees more. So, 90 into 2, 180 rupees is the extra cost I have incurred. Hence, it is an adverse variance. As simple as that. Nothing needs to be mugged up. Clear with this, guys? Next one. On the other side, what do we have? Material usage variance. Usage means consumption. Who is responsible for the usage? Production manager is responsible for the usage. Now, this production manager, he's responsible for what? He's responsible for the quantity, right? So within bracket, standard quantity minus actual quantity will come. You should have consumed 100 kgs. But you consumed only how much? 90 kgs. So 100 minus 90. So you have consumed 10 kgs less. Now I cannot leave it in kgs. I need to give it a monetary value into standard price. Sir, why, sir, here alone standard price? You are not taking the actual price. Remember, the purchase manager, this guy, was dependent on the production manager for the quantity decision. Whereas this production manager is not dependent on the purchase manager for anything. There is a one-way traffic only. Purchase manager is dependent on production manager. Our guy, production manager, he is not dependent on purchase manager for anything, right? Suppose if I take actual price here, then the efficiency or inefficiency of the purchase manager will be passed on to my production manager, right? So I don't want to do that. I want to clearly identify which manager is responsible to the extent of how much to the variance. Clear with this, guys? Hence, I don't take actual price. I only take standard price here because our guy, production manager, is not dependent on whom? The purchase manager. Clear with this, guys? So he's responsible for what? Quantity. So within bracket, standard quantity minus actual quantity into standard price, because our guy is not production manager is not dependent on the purchase manager for anything. Clear with this, guys? So 100 minus 90 into 10. So 10 kgs you have consumed less into 10. It's going to be 100 favorable. Good for the company. Now if you notice, ideally speaking, because of the purchase manager, I have lost 180 rupees. And because of the production manager, I have actually gained 100 rupees. Net of the net extra loss for me is only 80 rupees. So if I just report this 80 rupees, there is absolutely no meaning by itself. Are you guys clear with this? So now what we actually do is that we bifurcate this into price and usage variant and clearly identify who is responsible to what extent and how much do they contribute to the overall variance of the company. Are you guys clear with this? So here, this purchase manager has been super inefficient, right? So I will clearly take a corrective action here. I will never give him a bonus, or I will ask him for a pay cut. Whereas the production manager has been super efficient. Here, what will I do here? So to him, I will say, very good, you have done a very good job. Maybe I will incentivize him by giving a bonus and all these things. This way, overall, it helps in achieving the control. Clear with this, guys? Are you all able to understand? And that's about it. And that's about this area. So now, your material cost variance. What is the formula? Standard quantity. Look at this. Standard quantity into standard price minus actual quantity into actual price, bifurcated into two: material price variance and material usage variance. Material price variance, halt. Whose responsibility? Purchase manager. So standard price minus actual price into what? Actual quantity. Why? Because I'm responsible for the pricing on every quantity that I purchase. Quantity is not in my control, so the quantity is something which the production manager asks me to purchase. Are you guys clear with this? Right? Now, how about the other guy? Material usage variance. Whose responsibility? Production manager. So standard quantity minus actual quantity into standard price. Why not actuals? Because if I take the actual, I will be passing on the efficiency or inefficiency of the purchase manager to the production manager, while ideally the production manager is not dependent on him for anything. Are you guys clear with this? Logically, if you just remember all these things, there is no way you will find this chapter difficult. It's that simple. Clear with this, guys? Now, suppose a company uses more than one type of raw material. If a company uses more than one type of raw material to produce an output, then your usage variance is further classified into two: material mix variance and material yield variance. Clear with this, guys? So if a particular company is actually using more than one type of raw material, right, to produce every unit of output, then the usage variance is bifurcated into mix and yield variance. Right, now the formula for material mix variance is revised actual quantity minus actual quantity into standard price, and the formula for yield variance is ideally the balancing figure: standard quantity minus revised actual quantity into standard price, or there are two other formulas prescribed here. Now what is this, sir? Do not worry, this too alone, with the help of a numerical problem of actual example, an actual exam question I will take, and based on that we will be cracking this also. Clear with this, guys? Right, that is actually a strategy to crack all these areas. The best part is, once you finish material cost variance, automatically labor cost variances, even variable overhead cost variances are very similar, and it will also be done together. As simple as that. Clear with this, guys? That's why I'm spending a little more time here, so that we complete it smoothly. And in fact, guys, we are going to do some numerical problems as well, so I'm going to give an exhaustive coverage in the marathon itself, so that you guys get a very good comfort in this particular chapter. Right, guys? So now I'm going to pick one question from your CA intermediate, from your CA intermediate solved question bank. Now, guys, as I told you, there are separate question banks, separate materials we have for CA intermediate, CMA intermediate paper 8 we have a separate book, CMA intermediate paper 12 also we have a separate book. But this particular question, I'm going to take it from CA intermediate, right? CA intermediate solved question bank. It's in volume number 2. Right, so I'm going to take this from volume number 2. I'm handpicking a few sums, and that alone I'm covering in the marathon, because in marathon, it is meant for revision purposes. Right, when we are learning from the scratch, obviously every single sum we do in all our courses and all, in a marathon we are revising it. Still, for the benefit of all students, I'm setting the background concepts, and I'm handpicking a few sums and doing it in the marathon also. Right, I'm doing it only for the benefit of students, but don't worry, in all our courses we do the entire chapter fully. Clear with this, guys? So now let's get started here. So please take question number 2. Right, it's on page number 464. This is CA Inter solved question bank. This question is very much applicable for CMA intermediate, both paper 8 and paper 12 also. Right, so this is a revision we are doing, so that is the reason why I'm doing it in a common manner. Fine, guys. So now let's get started here. Now, the standard cost of a chemical mixture is as follows. So, one second, I will just take this question separately. Okay, one second. Yeah. Okay, guys. Fine. The standard cost of a chemical mixture is as follows. 40% of the material should come from A at the rate of 20 rupees per kg. 60% of material B, that is 60% of the total input, should come from material B, and every unit of B, every kg of B should be purchased by paying 30 rupees. This is the standard price. The standard loss is 10% of the total input. It is expected in production. Now, the cost records for a period showed the following usage, which means what? Actual data is given. 90 kgs of material A was consumed by paying 18 rupees per kg, and 110 kgs of material B was actually consumed by actually paying 34 rupees per kg. The quantity produced was 182 of kgs of good product, which means the actual output was how much? 182 kgs. right? Now this is what they have given. Now based on this we need to compute all the material variances. Now guys, this company is using more than one type of raw material to produce their output. In this case what happens, you have material cost variance bifurcated into material price and material usage. Further, material usage variance is bifurcated into material mix and material yield variance, right? Before that, first guys, we need four figures. What are the four figures? Standard quantity, standard price, actual quantity, actual price. We need it, right? Now how can we go about with this? First thing you need to know, sir, actual quantity, actual price and all are available, sir. Actual quantity, material A 90, material B is 110 kg, actual price 18 for A, 34 for B. All these things I have, sir. Even standard data, standard price I have, A 20 rupees, B 30 rupees. Standard quantity is where many students generally struggle. Simple guys, simple. Let me just take this up here and put it forward for you. So it's question number 2, your CA intermediate question bank. Now how do we go about with this? First, what have they given? Raw material A, raw material B, total input. If you look at it, raw material A, basically guys, what they are saying, say if your total input was 100 kgs, 40% should come from material A. Please have the book with you. You can download the book from our website. Please have the book with you, right? So 40 kgs will come from A. And how about B? 60%, 60 kgs will come from B. Clear guys? Now they are saying out of this total input, a standard loss of 10% is expected. So a standard loss of 10% on the total input means what? 10% on 100 is 10 kgs of loss is expected, which means effectively you will get an output of how much? 90 kgs. Clear with this guys? So, or in other words, can I say, if I input 40 kgs of A and 60 kgs of B, effectively only then I will be getting 90 kgs of total output. Guys, correct? This is the meaning. Now, based on this, can we compute the standard quantity data? Yes. Now, standard quantity means what? For the actual output, how many kgs of A and how many kgs of B I should have inputted. This is the meaning. Now, if you look at it, what is the actual quantity produced? 182. Now, keep that as the base, 182 kgs. Now, reverse work, simple. If I input 40 kgs, I need 40 kgs of A to get an effective output of how much? 90 kgs. So, to get an effective output of 182 kgs, how many kgs of A will I be needing? Simple, no? You can just reverse work and calculate. Guys, clear with this? So, 40 is for 90. How much is it for 182? So 40 by 90 into 182. If you do this, you effectively get 80.888888. Right? So I'm putting it here. It's going to be the calculation. 40 is for 90. So 40 is for 90. How much is it for 182? Clear with this, guys? So literally we will say the standard quantity of A that I should be inputting is 80.888888 kgs, right? Don't round off the decimals. Please retain it fully in your calculator. Next one. Similar calculation for B. If I input, I need 60 kgs of B for an effective output of 90 kgs. For an effective output of 182 kgs, how many kgs of B I should have inputted? Simple, similar calculation. So you can just say, sir, it's going to be 60 is for 90. How much is it going to be for 182? So 60 by 90 into 182. How much you get? You get 121.333333. Right? It's going to be 121.333333. Clear with this, guys? You can add it up, or you can also say simple. Overall input will be how much? I need to input 100 kgs to effectively get 90 kgs. For an effective output of 182, what should have been my total input? 100 by 90 into 182. You can say that you will get 202.22222, or in other words, you can add these two, you will get that. As simple as that. Clear with this, guys? It's going to be what? 202.22222 kgs is the total number of is the total number of the input, the total quantity of input that I will be needing. Guys, are you all able to understand this? So now literally what has happened here, I should have inputted 202.2222 kgs, right, to effectively get an output of how much? 182 kgs, which means the balancing figure, the difference between these two is going to be what? My standard loss. Are you guys able to understand? So how much is going to be my standard loss? The difference between the two. So 202.222, or in other words, you can also say 10 is the standard loss allowed for 90 kgs. How much is it going to be for 182? So 10 by 90 into 182, you will get 20.222, or in other words, 202.22 is the input allowed to get an effective output of 182. So the standard loss allowed is going to be how much? So it's going to be 20.2222 kgs. Are you guys clear with this? Right? So literally, this is how your standard quantity column will look like. Guys, are you all able to understand? Now, this is exactly what I have already done here itself. This calculation. This is how I have done this standard quantity. 80.888888 kgs is the kgs of A that you should have inputted. Kgs of B you should have inputted is 121.33333. You can see all the calculations. The back working is all given here. Just now we have done it. Clear with this, guys, right? The total input that was supposed to be done less loss, standard loss, you arrive at the effective output. Ideally speaking, this has to be 20.22222. Clear with this, guys, right? Now what is the standard price? Now we know it's given in the question. Every kg of A should be purchased at 20 and B at 30. So you can put it up here, 20 and 30. And how about the actual quantity? So actual quantity, 90 kgs of A. This is the actual, right? 110 kgs of B. Overall, what was the actual input? I have actually inputted how much? 200 kgs. Effectively, I got an output of how much? 182. By inputting 200, I actually got how much? 182 kgs, which means the actual loss was how much? 18 kgs. This is nothing but the actual loss. Clear with this, guys? What was the actual price here? The price was for A, 18 rupees per kg. B was purchased by paying 34 rupees per kg. Clear with this, guys? All these things are available. So now what you need to do, standard quantity into standard price, you'll get the amount column. So 80.888888 into 20. So 80.888888 retain full decimals into 20. Effectively you get 1167.7777. Then 121.333333 into 30. If you do, you get what? 3639.999. that can be rounded off to 3640. If you add the two, you get how much? 9257 5257.777, right? Ideally speaking, this is the total cost of material which you were supposed to incur to get an effective output of 182. Ideally speaking, the standard quantity into standard price, the total raw material cost allowed to be incurred is going to be 5257.777. But what is the actual cost? 90 into 18. How much is that? 1620. 110 into 34. How much is that? It's going to be 3740. If you add up the two, you get 5360. So the actual cost incurred was 5360 for the actual output of 182. So literally first the material cost variance, standard quantity into standard price minus actual quantity into actual price. Clearly you can say this is the cost you are supposed to incur, whereas this is the cost you have actually incurred. Or you can do product wise, standard quantity into standard price minus actual quantity into actual price. You can do it. That's what we have totaled it up and we have arrived at here. So it's 5257.7777 minus 5360. You actually get 102.2222 adverse, right? So 102.2222 adverse is actually going to be my total material cost variance. Are you guys clear with this? So this is the cost I should have incurred, 5257.7, but I have actually incurred more, right? So 5360, hence clearly there is an adverse variance. Are you guys clear with this? The most important thing with respect to standard quantity, and the beautiful area is that standard quantity starts from the actual output. Reverse working you need to do. Sir, for the actual output of 182 kgs, what is the cost? I mean, how many kgs of A, how many kgs of B I was supposed to consume? This working you need to do. Only if you do this, you will arrive at the proper standard quantity. Every other data is available. We just need 4 ingredients: standard quantity, standard price, actual quantity, actual price. Right? Actual quantity, actual price was available. Even standard price was available. Only standard quantity was required. And if you do it this organically, that's all is required. That's the reason why I started off even this revision marathon with the concept of understanding your standard cost and all. This is the reason behind that. Clear with this, guys? So the first thing that we have done is what? The first thing we have done is arrived at the material cost variance. Next one, what should we do? Material price variance. Now, what is the formula for material price variance? Simple. Material price variance is going to be, first, who is the responsible person? Your purchase manager. So we will say standard price minus actual price into actual quantity. Correct? This is going to be my material price variance. Right? Now what we need to do, raw material wise, we need to compute. Simple. Clear with this, guys? The logic and everything we have seen here. Right? So now we just need to do this raw material. I mean your every single raw material wise. So first, for material A, how much is the standard price? 20. How much is the actual price? 18 into how much is the actual quantity? 1620. So 20 minus 18, right, into actual, I'm sorry, actual quantity was 90. So 1620 is actual quantity to actual price. Sorry. So 20 minus 18 into 90 kgs. So each of the 90 kgs I have purchased by paying 2 rupees less. So obviously it's a favorable variance. So 180 favorable. This is for raw material A. How about raw material B? Standard price minus actual price into actual quantity. You were supposed to incur 30. You have ended up incurring 34. 4 rupees you have incurred more on each of 110 kgs. So it's going to be 440 adverse. So net off, if you see 440 adverse minus 180 favorable, there is a net adverse of how much? 260 adverse. Are you guys clear with this? Right? And that's about this particular variance also. Guys, are you all able to understand? That's about it. Now comes your material usage variance. Material usage variance. So what is the formula for material usage variance? You guys tell me. So the material usage variance is going to be, right, standard quantity minus actual quantity into standard price. Right? So this is the quantity, right? The quantity you should have consumed minus the quantity you have actually consumed into standard price. This is what we have seen, logic and everything we have seen now. Now guys, now material usage variance. What you need to do, once again, so component wise you just need to compute, right? Once again they have mentioned all this. This is not required. Fine. What you need to do, so product wise you need to compute 80.888 for first raw material A. Standard quantity is 80.88888, but actual quantity was how much? 90. Correct? So which means you are supposed to consume only 80.88888. You have actually consumed how much? 90. Right? Into standard price 20. So what you need to do, 80.88888 minus 90. Literally you have consumed 9.11111 kgs more. Right? So 80.88888 minus 90 into, so how much is this? 20. So how much you get? 182.22222 adverse. Are you guys clear with this? Here what they have done, 80 into 182 by 80. So all those things are not required. Directly we have computed. So 80.8888. That's all you need to write here. So you just need to write 80.88888 minus 90 into 20. If you do the calculation, you get 182.222 adverse. Right? Similarly, for material B, 121.33333 minus 110. You should have consumed 121.333, but you have actually consumed only 110. Guys, are you all able to understand? Right? So the difference is how much? 121.33333 minus 110. You get how much? So 11.33333 into standard price. How much is standard price? 30. How much you get? So 339.999, or in other words, it's going to be 340 favorable. You were supposed to consume 121.33. You've consumed only 110. Your consumption is less, which means it's savings in cost. So it's a favorable variance to the extent of 340. Are you guys clear with this? So here it's going to be 121.333. I'm putting it down. 121.3333 minus 110. That is what has been mentioned here. Minus 110. I think there's a mistake. Right? Minus 110. Right? Into standard price, which is 30. If you calculate exactly, it is going to be how much? 340. So what's going to be your total usage variance, guys? Your usage variance is 182.222 adverse for A, 340 favorable for B. So now what happens? Net of 340 minus 182.22222, you get how much? 157.77777. You get it as favorable. Clear with this? Clear with this? Right? So this is what you get it as. This is what you get as your material usage variance. Now quickly, I'll go here and sum it up. Quickly, I will just go here and sum it up. Till now, what have we got? So material cost variance. How much was the amount we got? We got 102.2222 adverse. Now this is bifurcated into two. What and what? Material price variance, material usage variance. Now how much is my price variance? We calculated it was 260 adverse, and the usage variance we calculated just now, it was 157.77. it was roughly 7777. It was going to be favorable, right? Or you can put it as 777 or 78. So if you net off these two figures, if you add these two figures, you should get your topmost figure. Let us check that. So 260, it is adverse, and favorable is 157.78 roughly. So minus 157.78. If you do net off, you get how much? 102.22222 adverse. Clear with this, guys? So it is an arithmetical check which you can do. If you add your price variance plus your usage variance, you should get your top figure called as material cost variance. So this is one check that you can do. Clear with this, guys? Perfect. Now I told you this usage variance can be further categorized into two more. What and what? Material mix variance and material yield variance. Clear with this, guys? Right? Now, sir, how do we compute it? You gave some formulas and all. So now, sir, how do we go about with this? Now, I will walk you through here. First, material usage variance. You guys tell me, what is the formula? First, who is responsible for this? Obviously, your production manager, right? So now the formula for this is going to be standard quantity minus actual quantity into standard price. Correct? Now, I told you guys, this is bifurcated into two. What and what? Material mix variance, material yield variance. Material mix variance, the formula is going to be revised actual quantity minus actual quantity into standard price. Right? Now, what is the yield variance? Now, yield variance is ideally the balancing figure. Now, if you notice, now I have on the outside, within the bracket I have something. On the outside I have standard price, correct? So clearly here also I have standard price. Outside here also I will have standard price. Now look at this. On the top I need to get standard quantity minus actual quantity. Whereas on the left side I have RAQ, something new was introduced, revised actual quantity minus actual quantity. But if you notice, if I add my mix and my yield variance, I should get my top figure. Right? Now I should get standard quantity minus actual quantity. But as of now I have what? RAQ minus AQ. So minus actual quantity I have. But here I have introduced a guy called as revised actual quantity. So now what should I do? I should ideally get standard quantity, right? But now I have revised actual quantity. So literally what I will do, here I will introduce standard quantity and I will subtract revised actual quantity. Sir, why do you do this? Simple. Only then, if I add the two, what happens? Revised actual quantity is here. Now this will get knocked off with minus revised actual quantity, right? And if I add the two, I will get standard quantity which I want minus actual quantity, right? The whole into standard price. Clear with this, guys? Or in other words, this is nothing but balancing figure, right? I will also tell you the logic, don't worry. Or if at all you forget, you can remember only this. The other one is a balancing figure. So I have R revised actual quantity minus actual quantity, but I want a standard quantity minus actual quantity. So minus actual quantity is already there. So what I need, sir, I need to replace RAQ with SQ. So SQ minus RAQ. Only if I do that, RAQ gets knocked off and I get standard quantity, and minus actual quantity is already there into standard price. Clear with this, guys? But before that, first, sir, why do we do this? I will tell you how to compute revised actual quantity. First, I will tell you, and then you will be able to understand. First, material mix variance. Let us do this. Now, so your raw material revised actual quantity, standard price, and your material mix variance. Now, guys, first fill this column actual quantity. Now, let me go back to the question. Now, what is my actual quantity? Here we have 90 kgs of A and 110 kgs of B. Correct? So I'll put it up here. It's going to be 90 kgs. So first A and B I will write down. A, B, then I'll write down the total. Now, actual quantity is how much? 90 kgs of A and 110 kgs of B. So the total was how much? 200 kgs was the actual quantity consumed. Correct, guys? Right? I'm talking about the input. Right? Now, what you do? Revise the actual quantity. Take the total and put it here. How much was the total actual quantity? 200. Perfect. Now, revise the actual quantity means what? Fine. You have actually consumed a total of 200 kgs. Fine, be it so. But this 200 kgs of total actual input should have been consumed in the standard mix, the proportion. What is the proportion in which you should have consumed? Sir, 40% should have been A, 60% should have been B, right? So now what I will do, I will take the total actual input, right? And I will revise that actual quantity for the standard mix. 40% should come from A and 60% should come from B. That's what the question says. 40 for A and 60 for B, right? So 40 A and 60 B. So now put it here. So 200 into 0.4, 40 for A. How much is it coming out to? 80 kg should have been A and 60% for B. So 200 into 0.6 is going to be how much? 120. Literally, guys, this should have been 40%. This is 60%. Are you clear with this? So I introduced a column called revised actual quantity. Means what? I take the actual quantity and I revise it only for the mix. Sir, it should have been, for some reason you have consumed actual quantity of 200. I am not comparing standard with actual. I am comparing here what I am doing. Sir, actual quantity itself I am taking and I am revising it for the standard mix. Clear with this, guys? So here literally I am comparing actual quantity at standard mix with actual quantity at actual mix. Mix means proportion. Clear with this, guys? So the actual quantity, this itself should have been in what mix? 40:60, right? But so that's why I revised my actual quantity. Clear with this, guys? And that I am comparing with the actual quantity, right? Clear with this, guys? So now, how much is the standard price? I mean, for this question, standard price we already know. The standard price is here 20 and 30 respectively. Let's put it up here. It's going to be 20 and 30 respectively. So now, what is my material mix variance? You could have consumed 80. You've consumed how much? 90. Clear with this, guys? So now, how much you consumed? 10 kgs more into 20. So 10 into 20, how much you get? You get 200. Is it adverse or favorable? Obviously adverse. You've consumed more than what you're supposed to. And how about here? 120 is the revised actual quantity minus 110. You are allowed to incur you are allowed to consume 120. We've only consumed 110. So 10 kgs less into 30. How much does that come out to? It's going to be 300 favorable. So the net of these two comes out how much? 300 favorable, 200 adverse. Net off is going to be 100 favorable. Clear with this, guys? Now, sir, what do we calculate in this material mix variance? What does this indicate? Simple. Understand, guys. Here, if you notice, we are not comparing standard quantity with actual quantity. We are only comparing actual quantity with actual quantity. Then what are we comparing, sir? Actual quantity at the standard proportion, standard mix is being compared with the actual quantity as at actual mix. Now, for some reason, you have actually consumed 200 kgs. Let me keep it there. But this 200, at least, you should have retained the mix, correct? Now, what has happened? What has happened? This 200 kgs, at least, it should have been in the ratio of 80 kgs of A and 120 kgs of B. Whereas what you did, 90 kgs of A you consumed and 110 kgs of B you had consumed. Clear with this? Now, between A and B, which is a costlier raw material? Obviously, raw material B, 30 rupees per kg, sir. Whereas raw material A is only 20 rupees per kg. Now, what these people have done, literally for A, cheaper raw material, instead of 80 kgs, they have consumed 90 kgs, or in other words, they have consumed 10 kgs more of a cheaper raw material. So how could they consume 10 kgs more? Because in raw material B, costly raw material, they consumed 10 kgs less, or in other words, they changed the actual mix. The actual proportion was 90s to 110. How, sir? They consumed less of a cheaper raw material and more of a costlier. They consumed less of a costlier raw material. A costlier raw material was consumed less, and this kgs, 10 kgs, they actually consumed more of a cheaper raw material. Now, if you sacrifice a costlier raw material and instead that you use it in actually a cheaper raw material, what happens? Obviously, you will save some cost. Clear with this, guys? Or in other words, this 100 rupees of favorable variance has clearly been achieved not because of efficiency, because I deviated from the mix. This is nothing but adulteration. Sir, here I should have used what? I should have used 80 kgs of A and 120 kgs of B. But what I did, that's how 200 should have come. But this 200, how I achieved? Right? 10 kgs less I consumed B. 110 kgs only I consumed. What I did, this 10 kgs I added here in A, right? Instead of 80, I consumed 90. So I consumed more of a cheaper raw material, less of a costlier raw material. Because of this, I achieved this 100 rupees of favorable variance. Ideally speaking, this 100 rupees of favorable variance is not because of the efficiency of the production manager to the extent of material mix variance. Here, this favorable 100 rupees of variance is purely attributable to your adulteration, the mix. Clear with this, guys? So what we are doing here, the usage variance overall is being further classified into mix variance and yield variance. In the mix variance, we are calculating not standard and actual, we are comparing look, because of deviating from the mix, how much is it contributing to your total variance is what is being found out in this particular material mix variance. Are you guys clear with this? Now, on the other hand, you have material yield variance. Here, what do we compare? The balancing figure. Standard quantity minus revised actual quantity into standard price. Now, clearly understand here. Here, we are comparing the standard quantity with the revised actual quantity. Clear with this, guys? Clear with this? Sir, why, sir? Now, if you notice here, standard quantity and revised actual quantity is being consumed. Here we compare the standard quantity. Obviously, the standard quantity will be in 40s to 60 in the standard mix. We compare that with revised actual quantity. We are comparing the actual quantity at standard mix. So literally here we are not capturing any variance happening on account of mix, because this is also in 40-60 ratio. This is also in 40-60 ratio, revised actual quantity. So here the deviation in the mix is being separately captured here. So we don't consider any mix variance here. Here we only look at the overall quantity difference. Standard quantity is being compared with revised actual quantity. So because of the overall consumption, the quantity difference alone, how much is going to be your variance is what is being captured under material yield variance. Clear with this, guys? Or in other words, literally you have standard quantity, you have actual quantity. In between, I introduced a guy called revised actual quantity. Now, this variance, usage variance, talks about standard quantity compared with the actual quantity. Now, what I did, First, mix variance, I compared what? Revised actual with revised actual quantity with actual quantity. And now in the yield variance, I'm comparing standard quantity with revised actual quantity. This way, I have broken down the material usage variance into material mix variance and material yield variance, where mix variance captures the deviation happening, the variance happening on account of change in the mix composition, whereas the yield variance captures the variance happening on account of deviation in the overall quantity consumed, while this will not capture any difference in the mix because that has already been captured under mix variance. Are you guys clear with this? This is how you need to learn this area. Nothing needs to be mugged up. So now just fill in the blanks, and that's about this area. So now what do you need to do? Standard quantity minus revised actual quantity into standard price. This is what you need to do. Simple. So raw material A. What is the standard quantity? Now standard quantity here, raw material A, raw material B. Let's put it up here. What's the standard quantity? Maybe you can just take it from here. Standard quantity is 80.888888 and 121.33333. So 80.8888 and it's 121.3333 minus revised actual quantity 80 and 120. So it's going to be 80 and 120 into what is the standard price? 20 and 30 respectively, right? So how much is this? 80.888888 minus 80, right? So you were allowed 80.88, you have only consumed 80, so 0.8888 less into 20. How much you get? 17.7777 favorable. 17.7777 favorable. Similarly here, 121.3333 is what you were allowed to spend, consume, but you have consumed only 120, so 1.333 kgs less into 30. You get how much? 39.9999, or it's going to be 40, once again favorable, right? So it's going to be total 57.77777 favorable. Clear with this, guys? Or here, if you notice, my mix variance is 100 favorable and my yield variance is 57.77777 favorable. Are you guys clear with this? Right? So here, material mix variance, I'm updating. It is going to be how much? 100 favorable, and material yield variance is 57.777 or 78 favorable. Clear with this, guys? Once again, here you can check material mix variance plus material yield variance. So 100 plus 57.78 gives you 157.78, your material usage variance. Or in other words, what is the understanding, sir? Sir, production manager, how much is the variance he is responsible for? Usage variance 157.78. Very good, sir. Were you efficient? No. To the extent of 57.78 shows his efficiency, because that is the difference between standard quantity and revised actual quantity. Standard is compared with actual. Whereas to the extent of 100, it was not because of his efficiency, because he used more of a cheaper raw material and less of a costlier raw material. Because of the change in the composition, 100 rupees was the actually variance that is attributable to this. So clearly now you can understand and judge. Now the managing director will not be happy for this 100 favorable variance. It is impacting on the quality of the product. Clear with this, guys? Right? So literally, genuinely, he should be rewarded only for this yield variance, for which genuinely it is because of his efficiency level. Mix variance is because of adulteration with this guy has done. Clear with this, guys? So this is the beauty of marginal costing. It will break down every single, your standard costing, it will break down every single variance and clearly tell who is responsible for what variance to what extent, and the reason. If you know for every single variance, nothing more you need. Clear with this, guys? And that's about this particular question. Now, guys, I told you for your material yield variance, you also have two other alternative formulas. Quickly, let me just walk you through that also. Now, another formula for material yield variance is actual yield minus standard yield into standard cost per unit. Now, let me just write it down here. Material yield variance. Yield means output. What was the formula we saw here? Actual yield minus standard yield into standard cost per unit, right? All these three are new terminologies. What it is, I will tell you, right? You can easily understand. Now, Now, first, standard cost per unit. Per unit means it is not per kg of input, it is per kg of output. Clear with this, guys? What is it? I will tell you. Now, literally we saw standard, we computed, right? Overall, you should have incurred a cost of how much? 5257.777. You should have incurred this cost for an effective output of how much? 182 kgs, which means what is the standard cost per unit of output? In this case, the output is also in kg. So per kg of output, what is the cost you are allowed to incur? So 5257.77777 divided by 182. How much you get? 28.888888, right? So clearly I will say here the standard cost per unit of output or per kg of output is going to be rupees 28.888888. Clear with this, guys? Right? So suppose if they ask, you can actually do it in this way also. Now in your CMA intermediate, right, you have this formulas, these alternate formulas. In your CA intermediate, these formulas are not there as such, but at times I have also seen institute suggested answers where they have used these formulas. In RTP I've seen a couple of times where they have used this formula also. So it is not like it's not there for you. Definitely these are concepts of standard costing globally are there, right? So they are one and the same. So there's nothing like specific for CA inter or CMA inter here. Clear with this, guys? Now the standard cost per kg of output is how much? 28.888888. Clear with this? This is the cost per kg of output you are allowed to incur. Now yield means output, right? Actual yield minus standard yield. What is the actual yield? Actual yield is actual output. How much is the actual output the company has achieved? 182 kgs. Correct? So put it up here. 182 is the actual yield. Now standard yield here means, please understand, here it's nothing but standard output for actual input. Sir, what is the meaning of this? I will tell you, and logically also we will understand this. Now actually I have inputted a total of how many kgs of input? 200 kgs of input. Correct? Now they have mentioned in the question a standard loss of 10% is allowed. Correct? Now a standard loss apply on the actual input 200 kgs, right? Now you were allowed, let us say, for 200 kgs, assuming after allowing for a 10% of standard loss, so minus 10%, how much is that? 20 kgs. You would have got an yield of how much? 180 kgs of output. Output you would have got how much? 180. I'm repeating, the standard yield, the output, standard output for the actual input will be how much? 200 minus 10% loss 20 gives you how much? 180. This is called standard yield for the actual input. Clear with this, guys? How much is it? 180. Clear with this, guys? 180. Now what they are saying, for the actual input, they kept input as the base here. You have actually achieved how many kgs of output? 182. But you should have ideally got only 180 kgs of output. Clear with this, guys? So literally you have got how many kgs of output more? 2 kgs of output. Clear with this, guys? This is kg of output. Correct? Hence I am multiplying this with standard cost per unit. Now 2 into 28.888888. How much you get, guys? How much you get? This is nothing but here you get 57.77777. Is it favorable or adverse? Obviously favorable. You have actually got an yield of 182 units or kgs, but you should have got, for the actual input that you had inputted, you should have got only 180. So 2 kgs you've got more, and every kg is valued at a cost of 28.8888. Literally you have got yield variance is how much? 57.777 variable favorable. Clear with this, guys? This is exactly what we got using that formula also. This formula also you got 57.777, right? That is exactly what we've got here as well. Clear with this, guys? This is another way of computing. Or there is one more formula. What is that formula? Standard loss minus actual loss into standard cost per unit. I'm putting it here. Standard loss minus actual loss into standard cost per unit. Now standard cost per unit, you guys know it's 28.888888. right? Now, standard loss minus actual loss. What it is, clearly understand here, the wordings are a little different. Actual loss, actually I've lost how much? Sir, I inputted 200 and I got 182, which means actual loss was how much? 18. But for the actual input, what is the loss I could have earned? I mean, what is the loss that was allowed for the actual input? 10% was allowed. 10% on 200 is how much? 20. So you could have lost 20, but you have lost only 18. Clear with this, guys, right? So standard loss here represents standard loss for actual input. Clear with this, guys? So standard loss for actual input, for this two formulas alone, the actual input is kept as the base. Are you guys clear with this, right? So the standard loss for actual input, how much is it? 200 you have actually inputted. For that you could have lost how much? 20 kgs, but you have lost only how much? 18 kgs. Since you lost 2 kgs less, ideally this is the reason why you got 2 kgs more as an yield, guys, correct? Or in other words, the difference in your output is nothing but the difference in your loss, guys. Clear or not? That is the reason why you got an yield variance. So how much is it? The same 20 you could have lost, but you've lost only 18. So 2 kgs you've lost less. So 2 into 28.888888. Literally, what do you get here? You get 57.77777 favorable. The same answer you will get under all the 3 methods. Correct. This is for yield variance. First formula is standard quantity minus revised actual quantity to standard price. You use this formula generally. Suppose they have asked in a particular question, calculate the yield variance alone, right? And they have not given all this data. They have given actual yield, standard cost. Based on this, they have given all the data. Only then you will use either of these 2 formulas. Are you guys clear with this? This could be a trick hack in your exam. In case they ask this, you can cover this also. Are you all able to understand this? And that's about this question. A comprehensive question covering one question that covers the entire concept of material cost variance with all possible adjustments, right? And this was once tested as a past exam question as well, right? Definitely it will carry a huge weightage in your exam. Fine, guys. So please go and update your library of adjustments. Write down material cost variance hyphen mix of raw material with losses. Mix of raw material with losses. A very good question, a signature and a masterpiece question, a must visit the day before your exam. That is the kind of importance I would attach to a question like this. So please mark this as a very, very important question. Fine, guys. Perfect. So now let's move on to the second segment of discussion, which is labor cost variances. Right? Fine. Now, guys, labor cost variances is exactly same as your material cost variance. Only one difference is here. Now, instead of quantity, here you have hours, right? There it was standard quantity, actual quantity. Here we have standard hours, actual hours. There we had price. For material, we call it as price. Standard price, actual price. Here we use standard rate, actual rate. So instead of price, here we have rate. Instead of quantity, here we have hours. That's all is the difference here. Look at this. Labor cost variance. What is the formula? The labor cost which you should have incurred, standard hours into standard rate, minus the actual labor cost you've incurred, actual hours into actual rate. Now, it's bifurcated into 2. What and what? Labor rate variance and labor efficiency variance. Now, who is responsible for rate variance? The HR manager of the company. Now, he is responsible for negotiating the wages with the workers. Now, so what is his responsibility? Rate. So standard rate minus actual rate into actual hours. Why? He doesn't decide for how many hours he should make the workers work. That is a decision of production manager. So literally, for the actual hours which the production manager is making the workers work, our HR manager is responsible only for the rate. Hence, that is going to be standard rate minus actual rate into actual hours. Whereas on the other side, labor efficiency variance, whose responsibility is this? the production manager's responsibility, right? So what is the formula? Standard hours into standard rate into, standard hours minus actual hours into standard rate. Why? Here, the HR manager is, the production manager is not dependent on the HR manager for anything, right? Suppose instead of standard rate, if I take the actual rate here, then I am passing on the efficiency or inefficiency of the HR manager to the production manager, which is wrong. That is the reason why here have standard hours minus actual hours into standard rate. Are you guys clear with this? Now, efficiency variance is further classified into two: labor mix variance and labor yield variance. Mix variance is also known as gang variance, right? And yield variance is also called as sub efficiency variance, right? Efficiency, this is sub efficiency. Simple. When will these two variances, mix and yield variances, when will they arise? When a company is using more than one type of skill set laborers, that is skilled, semi-skilled, unskilled. When I have more than one variant of workforce, labor force, in that case I have mix variance and yield variance. Now what is the formula for mix variance? Revised actual hours minus actual hours into standard rate. Exactly, everything is same. Here you have what? Balancing here. Standard hours minus revised actual hours into standard rate. By the way, guys, I think I forgot to mention this. Now earlier we had this in your material mix variance, I told you the formula is revised actual quantity minus actual quantity to standard price, right? Now, for examination purpose, logically speaking, revised actual quantity is the more sensible usage because the actual quantity is now being revised, correct? So, on the actual quantity, I'm revising with what? Standard. That's why I'm calling it as revise. So, the revision happens on the actual quantity. But in exam, in your study material, both in CA as well as in CMA intermediate study materials, they have mentioned this as revised standard quantity. That is, the manner of computation is same. The terminology alone, the wording alone, they have made it differently, right? Instead of revised actual quantity, it is better to mention it as revised standard quantity. In exam, just write it down as revised standard quantity. But however, you remember the manner of computation is same. Clear with this, guys? That's why I told this as revised actual quantity and did, so that, for understanding purpose, you will understand the logic, right? Later on, at the end, I wanted to mention it as revised standard quantity. That's why I have put a circle here and written it down as revised standard quantity. Just in examination, use the words revised standard quantity. Manner of computation, same. Now, here, what do we have? So similarly here, revised actual hours. Actually speaking, what do we do? On the actual hours, we revise it for the standard mix, but in examination, write this as revised standard hours, right? The terminology around is different. The manner of computation is exactly the same. Clear with this, guys? And, or there is another formula here. Actual yield minus standard yield into standard cost per unit. Here you don't have the loss because in labor there is no concept of loss. So actual yield minus standard yield into standard cost per unit. This is another formula exactly same as what we saw in our material variances. Now, sir, without any further delay, let's go and do a few numerical problems. With the help of that, we will complete this aspect also. So that's all, sir, in labor cost variances. There is one more thing called as idle time variance. What is it and all? I will just walk you through with the help of a numerical example. Quickly, let's get started. Now, please take your CA intermediate, once again, CA intermediate solved question bank, right? Please take question number 4. Please take question number 4. Yes, please take question number 4. Right? This is definitely applicable even for CMA intermediate students. Don't think that it is something applicable only for CA inter students. Nothing of that sort. It's applicable even for CMA intermediate students. Right? So I will definitely not take something which is not applicable for one particular set of students. If that is the case, then I will make it separate. Nothing to worry, and I will clearly mention what is what as well. Right? So come on, let's get started. The standard and actual figures of the firm are as under. Standard time for the job. For a job, you are allowed to take how many hours? 1000 hours. Okay, perfect. So this is nothing but your standard hours. What is the standard rate per hour? Every hour you should have paid how much? 50 rupees. Actual time taken, 900 hours. It is actual hours. Actual wages paid, how much was it? 36,000. What is the meaning of this? Literally, actual hours into actual rate is equal to how much? 36,000. So now with this we can compute actual rate, no? Yes, how? Because actual hours was how much? 900 rupees, 900 hours. So 900 hours into actual rate would have been 36,000, or actual rate is equal to, so 36,000 rupees is the overall labor cost for 900 hours. What is the cost per hour? It's going to be 4 rupees per hour. Sorry, it's going to be 40 rupees per hour. So, yes, 36,000 divided by 900. It's going to be 40 rupees per hour. Clear with this, guys? So now we have all the ingredients. Standard hours 1000, standard rate 50, actual hours 900, actual rate is 40. So now you just have to go ahead and compute. So what is going to be a labor cost variance? So now quickly I will just write it down here. One second, I will just take the question for my reference. That easy. I hope you guys have downloaded the materials. So yes, writing down, this is question number 4. Yes, so question number 4. So standard hours is going to be 1000 hours. Standard rate is going to be 50 rupees per hour. And the actual hours is going to be 900 hours. And the actual rate is going to be how much? Rupees 40 per hour. Now, what is going to be my labor cost variance? Standard hours 1000 into standard rate 50. This is the cost you should have incurred. Whereas actual cost is how much? 900 actual hours into actual rate. So it's going to be 50,000. One second. Yes. 50,000 minus. So 900 into 40 is going to be 36,000. So you were supposed to incur a cost of 50, but you have incurred only 36,000 rupees of labor cost, which means there's a 14,000 rupees of favorable variance, right? This is bifurcated into two. What and what? Labor rate variance and labor efficiency variance. That's about it. Labor rate variance. What is the formula? Who is responsible? The HR manager. Hence, what is going to be the formula? Standard rate minus actual rate into actual hours. So you should have paid 50, but you've paid only 40 on how many hours? Actually 900 hours. So on each of these 900 hours, you've saved 10 rupees for the firm, for the company, which means how much is the rate variance? So it's going to be 900 into 10, 9,000, obviously favorable. You've saved money for the company. And on the other hand, the efficiency variance is what? Standard hours minus actual hours into standard rate. How much is this going to be? Standard hours, every hour, you should have spent a total of 1000 hours, but you've actually spent only 900 hours into what is the standard rate? It's going to be 50. So you've saved 100 hours for the company. So 100 into 50, how much is that going to be? It's going to be 5,000, right? And it's going to be favorable. So you can also check, it's going to be 9,000 favorable plus 5,000 favorable. You get your top figure, 14,000 favorable. As simple as that, guys. Logical, simple and straightforward. Literally, look at this. We spent very little time in labor variance. Why? Because the foundation of this, we actually spent more time on material cost variances. As simple as that. Nothing beyond it. So please go and update your library of adjustments. Write down labor cost variance hyphen single skill set. Only one skill set is that. That is, there is no mix of skill set and all. Please write down single skill set within bracket without idle time. Within bracket without idle time. Within bracket without idle time. That's about it. Look how beautifully we can cover this area. So that's why we spent more time on material cost variance, and the two other variants, labor and variable overhead variances, are very similar to the concepts which we have studied there in material variance. That's why there's a beautiful saying of Abraham Lincoln: if you give me 6 hours to chop down a tree, I will spend the first 4 hours sharpening the axe, right? So we spent more time on the preparation so that the execution takes only a lesser span of time. That's about it. Now, please go to the next question. We can take question number 5 from the same CA intermediate only solved question bank. We will take question number 5, and with the help of this particular question, we will see the treatment in case of idle time. All right. Now, quickly, the standard output of a product X is 25 units per hour in a manufacturing department of a company employing 100 workers. Perfect. Now, what have they mentioned? Right? The standard output of a particular product is 100 units per hour in a manufacturing department of a company employing 100 hours, 100 workers, which means what? If 100 workers simultaneously, if they are working for 1 hour, 25 units can be produced, or in other words, can we say 100 man hours. If you spend 100 hours totally, that is 100 workers each spending 1 hour, means what? 100 man hours if you are spending, you will be able to generate how many units? 25 units. This is the standard. Next, the standard wage rate per labor hour is 6. So per person per hour, per man per hour, I'm going to pay them. You are allowed to pay how much? 6 rupees. Next, in a 42-hour week, in a week there are 42 hours, the department actually produced how much? 1040. Actual output, this is the base for all calculations, is 1040. Despite 5% of the time paid being lost due to abnormal reason. The hourly wages actually paid were 6.2, 6 and 5.7 respectively to 10, 30 and 60 of the workers. Calculate the relevant labor variances. Now guys, now a very important calculation is something that we need to do here. Now, if you notice what has happened here. Now, there is no multiple skill set of workers and all. Look, 100 workers you have. All the 100 workers should have been paid at the rate of how much? 6 rupees. But what did this HR manager do? To 10 workers, for 10 workers, maybe his relatives and friends, he paid more. 6.2 he paid. Right? Then for 30 workers, he paid 6 rupees. Maybe strangers. Then for balance 60 workers, he paid 5.7 rupees. His enemies. Right? He paid less. Clear with this, guys. Right? Actually seeing there is no multiple skill set, but this HR manager, he has paid a different amount for a different set of people. Why? For some reason. Clear with this, guys. Now we need to calculate all the relevant labor variances. Now how do we go about with this question? Now this is fine. The rate variance can be calculated separately for 10, 30, 60 workers. That is not a problem. Look at this. 5% of the time paid have been lost due to abnormal reason. Now, how do you go about with this? First of all, guys, there is a very important calculation that we need to do. Now, first, we need to calculate the total standard hours that you should have taken. Now, clearly we know that 100 hours, totally 100 hours, 1 hour where 100 people are working is equal to 100 man hours, right? So 100 hours you are allowed to take to produce how many units? 25 units. So to produce 1040 units of output, how many hours you should have taken is what we need to calculate. That is called a standard hours, guys. Correct? Simple. So how do you do? If 100 hours is allowed for 25 units, how many hours are allowed for 1040 units? 100 divided by 25 into 1040. Clear with this, guys? So 100 divided by 25 into 1040. That is what I have mentioned here. So 100, okay, 100 divided by 25 if you do, clearly you will get 1 unit you are allowed to take 4 hours. So 4 into 1040. You can also do it like this, or 100 by 25 into 1040. You are allowed to take a total of how many hours? 4160 hours. Are you guys clear with this? So you are allowed to take 4160 hours. Clear with this, guys? This is a very important calculation that you need to have. Fine, guys? Now, very good. Now, what has happened? This is the standard hours which we have now computed. Now, look at this. In this particular question, there is one more unique adjustment. What is it? 5% of the time paid has been lost due to abnormal reason. What is the meaning of that? Now, first, let me clearly put it in a tabular format. Then you guys will be able to appreciate this in a much more easier manner. Now, what is the standard hours you are allowed to take? 4160. Perfect. Now, what has happened? Let us look at the actuals. Now, actually, if you notice, please have the question with you. If you notice, right, what has happened is that, so number of workers, if you see, this HR fellow, he has actually categorized them into so many different workers, that is 10 worker, 30 worker, 60 workers and all. He has categorized overall 100 workers totally. Now what has happened, actual hours actual hours for which I am going to pay them, I call it as actual hours paid. Clear with this, guys? Now actual hours paid. Now for how many actual hours am I going to pay them? Simple. They have come to my factory and they have spent 42 hours in my factory. Clear with this, guys? So literally for all the workers, 100 workers, sir, they worked here. Correct? So 100 workers, each of them have spent 42 hours in my factory. So literally 100 into 42, total hours for which I need to pay them is 4,200 hours. Right? Fine. Category of worker, you can say. So you have 42 into 10 is equal to 420. For this 30 workers, so 42 into 30, it's going to be 1260. And 42 into 60 is going to be 2520. Clear with this, guys? Right. Next one. Now what they have mentioned here, there is an idle time of how much, sir? 5% of the total hours for which I am paying them is idle time. Or guys, simply put, in other words, simply, guys, so now 10 workers are working for a total of how many hours? I mean, they didn't work. I am paying them for how many hours? 420 hours. So 0.05 into 420, how much does it come out to? 21 hours. So 21 hours are idle time. That is meaning these 10 workers, sir, I pay them for 420 hours. But out of this 420 hours, 21 hours they didn't work. Why? It was not because of their problem. Maybe power cut has happened. Because of that, they were sitting in dark. Machines will not work. Right? Literally, 420 minus 21. This is going to be the actual hours worked. How much is that? 420 minus 21. How much is that going to be? 399. They have actually worked for 399 hours. But abnormal idle time was for 21 hours, for which I can't penalize them. It was an issue with the company. So overall, I have to pay them for 420. The breakup of 420 hours, actual hours I'm paying is 21 hours idle time, and 399 hours is the actual hours worked. Clear with this, guys? Similarly here, 1260. So 0.05 into 1260 is equal to how much? Going to be 63 hours of idle time. Right? And here 2520 is equal to how much? 126 hours of idle time. So out of the total 4200 hours, 5%, 210 hours are idle time. You can add it up, you get only 210. Clear with this, guys? Which means the remaining 95% is only the actual hours worked. So 1260 minus 63. So 1260 minus 63, you get actual hours worked 1197. 2520 minus 126, you get 2394. You add up everything. So plus 399 plus 1197 plus 23794, you get 3990. This is the actual hours for which they are working. Now guys, now you tell me one thing. Now labor cost variance, what is the formula? Standard hours minus actual hours, right? Sorry. Standard hours into standard rate minus actual hours into actual rate. Right? Fine, guys. Sorry for this. Someone knocked the door, so there was an attention lapse. Coming back here, the labor cost variance is going to be standard hours into standard rate minus actual hours into actual rate. Correct? Now here, actual hours is going to be actual hours for which I am paying overall. Let's not take the breakup. Overall, 4,200 hours I am going to pay them. Guys, clear with this? So here I only take the actual hours for which I'm paying them. Now, this is broadly bifurcated into two: labor rate variance and labor efficiency variance. Here, in labor rate variance, right, who is the responsible person? The HR manager. So, standard rate minus actual rate into actual hours. What will I take? Actual hours paid. That is, I'm just talking about the total. Forget this breakup, right? Actual hours paid or actual hours worked, the HR manager needs to pay them for 4,200 hours, not for 3,990 hours. They have worked for 3,990, but anyways, he needs to pay them for 4,200 hours. So here it's going to be actual hours paid only. Are you all clear with this? Now, go on to the other side. Efficiency variance. So who is responsible? Production manager. What is the formula? Sir, standard hours minus actual hours into standard rate. Now, if you look at it, standard hours, we calculated already. Sir, for this task, you are allowed to take a total of how many hours? 4,160 hours. So I'm putting it here somewhere. Standard hours is equal to 4160 hours. Now we are judging the efficiency of the workers. Now you should have taken how much? 4160. Now minus actual hours. Now here will I take actual hours paid or actual hours worked, or in other words, will I take 4,200 hours or will I take 3,990 hours? Now you guys tell me, we're allowed to take 4,160 hours. However, effectively these guys completed the job in 3,990 hours itself, right? Sir, then this extra 210 hours is not a time that these guys took, right? So please don't consider this 210 hours. If you add 3,990 plus 210, you get 4,200. Correct? Now, please don't say that we have taken 4,200 hours. The employees are saying, sir, we took only 3,990 hours and we completed the job. Extra 210 hours, we were made to sit idle because there was a power cut. Please don't put it in my efficiency. So literally, for judging the efficiency, what will I say? Standard hours minus actual hours worked will only come. Clear with this, guys? So standard hours 4160 minus actual hours worked will only come. Right? Clear with this? Into standard rate. Are you clear with this, guys? Are you clear with this? Now you tell me, sir, on the top, literally, sir, we have considered only actual hours paid. Correct? Here also rate variance, actual hours paid only. He's not bothered about how much is worked, idle time and all. For every hour they spend in the factory, this HR will have to pay. But for efficiency alone, I took actual hours worked now, sir. Now, how will it tally? It will not tally. That's why you have another variance called as labor idle time variance. What is it? Simple. Now, the difference between your actual hours worked and actual hours paid is only your idle time, right? So, literally what we will do here is idle time into standard rate. We will take it here. Clear with this, guys? Idle time is how much? 210 rupees into standard rate you will take. This will always be an adverse variance. Are you guys clear with this? So literally, if you are having idle time, there is a third variance called as idle time variance. And in this case, clearly understand, guys, whenever you are having idle time, you have standard hours, standard rate, actual hours paid, actual hours worked. Difference between the two is idle time. So this is split into three, right? Not one actual hours. You have actual hours paid, actual hours worked. The difference between the two is called as idle time, and then you have actual rate. Are you guys clear with this? So when you have an idle time, in that case there is one more variance called as idle time variance. It's nothing but idle time into standard rate, or this idle time, guys, is nothing but actual hours worked minus actual hours paid. Are you guys clear with this? So literally, if you see here, if you add this up, actual hours worked and actual hours worked gets knocked off, right? And here standard hours minus actual hours paid only will come in. Are you guys clear with this? Or in other words, this is the logic for idle time variance. Now, sir, who is responsible for idle time variance? Idle time variance is the responsibility of the maintenance department. Are you guys clear with this? Why? Simple. Now, they should have made sure, these maintenance guys should have made sure that this 210 hours should not have been lost. Sir, if there is a power cut, you should have arranged for a generator, genset, right? Now, there should not have been a downtime or an idle time. But these guys were not efficient. Hence, I should pin it on the maintenance team. I should not pin it on my production team. Are you guys clear with this? Hence, I take this idle time separately, create a variance called as idle time variance, and then on that we compute. And that's how we pin on the responsibility to the maintenance department. Are you guys clear with this? Now, on this note, let's do all the calculations. Now, look at this. This is what we have done. Standard hours is going to be 4,160 hours. Right? What is the standard rate? In the question, the standard rate is given 6 rupees. So 6 rupees. If you multiply the two, this is going to be standard hours into standard rate. So 24,960. This is going to be the total labor cost you are allowed to incur. Guys, clear with this? But how about the actuals? We calculated the actual hours paid, idle time, actual hours worked. We calculated, guys, clear with this? Now, what was the rate? Actual rate was given 6.26, 5.7. So you have 6.26, 5.7. So now to compute the overall variance, so now we need to have here, we can have this column, actual hours paid into actual rate. Literally speaking, 420 into 6.2, 420 into 6.2, you have how much? 2604. 1260 into 6, how much you get? 7560. Next, 2520 into 5.7, 2520 into 5.7, you get how much? 13,364. You add up, this is the total labor cost actually incurred. Are you guys clear with this? So now what is the labor cost variance? You were supposed to incur 24,960, you have actually incurred only 24,528. So the difference between the two, 24,960 minus 24,528 gives you 432. Favorable is going to be your labor cost variance. Are you guys clear with this? Very, very simple, guys, provided you have the conceptual understanding. Please do not fall into the trap of mugging up things here. It's all 100% logical. Next, what's going to be your labor rate variance? The formula is going to be standard rate minus actual rate into actual hours paid. Guys, correct? Who's responsible? We all know, the HR manager. Now, here 3 categories, we need to do it separately. Now, what is the standard rate? Always it is 6 rupees. So 6, 6 and 6. Whereas, what is the actual rate? Sir, for 420 hours, I used a rate of 6.2. Right? For the next 30 workers, actual hours paid was how much? 1260. I paid them at 6 rupees. And for the next 60 workers, I paid them at 5.7. So there are 3 different actual rates here. So 6.2, 6, 5.7. Correct? 6.2, 6, 5.7. Right? So standard rate minus actual rate into actual hours paid. You can take these figures. 420, 1260 and 2520. Are you guys clear with this? You do all the calculations. So 6 you should have paid, but you've paid a 6.2, 0.2 more on 420. So 420 into 0.2 gives you how much? 84 adverse. 6 minus 6 into 1260 is 0. Then 6 minus 5.7, so you get 0.3. You have saved 0.3 rupees for the company on how many hours? 2520 hours. You get how much? 756 favorable. So net of 756 favorable minus 84. 756 minus 84, you get how much? 672 favorable. This is going to be what? This is going to be your overall labor rate variance. How about your efficiency variance? What is the formula? Standard hours minus actual hours worked into standard rate. Correct? Simple. In this case, what is the standard hours? 4160. What is the actual hours worked? Right? You can take the total. Why? Because into standard rate only we are doing. Directly you can take the total. Clear with this, guys? You are allowed to take 4160 hours, but you have actually taken only 3990 hours. So literally how many hours you have saved? 4160 minus 3990. You've saved 170 hours for the company into 6. Literally 1020 rupees favorable. Look at this. 1020 favorable. Are you guys clear with this? Right? So that's about this. So 1020 favorable. Then the difference is an idle time. So how much is my idle time? So 210 hours, sir. So 210 into 6. So 210 into 6. 1260 adverse is going to be my labor idle time variance. Look at this. 1260 adverse. Idle time into standard rate. 1260. It is always an adverse variance. Clear with this, guys? So now if you knock off these 3, you will get your topmost figure, your labor cost variance. Let's check for this. So 672 favorable plus 1020 favorable. So 1692 you get minus 1260, you get 432 favorable. Clear with this, guys? That's about this question. Nothing beyond it. The only thing that you need to know is in this particular question, since idle time was there, in this case, what you need to do is segregate your idle time separately and calculate an idle time variance. In that case, your labor efficiency variance will be standard hours minus actual hours worked. Correct? So because when I'm judging the efficiency, you should have taken so much hours and I should compare with how much actual hours you actually worked for. Clear with this, guys? So standard hours minus actual hours worked into standard rate. That's how it should be. And the difference between actual hours worked and actual hours paid, which is your idle time, that should be separately taken. Idle time into standard rate. It's always an adverse variance which is captured, which is the responsibility of the maintenance department. That's the learning objective here. And with that, this particular variance, your labor cost variances with your idle time variance is also done. So please go and update your library of adjustments. Write down labor cost variance hyphen single skill set, labor cost variance hyphen single skill set within bracket with idle time. Labor cost variance hyphen single skill set within bracket with idle time. Right, guys? Fine. So in the marathon itself, we are doing a few numerical problems, and all these are signature problems, right? You can expect these kind of questions as it is in the exam also, or maybe variants of this also you can expect. But the main objective here is from an examination perspective, as well as I'm picking up, hand-picking questions to cover all variety of concepts covered across this particular chapter. Clear with this, guys? Now on that note, let's do one more question here. One last question in this labor related variances. Please take question number 7 for the same CA intermediate solved question bank. Please go and take question number 7. Question number 7. Okay. So please take question number 7. Okay. Look at this. NPX Limited uses standard costing system for manufacturing its product X. The company is following a budgeted data given in relation to labor hours for the manufacture of 1 unit of product X. To produce 1 unit of product X, you are allowed to take 2 hours of skilled labor, 3 hours of semi-skilled labor, 5 hours of unskilled labor. Total is 10 hours. And every hour of skilled labor should be paid at the rate of 6. Unskilled labor should be paid at the rate of 4, and every hour of semi-skilled should be paid at the rate of 4, and unskilled should be paid at the rate of 3. Now what happens? You have different skill set of workforce to produce every unit of a product. Now in this case, your mix and yield variance, right, will also come into picture. Your labor mix variance is also called as labor gang variance. That will also come into the picture. That's about it. For that purpose only, I've taken one more sum. In the month of Jan 2021, a total of 10,000 units were actually produced, right? And the following are the results. What have they given? Actual hours they have given here is going to be how much? 18,000 skilled, 33,000 semi-skilled, unskilled was 58,000. Total hours is given. Actual rate is also given. They have multiplied and arrived at the amount. Now, idle time, abnormal idle time during the month is also being given here. Calculate all the labor variances, right? Then they've also asked, show the effect of labor rate variance if 5,000 hours of skilled labor are paid at the rate of 5.5 and the balance are paid at the rate of 7. Now, let's focus on this, the first part of the question, the main thing here for this marathon. That's the most important thing. Now, guys, what have they given? Now, this is going to be, guys, this is going to be my actual rate, correct? Now, this is going to be my actual hours paid. Sir, how do you know, sir, this is actual hours paid? This could also be actual hours worked, you know. Idle time is there. Now, that is the reason why they've clearly given actual hours paid, right? You can check it. 18,000, right, into 7 will only give 1,26,000, correct? 18,000 into 7 is 1,26,000, right? Now, when they have given the amount, right, it means they are paying at the rate of 7 for how many hours? 18,000 hours, which means this 18,000 is not actual hours worked, it is actual hours paid. Clear with this, guys? Since they have given the amount, you can clearly take this as actual hours paid. Now, there were also some idle hours and all. So now what will you do? Sir, actual hours paid respective 3 types of labor. From that minus your abnormal idle time, you will arrive at actual hours worked. Clear with this, guys, right? So now this is also available for your information, and then you can go ahead and do this question, right, guys? So now what I will do is right now, first look at this. What is going to be the standard hours? How many units were actually produced? 10,000 units, which means 10,000 units you have actually produced. So you are allowed to take a total of how much? 10,000 into 2, 20,000 skilled hours, then 30,000 semi-skilled hours, then 50,000 unskilled hours. This is the time allowed, correct? Standard hours. So 20,000, 30,000, 50,000, right? Clear with this, guys? The total time that is allowed was how much? 1 lakh labor hours at the rate of how much? 6, 4 and 3. So this is going to be your standard rate. Are you guys clear with this? So standard hours we have, standard rate we have. If you multiply the two, standard hours into standard rate, right? So now you get the total labor cost which you are allowed to incur. right? So 20,000 into 6 is 1,20,000. 30,000 into 4 once again is 1,20,000. 50,000 into 3 is 1,50,000. So 1,20,000 plus 1,20,000 plus 1,50,000. How much is it? 1,20,000 plus 1,20,000 is 2,40,000. And 1 lakh, add 1,50,000 to that, you get 3,90,000. So 3,90,000 rupees is the labor cost which you are allowed to incur to produce 10,000 units of output. Clear with this, guys? Now, what happened to the actuals? The actual hours paid is given 18,000, 33,000, 58,000. These figures are all given, right? The actual rate, this is also given 7, 3.5, and 4. In fact, these figures are also given. They have multiplied and given total actual labor cost incurred is how much? 4,73,000. So this is actual hours paid, this is actual rate, and this is actual hours paid into actual rate. Clear with this, guys? Now, one more thing, please have it very clear in your mind. Idle time is also given in the question. 500, 700, 800 hours respectively. 500, 700, 800 hours respectively, which means actual hours worked is going to be how much? Simple. Actual hours paid. I paid them for 18,000. Out of which 500 was idle, which means 18,000 minus 500, 17,500. Only effectively they worked. Clear with this, guys? 33,000 minus 700, 32,300. Similarly, 58,000 minus 800, 57,200. This is the actual hours worked. You get the total figures. So now we have standard hours, we have standard rate, we have actual hours paid, idle time, actual hours worked, then we have actual rate. Now literally all the ingredients are available. With this, you can go ahead and do this question. Clear with this, guys? So first, labor cost variance. What is the formula? Standard hours into standard rate minus actual hours into actual rate. Simple. This is the labor cost you were supposed to incur, right? 3,90,000, but you've actually incurred how much? 4,73,500. So literally if you subtract it, so how much is the difference? 83,500 rupees you have incurred more. So literally 83,500 rupees adverse is going to be your total labor cost variance. As simple as that. Just list out the ingredients required, go ahead and crack the question. That's all is needed, guys. Clear with this? Next one, labor rate variance. Come on, tell me what is the formula? Standard rate minus actual rate into actual hours paid. Correct? So now what you need to do here? Simple. So standard rate 6 minus actual rate 7 into actual hours paid 18,000. That is what we do here. 6 minus 7 into 18,000. Here what do you have? 4 minus 3.5 into 33,000. 4 minus 3.5 into 33,000. Similarly, unskilled, you were supposed to pay them 3, but you have paid them 4. Actually, for how many hours? 58,000. So 3 minus 4 into 58,000. For skilled, you should have paid 6, you have paid 7. 1 rupee more on how many hours? 18,000. So it is 18,000 adverse. That's all. Semi-skilled, you should have paid them 4. You paid them only 3.5. 0.5 rupees you saved on how many hours? 33,000. 33,000 into 0.5 gives you 16,500. Favorable because you paid less. You should have paid 3 for unskilled, but you've paid 4, which means 1 rupee more you've paid on how many hours? 58,000. So totally 58,000 you've paid more. It's an adverse variance. So add up everything. So here you get these two are adverse. So 18,000 plus 58,000. Total adverse is 76 minus 16,500 favorable. Net off you get 59,500 rupees. This is going to be what? This is going to be your labor rate variance. Clear with this, guys? Next one. Next one. Labor efficiency variance. How much is that going to be? How will you calculate? Standard hours minus actual hours worked into standard rate. So literally, I will compare this column, standard hours. I will compare this with actual hours worked. You were allowed to take this time, but you actually took only so much. I'm judging the efficiency into standard rate. That's about it. Clear with this, guys? So respective figure, this column standard hours minus actual hours worked 17,500, 32,300 and 57,200. We only take this actual hours worked, clear with this, into standard rate 6, 4 and 3. You can just take it up and you will arrive at this figure, right? I'm not getting into the calculation once again. So this is the amount you get. Clear with this, guys? Are you all able to understand? And finally you have your labor idle time variance. What is that? Idle time into standard rate. Simple. So take this column 500, 700, 800, multiply that with the standard rate. Look at this, 500, 700, 800, multiplied with the standard rate, you will arrive at the figures. This is always an adverse variance, 8,200. Clear with this, guys? Right? So now what do you do here? Basically, you should understand efficiency variance is what? Here you have, this is actual hours worked. Please have this in your mind. So now, guys, so now ideally, always you should do the checking. So rate variance plus efficiency variance plus idle time variance should give you your labor cost variance. So 59,500 adverse plus 15,800 adverse plus 8,200 adverse, you get 83,500, right? So 83,500 adverse, it matches. Now guys, I'm just summing it up here, and from here we will do that the gang yield variance and your mix and yield variance, we will be doing it, right? One second, I will just summarize this here. So labor cost variance, how much was the labor cost variance? It was 83,500, right? 83,500 favorable, sorry, adverse, right? Now this is bifurcated into two. What and what? Labor rate variance and labor efficiency variance. How much is my labor rate variance? We calculated it was 59,500 adverse. And how much was my efficiency variance? My efficiency variance was 15,800 adverse, right? And in between you have your labor idle time variance. So it is going to be how much? 8,200 adverse. 8,200 adverse. Now guys, your efficiency variance is further classified into two. What and what? Labor mix variance, also known as labor gang variance. Mix or gang. Why gang? Gang means a group of people. So here you have multiple skill set of people. Labor mix variance or gang variance and labor yield variance. It's also known as sub efficiency variance. Formulas, same formulas guys. So here labor mix variance. What is going to be the formula? Come on, revised actual hours minus actual hours into standard rate. Clear with this guys? And here it's going to be what? The other way around, right? Actual hours, sorry, it's going to be standard hours minus revised actual hours into standard rate. That's about it. But please understand one thing here, actual hours stands only for actual hours worked. Why? Look, under efficiency variance only these two variances come. So in efficiency variance, right, what do we calculate? It is going to be standard hours minus actual hours worked only, right? Obviously, so these two are these two are actually offroots of efficiency only. So wherever you find actual hours, it is always actual hours worked only. Are you guys clear with this? So there is absolutely no second thoughts about that. Now with this, let's go and quickly wrap this off also. Now guys, now I'm just going here and now taking this table. I'm just taking this table, okay? So now, what is going to be my actual hours worked? So this is the table that we are bothered about. So actual hours worked. So let me just take this table. One second. Right. So now, here, I'm just using this table once again. So first, let me come up with a template. Skill set, right? Or in other words, you can say the type of workforce, type of labor, then revised actual hours worked, standard rate, and labor mix variance. Now, what is the type of workforce? Skilled, semi-skilled, unskilled. This is what you have here, right? Now, first, which column will you fill? Actual hours worked. How much is actual hours worked? 17,500, 32,300, then 57,200. What is the total? 1,07,000. Now, what will you do here? This figure, you will plug it here. 1,07,000. Now, here I am taking the actual hours, but I am revising it for the standard mix. Sir, what is the standard mix, sir? Go to the question. Now, clearly they have given, look, out of 10 hours, right? This is standard data. 2 hours should come from skilled labor, 3 hours should come from semi-skilled labor, and 5 hours should come from unskilled labor. Or in other words, 2 by 10 of the total hours should be your skilled labor, 20%. 30% of the total time should come from semi-skilled, 50% should come from your unskilled, correct? Now what you will do? Simple. So 2 by 10 into 1,70,000, 1,07,000 will be the revised actual hours for skilled. Similarly, 3 by 10 of your 3 by 10 into 1,07,000 will be semi-skilled, and your 5 by 10 into 1,07,000 is going to be your unskilled. So how much? 1,07,000 into 2 by 10, that's going to be 21,400. Then 3 by 10, it's going to be 32,100. And 5 by 10, it's going to be 53,500. Clear with this, guys? Right? Now, what's going to be the standard rate here? The standard rate, it's available in the question 6, 4, and 3. Right? This is going to be our standard rate. Perfect. So now, go and calculate your labor mix variance. So now, labor mix variance, how much is it going to be? So, you were allowed to take 21,400. You've taken 17,500. So 21,400 minus 17,500. You've saved 3,900 hours into 6. How much is it going to be? So 23,400 rupees favorable. Similarly, you could have taken 32,100. You've taken 32,300. So 200 hours you've taken more into 4 gives you how much? 800 adverse. Next, you could have taken 53,500. You've taken 57,200. So 53,500 minus 57,200 is 3,700 hours. You've taken more into 3. It's going to be 11,100 adverse. So now if you net this off, how much will you get? So 23,400 minus 800 minus 11,100. You get 11,500 rupees of hot favorable variance. What happened here? Literally guys, skilled labor is the most costliest labor. Semi-skilled, little lesser costly, and unskilled, it is the least costliest. Now what I have done, skilled labor, I should have taken 21,400 hours, but I've taken only 17,400 hours, which means I have used less time of a costly workforce. That's why I got a favorable variance here. And I have more time of a cheaper workforce. That is the reason why I have a favorable variance. Why favorable variance? I took more time of a cheaper workforce, less time of a costlier workforce. I actually changed the mix. Because of that, I ended up getting 11,500 rupees favorable variance. You tell me, is this because of efficiency? No, it is because of changing the mix of the gang. Are you guys clear with this? Now let's go on to the next one, which is labor yield variance. Now labor yield variance is going to be standard hours minus revised actual hours into standard rate. Now quickly, let's complete this also, and then the sum will be over. So here we have skilled, semi-skilled, and unskilled. So standard hours minus revised actual hours into standard rate. Right? Now let's do this quickly. So what's my standard hours? So it's already there. We've done this. Standard hours is going to be 20,000, 30,000, and 50,000. It's going to be 20,000, 30,000, and 50,000 minus what's my revised actual hours? The revised actual hours, just now we computed. It's 21,400, 32,100, and 53,500, right? So now let's do this. So 21,400. Then you have 32,100 and 53,500. All the figures are available. Nothing needs to be computed now. Into standard rate 6, 4, and 3. Come on, guys. So 20,000 you were allowed to take, but you've actually taken 21,400. So 1,400 into 6, it's going to be how much? It's going to be 8,400 adverse. This is the extra cost you have actually incurred, right? Next one. So you could have taken 30,000, but you've taken 32,100, 2,100 hours extra into 4. It's going to be 8,400 once again adverse. Then here 50,000 you could have taken, 53,500 you have actually taken. So 3,500 into 3, it's going to be 10,500 once again adverse. Right? So now if you add this up, you get how much? So 10,500 plus 8,400 plus 8,400, you get 27,300. What is it going to be? Adverse variance. Now guys, that's all it is. So your labor mix variance or the gang variance was 11,500 favorable, and here you have an yield variance of 27,300 adverse. So 27,300 minus 11,500, 15,500 rupees adverse is going to be your labor efficiency variance, and hence our computation is correct. Clear with this, guys? This is all it is. Now, literally, why did you have a mix variance? Right? The mix or the gang variance you had, because simple, it was a favorable variance. Why? Skilled was the most costliest, source of your labor, right? What happened? We consumed, or we actually incurred less time from a costlier labor source, and we took more time in a cheaper source of labor. Because of this mix difference, actually we had a variance to the extent of 11,500 rupees we could save. And actually, if you see, because of efficiency, these guys were inefficient. So labor yield variance is clearly proved that they've got 27,300 rupees adverse is the variance attributable to your labor yield variance. Clear with this, guys? So with this, we have completed this full question. This is the maximum complication you can have. This in labor variance, you have labor variance with the multiple skill set, that too with idle time and all. That's about it. So please go and update your library of adjustments right now. Labor cost variance hyphen mix of skill set within bracket with idle time. Labor cost variance hyphen mix of skill set within bracket with idle time. This is the most comprehensive question in your labor variances, right, guys? So with this, your labor related variance is also over. Now, ideally, your CMA Intermediate Paper 8 students, if you are a student attempting CMA Intermediate Paper 8, literally in this chapter, you have only material and labor cost variances. The remaining are not applicable for you. Clear with this, guys? So, CMA Intermediate Paper 8 students, only material and labor cost variances are applicable. And literally, we have covered in depth all the concepts, everything we have revised with the numerical problems itself. So, with that, we have completed our labor related variances. Let's move on to the next segment of discussion.